5,400 contracts, and FI's long exposure remains at multi-month lows, that is around 8%. On the option front, on the call side, 24,700, 24,600 call have seen biggest option build up, open interest build up, but again premium for both these strike rates have come down. But in contrary, on the put side, both 24,600, 24,500, even 24,400, all these have seen an increase in the premium with huge option build up. So support for Nifty, first support remains around 24,500, but if we fail to hold that level, next support comes around 24,430, resistance remains around 24,700. Two stocks that I have taken, first one is M&M, because yesterday we saw that there was some news about that GST on EV might be increased and all, but later on we got the clarification that GST on EV will remain around 5%. And one more stock, that is a Dabur, because FMCG stocks continue to see buying. Yesterday also Dabur was up around 4 to 5%.
Absolutely, Sudarshan. We'll surely be keeping an eye on all the stocks in the world of as well. But let's talk about the two-day GSE Council meet, right? Because we're seeing all these FMCG names, textile names that are buzzing in trade because of this possible cut that could come in. Now, obviously, the council is set to meet today. They're going to be discussing the centre's proposal for a simplified two-slab structure and Prime Minister Narendra Modi's vision in his Independence Day speech on the next generation of GST reforms could soon be a reality. Now, GST Council will discuss Centre's proposal to shift to that simplified two-slab structure, right? One is going to be 5%, other is going to be 18%, and with a special 40% rate for sin and demerit goods that could come in. Now, if approved, the move will make a wide range of common use items cheaper. So your daily necessities such as soap, shampoos, hair oil, toothpaste, biscuits, namkeens, bhujiyas, footwear, apparels below 2,500 rupees, along with ghee, butter, pencils and exercise books are expected to fall in that lower bracket of 5% range. Now, aspirational goods, when you'll talk about that, such as whether televisions, refrigerators, washing machines, microwaves, small cars, motorcycles that are below the 350cc, which are currently taxed at 28%, may move down to that 18% slab. Now, we spoke to Indian Hotels Marico to understand the impact of GST rate rationalization on these companies, what it will mean. Listen in to what they had to say.
Absolutely, and I think that 7,500 ceiling was created 8 years ago. It's not been even adjusted for inflation. So I think given that the sector is the highest multiplicator of jobs, it is in the best interest of the nation to change that ceiling and bring it to the 5% bracket. So it's not an unreasonable request from our side, and I think let's see, time will tell if that change happens or not. But should that happen, yes, it will be extremely positive.
I think one of the things is rate rationalization is something which I think is a tremendous opportunity to drive consumption. And it is happening not only in consumer goods, it's expected in things like auto and durables, which will definitely catalyze. It's a very, very bold move by the government and the entire simplification and rationalization. It will definitely catalyze consumption in the country.
Okay, on that note, we're going to slip into a very short break. After the break, we'll get you the latest updates related to tariffs. So stay tuned in. Welcome back to Power Breakfast on CNBC TV18. Now let's focus and talk about what's the latest update that's coming from Trump in terms of commentary as well. US Appeals Court on Friday ruled Trump's tariff as illegal but allowed the tariff to remain in place through 14th of October. The president has said that his administration will ask the Supreme Court now for an expedited ruling on tariffs. Listen in.
You know, other countries use tariffs on us for years, and we never did. I did a lot during my first term, but then we had COVID and we had to focus on other things. You couldn't be tariffing Italy, Spain, France, as they were dying by the thousands and millions. It's a very important decision. And frankly, if they make the wrong decision, it would be a devastation for our country. We've taken in trillions of dollars. And by the way, all these countries signed agreements. As an example, they're all happy. Everybody's happy. But some whack job put in a lawsuit, and now it's going to the Supreme Court. Now, we're going to be asking for early admittance. We're going tomorrow, and we're going to ask for an expedited ruling because, you know, when you look at the stock market's down today, the stock market's down because of that, because the stock market needs the tariffs. They want the tariffs.
The US president also commented on the high tariffs imposed by India. He said that the two countries got along very well, but also listed why India has been being charged a high amount of the duty that we're seeing. Listen in.
Get along with India very well, but India has, you have to understand, for many years it was a one-sided relationship. Only now, since I came along, and because of the power that we have with tariffs, India was charging us tremendous tariffs, about the highest in the world. They were about the highest in the world, number one. And we, therefore, weren't doing much business with India, but they were doing business with us because we weren't charging them. Foolishly, we weren't charging them. So they would send in massive, you know, everything they made, they'd send it in, pour it into our country. Therefore, it wouldn't be made here, you know, which is a negative. But we would not send in anything because they were charging us 100% tariffs. And, you know, I'll give you an example. Harley Davidson. Harley Davidson couldn't sell into India. There was a 200% tariff on a motorcycle. So what happens? Harley Davidson went to India and built a motorcycle plant. And now they don't have to pay tariffs. Same thing as us.
And moving on, and some commentary coming in from the domestic side on the ministry front, we had India is in dialogue with the US for bilateral trade agreement. That's a word coming in from Commerce Minister Piyush Goyal. He also hopes that things get back on track soon to conclude the bilateral trade agreement by fall or November. Listen in.
In every sense, one can see an excitement across the world to expand trading and business relations with India. We've had a little bit of a geopolitical issues overtaking trade issues in our negotiations with the United States of America. I do hope things will get back to track soon and we'll conclude a bilateral trade agreement by fall, November or so, as was discussed by our two leaders in February.
Okay, those are the comments coming in from Piyush Goyal. But let's look at, how the US market closed. Wall Street ended Tuesday's trading session lower. Investors were assessing the tariff concerns that were coming in. Dow, shed almost 250 points, while the S&P 500 lost 45 points in yesterday's trading session. The tech-heavy Nasdaq index also closed down 175 points. So there was some bit of a pressure that came in on that front. And that is why Nifty implied open is also indicating a negative start, given the cues overall from the Asian market opening as well as US market is negative. But on that note, we're going to step into a very short break and we'll get you the cues in the world of commodities after the break. Welcome back to Power Breakfast on CNBC TV18. Now let's look at what's happening in the world of commodities. To give us the latest update on that front, we have Manisha Gupta joining in with us. Good morning, Manisha. And seems like that uncertainty around tariffs and the commentary that keeps coming in is keeping the gold on the higher end.
Oh, well, absolutely. It's a third day today that we are looking at gold prices trading at a new all-time highs. And this time around, we are trading very close to that $35-50 an ounce as well. So with that, gold is up by 35% in this year, well supported by a flight to safety, broader political and economic risks, and tariff-related uncertainty as well. And then there are expectations of a rate cut coming in the month of September that is almost baked into the prices right now. The dollar index, also trading at a 5-week close, has been supportive not just for gold, but for silver as well, which is now trading at a 14-year highs. Platinum prices have surged to almost 11-year highs. You have copper prices trading quite firm as well. And not just the metals. When you look at the crude oil prices, we are trading at a 1-month highs onto this one as well, backed by geopolitical tensions and supply concern support as well. Also, the markets are now assessing the fact that Ukraine drone attacks have shut down nearly 17% of Russia's refining capacity. So that premium seems to be building up in prices also.
Okay, Manisha, thank you so much for that. Surely important to keep an eye out on crude oil prices as well as gold. But let's move on. And as Beijing rolls out a massive parade to mark 80 years since the end of World War II, visuals from the parade show Chinese President Xi Jinping, Russian President Vladimir Putin, as well as North Korean leader Kim Jong-un together in the front line as the Chinese president leads the foreign leaders in the parade. Nearly 24 of foreign leaders attend the ceremony, looking to strengthen ties with Beijing amid the US tariff tensions that are going on. A quick look at, the Asian markets, because we're seeing a correction coming in for the Hang Seng as well. Opened up with gains of 0.9% and now just managing to hold on to gains, just mild positive that's coming in there. Taiwan index also is just managing to hold on to gains of 0.3%. Keep an eye out on that. Cues for the Indian market not too positive. We're seeing Nifty implied open indicating a negative start as of now for the Indian markets. But that's all the time we have on this edition of Power Breakfast on CNBC TV18. Thank you so much for tuning in. Up next, Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Wednesday morning, middle of the week, we're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, good morning.
Hi, morning folks. So, at exactly 11:31 IST last night, I checked all possible, sources and social media. It was
What
actually...
were you doing awake, Surabhi?
I was just waiting for it. This, almost at the stroke of midnight hour kind of... new wave that was about to sweep us.
The time that we start is like early morning.
You don't lose your sleep on all these things. Wake up in the morning
Out of
headlines.
curiosity. I like curiosity. But anyway, we have some new posts on social media, but nothing very big or sweeping in terms of more sanctions or tariffs.
Absolutely. It's more of the same in a way, right? Reiterating what's been said before. So I'll just take it from the top in terms of stuff that you need to know. The big one here locally, and I think markets will remain, and specific stock sectors, whatever, will remain a little excited, hopeful, bid on the back of the GST Council meeting, which of course is starting today and runs tomorrow. We'll know what time we get the... I think it should be maybe post-market hours tomorrow. Usually these things run late. But this basically a third and the fourth is when when the council meeting is taking place. And we'll get you updates from Delhi. Our reporters are all on the ground. Of course, we've been telling you the broad structure in terms of what the GST GOM is thinking on the lines of rate cuts, rationalization, etc. on the agenda. And a fair bit there. So we'll come to that. US market saw a bit of a risk off, and S&P was down 0.69. NASDAQ was down about 0.82% as well. And AI related, AI stocks, the big mega tech stocks are deflating a little bit at the margin. And is that AI fatigue, or is it concern around incremental benefits of AI? It's an old question. How much money is being pumped into AI and what's coming out in terms of the spending? Everybody, of course, has gone absolutely berserk, putting hundreds of billions of dollars into the technology and, of course, the allied infrastructure. But markets finally are taking a bit of a breather. So far, it looks like a breather. Now, the WIX was up 9%, 17.5. Gold rose to another record high to, $3,600. So one-way kind of move. Silver, of course, has also been lagging, but doing well recently. The bond market, 10-year was up 4 basis points. The dollar saw a bit of a move, 0.65 to 98.4. I don't think there was any big reason for the move in the dollar. It started actually during Asia hours, and then it sort of continued into the US session as well. You had two data points, US PMI and ISM manufacturing, which came through. Services is later. That's the more important one. Both were mixed, but kind of sort of slightly weakish. After hours, Google, Alphabet, the stock is up 7%. In after-hours trading, Apple is up 6%. A federal US judge ruled that Google isn't required to sell its Chrome web browser. So, immediate impact on Alphabet, of course, but I think, Apple is also fighting a fair bit of antitrust issues in the US and elsewhere as well. So that also got a bit of a lift. So those are big names, and if this lasts as the US session opens, it'll show up in terms of indices. With regards to President Trump, he was asked whether he's considering lower tariffs on India, and I think he said no. And we'll play the soundbite out in a bit as well. He also said that he's going to ask the Supreme Court to expedite the ruling on tariffs after the lower appeals court ruled the tariff 7-4 illegal. So, but he's got to, it's the administration's need to now go to the Supreme Court to challenge the appeals court. So that's basically what's happening. There's nothing earth-shattering in that statement. I'll just tie in the levels here. Yesterday was a little disappointing for bulls because you had a nice move higher. The Nifty crossed the 20-day moving average. Actually, we went above the 20-day by about 50-60 points, but then sold off. So at the daily averages is where the market seems to be finding a bit of resistance. Yesterday's high is 24,756. That's the first resistance level. And the low of 24,404 becomes the support, has been the support for a while. For the Nifty Bank, it touched the upper Bollinger Band and then sold off from there. The support here for the Nifty Bank is 53,483 and 52,895, levels we've put out earlier as well. And the resistance becomes yesterday's high, the first at least, which is 54,160. So those are levels. GIFT Nifty will give you a quick sense of how we're likely to start. It's about 50 points lower. How is the F&O setup looking? Nigel has walked across to that setup. Nigel, over to you.
Well, yesterday we did come off from around the 20 DMA on the Nifty, and it was looking quite good till around noon, till around 1 p.m. odd, and then we lost our way. So there could be an element of weekly expiry as well that did play out yesterday, and we crashed into the 20 DMA, and we did pull back from there. If you look at the institutional flows, well, the net institutional numbers were positive, but just keep in mind the FI participation still is not at what we have seen in the recent past, so it's still a little bit lower. Today will be a crucial day because in all probability that FI participation will be back to around 100%. What did they do in the F&O market, though? In yesterday's trading session, there was some shorting that we saw on the Nifty Bank, and that's the easier index to short from a bearish perspective because that continues to underperform, and yesterday was no different. So though on the Nifty we saw some unwinding, but on the Nifty Bank there was some short build-up. And if you just tie in with what the FIs did in yesterday's trading session, they added short positions. 5,000 contracts is what they added. The short positioning has moved to around 92%. Now, those short positions are moving to those extreme levels. And that could be one of the reasons, actually, that India could outperform in this month itself. That's the month of September, when normally global equity markets are a little under the weather. The FI short positioning is reaching those levels where, in fact, we have seen that they reach their extreme level. And because of that, those shorts in the system keep the markets afloat. So we'll see how that goes. Well, you're looking at two strikes, 24,700 call, fair bit of open interest build up, 24,500 put as well. On both those two, there was close to around 20 lakh shares getting added out there. And the premium at around 40 and around 90 rupees odd. Well, moving to the levels then that we're looking at. The Nifty, important mark you wanted to defend on the downside is around 24,400. Crucial mark on the downside, while the resistance level is in line with yesterday's high, in line with around the 20 DMA. Though that's the crucial, both those two are the goalposts that you're looking at on the Nifty. On the Nifty Bank, well, that's been the relative underperformer over the last week or so and the last month as well. Well, important to see that it defends this 200 DMA. That's around 1.5% away from current levels. But that's the line in the sand. You don't want the Nifty Bank to break that mark. Moving to stocks in focus, well, I'm looking at two stocks. We had TBO Tech that came out, with an acquisition. They're acquiring Classic Vacations for around $125 million. It adds close to around 50% to the revenues that they delivered last year. And if you look at the EBITDA number, well, a third of that because margins are relatively lower. It looks accretive at the first look at it, so I'll keep an eye out on this stock. And the second stock that I'm looking at is First Cry, or Brainbees as it's commonly known. The stock has come off drastically. It's nearly half of what it was at its peak. But in yesterday's trading session, you had a fair bit of delivery-based buying in trade in percentage terms as well as in absolute volumes. That's the delivery-based buying that we saw in yesterday's trading session. So I'll keep an eye out on this one as well.
Okay, all right. That's from the F&O space and the F&O desk, all the cues coming in. By the way, across Asia, the biggest headlines are once again political this morning because of this, pomp and show at the military parade that's going on in China. And a lot of statements have come in with Donald Trump saying that China is conspiring against the U.S. And, the Chinese leadership also making some statements at that particular event, that big parade that's ongoing. Markets for the time being are absolutely flat. Not too much after the slide that we saw on Wall Street. Yeah, those are the visuals that I'm talking about. So the North Korean leader, Vladimir Putin, the Chinese leadership, all of them there. It's a grand parade, once in a decade. I think the event is happening after a decade. And obviously, Washington is watching every single bit of it. And that's when the quote came, please give my warmest regards to Vladimir Putin and Kim Jong-un as you conspire against the USA. Anyway, let's quickly move on and now talk about what's pertinent to us. And that is the US president's latest statement on tariffs with respect to India. He said that the two countries got along very well, but also listed out why India was being charged a higher amount of tariff.
We get along with India very well, but India has, you have to understand, for many years it was a one-sided relationship. Only now, since I came along, and because of the power that we have with tariffs, India was charging us tremendous tariffs, about the highest in the world. They were about the highest in the world, number one. And we, therefore, weren't doing much business with India, but they were doing business with us because we weren't charging them. Foolishly, we weren't charging them. So they would send in massive, everything they made, they'd send it in, pour it into our country. Therefore, it wouldn't be made here, which is a negative. But we would not send in anything because they were charging us 100% tariffs. And, I'll give you an example. Harley-Davidson. Harley-Davidson couldn't sell into India. There was a 200% tariff on a motorcycle. So what happens? Harley-Davidson went to India and built a motorcycle plant. And now they don't have to pay tariffs. Same thing as us.
Okay, well, separately, he also was asked whether he's considering lower tariffs in India, and there was a one-word answer. He said no. Anyway, U.S. appeals court last week had ruled against Trump's tariffs, called them illegal. The Trump administration has to go to the Supreme Court, and here's Trump himself essentially saying that they're going to do it and expedite a ruling on his tariffs.
Other countries use tariffs on us for years, and we never did. I did a lot during my first term, but then we had COVID and we had to focus on other things. You couldn't be tariffing Italy, Spain, France, as they were dying by the thousands and millions. It's a very important decision. And frankly, if they make the wrong decision, it would be a devastation for our country. We've taken in trillions of dollars. And by the way, all these countries signed agreements. As an example, they're all happy. Everybody's happy. But some whack job put in a lawsuit, and now it's going to the Supreme Court. Now, we're going to be asking for early admittance. We're going tomorrow, and we're going to ask for an expedited ruling because, when you look at the stock market's down today, the stock market's down because of that, because the stock market needs the tariffs. They want the tariffs.
Well, India is in dialogue with the United States for a bilateral trade agreement. That's the word that's coming in from Commerce Minister Piyush Goyal. He also hopes that things get back on track soon to conclude the BTA by fall or by November. Let's listen in to Mr. Goyal himself.
In every sense, one can see an excitement across the world to expand trading and business relations with India. We've had a little bit of a geopolitical issues overtaking trade issues in our negotiations with the United States of America. I do hope things will get back to track soon and we'll conclude a bilateral trade agreement by fall, November or so, as was discussed by our two leaders in February.
Okay, so that was Commerce Minister Piyush Goyal talking about where things stand. He's still, quite hopeful about that bilateral getting done by November or so. Matt Orton, Chief Market Strategist at Raymond James, is with us. Matt, always great to have you on. Thanks so much for joining in. So, the Indian market has started stirring a little bit. It's showing some sign of life, and everyone's really excited about this GST meeting that's kicking off today. You tell us, do you think we're at some sort of or at least close to a turnaround point? And are you looking at any sort of portfolio changes or addition if we indeed get these big GST cuts?
Hi, good morning, Surabhi. It's always great to join. And I think the GST is the right focus. Obviously, there's tariff.
I think we just lost that line with Matt. We'll try and get him back. But yes, the reminder that the GST meeting kicks off. Remember, it's a two-day meeting. And the big overarching reform, as the proposal carries, is that we will move to largely a two-rate structure, 5% and 18% for goods. Matt, sorry we lost you there, but you were saying that that GST is the right focus. Go on.
It is, because it gets back to the fundamental underpinnings of why India, I think, is an exciting long-term opportunity for investors. India is a primarily consumption-based economy, very similar to the United States. And I think GST, the simplification, is a signal to investors that have been concerned over the long term about the regulatory framework, some rules that don't make sense in India. This is a massive simplification. I think it will do a lot to spur the consumer. And I think it can help get enthusiasm back in the market, and hopefully you'll start to see a tangible uptick to earnings for companies that are exposed to the consumer across the broader market, as opposed to some of the more concentrated gains we've had in India so far this year to some of the winners versus a lot of other companies that have been left behind. So I certainly think it can be very positive. And hopefully it gets foreign investors in particular their attention focused back on things that actually matter longer term to the growth story of India.
Matt, good morning. In the US, are we starting to, are we in the first stages of a bit of a drift lower, a bit of a correction, small, I don't know. I mean, especially the large tech names seem to be deflating a little bit now.
Yeah, Prashant, I think it's a healthy consolidation. Would I be surprised to see a 5 to 10% pullback in what is seasonally the weakest month of the year? Absolutely not. But we are still very much in a secular bull market. And, I continue to think that this market's going to end meaningfully higher than where we are currently on the S&P 500 and for the broader market. Because again, the earnings that are underpinning the AI story are very much real. So people talk about a bubble in artificial intelligence, but I strongly disagree with that notion. You're seeing hundreds of billions of dollars spent in CapEx that continue to increase against all expectations. I would argue you're starting to see a return on investment across a number of these companies, and there's no leverage being used. You can't have a bubble if there's no leverage cycle, and you can't have a bubble if margins remain consistent and among the highest of all companies in the overall market. So I think there's a lot of durability to this trend. And in fact, when I look globally at attractive investment opportunities, I think this pullback is a great opportunity across the world to lean into some of these artificial intelligence-driven trades that are starting to pull back, and maybe you finally get an opportunity or a bite at the apple if you've missed those trades in the past.
All right. Hi, Matt. Good to see you. Matt, what's your view on global equities? The U.S. market has been rock solid. You threw a lot at it. You have Mr. Trump, who says one or the other thing, some uncertainty with regard to the central bank out there as well, and data is mixed. Do you think the U.S. is getting to a stage where it could be peaking out? And what could that mean for an emerging market like India, which hasn't got any flows? Earnings have been a little bit subdued, but we have been big underperformers.
Yeah, Nigel, I think the key word there is earnings. I think the U.S. has outperformed so many other markets consistently because it's really been the only place in the world where you've had consistent earnings that continue to surprise to the upside. So I do think the U.S. continues to perform well. However, when I look at the full global stage, I'm a lot more excited about emerging markets going forward than I am of international developed markets, broadly speaking. Not only because you don't have the economic growth that you do in emerging markets that's lacking in kind of the Europe, Japans of the world, but when you look at EMs, there's an inflection point for earnings. You've seen that in China. That's why Chinese equities have been so strong. Also, because a lot of U.S. policies are actually spurring reinvestments in semiconductors and onshoring in China, which is almost at odds at what the U.S. policy actually is. And I think India, you've seen earnings weakness, but I do think we're getting to an inflection point. And hopefully these GST reforms can be one of the reasons why we're going to start to see earnings move higher. So I would lean into, in the Indian markets, lean into some of this weakness, especially as a long-term investor.
So, Matt, leave us with some names, some stocks. You've liked financials, you've liked names like M&M, Interglobe. But tell us, since you're quite convinced on the GST impact, what would you buy from consumer?
So I'm looking at complements to some of my longer term holdings right now. I've actually reduced ICICI in my portfolio just because I have to respect technicals, I have to respect the market, and I've done incredibly well. So I'm looking a little bit away from financials right now. I'm complementing my travel exposure because, again, I think the consumer can do well under some of these GST reforms and strong economic growth. So complementing Interglobe with companies like a Make My Trip, adding to some positioning there, which is a name we've talked about in the past, but also quick commerce. So Eternal has been a winner of mine that I've added to my portfolio this year, but complementing that with a Swiggy, where valuation, I would argue, is very, very fair. Analysts continue to upgrade their estimates for the company, and you're starting to see a reduction in their cash burn, as well as an increase in their gross order volumes, thanks to some of the Max Saver program that they've implemented. So that name to me looks like it's climbing, and I think this is an attractive point to get into. And also Paytm. Again, it benefits from more spending. There's been favorable government reforms, and I think that they can continue to monetize a lot of the users that they brought into their ecosystem. So again, payments is related to the overall consumer that I think is going to continue to do well.
Okay, a little cut some positions in financials, added in consumers, Eternal, Swiggy, Paytm. Thanks very much, Matt. It's always great speaking with you here on CNBC-TV18. Look forward to the next one. Thank you. Well, let me just quickly run you through what's lined up here over the next two and a half hours. 8:35, Sirma, you'll hear from the manager of Sirma, and they join in to discuss the company's business outlook in light of its latest joint venture for electronics manufacturing. 9 o'clock, Sandeep Agarwal of Suvilo Investment Managers is coming on to talk about the IT stocks that he's betting on. Small caps is what Sandeep thinks you should focus on. 9:20, Navneet Munod of HDFC Asset Management will be a market master of the day. It's coming on after a while. 9:35, Rajiv Mantri of Bandhan Bank will be talking to us about whether they are at the end of the pain cycle for Bandhan. Aruna Banerjee of Sept talks to us at about 9:45 on the company completing the acquisition of Camzo and the possible impact of GST rate cuts and Trump tariffs on the tire business towards the end of the program. It's the economy, Indianomics, Latha in conversation with Dr. Saurabh Garg, Secretary of the Ministry of Statistics and Program Implementation on the first quarter GDP data. That's a big one from the government, which is coming up.
Well, time to take a short break. We go full throttle on stocks on the other side in our special top 10 segment. We're looking at TCS, Eternal, JSW Cement, DCM Shriram, Aarti Industries, PNC Infra, Waaree Energies, E2E Networks, and TBO Tech. All of them will be reacting to positive news flow, while Indus Stars will be reacting to negative news flow. Take that break, come back, get into further detail on all of these names.
Welcome back. Like we've been telling you, cues across Asia are mixed. Not too much of a directional headway, depending on what you're looking at. The last time the Hong Kong market was down, it still is, yeah. Some green in China. Let's pull up the implied open. Yesterday, the bulls couldn't quite hold on to the positivity, and they gave up a lot of that gain. And this morning, suggesting that it could be a 50-point lower start. So we'll see. Let's quickly move on and talk about the stock list of the morning. Our team is standing by with all of the details, the top 10 stocks that you need to watch out for. Guys, morning to all of you. Let's start with TCS, which has announced a big deal. I think it's in Europe. Rima, morning. Tell us more.
Indeed, it's a large deal win announcement from TCS. The company has signed a 550 million euro deal with a Scandinavian non-life insurance company called Tryg. This will be spread over 7 years. So 550 million euro, 7 years. But this is a renewal deal. So it's very hard to quantify what the incremental revenues will be. But in an uncertain environment, when we're looking for positive triggers for IT companies which can boost their growth, this large deal announcement comes as one.
Okay, all right. Thanks a lot for that, Rima. So a bit of a positive, but quantifying it will be a little different. Well, let's get Mangalam in. Mangalam, Eternal going ahead and hiking rates. Tell us more.
Right, so if you open your Zomato app to order something, up until day before yesterday, you would have had to pay 10 rupees as platform fee, and now that has come to 12 rupees as platform fee. But, the important part is that this is a dynamic number. Remember, around the New Year's time, when there is a high demand number, that number increases all the way up to 20 rupees as well. So it's not that the first time they've gone ahead and increased their prices. It also is a dynamic number, so not cast in stone. The good part is that they are foreseeing stronger demand, as a result of which they are able to take that price hike. And that's a positive for not just Zomato, but Swiggy as well. But the important thing to track is that will they go ahead and change any commission model or any take rates from restaurants due to competition coming in from Rapido? Were that to happen, that would be a bigger negative than any incremental positive that the increase in the dynamic platform fee would bring.
No, absolutely. And then there is a platform fee, then there is a rain fee, then there is a demand surge fee. So a little tough to know exactly how much the companies are making at which point in time. But thanks for that, Mangalam. Let's get back to Rima now. Rima, Indus Towers is heading to Africa.
It is indeed. So the board has approved the company's foray into the African markets. 3 key countries they will start with: Nigeria, Uganda and Zambia. So, the street is a bit disappointed because the company was, the street was, investors were hoping for dividend payout for the company. They had constituted a committee about 2 quarters back, but the dividend payout has been delayed. Now, when you're now foraying into the African market, this further puts a question mark on when dividend payouts, and if they get delayed, even though there is a risk that the dividend amount gets cut. So it may be a strategic move because, Airtel already has presence in Africa, but this puts a question mark on the company's dividend payout ability, which is why CLSA maintains its high conviction outperform rating, but cuts the target price to 520.
Okay, all right, Rima, thanks a lot for that. Well, I'm looking at JSW Cement backdated numbers because it's a Q1 numbers. The street is optimistic that in the second half of the year for the entire cement pack, we'll see demand revival, pricing revival, and in turn, profitability revival as well. But these numbers don't look too bad. Top line growth of close to around 80%. Operating profit bumped up by close to around 60%, which meant margins moved from around 14% to around 20%. The reason that they could do those sort of numbers is one, because costs were lower, telling you that there is operating leverage that's playing out. So if you look at the employee costs, other expenditure, or even power and fuel, clearly the focus on cost as well as operating leverage helped them. And that's why the EBITDA per ton popped up to around 975 rupees per ton, with having volume growth of close to around 8%. The net debt, well, it's perked up a little bit because of the ambitious capex plan that they have, 4,500 crores odd. Remember, the IPO was priced at peak valuations, but expect the stock to open up mildly in the green on these numbers. Going across to Sonal, though, she's here to tell us about DCM Shriram and Aarti Industries. Morning, Sonal.
Good morning, Nigel. Well, an interesting update that has come by because these 2 companies have entered into an agreement. It's a long-term strategic agreement for supply of chlorine. So basically, DCM Shriram will go ahead and supply that chlorine to Aarti Industries for the new plant in Jagaria in Gujarat. Now, do remember, they already supply 150 tons per day of chlorine to Aarti Industries for existing facilities. Now, they will add around 200 tons per day of chlorine to Aarti Industries once that plant is operational. What we need to understand is what the pricing is here, because chlorine is a very volatile commodity, and that's why we need to understand whether it benefits any of them when prices become very volatile. And when they say long term, what is the tenure of this particular contract? That will help us understand what the impact on the bottom line will be for both these companies.
Thank you very much, Sonal, for that. Vinny is now joining in with more stocks with the news. Vinny, good morning.
Good morning. So yes, keeping an eye out on a few names. PNC Infra, that's the first one. We're expecting the stock to open up in the green after the company has emerged as an L1 bidder, and this is for Lal Bahadur Shastri International Airport in Varanasi. The project value for that is around 297 crores. The next one we'll keep an eye out on is Vari Energies. Couple of news flows here. Board has approved the company's acquisition of 64% stake in Kotsons, that is for 192 crores. Other than that, the board is also going to be has approved the company to acquire 100% 100% in impact grade renewables. This is from its wholly owned subsidiary itself. And one more news that's coming, this is according to media reports where it's suggesting that US company has alleged that Vari's TopCon cells, which are one of these important solar cell technologies that Vari has, that is violating 2 patents. So that is an important issue that comes in. So maybe, open up in the green and then could see a flattish day coming in there. E2E Networks, that's the one we're keeping an eye out on as well. They've received a letter from the Ministry of Electronics and Information Technology, Government of India, and this is for approving allocation of H200 SXM as well as H100 SXM GPUs, and this is for a duration of 360 days. Value for this is approximately 177 crores of this order. So green expected here as well. And TBO Tech, the company signed an agreement to acquire US-based Classic Vacations. This is for a value of around $125 million. So keep an eye on that one. Positive expected here as well.
Okay, all right, got it. Vinny, thanks very much. So plenty of stocks on the radar. Let's quickly recap our list. The ones that have positive news around them would be TCS, Eternal, JSW Cement, DCM Shriram, Aarti Industries, PNC Infra, Vari Energies, E2E Networks and TBO Tech. Indus Towers is the only stock on the red side with respect to news flow this morning. Well, with that, let's move on and talk about the latest commodity market action. Manisha is joining in with the latest. Manisha, good morning. What's on your radar?
Thank you for that, Subi. Well, the commodities really seem to have started Asia quite well today. I'll start with gold, and we are trading at a new all-time high, and $35.50 an ounce seems to be taken right now. With this, gold is up 35% for this year. If you look at the dollar index, that one is trading at a 5-week lows, and that clearly has been one of the major supporting factors for many of these commodities. So not just gold, silver is trading at a new 14-year highs. Platinum is now at a new 11-year high. So it's a good going for as far as the precious metals go. But the base metal prices seem to be doing quite well too. Copper prices are trading firm, and this is despite the China weak PMI data, but that seems to be drumming up the stimulus expectations from China. You have zinc prices, which are trading at a 5-week highs. Aluminum doing quite well also in the overnight markets there. And finally, towards the energy markets, the crude oil prices with that 1.5% gain overnight are now trading at a 1-month high. The geopolitical tensions have been on the higher side, but this really has to do with the Ukraine drone attacks now having shut 17% of Russia's refining capacity. That premium seems to be coming in prices.
All right, Manisha, thank you very much for that. So a bit of a bump last night as far as oil is concerned, but largely remains in that range. Brokerage calls of the day. Sud has gone through the entire list. And Sud, good morning. What's on your list?
Good morning, Prashant. So today I have 2 stocks. First one is Glenmark Pharma. Investec has come out with a note. It has a buy call and target. It has given is of 2,510 per share. It says following successful AB licensing, next milestone could be star 0310, and this could trigger a milestone and lend credibility to its specialty pipeline. And also it could trigger another trigger is US facility, that is Monroe clearance and niche approvals that company may expect in the US, and also $700 million milestone from AB in September would strengthen company's balance sheet going forward. Citi has written on Mahindra & Mahindra Financial Services. It has a buy call and target is 292. It believes that company is making progress in journey to strengthen controls and compliance and also driving risk and collection management via centralization and verticalization. Company is targeting PPOP and AUM of 4 to 4.5%, ROA of 2.1 to 2.2%, and ROE of 15% in the medium term, and also targeting low-teen growth in vehicle financing portfolio, tractors, and refinancing to outpace going forward. Company is expanding non-vehicle financing segments to 25% of AUM by 2030 and more than 40% CAGR in the same period. So these 2 stocks might be in focus on the back of brokerage notes.
Okay, all right. So thanks very much for that. We do have to take a very quick break, come back on the other side, and we'll connect with Deven Choksi for some fundamental stock ideas. And also, we'll have the management of Sirma SGS join in to talk about the company's business outlook in light of its latest joint venture for electronics manufacturing.
Well, Prime Minister Narendra Modi has said that while oil is black gold, chips are digital diamonds. The PM inaugurated the Semicon India 2025 event and expressed confidence that the world is ready to build semiconductor future in India. My colleague Ashmit Kumar is here with the key highlights of the event to get a better sense of the chip manufacturing ecosystem, the challenges it faces, as well as the key tailwinds.
Semicon India 2025, over 33 countries, over 50 largest companies here, present here, the biggest names, ASML, Lam Research, Applied Materials, all present here. Now the semiconductor market, $600 billion globally, soon to climb to $1 trillion, and India wants to be a major part of it. With that semiconductor aspiration, Prime Minister Modi inaugurated Semicon India 2025.
Oil was black gold, but chips are digital diamonds. इस 1 ट्रिलियन मार्केट शेयर में एक अहम हिस्सा भारत का रहने वाला है। सेमीकंडक्टर के 10 प्रोजेक्ट्स में $18 बिलियन यानी 1.5 लाख करोड़ रुपए से अधिक का इन्वेस्टमेंट हो रहा है।
As a part of India's semiconductor mission phase 1, the government had allocated 76,000 crore rupees. The Prime Minister this morning announced that the next phase 2.0, ISM 2.0 of the support programs is just around the corner, and sources tell us it could be even bigger than 76,000 crores.
आपकी भाषा में कहूं तो डिजाइन तैयार है, मास्क अलाइंड है। हमारी पॉलिसीज शॉर्ट टर्म सिग्नल नहीं है, ये लॉन्ग टर्म कमिटमेंट्स हैं। आपकी हर जरूरत को हम पूरा करेंगे।
Well, sources tell us that the next phase of government support programs, that's ISM 2.0, will be quick to roll out. We'll see that before the end of the year. The industry will be watching very keenly if their demands are met. In New Delhi, Ashmit Kumar.
Okay, well, that is a recap of day one. The Semicon event continues today and I think tomorrow as well. So it's a big one, and we'll continue to get you visuals out of there. Big stalls and it's like the full thing. I just want to say one thing. Let's just put up Keynes, right? Keynes is, from a listed perspective, actually Keynes and CG Power. CG is just about started. It's not actually not started producing, but it's had a soft commissioning, and we reported on that. Stock's done well since that happened, and that was, by the way, last Friday. It's up this week some 6-7%. Keynes, of course, has done well as well. So from a listed perspective, listed universe, these are the two companies which are building this OSAT business. It's a new line of business for them. And both of them have got the central government PLI benefit. At some margin, the fear was that once the PLI benefits run out, I mean, was this going to be like a one-time thing? The indication from the Prime Minister seems to be that no. We don't have the details yet. The first sort of allocation was about 7,600 crores. It looks like there's going to be part 2 as well, perhaps even bigger. As I said, we don't have the details, but indications are that broadly the structure of what will be announced is ready. So I think something to wait and watch out for. But there seems to be continuity. And as the Prime Minister said, it's not short term. The ISM mission is here for the long run. Surabhi.
Okay, and speaking of semiconductors and manufacturing in India and electronics in India, good time to bring in the company that's on our focus radar as of now, and I'm talking about Syrma SGS. Now, Syrma SGS came out with an announcement. They are going to be getting into a strategic joint venture with the Elemaster. This is a company based out of Italy to strengthen the high reliability electronics manufacturing in India. Sandeep Tandon, Executive Chairman at Syrma SGS, is with us. And Sandeep, hi, great to have you in. I just want to lay out 3 key points that our viewers, your investors as well, would perhaps want more clarity on. Number one, we want to understand the rationale behind this joint venture and what it really brings to the table. And of course, we want to know your outlook on exports because so much is shifting across different geographies. And of course, an overall picture on the order book right now and how the rest of the year is looking like. So, Sandeep, let me open up with the JV. Very interesting. It's an Italian company, and I think you're going to set up the unit in somewhere in Bangalore, if I'm not mistaken. Absolutely. So let's start right there. What are you going to be making? Because the announcement said that it'll be products for clients like the railways, for a lot of companies in the manufacturing arena. So what are you going to make? What's the strategy and how much money are you going to put to work?
Okay, thank you so much for having me on. Elimaster is a large player out of Europe. They're headquartered in Italy, but they have plants all across Europe, also North America and China. They serve mainly mobility, the railway sector, and European defense companies and European medical. So very centered around European customers that are industrial, medical, and railway focused. Now they wanted a lower cost manufacturing partner that could be offshore, and they chose India as a location for their further expansion. And they see us as a very good partner to run that operation and bring their customers a solution for the India needs, because Indian market for railways is also growing quite substantially. So their customers wanted an India footprint.
Got it.
So that is the main reason we are focused on.
Got it, got it. So they needed better, more efficient, low-cost, high-quality manufacturing, and that's where the partnership came in. Now let's talk about the monetary nature of this partnership. What is the structure of this, the equity structure of this JV? How much money will you be investing from your side? And then, what is the ROI? In how much time will your lines be up and running? When do the first shipments begin?
So the total investment is 55 crores to start out. The plant is in Bangalore because we believe in starting small and growing big. So the 55 crores is the initial setup, but this is 55 crore alone should give us about 7 times turn in the revenue. The plant will be in Bangalore, and it is in a 60-40 split. So Elimaster will be investing about 40%, and we'll be doing about 60%.
All right. Hi, Sandeep. Good morning. Congratulations on this JV. Give us a few more details. What margins will this JV enjoy? 400 crores could be peak revenues. Yeah. And by when do you get there? Will this reflect in FY 27, 28?
This will reflect in FY 28 fully. So it's starting out, I think, FY 27, we should see about half of that quite easily. But we have already been working with them, so it won't be a slow start. It will be quite quickly starting out. The margins, India business is always stressful. So the margins on the India side will be always under pressure, but we expect operating margins still in double-digit range. And, with this, we also get to serve some export customers and also other services that we can add to the customer. So we are quite sure that should be double-digit range margin.
All right, double-digit margin. And just to clear the air on that, the JV will be primarily to focus on Indian clients, or as you said, it gives you all that optionality, right? You can also serve European clients. They're European clients. So how would that work going ahead? And ultimately, say you could have a 5-year horizon. How big do you see this JV becoming? Because the potential, going by what you're saying, is tremendous.
Yeah, it's tremendous. So I don't want to, color anything beyond what is right in front of my eyes. But if you see, Elimaster itself is about 450 million euros. So it's a sizable company, and they serve a lot of these large customers. So as the customers' needs keep changing, it's a very dynamic world, right? So we don't know what comes about, but we could serve those customers in India and their global needs. So Elimaster is excellent in serving them for the, prototype build, and for lower cost alternatives, we could be the partner also. So I don't want to, confirm anything, but we definitely see what we have in face is quite substantial.
Sandeep, you said that the investment is 55 and it could be 7 times, the revenue turn. So I'm just trying to figure out scale up. Let's say if you're up and running by FY 27, as you said, because it'll happen quickly. So what could the revenue be in year 1, year 2? Are we talking, to begin with, is it going to be...
Like I said, FY 27, we could hit about 200 crores in revenue.
FY 27.
It's not so much the capacity, right? It is also qualifications. These are high reliability electronics. So approvals itself take 6 to 9 months sometimes.
Okay. All right. Very quickly, since we have you, Sandeep, what's the status of the Bare PCB project? Have you scouted for the land? Has the company applied for ECMS?
We've identified the land, and we have already been approved by the state of Andhra Pradesh. Now we're waiting for the central approval. That's part of the component scheme that should be coming out. Approval should be happening end of this month. We were one of the first to apply, so
correct.
We should get that quite quickly.
So you'll have applied for the ECMS scheme. Yes. Is that correct?
Correct.
All right. And what's the total capex for this Bare PCB project that you'll have laid out, say, in the next 2 to 3 years?
So 2 to 3 years, it would be about 300 crores.
300 crores. Always good speaking to you.
Just one thing. One last question. We were just talking before you came on. We were talking about the Semicon event which is happening, and maybe there's another scheme which the government announces. The first one, of course, was fully utilized. So is that something you would be interested in? I don't know if you were interested the first time around.
So always it's backward integration, forward integration are critical in this opportunity. But we always believe in working with the right partner, right? I don't want to put up a plant just because I have a subsidy. I want to make sure I have capacity filled up before we put that up. So we are looking for the partner for this also. We have a lot of conversations on.
Okay, for a OSAT basically.
Correct.
I see. So once you have it, then you will apply. I mean, but you may have to do it simultaneously if the But that's very much on the agenda.
Yes, definitely.
Okay, all right. And any numbers there in terms of how much? Are you close to getting a partner on? Are you? I mean,
it's not. It's not confirmed yet, so I can't tell you anything about that.
Okay, fair enough. We'll leave it there. Thank you very much for joining us. Good speaking with you. So that is Sirma, with of course what they've done with Elimaster, but maybe a little bit about that OSAT business where Keynes is there. Sirma very much interested, but we'll see if they find a partner, as he said. Let's talk about markets, and Devin Chokshi is with us to help us with that. Devin, good morning. Great to have you with us here. Thanks very much. So GST meeting. Is it, how are you thinking about this, Devin? Will it keep stocks bid, especially in areas like autos, etc.? Or you think for most areas it's going to be a little bit of, buy the rumor and sell the news?
Yeah, Shan, good morning. Well, I think the market has already started factoring the GST-related impact, particularly on the high GST items, high GST rate items. Factoring that, I think this is coming down, which is in a way good because I think the market is definitely forward-looking on this subject. Auto ancillary, which you mentioned, I think definitely remains the best part of this entire reduction program, which will happen. In my viewpoint, I think the sluggish demand scenario, particularly in the passenger vehicle segment, could possibly see the lift if we see the rates coming down. And I think those rates which are on the premium products, if it is coming down, then it is even better. We believe that I think market has partly factored this particular news and momentum, which might quite possible that after the announcement, I think the market price would start correcting for some of the stocks. But on the whole, if you look at the earning opportunity that one is getting out of the business, I think these companies are likely to show relatively steadier to better performance. Not only in the current financial year where I think the amount of demand scenario is emerging, but also in subsequent period in next 3 to 5 years. So one remains cautiously optimistic about the possibilities going forward with the rate reduction happening. It will be only a boost coming in some of these companies.
Okay. So all the consumer stocks, auto stocks, all of them on our radar. Good morning, Devin. Good to have you in. Every time I order something on one of these quick commerce apps, I realize that the fee ends up inching a little higher and higher. Now we have confirmation, right? Zomato has increased the platform fee from 10 rupees to 12 rupees. Swiggy is already, I think, at a higher point. And the stocks have been doing extremely well. What's your view on both Swiggy, Zomato? Do you like either or both or neither?
Yeah, Sylvie, good morning. Well, I think I believe in consuming more than buying for investment in stock at this point of time. Largely more, but because of the fact that the valuation-wise, I think these companies have already reached to a scale. And certainly, I think if they keep on increasing the fees by 10-20% every now and then, it means that the profit performance would probably happen faster for these companies, which they have not seen in the previous years, I think, since they have listed also. In my viewpoint, I think that is justified. But at the same time, I think everything is in price today. We are not getting this business cheap. And at the same time, I think we are seeing that quick commerce, Reliance is entering into quick commerce. I believe that I think this is one company which one will have to be mindful because I think wherever they have operated, in whichever space they have operated, they have reached number one by disrupting the markets. And I think that's where probably the larger amount of threat would be to the existing players. So we'll have to wait and see, particularly more because the valuations are expensive. I think one would like to wait and see.
Okay, all right. Devin, I'm not sure whether you've seen this. The TBO Tech, they've gone ahead and they've done this acquisition for around $125 million. And just back of the envelope calculation suggests that their revenues could go up by approximately 50% in comparison to the base year, and EBITDA by around a third. Valuations as well look pretty okay. Any view on this? The acquired entity, margins are around 10%, they do around 17%. But otherwise, in the entire scheme of things, it looks like it's accretive. Any view?
No, Nigel, I think I haven't seen this thing in detail, so could probably comment it later.
Okay, all right. What about JSW Cement? They came out their numbers. The numbers are backdated because, they're still giving numbers for Q1. But we know that the group actually has created wealth. If you look at the steel assets, even the power assets as well. So the parentage is good. The valuations are expensive. But they have said that in the time to come, they'll scale up profitability as well as size. Your view at around $150?
Yeah, I think we are convinced about the scenario per se in the commodity in cement. That is something which we understand well. My take is that I think whenever the companies put in more money in the expansion of capacity or even for that matter inorganic growth, I believe that I think the investors don't earn enough in those kind of situations. Maybe in a temporary momentum, you might see the price rise in the stock. But ultimately, I think till the time they absorb the entire capex program, the investors don't make enough amount of money. So in such situation, when the valuations remain expensive compared to peers, I think one will have to be a little bit more watchful at this point of time. I believe that I think there is a scope for upside of 10 to 20% in most of the cement stocks. And maybe I think if the price firms up a little bit more, the tailwind could be a little bit more as well. But around 20% kind of an upside can't be ruled out in most of the cement stocks as we see it today.
Okay. Devin, thank you very much for joining us. A quick conversation. Appreciate you joining us here on the channel as always. We'll take a quick commercial break here. We're going to come back, focus on the big movers on Dalal Street yesterday. Hormuz is going to join us for that. Stay tuned. Coming up. Welcome back. Hormuz is now joining us as promised with the big movers yesterday and of course what the numbers show us in terms of the volumes, delivery statistics, etc. Hormuz, over to you.
Morning, Prashant. And sugar, of course, was the highlight of yesterday's session. And almost all those stocks ending with double-digit gains. I've picked out 3 of them, being Sri Renuka, Dwarikesh and Dhampur. And all of them had their highest trading volumes in a year or more than a year in yesterday's trading session. And take a look at those volumes. Sri Renuka having almost 17.25 crore shares changing hands. The 20-day average is just over 20 lakh. Same is for Dwarikesh, around 66 lakh shares for traded yesterday compared to a 20-day average of just around 3.5 lakh. And same is the case for Dhampur. Take a look at Dhampur here. 41 lakh shares traded. The 20-day average is less than a lakh. And when it comes to the delivery as well, the delivery volumes are too significantly higher for Sri Renuka as well. Almost 1.5 crore shares marked for delivery yesterday compared to a 20-day average of 9 lakh. Dwarikesh and Dhampur as well, almost 4.5 lakh shares for delivery for Dhampur, and the 20-day average for delivery is less than 50,000 shares. So it shows the kind of moves that sugar stocks had yesterday. A stock that made a new high in yesterday's session was MRF, and now one share of MRF costs more than 1.5 lakh. And that 6.25% surge that you saw in yesterday's trading session was the biggest single-day gain that the stock saw since May of 2022. Of course, a closely held stock, not very liquid, but even then, the stock is up 10% in the last 2 sessions. Yesterday's session saw 33,000 shares change hands in a single day, and 20-day average is 6,500. And for delivery as well, over 11,000 shares marked for delivery. The 20-day average is just 2,500 shares. The other highlight of yesterday was MobiKwik. The stock ending in a 20% upper circuit after ADIA's exit. The stock closing above its IPO price, and more than 6.5 crore shares changing hands. 20-day average of just 22 lakh, and almost 70 lakh shares marked for delivery. A 20-day average of just 4.5 lakh shares for MobiKwik.
Okay, all right. Thanks a lot for that, Hormuz. Well, let's go across to Rima, because Indus Stars has forayed into Africa after it got its board approval. Rima, the street was looking forward to a dividend, but they have gone the other way. Tell us more.
Thanks so much for that. So, Indus Stars board has approved international expansion. They will be entering into the African market, and they will start off with 3 key markets: Nigeria, Uganda and Zambia. Investors are a worried lot, because this expansion would mean that the dividend payout that they were anticipating perhaps gets delayed further or even gets cut. So CLSA maintains their high conviction outperform rating on Indus Stars, but cuts the target price to 520. They say, we had expected the management to focus on improving the capital structure by paying out high dividends. While the board is committed to reinstatement of distribution, but there is an unjustified delay in dividends. But on the other hand, Citi continues to remain bullish. Their target price is at 460, which compares with 330 of where the stock closed yesterday. So significant upside. They believe the concerns are overdone, whether it's to do with VI sustainability or the slowing rollout of, or even the delayed payments. They believe all these concerns are overdone. Current valuations remain favorable, and they say their bear case scenario is 300 rupees on Indus Stars, and the stock is not very far, 330 from it. So therefore, from here on, downside, according to Citi, remains limited, and any relief, whether it's on the dividend front or VI, could actually act as an upside trigger for the stock.
All right. Thank you very much, Rima, for that. That's an important story. I mean, the dividend at Indus Tower, long in the coming, and perhaps now a little bit more in terms of delayed. But we'll get you some opinion on this as well. Take a quick commercial break here. We're going to come back with a pre-open. And of course, some trading ideas. Sudarshan Sukhani and Mitesh will be with us to help us with that. Stay tuned.
All right, pre-open rates will be flashing for you on the screen. Boy, oh boy, we would have loved that. The Nifty pre-open suggesting 600 points up. Woohoo! Hopefully someday. But for the time being, let's get in our technical guests. We have Sudarshan Sukhani and Mitesh Thakur who joins us. Good morning, gentlemen. Good to see you in as always. Well, that pre-open rate is still settling down. You know, there'd be a day when we could see that sort of a gap up, but not today. How do you approach the index? Mitesh, you go first. Your view on the Nifty, yesterday things look good, and then that expiry-related factor played out, and you don't know what Trump is going to announce next, and that's why the 24,700 mark got rejected. But for today, how would you approach trade?
Morning, I think both the indices, especially the Nifty, to me appears to be getting into a range. You will get support around 24,400, 350. And then on the upside, you have 24,800 as the midpoint of the range and 25,100, 150 as the upper end of the range. So I think the Nifty will consolidate. There is mild weakness in the banking and the financial names, while FMCG as a sector had a good breakout. So that's where the positive signs are. But broadly, it looks like a market where you would want to be more of stock-specific approach is recommended. And I think, that's the way I think it will be for next 1 to 2 weeks.
Okay, so stick to individual stocks. Got it, Mitesh? Coming right back to you for those individual stocks. But let's welcome in Sudarshan as well. Sudarshan, morning. What's your view? Any index trades?
Yeah, good morning. Yes, yesterday the idea was to buy on a dip. We have got that dip in the afternoon and today morning, I hope. So I would be a buyer in the Nifty. Our support levels are somewhere around 24,400. So assuming that the entry is where the SGX, as the GIFT Nifty is suggesting, we have a very decent and tight stop loss and the possibility of an up move. So the risk reward ratio becomes favorable. So the trade is wait patiently for the markets to sort of consolidate, cool down in the first few minutes, go long, keep a stop under 24,400.
Okay. All right. Now let's talk about individual stocks. Mitesh, so tell us what's on your list.
Morning, Sulbi. As I said, the FMCG index is the one where a lot of action is happening. So I've got 2 FMCG stocks on the recommendation list. Dabur is the first one, managed to get past the earlier highs. So buy with a stop below 535, 536, and a target of 565 can be looked at. Britannia also made a fresh swing high. So buy here with a stop just below 58.40 for targets of around 6,000. A buy on IGL, which had a good gap breakout. So if you get it on a mild decline, around 215, 215.5. Buy with a stop below 210 for targets of 228. And ICICI Bank is on the sell side on a mild pullback of around 5-6 points, around 1,400. Try to take short positions with a stop just above 1416 and a target of 1360.
Okay. All right. Got it. And Sudarshan, what about you? Which stocks today?
Well, I also have 2 FMCG stocks. Fortunately, they are different names. United Spirits is a buy with a stop under 1,305. Tata Consumers is a buy with a stop under 1,083. Now, for the other 2 stocks, Hudco is a buy with a stop under 211. And Petronet is a buying opportunity with a stop under 272. It's an all-buy list. And as I've already said, look to buy the Nifty.
Okay. All right, gentlemen, thanks very much. We'll come back to you a little closer to market opening. But for the time being, we're putting the spotlight on IT. 2 things. Off late, so far this week, we've actually got some positive notes, some positive murmurs from various brokerages, including CLSA, turning tactically at least a little less negative on the sector. And then, of course, this morning's news is the big one. TCS has signed a big deal. It's 550 million euros. This is the digital transformation deal that the company has signed for 7 years with a Scandinavian insurance company. We've got Sandeep Agarwal, fund manager at Solio Investment Managers. Sandeep, hi, great to have you on, and perspective is, always very, very welcome from you. So, okay, let's start with this. A deal of this size, now these are long deals, right? So I don't know if it really signals anything. Should we read too much into it? I don't know if it's AI or, of what in nature. But really, go back to the same question, large cap IT services. Is there any light? In between, by the way, Infosys set up an AI subsidiary as well. So you tell us, since our last conversation, do you see any positive indicators of change?
Hi, good morning, and thanks for having me on the show. So I will not, comment on any specific stock, but let me put it this way that, the large cap or the IT sector in general
We need to see very clearly in three pockets. Now, I think it will be very difficult for large cap names because of the penetration which is there in the developed market to give very good growth rate. And what I mean by very good growth rate is either a high single digit or a low double digit growth. I don't think those times will be anytime soon. It will be tough to do that. We will see this sector more like 5-6% growth. The mid cap, which have seen, post COVID a 25-22% kind of growth, they will come down to low double-digit growth for next 4-5 years. And probably the small names, small companies which are very few in the listed name, they can really do higher growth because, the sizes of contracts have consistently been falling last 10 years. So in earlier disruptions, large caps were beneficiary. In 2022 COVID disruption, the mid caps were beneficiary. And I think the AI part, I think the small caps will be the beneficiary. And that is the way we should look. And the good part is that, the multiples are reversed. The small cap multiples are lower, the mid cap are the highest, and the large caps are in between. So I think this sector for the large cap is now more or less ex-growth sector. It is not a growth sector.
Okay, so yeah, and that's been your view for many months now. So nothing changes really with some of these announcements that we've got off late, including today's deal that TCS has signed. The other aspect is just how investors, yourselves including, and how would you look at just valuations right now, even if it is large cap IT, with the overall market context in mind. Now, CLSA's view was that if there is a rate cut in the US, which is the base case, then maybe it'll be positive for Indian IT. Discretionary spends might go up, and therefore they're tactically, like I said, they're less negative. Is there a reason to be tactically less negative on IT given its underperformance?
Yes, so this sector also has some positives. They do consistent buyback. They do give a lot of dividend, and as rightly mentioned, that when there is such a long duration of underperformance and such a sharp underperformance, then there is a chance of some revival. Secondly, the way people buy market funds and the ETFs and replicate index and all. In those cases, generally you buy everything. So this sector will also be a beneficiary of that. So in my view, while valuations have come down, fundamentally the PEG ratios have not come down. But at the same time, yes, the underperformance means that, the downsides may be limited. And I firmly believe that this sector will be replacing some portion of FMCG as defensive going forward in next 4-5 years, because at similar growth rate, if you are getting some other sector at half the multiple, then probably, that is the way people will also look at it. So I think that given the underperformance and the correction, it is possible that, tactically this sector can move up.
But I mean, to create wealth here, Sandeep, it's small caps, right? Small cap IT names.
Yes.
Where the focus should be.
Yes, because you have to find out those companies where, there is no middle layer, because middle layer is the one which is right now facing maximum challenge. And in the small companies, what happens is that the number of total employees itself is less. And for them to pivot to, changing technology will be much easier. I'm saying that even the large names like, Infosys, TCS, any one of them would be doing like 20-30x more work on AI and everything. But in overall scheme of the size, the percentage of those changes will be so limited, and it will take so much time to, make a meaningful change, that the first one to reflect those impact of those changes will be the smaller size ones. So I will repeat that, 2022 was something for the mid cap. You will see probably next 2-3 years, same thing happening in the very small companies, it will be very easy for them to do $50,000 or $100,000 projects in AI and machine learning. And so it opens up a lot of clients to them. So that is the big change which is happening.
Sandeep, there's no question about, a few things have happened, right? Last 3-4 months. There was that MIT paper which raised doubts about the productivity. There was that Apple no reasoning paper. There was, of course, Altman's bubble comments and a few other things, all in the matter of last 1.5 odd months. It just sort of, how should one look at this? Just tactical kind of things as in the long journey, which is AI and what it'll do and how it'll shape things?
No, so, I think AI will be very disruptive, and it is already disruptive, because AI basically means that your efforts will go down. But within AI, if you see the big change which is happening within AI, also now people are looking for more and more improved versions of it, because right now it is churning too much of data, which consumes lot of power, which needs lot of computation power. So GPU sales are at like going up substantially. So I think better versions, what will happen is that hardware cost will start coming down, the GPU sales will start coming down, and the power consumptions and other aspects will also come down. So it will become more and more efficient going forward. Good part for us is that, finally this thing will also become a process, will get into process, and that is where we have expertise. So our large cap IT companies after maybe 2 years will also start benefiting out of it. Now, how much will be that benefit? We have to see, because, at the same time, efforts will start going down. So net, what will be the incremental growth rate? Very tough to say, but efforts will go down and realizations will go up, and we will also get work once this things become processed.
Sandeep, just very quickly, I wonder if you've looked at a company called E2E Networks. It's just got this order from Meti. It'll be supplying GPUs, I think. Now, I don't know how how deeply entrenched they are in the AI chain or in the GPU process, which part of it. But it's not a stock advice or idea. But in case you've studied this company or any other small cap, mid cap company that's actually making tangible progress on AI, can you share anything for us with us quickly?
So, I have studied the company, but I won't comment on that. But I can tell you this, that, there are a lot of companies right now in India who are doing phenomenal work in AI. It is that, they are at very nascent stage, so it is not reflecting. And they are doing a lot of collaboration also, and a lot of things are happening. And I am very positive that in next 3-4 years, you will see a lot of companies coming out of Pune, Hyderabad, Chennai, Bangalore, who will be deeply entrenched in this space, and they will be doing parts of it. And I honestly believe that, the GPU is something which has happened. Now we have to look forward. So I think, GPU sales, in my view, what NVIDIA is doing right now, the kind of profits they are making, you will see strong competition coming in there, because finally it is something which people, there are many people who are also working on it, and they are also at advanced stage. But I think the bigger thing will be to do in LLM, and what changes you can do there, what kind of APIs you can build around the agentic, and we are very, very strong in that space. So you will see a lot of companies from India coming in.
Sure.
All right. L&T has 20%.
In E2E Networks, correct.
So that happened a couple of months back. Sandeep, thanks very much. Good speaking with you. Appreciate it very much here. Just a quick recap of the stocks which should be in focus and stuff that we put out. Let's move this along, please. So TCS is the first one, which is up on your screen. $550 million deal. There is Eternal. There's a platform fee hike, which is up about 1%. Indus Towers, of course, I guess dividend delayed even more. Stocks down 1.5% as it opens up. Was down 3% yesterday. JSW Cement on the back of earnings, and just looking at how things have settled in the pre-open. DCM Shriram, Aarti Industries will come up. There's PNC Infrastructure, E2E Networks, which we were just discussing earlier. There's Vari Energies, maybe slightly negative. TBO Tech, of course, is related to the acquisition. Stocks opening up about 12.5% is a recent listing which came through. Sudarshan is with us with what says 910 call. Sudarshan, what do you have?
That's United Spirits, buy with a stop under 1305.
Okay, all right. Mitesh, what about you?
I choose a buy on Dabur for targets of 565.
All right, Sudarshan and Mitesh, thanks very much. 2 minutes to market open. Just want to quickly run through what Investec has to say about Glenmark as well. Ekta is standing by with that. Ekta, over to you.
Well, they have a buy with a target price of 2,510 following the successful AbbVie licensing deal. The next milestone, according to them, could be star 0310. This could trigger a milestone and lend credibility to its specialty pipeline, according to Investec. The triggers also include the U.S. facility Monroe clearance as well as niche approvals in the U.S. The $700 million milestone from AbbVie in September would strengthen the balance sheet, according to Investec on Glenmark.
All right, Ekta, thank you very much for that. Just running into market opening, less than a minute to go, and we will see how trades and rates start to come up. As always, we'll look at the Nifty, the benchmark indices, and we'll go into individual stocks, etc. The big one is TBO Tech. I think we just sort of flashed the rate 12.5% higher. Recent listing, and it's really gone up substantially on the back of the acquisition. Just counting down to the market open should be, slightly higher, flattish, but not very definitive in that sense. Yesterday, of course, market sold off from daily averages. 24,600 is where the Nifty is at. It's flat, absolutely flat. Nifty Bank, I think, is also flattish, 0.1% or change. Sensex is flattish. Small cap index and mid cap index maybe a little better, I think so. So 0.4, 0.5% odd on those indices right now. So not very much directionally right out of the gates. What do we have in terms of the market heat map? How many up and down on the Nifty at least? So it is kind of evenly split, more up though. And Eternal is one of the names we highlighted with news. It's on one end, and on the other end there is Infosys, which is starting. But these are just very, very first rates inside the first 1 minute in terms of market open. 24,600 on the Nifty. Surbhi.
Okay, so it's all about food delivery and quick commerce. Eternal, 1.5% up, and Swiggy is moving up as well, slightly higher, 2%. Remember, Swiggy is anyway charging, I think, 12 rupees as platform fee. Eternal has caught up, and it's now at 12 rupees as well. M&M fell quite a bit yesterday. There were worries about what happens with the GST on EVs, etc. But the stock's recovering this morning, 2% higher. There's some buying in metal names, Tata Steel, Hindalco, both looking up. IndusInd Bank is slightly higher. TCS is reacting positively to that deal announcement, the 550 million deal that they've done in Europe. So that stock's up. SBI has started off at least with a 0.5% gain, and then it really fizzles out beyond that. On the downside, Infosys is the counter. ICICI Bank is the red counter on the lower side. So that's not letting the Nifty make any tangible move, even Lever for that matter. L&T, you have enough big boys who are choosing the red side of the screen this morning. So the net result is not much of a move at all, just about 18 points up on the index. Nigel.
Well, that's right. Some of the big movers that we're seeing this morning, one is UPL. They've undertaken internal restructuring, transferring its wholly owned subsidiary, Post-Harvest Solutions, that's Deco, business to Adventa, at an enterprise value of around $500 million. The street likes that, could potentially be laying the groundwork for some kind of monetization. So that's the way the street looks at it, and that's why that stock is up close to 2%. The reason that TBO Tech is running away is because this acquisition helps them to foray into the North America market. It adds close to around 50% on the base revenues of last year, and on the EBITDA front, close to around a third. And the valuations as well that they've acquired this are pretty much attractive. So that's why that stock is running away. That's up close to around 10%. On the flip side, Indus Towers, foraying into a new market, she doesn't like that. They want to see dividend. And that's why that one's down close to around 5% as we speak. Another loser is Kirloskar Oil. I'm not sure what's gone on there. But that stock is a notable loser on the downside. And you have Vimta as well. Just pull up that stock. Yesterday it was flying away. It was up close to around 20%. Today as well, that stock is up and about in today's trading session, up another 6%. One of the top volume movers today. Add to the list, Ola Electric took a bit of a break yesterday. Today it's back to its winning base. So that stock as well, up 2.5%. Prashant.
Okay, I think, a lot's happening in terms of the opening rates. Let's straight away welcome in Navneet Monod, who's the Managing Director and CEO at HDFC Asset Management. He's with us here in our studios. Navneet, great to have you with us here. Thanks very much.
Entirely my pleasure.
Long time. What took you so long?
Really long time.
First of all, greetings on the Ganpati Utsav.
Same to you.
We are entering the festival economy, wedding economy, and a winter economy. And I will get the GST gift during that time. So hopefully this will turn out to be a very auspicious time for the economy also.
Oh, absolutely. And hopefully somewhere in there, these tariffs also get negotiated lower. I mean, sooner rather than later.
More than the tariffs, I think the world is moving from a unipolar world to a multipolar world. And everybody in the world is recognizing. You pick up global media and you can see the front pages pictures of our Prime Minister with the global leaders. And India clearly as the center of the world in which direction it is moving. So mother of civilization, the largest democracy and the future of planet is clearly going to drive and play a very, very big role in the world that we are going to witness in this century.
That's a super charged up, and that's the way to be, right? I mean, you got to back yourself.
No, clearly, I think last few days we have clearly seen, I think the institutional degradation that has happened in US and the way India has responded, I think 1.4 billion people are very proud of that.
It's come to a pass, Navneet, that even US media, which typically would be completely against, would back the Republican administration, Trump administration. I mean, most of it is now saying, well, this has gone too far. I mean, you're antagonizing one of your oldest and strongest allies in the region in terms of India. So I think there is recognition in the US as well, but I think it's just one man who has to...
I think they forgot that Peter Parker in Spider-Man, with great power comes great responsibility. I think if you are a great power, if you are a reserve currency of the world, if the whole world is trusting you with their money, it comes with great amount of responsibility. I say this to entrepreneurs also. When you raise public money, it comes with great responsibility. You are a trustee. I think same is true for United States as a country.
But Navneet, I completely take your points on the global stage. I think that picture, the all smiles picture with Mr. J, Mr. Putin, the handshakes, I think Washington took very serious note of it.
The Japan has not been as many pictures, but if you ask me, I think they have the technology and they have capital. India has talent and the trust capital. I think together it could be a defining relationship of this century.
Absolutely, absolutely. You know, but now from global politics and geopolitics coming down to the here and now, and I want to get your thoughts on the way the market has reacted to a series of events in the last three, four weeks, I think. And good things have been announced. I mean, that GDP number, 7.8%, GST cuts. But the reaction has been, I mean, euphoria is a very big word, but even otherwise, I mean, there's a sense of disbelief and despondency and that, you know, it's still ambling along. Best case is, chalo, market gir to nahi raha hai. What have you made of the way the market is reacting to what could be big changes? You yourself started by saying that on GST.
But don't you think market has been having a very good belief? There has always been this saying, and this is like Teacher's Day 2 days later, that whenever your driver gives you a tip, that's a time to sell the market. Now I tell people my driver has been doing the sip. He's not giving the tip. And he's the one I look up to now. And the whole world should look up to. I think he's been right last couple of years, just kind of maintaining the faith in the market and not paying too much of attention to the noise from rest of the world.
So from the tip to the sip, that's the transition of the Indian market.
Navneet is dropping all bombs today. I mean, that's a nice one. I've never heard it before.
But I've always said that this nation, this is underestimated. And Prashant, we discussed when I think SIPs crossed 4,000 crores, that I think this nation is transforming from a nation of savers to nation of investors.
Right.
And that 4,000 crore a month has become 28,000 crores a month. And we have seen COVID, we have seen Russia-Ukraine war, we have seen Israel and Middle East, we have seen like oil prices going up, coming down. We have seen many cycles, rates going down, going up, now coming down again. But I think this is a very, very structural transition.
I just want to ask you on the flows part, Navneet, just one thing, right? FIs have sold about $14 billion worth of stock this year. Local money is about, what, $55 billion?
Yeah.
Which is coming, right? 14 versus 55.
So since 2021, mutual funds have invested $165 billion.
But just this year, I just want to say, what is, I've always wondered, $55 billion, it's, you know.
Of local money.
Of local money versus $14 billion of selling. And the market
is still flat. But that's also paper, right?
So what is the, what's the equilibrium where?
I think the two things. We are seeing the flows from the domestic investors. On other side, you are seeing two things. One is that foreigners have sold. And number two, you have seen the primary supply. So there's a supply from private equity and venture capital looking for exits. You have some of the promoters diluting. You have companies raising capital, which is not bad. I mean, how a trade will happen, Prashant. Ek koi buy kar raha hai, somebody has to sell that. And that's where the supply is coming.
Sometimes
next several years, when people tell me with this liquidity, market can go to any level, it won't happen. There is so much of supply waiting to come to the market. So at every rise, with every incremental liquidity, you will see the supply.
Which is also a good thing, because otherwise you can have a blowout top.
Not a good, it's a great thing. The universe is expanding, and Indian markets, I mean, we are already fourth largest in the world. In fact, that would be critical. It is not only the price appreciation, but the new paper that will keep coming. And the new businesses, you have to meet the younger entrepreneurs to...
Urban Company, I mean, they filed their prospectus just now. I mean, absolutely new business.
So many of them.
So much. So we don't track it, but so much money is going into newer unlisted entities.
Absolutely.
I mean, old public market investors have all become venture capital investors because there is, I mean, the breadth of the companies which are out there. So absolutely take your point. Nigel.
Navneet, but good to have you in the studio, Navneet. And, you know, I'm giving your driver company as well. I'm keeping the sips going. And, you know, and my staff as well at home, you know, advise them just keep it going. And now they're saying, sir, should be. So that's what we're doing. That's all great. You know, that liquidity, the entire evolution of this equity cult here in India, that's very, very positive reading. But in the near term, this Trump tariff is clearly, you know, is ruined sentiment. As is, we were underperforming. Now, do you think the markets can still continue to hold on even if we don't get a breakthrough on the tariffs? Or do you think in the next couple of months, the market believes that, yes, we'll get some kind of a breakthrough? Because the GST cut obviously is going to be positive. It's going to help. But I think the single most, you know, the biggest factor right now that can bring back the positive sentiment will have to be some easing on tariffs. Do you agree? Or do you think the markets can climb the wall?
It's not only that. I think we are in a world which is so uncertain that the only thing I can say with certainty is continuity of uncertainty. We really don't know which way the year is going to end. So it's very difficult to predict, Nigel, in next few months where the markets would be. Where a known we know, known unknown we know, but unknown can come from anywhere. You look at last 5 years, the way they have come. What I think that the market wisdom is telling us that in spite of all of these negative news, if markets have held on, it is not only about the liquidity. The market wisdom is telling you that India is a country which is growing at a rate higher than China. Our inflation is lower than Japan. Our current account deficit, fiscal deficit, and public debt levels as a percentage of GDP are lower than America. And our foreign exchange reserves are higher than most of the developed markets in the world. And you are seeing from a $2,500 per capita a clear view for the next several years that with ease of living and the ease of doing business over a period of time with entrepreneurship and a conducive policy environment, you are going to see a consistent long-term growth. This is my view. This is, I think, the market wisdom is saying. And this has brought down the volatility of the market also. With kind of erratic news flow we had, market should have been a lot more volatile earlier. He talked about the FPI numbers. Imagine like a couple of $1 billion, what it would have done at a stock level and at a market level. So it is not only about the liquidity, but I think the policy prudence, I think the agile execution, I think it's the effective communication, and I think the way we are navigating the global geopolitics, it's commendable.
Navneet, you said it, and having a problem is one thing, but the kind of monetary support, policy support, as well as now the fiscal policy support, acknowledging the problem and dealing with it is important as well.
So look at last few months, what we have done. We have cut interest rates more than what anybody expected. Now we are going to do GST cut, which nobody was expecting till few days back. And we have done the income tax cut, personal income tax cut. Now, all of this should lead to what I talked about, wedding economy, winter economy, and the festival economy.
So eventually, I mean, they say
in
that...
In the near term, but structurally in the long run. Yeah.
So eventually they say that, the food for any bull market is liquidity and it's decent earnings. I mean, listed companies with decent earnings growth. Now, given all that you mentioned, GST and the monetary stimulus, etc., because when we talk to foreign investors as well, we were speaking to one yesterday, that's their only grouse. They're looking at China very closely. They've started going back to China. Now, God knows if it's short term or long term, because nobody wants to miss out. When a market is up 20%, everybody wonders, oh, did I miss it? So they're looking at China very carefully, but they're saying, India, forget the tariff issue, forget Trump and 50%. Your earnings are very anemic. So do you see something changing here?
I will say one thing, they're all the grouse against China for 2 years.
Yeah,
nobody wanted to go there.
Absolutely.
The markets were really cheap and they have done well. They surprised positively on policy and markets were really cheap. Money has gone there. I know it's up almost like 40% in last 1 year or so.
And it's all local Chinese money again, which has driven the market higher.
Also the foreigner money as well, which has taken the market higher. I think in India, maybe for a variety of reasons, just that, as I said earlier, that when you have so much of local money coming in, somebody has to supply the paper and they have supplied. The domestic ownership has been inching up, the foreign ownership has been coming down. So a larger part of India is owned by Indians, which is what our wish was in 90s and 2000s. Finally, it's good in my lifetime, I'm seeing that.
No, but from, absolutely, so that's on the flows picture, but from the earnings perspective, I wanted to know if your team is convinced about all the estimates out there, because we've made a habit of starting at 13-14%, then we come down to 8-9%, then we end lower. But is your team of fund managers now convinced that there is a turnaround in the works?
Of course, I think some of these sectors, particularly like consumption we talked about, we are seeing a positive sentiment. And of course, everybody is now looking for the move on the GST in next few days. But you made a very important point. I think ultimately stock price is nothing but the slave of the earning power of the underlying company. And these valuations can only sustain if you see the earnings growth. If you see higher economic growth and we see the higher earnings growth, after 3 years of 20% CAGR in earnings growth, we have seen maybe a period of consolidation last 5 quarters, maybe another quarter or two. From next year onwards, earnings have to fire. They have to be at least in line with nominal GDP growth, if not more, for the next couple of years. And I think that's what the hope is. The one thing I would say is that in last couple of years, market is paying a lot of premium to free cash flow, to, let's say, becoming asset light, to higher return on capital employed. But looking at the opportunities in the world, I think we need to invest more. My message to corporate India will be, you need to take a little bit of more risk. And investors also. Today, investors, I think are shying away from anything which is like a large...
I think that is happening now. That is happening.
There's an acquisition announced, the stock starts falling.
Yeah, it's changing at the margin, which is positive. Look at US. Amazon is going to invest $100 billion this year. You look at like larger companies going to invest in 80, 90, $100 billion. We won't do that. I think we have frugal engineering in India. We'll take advantage of all the investment they will make, like what we did in 90s. We were the best.
In terms of...
I mean, the beneficiary of the investment in fiber and the network and everything.
Navneet, I want one business I want to talk about is the asset management business. And HDFC Mutual Fund, of course, was always this behemoth. And I think you've built it up in an even larger scale, larger way. Stocks done phenomenally well. I was just, last week or 2 weeks back, I was just joking that there are only 2-3 sectors where you have visibility of very strong sort of earnings growth, durable earnings growth. And asset management companies were one of them. I just wanted your thoughts. Is it, as a space, do you think it'll... the runway is higher and long as you see it?
Well, the policy environment is supportive. I think the overall macroeconomic backdrop is very supportive for us. The point I made on the country transforming into a nation of investors is very supportive. This is a structural trend. 75 lakh crores of AUM is around $800 billion. This is where United States was in 1988. By the end of 90s, they were close to $4 or $5 trillion. So that has been the trajectory that we have seen in US. In many ways, the trajectory of asset management industry in India in terms of growth potential can be looked at as what has happened in US in 80s, 90s, 2000s. And these are like very early days. It's just that we have got 55 million investors, so a long, long way to go.
And you got newer instruments also being introduced, right? I mean,
absolutely, yeah.
I mean,
it's been and over the next couple of weeks, we'll be starting the whole new series with you in terms of how do we take the mutual fund Sahiya message to the masses, and how do we convert the awareness into the action. The why we still have only 55 million investors, that number can multiply. Why the average ticket size of SIP is less than 3,000 rupees, that number can multiply. So still long way to go.
And just, to ask in terms of size and scale and opportunity, you've laid it out. We have now, I think, over 50 asset management companies in the country, right? And more keep filing, more keep coming in. How will that impact the growth and the competitive dynamics, the spends on whether it's distribution, etc.? And what do you expect on that trend? More and more AMCs coming up.
25 years back, when industry was less than 1 lakh crore, there were 30 players.
Okay. So then
it hasn't really increased that much. It is also maybe, I would say, confirmation of our positive view on the industry, that a lot of people think this industry has a huge runway for growth. So that's positive. We welcome everyone. But the second point you asked was on...
what that will do in terms of just operating costs, the hunt for talent, distribution expenses, because I'm sure it does get competitive.
I think many things. The asset managers who have made it big, what they've done right is, I think, delivering a great experience to the investors in terms of investor performance. I think they have investment management, risk management, and product management capability, which is world class, and at the same time, it is backed by the franchise, governance, and the distribution network. This is what we have built painstakingly.
So space for all, absolutely. So Diwali is coming. The bumper GST announcements have been made. Anything else from the government, from the Reserve Bank? Any other Diwali or New Year bonanza?
I think they have been, they have pumped in a lot of liquidity. The CRR cut will also enhance the overall liquidity, particularly in the busy season for the credit growth. I think what everybody is looking at, that RBI has done whatever it can. They've taken the horse to the water now, can't make it drink. I think the supportive environment, what the government is doing in terms of GST, in terms of some of the other measures, and what I think what we are doing on the geopolitical side to kind of build up newer relationships. Tomorrow, Singapore PM is in India. What we are doing with Japan, China, Russia, many other countries, and some of the FTAs have been signed. And I read the front page today, like Commerce Minister had mentioned that the US-India may not be too far. So,
Navneet, great interaction, and come more often, I must say. Really charge all of us up. And
it's needed. So positive now.
The dose is needed once in a while.
Don't fight against the might of a billion people.
Whoa.
Billion and a half. So thank you very much, Navneet. Appreciate you joining us, and lovely interaction as always. I just want to take a quick, look at the market, which is kind of flattened out, absolutely flattened out for now. And what do we have? 1,800 stocks are higher, about 700 stocks are lower. It is MobiKwik is up about 6.5% once again. So it's turning out to be a fantastic day so far. But it's not alone. TBO Tech we highlighted. And there's one more name, which is Moil. Moil is up 6%. Nigel, what's happening here? Tell us more.
Well, yeah, Moil is up because they've come out with their operational update. And for the month of August, in fact, it's up by close on 17%, the production number. So the street likes it. But the brokerages, sell side, they're still a little bit skeptical about them going ahead and achieving a big guidance from year on, because this growth has come on a lower base. And year to date, actually, the growth is up only around 9.5% approximately. So they'll have to keep this momentum up to continue with, continue and achieve that guidance that they sent out earlier. But the reading for August is good. It's coming on a lower base. They have cash in their books as well. So for the time being, the street is headed positively. But as we've seen in the past, it'll be interesting to see whether or not it can hold on to those gains of around 6.5%. For the time being, the street likes what they see. Let's focus on the big mover this morning, though. TBO Tech, the acquisition has gone down well with the street. Mangalam, tell us more.
Well, the street likes it. It's the acquisition season right now for some of these companies. We have a Classic Vacations. There's a US-based company that TBO Tech has decided to acquire for about $125 million, roughly converted to 1,100 rupees. And Classic Vacations has a network of luxury travel advisors and suppliers. And if there's one thing that we know about the travel industry right now, is the luxury segment, which is doing extremely well. So if you look at their performance, 2024, because it's a US-based company, they follow the calendar year method. The revenues were close to around $111 million, which is roughly one-time sales that the company has given. And the EBITDA is $11.2 million, which is roughly, again, 10% margins. The only thing we need to watch out for how TBO Tech scales this, because basis TBO Tech's own revenue of 1,737 crores the last year, this deal itself could aid their revenue by 55-56%, but won't be margin dilutive, because last year they did margins of 16% and this company has margins of just about 10%. They also had cash and equivalents of close to 1,285 crores. So basically, they're exhausting nearly their entire cash to go ahead and make this acquisition. So what they do with this big bite that they've taken is a big question.
All right, Mangalam, thank you very much for that. TBO Tech, 13% higher, holding on to gains that had started. We'll take a quick commercial break here. We have the management of Zydus join us on the other side. So stay tuned. That's a conversation you don't want to miss. A recent acquisition, market reacting quite favorably to it. Stay tuned. Okay, welcome back. 15 points lower on the Nifty, and there is a big order. Man Industries, 1,700 crore order for the supply of coated pipe stocks, jumped about 9%. The intraday, I think, will show you what's happening there. Maybe just a few other names, right? We highlighted Moil and TBO Tech and MobiKwik, etc. earlier. Maybe put these up as well. NetWeb is jumping up on very large volumes, stocks up about 4%. There is Jindal Steel, which is up 3% right now. E2E Networks, which Surabhi highlighted in the morning, is up 10%. So it's limit up E2E Networks. There is, what else? Reliance Infra is coming up with a 4% pop, 290 on it. It's got volumes as well as, of course, had a large fall recently. Edelweiss, there was a large block deal and 3% on Edelweiss, 114 rupees back on the price. Acme Solar is coming up with a 4% gain. Stocks at about 299 as things stand right now. And there is Tejas Networks, a completely bombed out name, Tata Group company, but it's coming up with about a 4-5% odd kind of a gain at this point in time. There's more stuff, but Coromandel, rate gain is again coming back from, again, bombed out kind of levels, right? 10 days back, stock was at about $400. It's at about almost 570 now. So that has seen a very large, move coming through in the last fortnight or so. Of course, rate gain fell from very high levels as growth rates faltered and the guidance was cut massively over the last 3 or 4 quarters. But it's seeing a bit of a pop. I'm not sure if something is changing once again here at the margin. On the downside, Indus Tower is, of course, become the top volume-led loser, something we highlighted in the morning. It started with about a 1.5-2% cut. It's down 5% now. So that's huge volumes, by far the number one volume-traded loser. Phoenix Limited, there was an upgrade yesterday. Stock did well, is down 2.5% right now. Zuari, Sept, Castrol are some of the other names which are coming up with some volume as well, but nothing very large. I think we've got the management of Zydus Wellness now joining us. They've acquired UK-based Comfort Click for about £240 million. We have the CEO, Tarun Arora, now joining us. Tarun, good to have you with us here. We're going to talk about 3 points here. Let's just quickly go across to Tarun. So we'll talk, of course, about the synergies behind the Comfort Click acquisition. We'll talk about the pickup in growth post the first quarter, which was kind of weak. And, of course, revenue scalability in international markets as well. Tarun, good to have you, and thank you for joining us. So the first point, the logic, the synergies behind the Comfort Click acquisition.
My pleasure to join CNBC. I think if you really look at it, our journey on consumer wellness has covered a broad spectrum of spaces, broadly under 2 heads: food and nutrition on one side and personal care on the other side. Food and nutrition has been our largest space and provides a lot more opportunities on expanding wellness space. Specifically, if we focus on nutrition, we acquired last year RightBite, which was basically a max protein sub-brand looking at macronutrition. We obviously recognize that there is opportunity to build further on the micronutrition. Therefore, the VMS segment is something we've been fairly keen on building forward. So there have been several thoughts around it. So it's one space that we were looking at. Secondly, as the world evolves and the ways of consumer behaviors are changing, and the digital space has become extremely crucial for us to build on. So that was the other tick mark that happened. And third was complementary geographies. They're largely a Europe online first VMS brand and doing rather well, growing at more than 50% over the last 5 years as a CAGR. So very successful business built on a very basic fundamentals, amazing set of products. So we said this really fits in from all those points that I mentioned. So a great tick mark from our strategy forward, and that's how this happened.
Tarun, no, that's very well explained. We have more questions. Can I request you, Tarun? The line's a little shaky. If you can ask, I think you're in a car, but is it possible for you to just sort of just park on the side of the road? I mean, the reception will be better. We can hear you clearly, but your video is a little patchy. Nigel, go on.
All right. Hi, Tarun. Good morning and good to see you. Ben, could you give us, a little bit of a sense in terms of revenue scalability? Comfort Click has moved up to around $130 million from just around $50 million in 2 years. How do you see the revenue scale up from here? If you could give us, say, a 2-3 year horizon from here. And margins as well, I think it's in mid-teens. Do you see it scaling up even further from here?
So, so we do believe the growth trajectory is consistent even for going forward. We don't give any specific trajectory, but our own view is that it'll be a high double-digit growth even here on as well. And
there is enough and more potential within the European markets. Comfort Click also got into US market, and there are multiple opportunities. If you really look at it, there are many other markets that we could extend Comfort Click to. I'm not just counting India as well, but it could be Middle East, Brazil. I mean, several other markets. So US itself is such a large market. So we look at all those. So our view is that a growth journey will continue and at a high double digits. Going forward as
but
well.
the entity
from a margin perspective, I think
yes. Tarun, the entity is growing at 50-60%. $53 million has become $134 million. So double digit is being very, very modest. Do you think it can continue the kind of momentum that it's been growing at? And also, if you could tell us with regard to margin moving up from here on.
Yes. So I'm saying will remain consistent. Now, numbers are very hard to not commit, but double digits will stay.
I think it's just a bad line. Can we put Mr. Tarun on the phone line? If we can, let's do that. Because the audio, the video quality, and I think now the audio quality is also a little poor. But that's an important conversation. I'll just wait for 2 minutes before, if you're able to do it. What do we have otherwise? I mean, markets down about 25 odd points, and 1,900 stocks are higher, about 700 stocks are lower at this point. So, market breadth is looking positive, and of course, I mean, some of those names we've highlighted continue to do extremely well at this point in time. Indus Tower, I mean, if you can pull that up, a lot of hope, a lot of expectation, and a lot of believers in that name over the last actually 1.5 odd years. But I think, that, and of course, the dividend postponement was the first big blow. The stock took a big hit. Expectations started building in once again that it perhaps is coming. It's delayed, but now it'll start. Investors will see the dividend. But I think now, with of course what's happening in Africa and the plans, etc., as Rima highlighted, that investors and of course brokers who cover the stock have also taken their price targets down 1 or 2 pegs. Kirloskar Engine Oil is another one which is down about 3.5%, and Zensar is down about 3%. Or so. I think, guys, we have Tarun back if we have a question. Nigel.
Yeah, all right. Tarun, you're making that point. You said that it's difficult to give a number, but the question was, can Comfort Click continue growing at the similar momentum that you have seen? And you were also giving us a number in terms of margins. Please go ahead.
Yes. So our belief is that they've grown at 57% 5 years.
Yes.
We hope that we can continue. The momentum is there. The numbers will be a function of the market and opportunities, and also how new markets shape up. But the momentum continues, and we do believe there is more opportunity sitting there. So we are working with the team to see how we can. On the margin front, it's quite this marketing is an expensive proposition, but we hope to further look at operating leverage flowing out. So right now we'll hold it at mid-teens, but maybe 6 months or 12 months into the business, we should talk about what are further opportunities. But right now I'll hold it at mid-teens as it is.
Mid-teens. All right. And you think that in the next 5 years, the business can be a $500 million revenue opportunity?
We sincerely
mathematically it appears possible.
Global market is huge. Market is huge. The possibility absolutely exists, and new markets that we are extending are even bigger. So if we get it right, we can get there.
What is the current share you get from international revenue from the international markets? And post this acquisition, where do you see this scaling to?
So currently our international markets account for 3 to 4%. Post this acquisition, it's almost half our current business, or assuming a 1/3. So about 33-35% is where we'll land up this year at. And then we'll see here on how the things shape up.
Sure. So the goal would be to take it to what? In terms, if you look at a mix.
So I think we've already, got our mix very well. Now, whether it lands up at 40-50% or the Indian momentum also picks up is something to see. But right now, this business is growing at a much faster pace than the India business. So the mix may change in favor of the international business.
Okay.
over the coming years. But we'll have to wait and watch how it happens.
Right. Got that. Tarun, thank you very much for joining us, and appreciate you joining us on, of course, the phone line now, but hope to see you here in the studios sometime soon. Good luck with that acquisition as you execute this one. Survey.
A very quiet market, really. There is little cheer. I mean, the GST meeting starts today, but I think the market's just waiting and watching to see what the final rates really are and then take a view on which way to go. Trent is under some pressure, down about 0.5%, and Infosys is down a little more than 1% at this point in time. But the metal stocks are really fired up. Look at Tata Steel. It's the index winner now, 1.5% up. Hindalco, 1.4% higher as well. Even JSW Steel. So it's really metals all the way, looking good. Okay, for the time being, let's put the spotlight on the automotive space. Tire maker Sept has completed its acquisition of Michelin Group's Camso. This will increase the company's overall capacity by 15%. Our colleague Parikshit caught up with Arnab Banerjee, MD and CEO of the company, and started off by asking him about the acquisition and what their growth plans were going forward. Take a look.
Off-highway tires had always been at the top of the heap as far as capital allocation goes. And globalization was another interesting trend that we were trying to tap into. And of course, selling more premium tires. So it ticks all the boxes, the Camso, OHT, compact tire and construction, compact construction tires and tracks business. It is premium and it is mostly sold in EU and North America, and it is high margin. So it's going to add about 10% roughly to Sept's turnover right away. The current plant that we have acquired has capacity utilization of just about 50%. So there is a lot of scope and headroom for further growth from this plant itself. And of course, when we acquire the brand 3 years hence, then a lot of other categories will open up for us, and we have to invest further to tap into those segments as well.
Right. Just to ask you again, how does this increase the overall capacity that Sept has currently?
This plant is about 250 tons per day. So this is roughly about, you can say, a little less than around 15% capacity is getting added overall to Sept's current capacity.
Right. I would also like to ask you that in terms of global markets, how does this increase your exports? What is the kind of increase that you are expecting on an annual basis?
So today our international business contribution or saliency to our overall business is about 19%. With the integration of Camso business on an annualized basis, this will go up to 25% straight away.
Okay. Just to also ask you about whether Sept is considering similar acquisitions in this fiscal. Are you considering more acquisitions in other markets?
Well, this is going to cater to North American and EU markets. As you know, OHT is at the top as far as capital allocation goes, followed by passenger car tires, followed by actually two-wheeler tires, then passenger car tires, and then truck bus radial. So that's the hierarchy. We would be looking out for opportunities, but our first task is to integrate this business well and grow from there. But we will be proactive henceforth to look at opportunities which we can bite.
From your statement, it is clear that you would be investing about $171 million in the Sri Lanka market. How is this funding being generated?
So right now, about $137 million has been transferred to Michelin. Not all of them have gone to Sri Lanka. But broadly, 70-30 is the funding, 70 debt and 30 equity.
Okay. Overall, what would be your demand outlook for the domestic market currently?
In India, the demand outlook, as I have maintained, is fairly robust for truck bus radial, which is roughly at mid-single digits volume-wise. The passenger segment, four-wheeler segment is somewhat subdued, very low single-digit growth. And two-wheelers, especially scooters, also motorcycle tires are doing very well, very close to double-digit or high single-digit growth. supported by very strong rebound in the rural markets.
The proposed GST changes, how do you stand to benefit from this?
Well, we don't know for a fact what these changes will be, but if it comes down from 28% to 18%, I think that's a very, very good input for long-term growth of the entire industry in the country. And we are looking forward to it happening whenever the changes take place. There'll be short-term adjustments in the market because the price to the consumer will go down to that extent. But I think the long-term view is very, very strong.
Right. 50% tariffs by the United States and ongoing trade tensions with the US. How is that impacting Sept, and what kind of recalibration in strategy have you had to undertake?
So our total exposure to the US market is less than 3%, or just about 3%. Out of that, 25% is actually the auto component duty, which is applicable on truck bus radial and passenger car radial, and 50% reciprocal duty is applicable on off-highway tire. So off-highway tire is about 1.25% of our overall business, not much. So that will come to a standstill if it continues at 50%. But for the rest, I think we are not very uncompetitive with the rest of the world. We are actually at par with the rest of the world because it's a category level duty of 25%. So we will continue to explore growth in passenger radial and truck bus radial in the US market. Sri Lanka, from where Camso will operate, has a duty of 20%, which is again at par and very competitive with other similar markets like Vietnam, Indonesia, etc. So we'll continue exploring the US market for further growth for OHT from Sri Lanka.
Right. That is an important point. You will use other markets to manufacture and export to Sri Lanka to US as well. And overall, if you were to be asked about growth in FY26 in light of geopolitical uncertainties and the demand sentiment in India, how would you peg that, and what would be your outlook at this stage?
So Q1, we have grown by double digits, and we expect to continue this momentum through the year and end the year with a double-digit growth. There'll be some headwinds when the GST changes happen, as we expect. Maybe a couple of months, the trade will downstock and adjust to the new regime. But again, the growth will be stronger post the drop in GST rate if it were to happen. So I'm overall quite bullish that we should be able to deliver double-digit growth through the year.
A flattish start to trade. The Nifty is holding more or less flattish. The good news today, though, is the breadth of the market. You have close to 2,000 stocks that are advancing and just 600 stocks that are declining. So that's what will be making your portfolio feel good. Vijay Rajani, the senior technical and derivative analyst at HDFC Securities, joins us on the show. Hi, Vinay. Good morning. Good to see you in. What's your view on the Nifty? Do you think we are closer to the lower end of the range and you look to buy the Nifty? And also fill us in with a couple of trading picks.
Yeah, good morning and thanks for having me on the show. So definitely the broader markets have been doing good despite the sell-off yesterday we saw from the higher level. Nifty fell by more than 200 points, but broader market did not fall. And in fact, some of the sectors and stocks keeps on moving higher. So breadth has been positive. That gives us the sign that there should be some positive bias, and at the lower level we should find support and bounce back. So overall, we are advising that unless we see a Nifty closing sustaining below 24,400, trade should be on the higher side only, and we can expect some sector and stocks to continue to do well. So 24,400 is a trigger level which should be utilized as a stop loss in the trading long position. And yes, there is a resistance around 50 days EMA which is placed around 24,800, above which the momentum will come back to the in the favor of bulls. So right now we can say that Nifty is oscillating between 24,800 to 24,400, and above and beyond this level we can expect some momentum to come back. Till then we can trade stock specific and sector specific. But yes, overall bullish bias is there. Some sectors are performing well. So selectively we can do a bullish trades in the market.
What about stock picks?
Yeah, so I see some strength in the railway stocks and some defense stocks. So BEML is the stock which is having exposure in both segments, and PSU stocks has also started doing well. So BEML can be traded long around 4,100. Stop loss I'm suggesting around 4,000 for the short term.
4280 should be the target in BEML in next couple of sessions. The second pick I would take is the PSU Bank. So Indian Overseas Bank is looking quite strong. It has reversed from the lower level and now showing strength with the volume. So around 39.85, one can go long in IOB. I would suggest a stop loss at 38.5. On the upside, I'm expecting a target of 42.80.
Okay, Vinay, we'll leave it there. Thank you very much for joining us. Good speaking with you. Appreciate it. We'll take a quick commercial break here. We're going to come back, more markets on the other side. Stay tuned.
Welcome back. Well, one stock that we highlighted yesterday in our morning chat was MobiWik. You know, the stock is a beaten down stock. Pull up a one-year chart of the stock. It's far cry away from the highs. The only thing was there was a pending block trade from Adya, which got cleared out. And post that, you know, just take a look at the stock still after the kind of rally that we have seen of around 22% just in the last two trading sessions, it's still up only around 5%. So it's a far cry away from around, you know, that 640 rupee odd mark that we saw earlier. But it's bouncing back post this, post this clean out trade, and also that commentary that the management has given that things will start looking up from FY28 onwards. And if you look at it on EV upon sales, well, it trades at around 1 times or thereabouts. So I guess that's another factor that's playing in that favor. Let's take a break from the equity markets, focus on the commodity markets. Manisha Gupta joins us as always to tell her what is she picking up. Manisha.
Well, I'm looking at precious metals really because can't take your eyes off that. Today's the third straight day that we are looking at all-time highs continuing in case of gold, and the Indian markets have seen all-time highs yet again for silver. So until time, we're looking at $3,547 an ounce as an all-time high in the international markets for gold. And with that, it's 35% up in 2025 till time. There is a support to flight to safety, and that is what we are seeing in many of these precious metals, the way the money seems to be churning in here. And then apart from that, there is broader political and economic risk, which seems to be supporting markets. It also has to do with the tariff concerns. Remember, 50% on India. There is some premium that we've seen building up onto this as well. The rupee depreciation has led to Indian markets see higher prices than what we are seeing anywhere else in the world. The expectations of US monetary easing really seems to be doing the trick. As of now, there is nearly 90% probability of a 25 basis point rate cut for the month of September. And then you have banks and brokerages talking about 2, maybe 3 rate cuts. And that is what seems to be fueling the gold rise there. The markets also have seen diversification away from the US dollar into gold. When you look at all of that central bank buying in sense of forex reserves, gold clearly tops that list. The support also seems to be coming in from the dollar index, which is trading at a 5-week close. Most of these commodities are dollar denominated, and the decline in dollar and treasury yields also has been quite supportive there. So it's not just about gold really, because silver prices in the international markets also are trading near 14-year highs. So if gold has gained up by 35%, you have silver up by nearly 41% in this year until time. And then it's not just about silver as well. Most of the other PGMs are doing quite well. If you look at platinum prices, those are trading at an 11-year highs. Pardon me, and platinum prices have actually outperformed overall precious metal prices. We have seen gains of 57% onto that one on a YTD basis. Well, where is gold headed from here is a big question that the street seems to be working with right now. We have a report from Standard Chartered overnight, which is anticipating that the prices could be headed to $3,700 an ounce by the end of this year. You have 36 and 3,700 kind of levels also coming in from Citi and Goldman Sachs, and then it is about 3650, 3675 is what JP Morgan and Bank of America seem to be putting out in sense of forecast. So even as we're trading at 3550, it is about higher highs in the fourth quarter of this year that the banks seem to be working with.
All right, Manisha, thank you very much for that. We're going to focus on Indus Tower one bit more. Stocks down about 5%, large volumes as well. Winnie is here to put the spotlight back on this one. Winnie, over to you.
Hi, good morning. So Indus Towers today, what is the news flow that came in? The board has approved the company's foray into African markets. They'll be starting with Nigeria, Uganda, as well as Zambia. Now, this is not a bad news flow, but why is the stock falling today? Because investors are concerned about the dividend payout. Now, this could maybe delay the dividend payout that would come in for the company. Now, what is CLSA saying? They have high conviction, outperform rating for the stock, but they've cut the target price to 520 rupees from previous 595 rupees. They said that this was on expected lines. They expected the management to actually focus in terms of improving Indus's capital structure by paying high dividends. Now, that will happen, but it will be at a delayed pace, and that is the concern that investors are highlighting. Even Citi is saying that, right now, maintaining the rating, maintaining the target price at 460 rupees, but the delay in payouts, Vodafone Idea, sustainability and Bharti's slowing rollout appears to be a bit overdone, a bit of a concern that's coming in over there. They've given a bear case scenario as well where they're valuing it at around 300 rupees. But as of now, value proposition for Citi is not bad. They're maintaining the current valuation, seem favorable versus peers. The concern that they're highlighting that, not a concern, a positive that could come in for Indus Towers would be if there's a government relief that comes in for Vodafone Idea, then that would lead to a positive benefit for Indus Towers, but that is what everyone's keeping an eye out on. As of now, investors concerned about dividend payouts.
All right, the stock's selling off a little bit. Vinny, thank you very much for that. We'll take a break here. Indianomics coming up on the other side, and Lata in a very special conversation with Dr. Saurabh Garg, the Secretary at the Ministry of Statistics and Program Implementation on the first quarter GDP numbers. Stay tuned.
Welcome to Indianomics. The first quarter GDP came in at 7.8%, much higher than Reserve Bank's forecast of 6.5% for the first quarter, market estimates of 6.8%, and the budget estimates of 6.3 to 6.8 for the full year. Now, while some of the positive surprise can be attributed to a 52% rise in government capex in first quarter, rural prosperity because of excellent rains, economists say some of the positive surprise is because of the ultra-low deflator of 0.9%. This very low deflator explains why the nominal GDP at 8.8% is 1 percentage point below last year's 9.7%, but real GDP is up 1.3% over last year's 6.5%. To understand how the NSO calculates the GDP and what inflation indicators it uses, I have with me perhaps the best expert on the field, Mr. Saurabh Garg, Secretary, Ministry of Statistics. Mr. Garg, good morning, and thank you very much for sparing time for us.
Good morning. A pleasure to be here.
Well, so first, the economists charge straight away, let me start with that the low deflator is making the GDP look a little better than it is. Can you take us through how the MOSPI deflates or inflates the GDP collection?
Yes, of course. So for the quarterly estimates, we use the benchmark indicator method. So we have a set of indicators. For example, for crops, we have the production estimate on the agriculture side. On the fuel side, we have the production of coal, petroleum. We have cargo handled and a host of such indicators that we use. Some of these indicators, we have the production values or the volume indicator itself. And in some, of course, it's the value. So for those where we have the volume, we in fact inflate the actual numbers to get the nominal value. And for the value ones, we use a deflator. So around 40% of the total quarterly GDP that estimates, you calculate, around 40% we use volume estimates, and therefore we are first calculating the real GDP and we inflate that to get the nominal GDP. In the balance, we deflate it.
Okay.
Now, what is the deflator that we use? It's not that we use the entire CPI or the entire WPI number that you see. In the CPI, if you notice, we have a number of sectoral indicators. We have for housing, we have for education, yes. We have for health, and similarly on the WPI side also, we have inflators for manufacturing and other goods. So the sectoral indicators are used for that particular sector. So that, for example, if you look at the WPI sectoral indicator for fuel and power, it was in fact negative. For food, it was at a lower at 1.76%. And a combination of this is what is used, some to inflate and to get the nominal number. Where we have the nominal number, we use it to deflate. Now the question that has been worrying a lot of people is why did we use such a low deflator? And that's a function of the actual inflation rates in the first quarter. So, and that's a direct result of the number of fiscal and monetary policies of the government. Let me just give a few interventions that the government took. For example, under the Bharat brand, since October 24, there have been retail sales of atta, rice, chana dal, etc., which is keeping food inflation low. There were stock limits introduced on wheat. There was reduction of customs duty in pulses and oil. There has been diversifying of fuel sources to keep prices in check. So therefore, and plus on the monetary side, of course, you are aware of the 100 points drop in the repo rate since the early this year. So if the inflation rates are low, they get reflected in the deflators, which I think is but natural.
Okay. No, that's a fair point, sir. A lot of effort, and even nature has blessed us with good rains, and even global WPI prices of metals, etc., were low. So that point is taken on WPI being negative. The question that I get from economists is that our GDP is composed 57% of tertiary sector, which are services. Many people consider even construction as a service only. So that makes it 66% coming from services. And we are deflating most of it with WPI, which, may over-deflate. Is that a worry that we are therefore, looking at a higher... because tertiary sector has given over 9% growth in real terms. And that may be because we are not deflating it enough. We're deflating it with WPI.
Yeah. So first, as I mentioned earlier, nearly 40% of the economy on a quarterly basis we estimate on volume indicators.
Yes.
Where in fact we calculate the real GDP first. So there's no deflator used in that, and there's no issue at all of whether the deflator is correct or not. So nearly 40% is that. And that includes some of the services also. For example, whether it's transport, construction services. Construction comprises a majority of cement and steel, which determines the cost of these services. In transport, we have the volumetric growth in rail, road, air cargo, etc. So some of the services do not need a deflator, and we calculate the real growth. Some of the services are captured in the CPI, and we use the sectoral deflator for that inflation index, health, education, some of the personal services, for which we have the relevant CPI for us. And in others, some we use the WPI. Let me just take trade services. The price of trades is based on the volume growth of goods, for which we have a very clear indicator, the volumetric growth. And it's only on top of that is the price of trading, if I can put it that way. And financial services, which form a significant part. Internationally, whether it's the IMF or the UN system, the non-financial sectoral deflators or an implicit deflator is used because a large portion of the financial services comprise of banking services, which are deflated and suggested to be deflated using such a sectoral non-financial deflator. So I would say it's incorrect to say that the entire 60% is being deflated by using a single number of WPI, when actually the actual story is much more granular, and we have adequate number of deflators. Obviously, we can make improvements in that, but I think we need to realize how actually it is done.
Now, I take your point, sir, that, internationally it is accepted. It is just that we have a large services component in our GDP, and we don't have a large services component in WPI at all. It is in WPI it is zero. In CPI, it is about 20%. So it looks inadequately deflated. But before I come to what changes we can, I just want to tell you what I get from the groundswell. If you speak to FMCG companies, and I didn't speak to any individual company because they could be mucking up their business. I spoke to Nielsen. They say that in the first quarter, the volume growth of FMCG consumption was 6%. Value was 9%, which is, nominal GDP. But volume, which is real GDP, was only 6%. Whereas we have a 7.8% growth. So it is not gelling with the real. Why is it not being felt at the ground level?
Yeah, so let me look at some high frequency indicators, since that what. Look at gross GST collections in Q1 of FY 25-26 compared to year-on-year last year, the Q1. For example, in April, we had 2.37 lakh crores, and if you look at the 3 months, April, May, June, compared to April, May, June of the last financial year, there is an 11.8% growth in GST. And GST comprises a large proportion of the economy, and our nominal growth is only 8.8%. Look at another indicator, e-way bills. In 25, it crossed for the first time the number of 12 crore, and in fact in July, it has crossed 13 crore. But you look at Q1 growth in e-way bills, April, May, June of this year compared to last year, it's a 20.5% growth in e-way bills. Look at another highest frequency indicator, UPI transactions, which in a way capture the velocity of money to some extent. August 20, of course, August this year, we crossed 20 billion transactions. In July, it was we crossed 25 lakh crores. But year on year, quarter, if you compare with last year's quarter, it increased by 21.6% in value and a whopping 37.5% in number. Now, these are three economy-wide indicators, high-frequency indicators, which actually show what kind of transactions are happening. So if you look at it in that context, and you look at, for example, what the industry brings out. I mean, we don't bring that out. That's the PMI of manufacturing, the PMI of services, the business analytic index. You look at all those numbers, and they are at 10-month highs, or the growth is extremely positive. I take your point that in the FMCG area, even the IIP shows a low growth. If you see the numbers of May, June, and then July, they are increasing. So there was a slight downward numbers in FMCG, but even they are improving. So the point I'm saying is you need to look at other indicators, and as a whole, look at how infrastructure has been doing under the IIP numbers also, and they are extremely healthy. So there are large parts of the economy doing extremely well, and 8.8% numbers of nominal growth have to be seen in comparison with the growth in GDP of nearly 12%, e-way bills of 20%, UPI transactions of 22%.
I take your point. Actually, PMI is at a 17-year high for the month of August itself. So, much depends on what indicator you want to pick. We have a lot of corporate guests coming in. We have industry experts coming into the channel. We have bankers, and bankers keep saying RBI has given us a lot of money, but we don't know whom to give. Most people are not, checking our requirement in terms of creditworthiness. So there are those, worried voices as well. But I just want to tell you again, coming back to, getting the services deflator right. I know that you have set in motion a lot of new ideas at the MOSPI. Are we going to have a PPI index? The advantage of a PPI over WPI is because a little bit of services comes in. Producers give you the price that they are getting the inputs at, which includes logistics, warehousing, transport, etc. So services gets included in PPI. Are we transiting to it so that we get services included?
Yeah. So on the PPI, it's definitely desirable to have a PPI, and there is an expert group working on it, and it's made some considerable headway, and we expect that to happen soon. But let me put it out there that the WPI that we are calculating since 2011-12 had substantial changes from the one that was calculated in 2004-5 or earlier. And one of the basic changes done was that the WPI is calculated at the ex-factory price, at the basic price, and the taxes, indirect taxes, were removed from it. So it is not dependent on fiscal policy changes that might occur, but it is at the basic price. And the sectoral WPI that is calculated, that is identical to the PPI that would be calculated. The PPI, in addition, would have export prices, the export product prices. So to that extent, there will be some difference. And the WPI that we use, which is item-wise or sector-wise, is based on ex-factory price. I just wanted to mention that issue so that that clarity is there. And the second issue, which you alluded to earlier, is regarding the proportion of representation of services in the CPI. The CPI is calculated based on the products or services that consumers actually purchase. And it is based on the household consumption expenditure survey. So nearly 1/4 of the present CPI has services. There are in fact 62 items of services which are aggregated to 40 types of services in the present CPI. The base revision of CPI is underway and is expected early next year. And the weight would increase. And more importantly, the number of services would increase. There would actually be somewhere more than 92 odd items of services and 50 types of services. And I mean, let me just make one more point. For example, trade services, as I mentioned earlier. are based on the volumetric growth of the goods.
Yeah.
And we have good proxies for some of the services in the area, whether it's construction, whether it's transport, and as I mentioned, financial services in any case globally have a different method of looking. So we should not look at it services as an omnibus. We have areas where there are good indicators and some areas where some improvements can be made.
No, I take your point, sir. I read through your 2017 document and, number of minutes of telephone used, number of subscribers, all those are there in communication. Railway tonnage moved, railway kilometers, passengers. So there are a lot of very legitimate volume numbers that you have. But as you pointed out, this volume is only available for 40% of the GDP. For the remaining, we have to go with NSE, BSE, corporates. Okay, let me get another point in. The other issue is this double deflation. In some countries, they deflate the input prices, output prices, and get the value add. We are only deflating the top line. So the manufacturing, for instance, is a strong 7.7, something which didn't gel with the Economist poll that I did. So is there a double deflation also that we will include in the revised GDP?
Yes, I mean, that is something that we are moving towards, having either a double deflation where data is available or a volume extrapolation in which you calculate the real value of the GDP in any case initially and then go to the nominal value. On the double deflation, I must mention that it can go either way. It's not that always it will mean that the GDP is overestimated, because what do we do in the single inflation? We look at the GVA that is there and then deflate that based on the output prices. So based on separate how the movement of prices might happen separately on the input side and output side, the double deflation does not necessarily always mean that there would be a reduction in the real GDP compared to the normal GDP. So I think that realization should be there. And the second, in 40% of the GDP, in any way, we calculate the real GDP values.
Yes.
So therefore, the errors, if at all, there might be, it's not substantial to have any reasons to doubt the value of the real GDP growth, especially given the nominal numbers in other cases that I mentioned earlier.
No, I take your point. Actually, I overestimated it. I put that volume and constant prices inflated at 55%. As you say, volume is available for 40%. I should rectify that. So a quick break. I have a couple of more questions for you. Thereafter, I'll come back in a minute.
Shares of Indus Towers slip in today's trading session, down 4% after the board announced expansion into the African market, starting with Nigeria, Uganda and Zambia. Analysts say the company's Africa foray could impact dividend payout further.
TBO Tech jumps more than 10% in trade as the company is set to acquire US-based Classic Vacations in a deal amounting to around $125 million. It's adds scales to their business, and valuations as well are pretty good.
UPL trades higher after its subsidiary Advanta Mauritius approves the $502 million purchase of Deco Holdings UK as part of its internal business realignment.
Shares of Eternal trade with gains as Zomato hikes its platform fee by 20% to 12 rupees from an earlier charge of around 10 rupees.
Shares of JSW Cement rise in trade after the company's revenue and operating profits rise due to a significant drop in overall operating costs.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. The markets are more or less flattish. The good news, though, is that the broader markets are outperforming. With Mangalam, we've got a couple of managements waiting by, so let's get straight to the action.
Let's get straight to the action. And the good part is that the Nifty Bank is taking part in the action today. So it's up around 0.25%, even as the frontline indices are flat. That's been a bit of an underperformance. So the question is whether this continues or not. But let's get the first management joining us on the show. We have Skand Prasad Sitaraman, who's the CFO of VA Tech Wabak, joining us from the sidelines of the Motilal Oswal Investor Conference to discuss the company's recent order wins, but more importantly, the road ahead as well. Thanks a lot, sir, for joining in, and congratulations on the orders that you won recently as well. So the stock doing fairly well in today's trading session, but in the past as well, if you look at it, it has celebrated some of these order wins. So just to read out some of those orders that the company has won over the last few weeks or so, they've announced order wins of nearly 2,500 crores in the second quarter so far. This after winning 2,600 crores worth orders in the first quarter itself. Sir, so far in this year, you've got orders worth nearly 5,000 crores. Could you tell us what your updated order book, tendering position and your L1 position is?
Yeah, good morning, Nigel. Good morning, Mangala. Thank you for having us on the show. I think as of end of Q1 and as we speak, we are close to a 16,000 crore order book. And we also announced to the market that close to 3,500 crores worth of orders are in the pipeline where we see us as a preferred bidder. And in the last few weeks and months, we've also placed tenders. We are working on orders which could be anywhere near $1 billion. So the pipeline is looking very healthy. We are seeing regular inquiries from the Middle East, African region and India now. So the order book is robust, the outlook is robust, and also the pipeline is very, very robust.
The numbers that you gave us are post first quarter, where the order book was closer to 16,000 crores. And that is when you said that you are the preferred bidders for orders worth 3,500 crores as well. But since then to now, you've won orders worth 2,500 crores already. So what is the updated order book? If you could give us a sense of, the kind of order inflows that you've had this year so far up to date, and what is the outlook for the remainder of this year when it comes to inflows?
See, I think in this year, the two main orders in this fiscal, the two main orders that we won was one in Saudi Arabia, which is about a $272 million order for a desalination plant at Yanbu, Saudi Arabia. And the other one is a 400 crore plus order for BWSSB, where we are building advanced wastewater treatment plants. So these are the two orders which we announced during Q1, apart from other orders which took us to 16,000. Now from 16,000, we said we are preferred bidder in another 3,500 crores, both in the Middle East as well as Africa and Indian region. So together with the two, the first quarter where we had close to 2,700, 3,000 crore orders in, we are seeing another 3 to 3,500 crores of orders which are in the pipeline where we are preferred bidder. We are further bidding for orders close to 8,000 crores, which I said that are in various stages as we speak. So for the year today, we have orders in place already, plus a visibility of another 3,500 as of today. But on the overall, there is much more robustness that is there, and we are very, very confident of closing the year with a very strong order book.
All right. Hi, sir. Good to see you in. This is Nigel on this side. Could you break it up geographically? In India, what kind of order intake are you expecting? You know, outside of Chennai, is there an opportunity over there? If you could give us some color out there. And the Middle East opportunity as well. You know, how big is that?
So Nigel, I think this year will be a year which will be dominated by the international business. Middle East will of course lead the way, and also the Southeast Asian region. In India, the kind of orders that we are getting is wastewater from the government entities which are backed by multilaterals, or from the PSUs and other oil and gas companies, where we will build either effluent treatment plant, zero liquid discharge, or orders in the solar sector, where we have already announced one with Renewables. We are seeing 2-3 more inquiries on that count. So from a volume perspective, it will surely be an year which is dominated by the international geographies. But now we are seeing traction also in India. When it comes to Middle East, as I said, we have submitted orders worth close to $1 billion in the last couple of months. And a majority of that has been in the Middle East region, specifically in Saudi Arabia, to be more specific. So we are seeing a lot of traction over there. And as I said, 5,000-6,000 crores easily we have submitted tenders or RFPs or replied to inquiries from the customer. So Middle East will lead the way. Other international geographies will follow. And India is now picking up traction from an industrial perspective and wastewater perspective.
So if we had to look at your revenue over the next 3 to 5 years, for which you have given us a fair amount of guidance as well, what would the mix look like? How much would come from India? How much would be from overseas? And in overseas, how much would be from Saudi Arabia and how much would be from other geographies?
See, if you take the last 5 years, we have had approximately 40-45% coming from international geographies, and anywhere between 50-55 from the domestic front. This we see more tilting towards a 50-50 between international and India. On the international front, between Middle East and Africa, we would see anywhere between 60-70% of the orders to come.
All right, sir.
Come from there.
Got it. All right. Before we let you go, you know, all new energy sectors, semiconductors, green energy, manufacturing, all of them, they require clean water, right? How are you placed to cater to that? Correct. And also, since semicon has been the buzzword, a lot of players, you know, talking about the opportunity, are you in talks with any of the semicon players for clean water contracts?
Yes, we are already responding to inquiries from few of the semicon companies. You've already seen we have forayed into the solar sector. We've already got 2 orders, one from Indosol and one from Renewables. So for us, this is more a decadal view towards the business. Semicon, green hydrogen and solar. This will be the businesses for the future, which we are investing today. We have references, we have proven track record of delivering ultra pure water. We are also scouting for technologies and partnerships in the market, which will help us strengthen our offering. But the proof of the pudding is already there, where you are seeing orders already coming in.
All right. You know, your stock has moved to the high point of the day. The street seems to be liking what you're saying. Final question, guidance for FY26. What kind of revenue growth can you do? And will you hold on to these margins, which are in that 13-14% mark?
Yes, the margins will be in the 13 to 15% range. This we have guided for a 3 to 5 year period. And we have said on a CAGR, we will be 15 to 20%. That also we will continue to hold. And wherever possible, our aim will be only to surpass this.
Take that point. Thank you so much, sir, for joining in and giving us all those details for the near and the long-term future as well. That was the management of VA Tech Bawag joining us from the sidelines of the Motilal Oswal conference. But what is currently underway and will be Beginning today is the GST Council meeting, set to meet today and tomorrow to discuss the centre's proposal for a simplified two-slab structure plus a 40% special rate as well. Timsi joins us from the opposition leaders meet, and Shivani joins us from the Sushma Swaraj Bhavan, where the GST meet is set to take place shortly. So we have our entire battery of resources giving you the best and the first news from the regulators as they were. Let's go across to Timsi first, who will apprise us of what the happenings in the opposition states meeting was. Timsi.
Let me be very clear at the beginning. This is a key meeting that we were tracking here. Right before the council, all the 8 key opposition leaders who are part of the GST Council held a meeting preparing their strategy, what should be the way forward in the GST Council when they will begin discussing on the proposal to shift to a two-slab structure. States are very clear that they want revenue protection and a clear-cut direction on protection for the consumers so that the rates that are about to kick in, the rates that are on the proposal should be actually transpired to the end consumer. So 2 key demands, revenue protection, and there should be no windfall gains for the companies. All the rate rationalization exercise can be approved only if Centre comes to table with a proposal on how will they do revenue protection and protect the consumers, protect the people of the country, protect the end consumer to get the benefits of these reduced rates. States were very clear that Centre has to give compensation to the states. It is part of their responsibility is what they said. They have to protect the revenue, and that is going to be the key deal maker for this proposal, which has been put forward as the vision of Centre, which we heard Prime Minister Narendra Modi saying in his Independence Day speech, that next generation GST reforms are coming down to a two-slab structure of 5% and 18% with a 40% rate only on demerit and sin goods, which are a very limited scope items, and all the common use items will be brought down to 5%, all the aspirational goods to be brought down from 28% to 18%. That's the vision that the country now is looking at. But yes, crucial GST Council meeting where opposition leaders are the key king makers, whether this proposal will pass through or not.
Got it. Okay, all right.
We'll have to see, and very clearly, their demands are superbly clear. Revenue protection till the time the states attain 14% revenue collection growth rate.
Yes, Timsi. Got that. Shivani, coming across to you, you're at the GST meeting venue. What's the activity there?
Well, it is a bright sunny morning in Delhi after a lot of rainy days, and it's a high-profile meeting today, Nigel. As you can see, I'm standing outside Sushma Swaraj Bhavan, where we have seen already some state finance ministers have already entered. As Timsi was mentioning, a very high-profile meeting before the GST Council begins was also happening among the opposition states, so they are also likely to be joining this meeting any time now. So we have seen a lot of finance ministers from states already going in to the Sushma Swaraj Bhavan. So a very crucial two-day meeting about to begin at 11 o'clock today, which will be, of course, chaired by the Finance Minister Nirmala Sitharaman. A lot of big key agendas, key issues on the agenda, including the life and health insurance, including GST on auto, and of course the rate rationalization exercise to 5% and 18%, and of course the 40% slab for sin goods. So what happens at the end of this meeting, we'll have to wait till tomorrow when the GST Council concludes. But as I said, a big high-profile meeting ahead of states, the centre's vision of rationalizing and simplifying the reforms under GST, which the Prime Minister also, as Timsi mentioned, spoke of from the podium at the Red Fort this Independence Day, that the public of India will get a gift in terms of the GST ahead of Diwali. So let's see what happens. But as I mentioned, 2-3 very big, very key issues today on the agenda. One of that is the rationalization of rates to 5% and 18%, and also the health and life insurance issue. And as Timsi mentioned, opposition states will be very crucial in today's meeting.
Shivani, Timsi, thank you so much for joining in. We'll keep coming back to you for all the updates as they occur, and keep apprising our viewers of the developments as well. With that, we'll take a short break. But on the other side, we have the debutant on D Street, Vikrant Engineering. The shares listed today. The issue price was 97, the stock closer to around 99. we have Rakesh Markedar, who is the CMD of the company, joining in.
Welcome back. Let's turn our attention to the new listing today. We have Vikran Engineering. Well, it had a pretty decent listing, I think. The stock had opened up in the green. We have Mr. Rakesh, the CMD of the company, who joins us on the show, 3% higher. That's right. It's holding on to the morning gains. Good morning, Mr. Rakesh. Thanks a lot for joining in, and congratulations on a good listing. Welcome to the stock market. Now you've raised some money from the market, so we'll be talking more often as well. Give us a couple of brief details first. You've used some part of this money to help out in terms of working capital. So could you tell us what is the debt number currently? How does it improve things on the working capital front? Point number one. And two basic numbers. What kind of revenue growth are you looking like? And margin trajectory. Please go ahead, sir.
Okay. So first of all, thank you very much for your the kind words and the compliments. See that at Vikran Engineering Limited, that the utilization of this IPO fund is going to be that mostly in the working capital and for some general corporate expenses. And that what we are looking for actually that utilization of this fund for that bigger size project what we intend to get in now we are already quoted these projects. So the growth is certainly there in mind. That is the reason we have gone for the IPO. So that mostly this is utilization for the working capital is concerned. And as far as the debt is concerned, we have not very high debt. It is just 230 crores approximately. But that just in our working capital net cycle is around 120 days. So that is in control, well within the control. So we are looking forward to execute goods. Bigger size projects to show really good growth and competence.
Got it. So, what kind of confidence can you give us in terms of revenue outlook? Last year, you moved, I think, to around 920 crores. For this year, what kind of a revenue trajectory are you looking at? And margins will be in that mid to high teens?
We are on track. On all our fundamentals are set now. The pre-qualification is there. In the company, technical and financial qualification is there. So we have good talent pool, good orders we have already bidded, and we are expected to have some good new orders. So all set. And then once we complete this quarter by end of September, we'll be announcing our result This is what I can mention now.
Can you give us some details, Mr. Marketkar? Because, you know, over the last 3 years, when we look at it, your revenue has increased from 500 crores to 900 crores, but your order book has stayed constant at 2,000 crore to 2,050 crores itself. Now, this could be a function of two things. One, you executing faster, or secondly, you not getting as many orders and you are just, you know, holding on to what you have in terms of your order book. Now, your execution to order book ratio has come down over the last 3 years. Can you tell us what are the kind of order inflows that are likely to come by over the next couple of years? What have you bid for? And are you banned from any entity from making an order?
No. Let me brief you. See, we are making, first of all, our unexecuted order book as of today is approximately 2,500 crores. That is very much sufficient for this financial year. And now coming to the order book, there is a no decline practically. That is a part of our strategy. We maintain the fair balance between the execution order book and working capital, growth in working capital. So though it by end of financial year, it looks like that it has been reduced for that FY25, but it is not like that, because whatever the orders in pipeline, our focus is to execute those orders. So though the market is good, government projections are very good, and the business outlook is very good, so getting the order is absolutely no problem. But only thing is, we, as you very rightly said, we are focusing on execution. Our execution is very fast. Now, since we got our working capital limits in the form of IPO funds now, so we'll be really going henceforth very that positively and confidently. Coming to that, there is, see, our 70% is business from power, and balancing is from the water infrastructures and all. And railway is hardly this 1.5 to 2% business railway. There was some this misunderstanding with the railways that but we are continuing to do the project. We are getting the projects, and we are getting payments also. But that time we got a stay from the court just to make it the things are clear. So nothing is there. We are executing the projects. And that railway itself, it is hardly 1.5 to 2%, so we have nothing to worry. And we are not banned at this moment.
So you said that now that working capital issues have been sorted, you will be bidding more aggressively for orders. So can you give us a sense of what the order inflow is likely to be? And by the end of this year, what could your revenue be? Are we looking at around 1,000, 1,100, 1,200 crores?
See, so definitely there is a growth, and whatever the growth we are able to maintain for the last 3 years, we'll be maintaining that. That is absolutely no problem. And now, since we got the big boost in terms of the working capital, so there is a no looking back to the things, and now we are really very confident to go ahead. And then, as far as the figures are concerned, we will be just completing this H1 by end of this month. So we'll be announcing our results. You know, I'm very confident on that.
And you're confident, and we're looking forward to having a chat with you when you announce those results. But you must give us one number. You know, tell us, what is the bid pipeline looking like? You know, you bid for the size, the value.
Pipelines is definitely better.
Better, quantify, sir, quantify.
Better since we are. So I don't know whether I'm.
You really, can, sir. Now you're listed. You're listed, sir. No problem. Regulator is okay with it. You can see what is the pipeline.
But the pipeline is very sound, and you will get some good the positive news also in coming months in terms of the order booking, and hence our figures will be very attractive.
Mr. Rakesh, we appreciate you joining in. You're confident. You're saying growth is going to be better. Working capital issues are sorted out as well. But we look forward to chatting up with you when you declare your numbers. And at that point of time, hopefully, some kind of numerical guidance is what you could give us.
All he's saying is that the quality of the pipe is fairly strong. Definitely. Let's see what blows through that pipe over the next few quarters or so, now that you've secured the funding. Thanks a lot for joining in. As we speak, the stock has hit the triple-digit mark, slightly higher. So the street is holding you on to the guidance that you've been given. The last 3 years' revenue trajectory will be maintained. You are focusing on execution. The unexecuted order book currently stands at nearly 2,500 crores. Take a short break, come back, tell you more on the markets and stock-specific actions. Stay with us. Well, the frontline indices flitting between red and green. When we started the show, they were marginally in the green. Now they're marginally in the red. Nothing really to worry about. The indices above my head, the mid-cap index and the Nifty bank doing a slight outperformance. Let's see whether that continues or not. Over the next couple of days, big important triggers. What happens to tariffs worldwide from the US is something we'll be watching out for. And additionally, the outcome of the GST Council meet, which will start shortly, is something we will track for now as well. With that, we'll leave you on this edition of Chartbusters. Don't go anywhere, because after this short break, a very important market conversation lined up for you. Mark Mobius joins in. Stay tuned to CNBC TV18. Trading Hour comes up next.
Hello and welcome to another episode of Market Masters. My guest today is someone who's seen more market cycles than most of us have had hot dinners, but is still as curious, sharp and excited about the future as any first-time investor. Mark Mobius, the legendary voice of emerging markets, joins us once again. He may have decades of experience behind him, but his forward-looking views still make headlines. Mark has also authored a book. It's called The Book of Wealth, A Young Investor's Guide to Wealth and Happiness. It blends in investing insights with reflections on financial well-being. Mark, thank you very much for coming back on this program.
Pleasure being with you. Thank you.
Mark, before I start, let me just quickly recap some of your big, some of them out of consensus calls, right? And just I'm going to list 5 of them, and then we'll sort of dive into how your thinking has evolved on some of the big issues. Number 1, Mark's call was India will overtake China as the world's second largest economy over a matter of time. It is a matter of time, according to Mark. Number 2, US manufacturing is coming back. It's powered by AI and automation and not cheap labor. Number 3, and this I found as sort of Mark as one of the lone voices when he made this call. He said US deficits may shrink and not explode. He was referring to, of course, tariff revenues. Number 4, and again, this is completely out of consensus, non-consensus, dollar will strengthen according to Mark. Number 5, China's official data can no longer be taken at face value. It is suspect. So those are the 5 sort of big calls, views, whatever you want to call it, but those are which kind of sort of stayed with me since Mark sort of spoke about them. Mark, thank you very much once again. A lot has happened since the last time we spoke. There's this 50% tariffs, which now, of course, have become reality. And it's kind of a waiting game between India and the US. It doesn't look like either side is going to blink. So I just want your thoughts on, why this has happened and what's the end game here? 25% base tariffs and 25% tariffs because of Russian oil.
Well, I think, Trump has gotten exasperating news from Russia. There hasn't been any decline in the situation in Ukraine, and this has made him very, very frustrated. So he's taking it out on India. He's hoping that India will help. But I'm afraid his hope is going to be shattered because obviously India doesn't want to give up its imports of oil from Russia. And at the end of the day, even with the big tariff increase that you're talking about, it will hit the exports from India. Maybe 40% of exports will be hit. And most important thing is that the big sectors that are going to be hit in India are the high labor content sectors, the jewelry, gems, garments, that sort of thing. Unfortunately, that will hit a lot of people, a lot of workers that need jobs in India. So hopefully the government can do something to alleviate this difficulty. But it must be remembered that pharmaceuticals, electronics are off the list. They will not have this tariff. So those exports will continue to the US. So the impact on India from a GDP point of view is maybe 0.5%, at most 1% hit on the GDP. So when you look at it in the big picture, it is not going to be that big an impact in terms of the growth in India and in terms of the health of the Indian market.
Right. Mark, did I hear that correct? You're saying Trump will be disappointed if he thinks this 50% tariffs will work with India. I mean, he'll get what he wants by imposing this 25%. You don't think it will?
No, I think he will be disappointed. Now, of course, we've seen Modi holding hands with Putin. That is not going to be very encouraging to Trump. So obviously, the U.S. is going to have to step back. And I think probably they will begin to realize that India is not going to give in to the pressure. So I think Modi has given a clear message to Trump that he will not be pressured. And I think for good reason. I think India has got to stand up to this kind of imposition in terms of trade.
Yeah. But so what's the end game here, Mark? I mean, this 50% surely cannot be permanent.
No, I think they will reach an agreement. I would give it maybe 2 or 3 weeks, and you'll see the U.S. coming to the table again and negotiating something with India so that this is not going to take place. India may make some small concessions, but at the end of the day, it'll be the U.S. that will have to step back.
Okay. In your assessment, because this is a bit of an overhang in terms of percentage impact on GDP, it is small. It does, as you said, hit labor-intensive sectors. But it is an overhang, right? And it goes beyond tariffs and numbers, etc. I mean, this is a strategic long-term relationship which is soured. And hence, I'm asking this question. To your mind, this drags on for how long, you think, Mark?
I don't think it'll drag on too long. I'm talking about weeks where they will come to the table and reach some kind of an agreement. Because, as you mentioned, the strategic partnership is very, very important to the U.S. And the U.S. will have to pull back in some area, whether it be definitely on tariffs, but in other areas they'll have to reach some agreement because the relationship between the U.S. and India is very, very important to the U.S.
So you're saying a de-escalation with regards to these 50% tariffs, the secondary 25% basically is what is it? What's the issue here? That de-escalation it's a matter of weeks, according to you, Mark.
I think so. I think they'll make some agreement that will de-escalate this whole situation.
Yes. What is it? I mean, how is the U.S. Finance industry in that sense? People who allocate large sums of money around the world looking at this. If you remember, Mark, till last year, I mean, there was almost bipartisan agreement that between Republicans and Democrats in the U.S. that China is a big one. China is the rival, the big rival, right? And a lot of finance guys, fund managers, etc., they kind of sort of pull back from China. Under President Trump and under earlier President Biden as well. You don't think that kind of sentiment is there with regards to India, right? Because of what Trump administration and the White House is doing right now. It's very different, I'm assuming.
Oh, very, very different. You must remember, China represents a very, very substantial threat, a military threat. So that is definitely not the situation with India. India has shown that they are more interested in peace rather than in confrontation. So I think at the end of the day, China will continue to be a strategic concern on the part of the U.S. policymakers and Trump as well. So I think it's a completely different situation, which is why I think accommodation will be made with India. The U.S. and India will remain partners at the end of the day.
Yeah, and once this is resolved, right? You think this has done any? I don't want to use the word long term, but at least for the duration of President Trump's term now, remaining 3.5 years, you think it's going to remain a little tricky, a little tough? What's your sense, Mark? And this is not just about tariffs per se, but I mean, the entirety of the relationship.
I don't think so. I think that you must remember, India is becoming a very important manufacturer of electronic products for the U.S. As you know, Apple is manufacturing a lot in India now and will continue to do so and probably increase going forward. So we're going to see an expansion of that kind of activity. You're going to see more investment on the part of U.S. companies in India. And, one of the positive aspects of this whole situation is that I believe that India, as you know, Modi has wanted to loosen up the incredible amount of bureaucracy that India has confronted the manufacturers in India with. And I believe that will begin to decline. India will begin to make some reforms in terms of the bureaucracy, making it easier for companies to come in.
Yeah, absolutely. Mark, you watched China for a long time. For the last 5 years, things were tense, right? Since the Galwan clashes in 2020 between India and China, no direct flights, all of that seems to be changing. Maybe, of course, in the backdrop are these Trump tariffs. China is tariffed at the highest rate. Effective tariffs, I think, for China are 42%. India's effective tariffs after exemptions is about 34%. But number one and number two. How do you see this relationship evolve? And, if at least on the economic front, things can be normalized in terms of allowing Chinese FDI, access to markets, Chinese technology, for example, technology transfer. You think it could be a big one? Or, as we've heard from US officials, top US officials saying that they are surprised by what they're saying, what they're seeing right now, and they don't see this as a durable alliance, even, of course, as the US imposes these tariffs in India. What's your sense?
No, I think policymakers in the U.S. realize that from a long-term point of view, China cannot be a partner with the U.S. They've got to continue to pressure China to open up their market to U.S. companies and to change their entire policy. But that won't be easy for China to do. India will be a much easier partner for the U.S. because they have basic principles of democracy in place. China doesn't have that. I think that's a very, very important difference between India and China in relationship to the U.S. So now the hope is that the Communist Party in China changes into a more democratically oriented party, but that's not in the foreseeable future. That doesn't seem to be the case, at least the way things look now. Whereas India is a completely important partner, a different partner to the US, a much more democratic, open society. What has to happen, I think, going forward is India will have to reduce the amount of bureaucracy and the restrictions that they have, not only in foreign investors, but in domestic investors as well. So once that is accomplished, and I think Modi is working very hard to accomplish that, not easy, when you think about the differences between the states, different states in India, it's not an easy task, but that is going to be a very big game changer in terms of not only Indian development, but in terms of India-US ties and relationships.
Yeah. No, you're absolutely right, Mark. You know what we're going to do, Mark, is stay with us. We're going to take a quick commercial break here. We're going to come back and continue this conversation. We've not even touched upon what markets are likely to do, in your opinion. So we'll do that on the other side. Stay with us. Well, we're in conversation with Mark Mobius here on another episode of Market Masters. Mark, before we get to the market, just a couple of things I want to clear out and get your views, right? Your view was US tariff revenues will be large and sustainable. Deficits will be under control, and there's no reason for the dollar to fall substantially. Are those 3 points, you still maintain those 3 points with what has happened over the last couple of months?
Yes, I do. I think you're going to see the U.S. deficit coming down as a result of the tariff revenue. And both, you must remember also, there's been a lot of cuts in government spending in the U.S. That will be an important factor, but the most important factor will be the tariff revenues. And as a result, the U.S. dollar will get stronger. Well, you've already seen against some currencies, but for example, against the Indian rupee, the dollar is getting stronger. It won't be a substantial move. You must remember these currency moves, with a few exceptions, are not dramatic. You get 5–10% change, but for the U.S. dollar, that's a big change.
So sorry, 5–10% change lower for the dollar? Higher. So, Mark, you do realize this is a completely non-consensus view, right? Everyone out there thinks, at least the mainstream research houses, funds, I mean, we talk to everybody and they say, well, deficits continue to rise and the dollar, I mean, the one strong view out there is for a weaker dollar, if I can put it like that. So this is completely non-consensus.
Yeah, I just don't see it. And I noticed that gold has moved up pretty dramatically, about 5% in the last few days. So that's a lot of people think, well, hey, that means the dollar is going to get weaker. But I don't think so. From a longer term point of view, the dollar will get stronger.
You're sticking to that view. Absolutely. Mark, the big reason why US markets have done so well is this entire AI theme, right? The large technology stocks. We are starting to see a little bit of wobble. NVIDIA, by the way, is about 8% of the S&P, just one stock, on a market cap basis. Sam Altman recently said AI investments is a bit of a bubble. Do you sense that at all? Or you think, I mean, this is the apex technology of our times and, I mean, it's the theme which will continue to drive US markets higher? What's your sense?
There's no question. AI is somewhat of a bubble in the sense that everybody is talking about AI as a big change, as dramatic development in technology, but it's not. It's basically an acceleration of information flow of the speed that is possible by new chips coming into the market. But at the end of the day, there's no question that technology is going to drive what goes forward. And by technology, I mean not only chip design, chip development, but also automation, robotization of manufacturing. This is going to be the big change taking place going forward. And by the way, that's one of the reasons why the U.S. will be able to get a lot of more manufacturing into the U.S. market because of robotization. Obviously, labor rates in the U.S. do not compete with labor rates in other parts of the world. But when it comes to robots, a lot of the manufacturing will be able to be done in the U.S. So I think at the end of the day, it's not only about AI, it's about all the rest of the developments that are taking place in technology. And as you know, in India, Modi has set a target for India to do more design of chips. I think the number now is about 20% of chip design globally is being done in India anyway. So I think more and more that is going to take place in India, and manufacturing will take place in India. And that will drive a lot of the technology improvements that we see coming down the pike. And not only in India, but in other parts of the world.
Yeah, absolutely. And design is happening.
Well, that is an interesting conversation going on with Mark Mobius. For the markets, things are very quiet. The Nifty is hovering around 24,600. On one hand, you've got Wall Street under pressure, Asian markets weak in trade. If you pull up, frontline Asian markets, Shanghai is down over 1%. The Japanese markets, that's Nikkei, lower by nearly 1%. Hang Seng 2 is struggling today. It's got a loss of more than about 0.5%. So we're weighed down by the weakness in our global cues, but that's being offset by the optimism going into the GST meet, which is why right now, at least, markets seem to be evenly balanced, just holding out with a mild positive bias right now on the benchmark. The Nifty is up 15 points. Sensex is up close to about a point. It's absolutely flat, 25 points up. The individual stocks continue to do very, very well. Of course, the star today is TBO Tech after the company made an acquisition of a US-based luxury travel company, Classic Vacations. They will be spending $125 million on this particular acquisition. The acquired company revenues were $111 million, which basically means the company is making this acquisition at one-time sales. So that's been, a big mover. And with the gain today at about 1,500, the stock has finally gone above its listing price. The issue price for TBO Tech was about 920. It listed at 1,404. After that, the markets, the stock soared to levels of 2,000. It fell to about sub 900 rupees in April of 2025. And since then, it's had a fantastic comeback. This is the entire 1.5-year journey of TBO Tech since listing. And on the way down, it's Indus Stars, and we'll discuss that in greater detail. And that continues to be the stock under pressure, down more than 4%. Get into a break. On the other side, we'll come back with more.
Welcome back. You're still tuned into Trading Hour. A 60-point cut on the Nifty. The Bank Nifty too is seeing some cuts. It's been volatile in the last couple of trading minutes, and that's something we'll keep tracking. GST continues to be the big story, but we have to get stock specific now. Hormuz is here with us to put spotlight on top movers in the market. Hormuz, tell us more.
The benchmark indices are a bit choppy, but of course there are some movers in the broader markets in today's session, and TD Power is one of them. Is the biggest single day gain that the stock has seen since May of this year. We already had close to 15 lakh shares changing hands compared to a 20-day average of just close to 2 lakh shares. And courtesy of this move, the stock has also now nearing overbought territory on the charts, with the RSI now at 65 and the reading above 70 indicates that the stock is in overbought territory. Now, also the stock is at the start of 2020, the stock was at 27 rupees, and after this move, the stock is now from those levels to now at record high levels of around 555 is TD Power. The other mover today is Vimta Labs, and that stock is now extending its gains today, another 7% higher on the stock. It was up 17% on Tuesday as well. And this session today itself has already seen more than 70 lakh shares change hands compared to a 20-day average of just compared to 9 lakh shares. And the stock has gained in 4 out of the last 5 trading sessions, has Vimta Labs. So that's been a good mover in today's session as well. Among the PSUs, Moil is the other one that has also gained in 4 out of the last 5 trading sessions. Of course, it reported its business updates based on which it is reacting. 4.5% higher on very strong volumes, up 10% in the last 3 sessions. Today's volumes being the highest since May of this year. And we've already had 41 lakh shares change hands so far, and the 20-day average is just 1.5 lakh. And courtesy of this move, the stock has broken both above its 50 and its 100-day moving average, which is between 355 to 357. And to round off the list is Indus Towers, of course. Second day of losses. Today the stock had ended at the lowest point of the day yesterday as well. And today itself we have had already close to 3 crore shares change hands compared to a 20-day average of just around about 20 lakh shares. It's been an underperformer this year, down around 30% from its 52-week high. And courtesy of this down move, the stock has been declining for 3 months in a row now. It has also turned negative on a year-to-date basis.
Okay, all right. Thank you so much for joining us with that list, Hormiz. Those are some buzzing stocks, some interesting names that are making major moves in the broader markets. Let's get in Apoorv Sheth from Samco Securities for a quick technical check on the markets. Apoorv, good morning. Thank you so much for joining in. What do you make of the market moves currently? What is the next important level to watch out for on the Nifty?
Thank you and good morning for inviting me, and thank you and good morning for inviting me on the show. Now, 24,500 is a major support on the weekly chart. So that until and unless that level holds on, I believe bulls have some strength in their power. There's a double bottom formation which is happening on the short-term charts. And the RSI is also developing a bullish divergence. So along with that, the market breadth is also oversold. So I believe that 24,500, 24,400 is a good level for the bulls. So currently is a good level to go long on with a stop loss of 24,400 for a target of 25,000. And amongst the stock picks, Navabharat Ventures, Nava, is one of our picks. So the stop loss for that would be 650 and target would be 800. It has recently witnessed a strong price and volume breakout a few days ago, and it is also holding in a falling market. So it's quite resilient, and the short-term charts are also looking good. And another stock is M&M. So on 18th of August, we had witnessed a very large gap up move on the Nifty auto index. So a lot of auto stocks had moved up after that. And M&M also managed to break out above the 3,200 mark. So that level is now acting as a support for the stock, which was earlier acting as a very strong resistance. So M&M can be bought at current levels with a stop loss of 3,190 for a target of 3,400.
Apoorv, thank you for sparing time and joining us today with your views on the index and on specific stocks as well. By the way, just before we take that break, just pull up Piramal Pharma. That stock is now at the highest point of the day, extending its gains from where it started off in the morning session, almost 8% higher now on Piramal Pharma, back above the mark of 200 rupees. Is where the stock stands. Of course, the stock doing well on volumes as well. So 201 on Piramal Pharma, 8% higher on the stock. Take a short break. On the other side, we bring you a conversation with Ashwini Kumar Tiwari of State Bank of India on the GST, tariffs and a lot of other subjects. Stay tuned. We'll be right back.
Welcome back. You're still tuned in to Trading Hour on CNBC-TV18. Well, we've been talking about that big fall in rupee against the dollar. It is at a record low as well currently. So how does it impact some sectors, and oil and gas specifically, because this sector imports a lot in terms of gas, in terms of crude oil as well, and the stocks tend to get impacted by that as well. So let's get started with the top of the chain. That's the upstream companies. ONGC and Oil India, how do they get impacted? So basically, they are oil producers. So if dollar is getting strengthened, it is something which is positive for these companies. According to ICICI Securities, standalone EPS would rise by 1 to 2% for every 1 rupee depreciation against the dollar. So that is a positive for them. Additionally, remember, Oil India had also acquired Numaligarh refinery from BPCL. Any improvement refining margins from there, because they are also dollar denominated, this would be an upside for Oil India as well. For Petronet LNG, which imports gas, regasifies them, for them it will be in terms of a positive, because regas margins for them, they are US linked. So it will be leading to 1 to 3 rupees per percent increase in EPS for every 1 rupee depreciation. For Reliance Industries, it's a mixed bag. Remember, they import crude, LNG, ethane, but that will be offset by stronger realizations that will be seen in refining, because they export petchem and upstream as well. So it will be a mixed bag here, but if we talk about the overall impact, it will be limited to -1 to -1.3% for every 1 rupee depreciation that we see. Let's talk about oil marketing companies. Now remember, in terms of refining, of course, they'll see better margins coming in because dollar is getting strengthened. However, it will be offset by retail margin compression, because that is somewhere we'll see an impact, because they will be importing crude in dollar denominated terms, and the selling price will not be changed accordingly. So EPS impact could be 11% for every 1 rupee of depreciation that we are seeing. Again, a mixed picture, but the overall impact is around 11%. For CGDs, now remember, they import LNG, which is liquefied natural gas. It is a limited pass-through that they see as well, because it could impact their volumes if they pass through the entire dollar strengthening that they are seeing. So EPS impact could range from 4 to 11%, depending on how much LNG they import. Like Gujarat Gas imports the most, so there could be a bigger impact there, followed by IGL and MGL. So this is how the picture would be. If this record low levels of rupee continue, it could start hitting some of them, while it could be positive for the exporters and for those who have dollar denominated margins.
Okay, that's about the oil and gas space. Let's move on and talk about Indus Stars. That's the stock under pressure. This is because the company has announced its global expansion. They will be getting into Africa, and they will start by 3 key markets. One of them is Nigeria, the other one is Uganda and Zambia. Now, the street is disappointed because the street was hoping that the company will start paying out dividends. You know, this was a cash-rich company. They used to pay dividends for a while. And then because Vodafone Idea started struggling and there were overdues, receivables from Vodafone Idea, Indus Stars had stopped paying dividend. But now, as you know, the Vodafone Idea, about a couple of years back, had done that QIP, there was that FPO, they raised some money. Indus Stars started making good on its receivables. Even the past receivables were cleared. So therefore, Indus Stars once again became in a comfortable free cash flow position. And therefore, the street thought that now is the time, Indus Stars will go back on its capital allocation, which is repay 100% of their free cash flow and start giving out dividends. So the street was very hopeful on that front. But now with this global foray expanding into Africa, this dividend payout is going to be questioned. One, will there be a delay to that? Delay to when they'll start, reinstating the dividend? And two, will the amount also get cut? Will the capital allocation policy need to get revised? So street is concerned, which is getting reflected in the stock price today. CLSA has cut the target price to 520. They say we had expected the management to focus on improving the company's capital structure by paying out high dividends, while the board is committed to the reinstatement of distributions, but with an unjustified delay in dividends. Citi, though, is still bullish, 460. In fact, both of them, even CLSA's target is 520, Citi is at 460, the current market price is 316, so it's a lot of upside from current levels. Citi believes the current concerns are overdone, current valuations are favorable, and crucially, I think the most important point that Citi makes is that their bear case scenario is a valuation of 300 rupees, and Indus Stars is very close to that current market price, which means downside from here is limited, according to them. So that's the story on Indus Stars. This dividend hope is getting pushed forward now.
Yes, that's not something that the street is very impressed with, and it shows that the stock is falling on very heavy volumes as well. So Indus Towers among the top losers in the broader markets today. Slight recovery from the lows, but still 4% lower on the stock and extending its losses from its 52-week high. But the big news today is, of course, the GST Council meeting that begins today, and the rejig in the rates is expected to drive a surge in consumption. Now, to understand the impact of the proposed cuts and also to understand how tariffs will impact banks and others such segments, our colleague Ritu caught up with Ashwini Kumar Tiwari, the Managing Director of Corporate Banking and Subsidiaries at State Bank of India. Listen in to that conversation.
We see a lot of positivity, especially on the retail side with the GST cut. We hope a lot of cars will get sold and a lot of other personal goods will get sold, leading to demand for personal loans, etc. So good possibilities of credit growth going forward.
Well, while that may be the case, Mr. Tiwari, but in the second quarter, as spending gets delayed in anticipation of newer, lower rates that are yet to come, do you see some temporary impact in the second quarter growth numbers, as people wait for these cuts to happen and perhaps delay their spending until then?
So some waiting may be happening, especially on the large tickets like auto, etc. But what we are not seeing any changes in the mortgage portfolio, which continues to do well. The credit growth is fine. Overall, we see no significant impact on our loan growth. There may be some individual segments here and there which might be. So for us, mortgage is doing well. SME continues to do very, very well. Last several quarters, it has posted growth rates of above 15%. So overall, we see no impact of this anticipation of GST cuts so far. Whatever it's happening is to the localized industry level, maybe there is some impact on sales.
All right. Even the recent GDP numbers, we've been positively surprised with the 7.8% print. From SBI's vantage point, does this feel broad-based on the ground as well? I mean, where are you seeing actual green shoots?
So see, part of this, while this is a very good number and it probably beat a lot of expectations on the upside, part of the reason also is some front loading of exports, etc., which got done because in anticipation of the incoming tariffs and all. How much of that is, we will know only when more details emerge. But on the ground, as I said, we see the credit growth steady. We are not seeing any spurts either on the upside or any downward trends, etc. We see a steady thing. On the CapEx side from corporates also, we are now seeing a lot more intent, more importantly, more proposals. And as I think in the first quarter earnings call, we had given out a pipeline number of 5 lakh crores, including sanctions and those under discussions. And we are seeing a lot of that getting converted now also. So I don't see a lot of either up or down movement as far as our book goes.
Mr. Tiwari, just to reconfirm, the pipeline figure for these corporate loans that you had given us earlier, was that 5 lakh crores or 7.2 lakh crores was the total figure as we understand?
So the 7.2 lakh crores was 3.45 or 3.4, that number was the under discussion. And the remaining is both unutilized credit limits, which I had not mentioned now. So the remaining portion is the sanctioned but not utilized working capital limits.
Okay, got that. Let me quickly come to the flip side. With the higher US tariffs on India and the narrative adding a lot of uncertainty, what could be the impact on your bank? Which borrower segments are you going to be more watchful of? And how exposed is SBI's loan book to the industries that will get affected because of these higher tariffs?
So we have done an analysis. Well, I can't give you exact numbers, but the overall impact on our book is not significant. There are some units in the industries which are more impacted. For example, we know all these industries, these gems and jewelry, the seafood, especially shrimp. We have the textiles industry, we have engineering goods, we have some specialty chemicals. So 5-6 industries are the major ones impacted. So while we have exposure to some units in each of these, but the overall impact on our book is not significant. One other thing is that many of these exporters are cash rich and have not been borrowing heavily, even if they have lines available. So on balance, we don't see too much of impact on our book directly. On the second order effects, if any, we will have to evaluate that and as we go forward.
Mr. Tiwari, when you say it's not significant, your exposure, should we assume it is less than 10% in single digits?
No, we can't give you a number, but it is quite less compared to the overall book size which we have. It's not significant in any significant manner. And many of those who we are talking to are also, sorry, many of those who we are talking to each of these large players especially, they are also looking to diversify, looking to get alternate places. Many of them already have some setup either in the Middle East or in other Asian countries from where they look to supply. So they are trying to find ways in which to lessen the impact of the tariff as well.
But you just sum up this credit growth conversation, sir, with the tariff impact, investment decisions getting delayed, all of that, and your own corporate loan book, growing in single digits in the previous quarter. How soon do you expect to get back to double-digit credit growth? And do you retain that overall credit growth guidance of 12 to 13% for the fiscal, or could that be slightly lower?
So 12 to 13% is we still retain that. I mean, unless something goes drastically wrong, in which case it could come down a little. I mean, you are aware that the last quarter numbers for all scheduled commercial banks is somewhere in the range of 10.5%. So that has come down on an industry level. But we retain the guidance. And the reason for that is that on the retail side, we continue to see strong growth. And we are focusing now also on the personal loans, which have not been grown well.
India's largest lender retaining their credit growth guidance of 12 to 13% for this year. Absolutely directionless on the index right now, and a less than 100-point range is where the Nifty is, still hovering between that 24,550 to 24,650 range in today's trading session. Take a short break, put the spotlight on the crypto markets on the other side with Manisha Gupta.
CNBC-TV18 presents Crypto Corner, powered by Coin DCX.
Welcome back. You're still tuned in to Trading Hour. As promised, let's shift focus to the crypto space. Manisha Gupta is joining in now. Manisha?
In Crypto Corner today, we are talking about tokenized gold. Well, tokenized gold market is at a record $2.6 billion right now. The surge clearly comes in on the back of the gold prices surging at a record highs of around $35–50 an ounce. And because of this strong demand for gold, there is also a strong demand for tokenized gold, as we have seen in the international markets. So when you look at the tokenized gold, it represents gold-backed crypto tokens, which is tokenized gold, it is digitized, and it is minted on blockchain. Tokens are backed by an equivalent amount of gold as a back end there, and also it is held as custody by the issuing authority. Most gold-backed tokens are built on ERC-20 standards, which is on Ethereum blockchain. This is also done via smart contracts. And when you look at tokenized gold accessibility, well, one, it is fractionalized ownership. Second, it is easier trading, and it can be used for decentralized finance as well. So it gives you a lot of advantages in that sense. And then gold tokens are transferable, they are tradable, they can be used on centralized and decentralized exchanges also. And some platforms also give you facility of exchanging this for actual gold or also converting it into fiat currencies. Well, when you look at the blockchain technology benefits, the storage cost is eliminated. There is safety and security when it comes to blockchain, and it can be really brought at a very, very fractionalized way, because when you look at the gold prices itself, 1 kg is for more than ₹1 crore now. So buying it smaller in smaller denominations and buying it on blockchains with crypto backing is something that market sees as very, very positive. Let me also take you through the two largest gold-backed tokens. One is Tether's XAUT. This is the biggest in sense of market cap as well, at around $1.3 billion. And the minting for the month of August in this case has been really the highest. The other one to watch out for is Paxos PAXG. The market capitalization for this one stands at around $983 million. And then there are some other gold tokens as well available, which the markets seem to be trading quite strongly at this point in time. It is Quorium, it's Kinesis Gold, Vera One, Novem Gold and Gold Dow as well, which have done quite well in the previous quarter and in the last 1 month as well. With the way the gold prices are increasing, the gold-backed tokens doing quite well too.
Thank you very much for that. Get into a break. On the other side is our big story. Stay tuned, don't go anywhere.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. On to the big story of the day. The GST Council is set to meet today and tomorrow to discuss the centre's proposal for a simplified two-slab structure. Timsy is at the Sushma Swaraj Bhavan where the GST meeting is taking place. Timsy, over to you.
Well, yes, as you rightly mentioned, the high-powered GST Council meeting to discuss union's proposal of shifting to a two-slab structure of 5% and 18% is underway. We heard opposition states keeping a clear demand that their revenue protection and ensuring that there is no profiteering being done by industries. All the benefits of reduced rates should be passed on to the consumers. These are the two key demands. And remember, revenue protection is the only key deal maker. That's what sources are saying. Centre proposal on the table, and what is going to make the deal, what is going to pave way for this two-rate structure to become a reality is going to be the promise to the states on revenue protection. We are understanding from sources that not only just opposition-ruled states, even some BJP-ruled states are likely to face huge revenue losses for which this revenue protection is required. More crucially, we have to see how soon these rate reduction process actually kicks in to boost the consumption. 5%, 18%, 40%, 40% only for demerit goods. And remember, all common use items, toothpaste, soap, shampoo, biscuit, everything coming down from 18% and 12% bracket to 5%. Aspirational goods such as consumer durables, we've seen televisions, air conditioners, etc., which currently attract 28%, are likely to come down to 18%. Overall, a mass consumption boost is being pegged through a simplified GST structure. But the only bone of contention, compensation cess levy likely to end by end of October, and what could now give the revenue protection to the states. Apart from that, another key proposal on the agenda, reduction of insurance premium of health and life insurance, including reinsurance, including the family floater programs, which likely is going to have about 9,900 crore rupees of annual revenue loss. So overall revenue loss position is what the states had asked Centre for. It is likely to be tabled in this council meeting. Also, states had demanded that there should be an additional levy. A carve-out needs to be made to ensure that there is an additional levy within the GST law, whether states agree to this or not, whether Centre agrees to this demand of the states or not. Everything in this power-packed GST Council meeting, which we are tracking.
Okay, all right. Thank you so much, Timsy, for joining us with those details. The markets watching out for what's the outcome. And of course, this is the big story that we are tracking today. But with that, we'll wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.
Stocks stay ranged as the crucial meeting of the GST Council on rate rationalization kicks off. Metals and healthcare eke out some gains, but IT and telecom drag.
Indus Towers is set to piggyback on Airtel to foray into Africa, starting with Nigeria, Uganda and Zambia. The move to scale and diversify its business, while positive, will hit dividend payouts, which is a key concern for investors. The stock is lower.
Eternal's food delivery arm, Zomato, has upped platform fee for orders by ₹2 to ₹12 ahead of the festive season. Analysts see the move as modestly positive, as some of it may trickle to the delivery partners. The key concern remains competition from Rapido.
Professional services at home platform Urban Company announces its 1,900 crore IPO, including an offer for sale of over 1,400 crores. Both, best known for its headphones and smartwatches, also get SEBI's nod to go public.
Two big policy issues grab the spotlight today. While the critical meeting of the GST Council kicks off to decide on rate rationalization with states firm on revenue protection, Commerce Minister Piyush Goyal holds out hope of clinching a trade deal with the US by November.
Hello and welcome to Halftime Report, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Mangalam Malu as well as Ekta Batra. Hi guys, good afternoon. But today what we're seeing in terms of the benchmark indices, a bit of a volatile and range-bound trading session. But broader end of the markets are outperforming like yesterday.
Yep, it's a good market. I'd say that because, despite the consolidation that we're seeing in the frontline end of things, two internals look a lot better than what they were over the last few trading sessions. One, the advanced decline. That's doing extremely well. We have nearly 2,000 stocks which are in the green for about 800 stocks which are in the red, marking the third straight day of more advances than decliners on the straight. The second part is that the Nifty Bank, which was underperforming for the last 10 or 12 trading sessions, is now outperforming. Not by a much, but it is still an outperformer. So that's a positive. And the third thing, as we're looking at the India VIX, which is down 3%, even as the frontline indices are consolidating. We have two big events, the GST Council meet, and any sort of, clarity that comes by on tariffs would be triggers for the market. So let's see how that goes. So biding time, but not bad.
Oh, well, yes, biding time for sure. And not blowing our trumpet. But nonetheless, it is turning out to be a day of consolidation. And we have the GST meet, which is, today and tomorrow. So that is going to be just about waiting and watching. But we do have a lot of stocks in focus. And that seems to be the key theme playing out in today's trading session. And a lot in terms of what's moving companies include acquisitions. So TBO Tech is in focus on the account of an acquisition. NetWeb has, a significant order win of around 1,734 crores. Moil, their manganese ore production for the month of August was up around 11%. So that was also a positive. And JSW Cement is reacting to its first quarter post a listed company. So that stock is up around 1.6% and good amount of volumes traded on that one as well. But that's all that's taking place in terms of specific stocks. So it is a lot of stock specific action in today's trade. Let's kick off the show, in fact, with some opinion from the 21st Motilal Oswal Annual Global Investor Conference. Our colleague Nimesh Shah did catch up with Nitin Jain, who's the CEO and Principal Fund Manager at Kotak Mahindra Asset Management. He manages over $5 billion in terms of funds. He shared his outlook on the Indian market post the recent correction and how to tackle the tariff uncertainty. Listen in.
The mood about Indian markets, honestly, and thanks Naresh for having me, is a little bit, not the best of the moods at this point of time. That said, there are a lot of things which are working behind the channels. Of course, currently speaking, the tariff, the US tariff is overwhelming everyone's opinion about India. Maybe this is a good time to reassess India. The pessimism seems to be at real peak as we speak.
Sure. So, are you looking to deploy more funds into India? How are you positioned in India right now? Are you sitting on cash? Are you fully deployed?
So, as a philosophy, we are a single country India fund.
Okay.
We don't tend to use cash as an instrument. Okay. So what we do is always for long-term investing. So we don't change our portfolios too much in that sense. So in some ways, we are invested in India, and the current valuation and the pessimism that we see, there is no reason for us to
held back or hold back.
Sure. So, but we will have some cash here and there, but it's not out of sync with our long-term trends.
Okay. Nitin, the very near-term trigger is going to be the GST rate rationalizations. That's something which everybody's been talking about. As a fund manager, have you looked at realigning your portfolio to some extent towards consumers? Because that's been the big talking point that maybe it's time to shift from capex to consumption.
If you look at that theme, last few years it has been more about capex infrastructure. But we have been very, very clear in a long-term view that in India, consumption plays a very important role. As incomes rise, consumer discretionary consumption will take a big benefit out of the income rise. So if you look at our portfolios, say 6 months back, we were overweight consumers, especially consumer discretionary. Now the new environment makes that view even positive. So we have seen tax cuts, we have seen monetary policy rate cuts. We're now talking about GST rationalization. We are running into festive season. We have seen low inflation. We are talking about rural income recovery. So consumption, broadly speaking, remains a core of our portfolio. Now, all of these steps are going to be taken positive from our perspective, just reinforces our view that consumption should be a core of your portfolio at all points of time.
Sure. Just to play devil's advocate on consumption, Nitin, there is an argument that the valuations are still not very cheap for the consumption stocks. Everybody's sitting at 40, 50, 60 times. But you sitting out of Singapore, looking at all the other markets as well. In that context, do you think Indian valuations of Indian consumer names are decent enough?
So,
how do you look at consumption as a basket?
So, consumption is not at the same valuation that the market is. When you think about India premium to emerging markets, it's come down from a very significant premium towards long-term averages, which is still a steep premium to other emerging markets. And there are many reasons which have been documented over a long period of time why India enjoys a premium. In our view, nothing dramatically changes in that. The reason for India premium stays, and the premium has now come down to long-term averages. Now, within a micro sector of consumers, India consumer story is very, very, very promising. Ultimately, it's 1.4 billion people who have a combined story of penetration, premiumization, and consumer discretionary on top of it. So I think the story on long-term basis is very, very intact as we speak. Now, valuation, one might look at growth. So consumer staples may look expensive, consumer discretionary may look expensive, but our view in consumer discretionary is consumer discretionary has much higher level of growth and profitability levers, than what the other segments of consumption may have. So we are looking at businesses where there is obviously growth and there is profitability to follow.
Apart from consumption, how are you positioned in the Indian markets in terms of IT, in terms of say metals or any sector which looks very attractive to you at this point in time?
So traditionally, we are not a very large commodity investors. So we tend to stay away from energy commodity in our portfolio. So we are in IT in specific a little bit cautious, given how things are panning out. I think at this point of time, the valuations are looking reasonable. We do worry at some level that the US-India tariff situation does not extend to services. Hopefully, it never does. So that's a risk that is there, but that's something that we really don't overtly worry about it. But it's back of our mind. But net to net, we are positioned well in consumption. We are positioned well in financials. We are positioned well in healthcare. We look at services in a positive view, and we have others like we have toned down or dialed down some exposure to industrials in favor of consumption. That happened over the last 12 months. But broadly speaking, that's where we are well positioned in our portfolio.
Nitin, I know you're known as a champion for mid-cap picking. You're broadly into the mid-caps and small-cap universe. What's your take there? Broadly, from a valuation point of view or from stock picking point of view, are you finding enough opportunities in the broader market stocks?
So first, let me correct, we are in mid-market. Yeah. So we do run all cap and we have mid-market. So we have a large mid-market practice at our end. Yeah. So our focus is not on the smaller mid-caps, we focus on the larger mid-caps, which are category leaders, good strong balance sheet, good management. So we stick to that. Interestingly, our mid-market universe over the last 5-6 years has widened quite a bit. Yeah. So we have more and more opportunities. Yes. Of course, we know that liquidity has also improved quite dramatically. So the risk associated with mid-caps, traditional risk of illiquidity or diversification is no longer a problem. In the last 4 or 5 years, the balance sheets of mid-market companies have also improved quite materially. So we are not finding any big need or trouble on the other side of finding good businesses. Now, our businesses are growing at a clip which is faster than economy. We know that economy is going through a little bit of volatility at this point of time, but as long as the underlying businesses that we own are doing what they are expected to do, we are not too overtly worried. But we keep a very close eye on the macro developments, and in that sense, obviously, the US tariff situation is something that one keeps a close view on.
Okay, interesting chat there with Nitin Jain. But let's talk about some of the stocks that are moving in today's trading session as well. Vamakshi is joining with us for those details. Good afternoon, Vamakshi.
Well, good afternoon, Vinny. Let me first take a look at TBO Tech. The company's unit will be acquiring US-based classic vacations for around $125 million. So that's the news flow, which is why the stock is surging up high by almost 13%. And this is the third consecutive day where the stock has advanced. In fact, the gain today is the biggest intraday advance that we've seen since the company's IPO. And this up move is coming on the back of extremely strong volumes as well. 24 lakh shares traded so far, which is almost 20 times higher as compared to the 20-day average. The next stock in focus is Piramal Pharma. The stock is seeing the biggest intraday advance since the month of March. The stock, however, has not done very well. So this is one of those beaten down names which is finally coming to life this time around. So far it's down almost 22% year to date. In fact, it cooled off almost 35% from the 52-week high. And this up move today of almost 7% is coming on the back of very strong volumes. 1.25 crore shares traded so far. NMDC Steel is the next counter we're watching out for. It's up for the fourth consecutive day. The stock has managed to see a good recovery from March, April onwards. It has managed to recover almost 33% from the 52-week low. And the volumes today are very strong. They're almost double as compared to what we saw yesterday. And lastly, take a look at Jain Irrigation. This counter too is doing extremely well in trade today, up almost 7%. Jain Irrigation, the stock is advancing for the fifth straight session. In fact, in the last 5 days, the stock is up almost 21% and the volumes are almost twice the 20-day average we've seen so far. So Jain Irrigation too having a good day in trade today.
Okay, all right, Vinny. Thanks very much for that. So those are all of the buzzing stocks at this point in time. Vamakshi. But we'll take a short break on that note. We'll get you more on the markets and lots of stocks on the other side. Stay tuned. Welcome back. Well, for the markets, it's just about consolidating at this point. The mid-cap index is where the action's at. So the mid-cap index is up around 0.3%. There's a little bit of a pickup which has taken place for the Nifty as well, but it's just, up around 50 odd points on an absolute basis. So while there has been a little bit of an incremental shift which has taken place, on an absolute level is just about higher by around 50 odd points. And for the Sensex as well, just about higher by around 130 odd points. The important parameter is the advanced decline ratio, which continues to be on positive terrain. But let's now shift focus to our fundraise segment. And it's an interesting segment that we have where we're discussing the PE and VC investments that we've seen this year as well as in August. India's private capital markets have witnessed a shifting landscape. And the PE VC investments, in fact, have declined 55% in the month of August, according to reports. And on a year-to-date basis as well, it's down around 16.5%. We have with us Vivek Singla, who is the managing partner and CIO private equity at Incred Alternative Investments, to discuss this. Vivek, hi, welcome to the show. Well, what is taking place considering that PE and VC investments have fallen 55% in the month of August on a year-on-year basis, and as well as around 16.5% to 17% this year? Is there trepidation, some amount of cautiousness which is now coming about?
Right. First of all, happy to be here. Thank you. I think you're right. We've been seeing, volumes and value on the, on the deal making front have been soft for some time. Okay. We used to be around $60-70 billion a trade in a year in the last, I think, year or so by 21-22. And that slipped to about $40-50 billion in 23-24. And even this year, I think we are seeing a slippage in the deal value. In my mind, I think there are two large reasons for this. One, I think, coming back from the highs of 21-22, when there was huge amount of focus on growth, I think profitability was sort of pushed back in the corner, and excessive amount of investment happened during that time. But I think as the time has passed, more and more firms have realized that, ultimately the underlying businesses have to perform, and which is why profitability has taken center stage. Right. And I think the firms are now waiting and watching for profitability to kick in before writing the checks. So that's number one. Number two, I think if you see what is happening in the public markets for the last 12 months, I think we are finding that there's a bit of sluggishness in the environment. And I think, some of the big unlisted companies which had a huge fan following in the unlisted domain, they did not perform up to expectations post-IPO. So that also is weighing on the minds of the PE firms before, going in. I think they're keeping a bit of margin or buffer before going in. And I think both these parameters, the pricing as well as profitability, are the factors which are driving that, elongated deal making or the process of deal making, which is why you will find the closures have been a little soft.
That's interesting, 59% decline because of the reasons that you're talking about. One, looking at profitability. The second is maybe exits haven't been as lucrative. But at the same time, if you could give us a sense on, whether there is dry powder with the PEs, what is their investable capital versus what is invested? How does that ratio stack up over the last few years? I mean, we just want to understand, because a lot of the family offices, a lot of the HNIs, all of them are looking at private equity as against public equity for as an attractive option right now, or getting much earlier in the line. So from the investable capital that there is versus what is invested, how has that ratio panned out?
I think the fundraising has been still quite robust, if you ask me, the last couple of years. Okay, we find both on the international front as well as even in terms of the domestic flows, the AIF fundraising, etc. There have been a lot of investors who have started, exposing themselves towards the private markets, and rightly so, because this is that market which is likely to deliver that alpha. And I think the dry powder with the firms, definitely over the last 3 or 4 years, I think we are finding billion-dollar funds have been raised in the market. Investable surplus is definitely high. And at the same time, I think India being such a large opportunity set, the considerations that when it comes to investments are also, I think that set is also fairly large. So I do find that maybe in the near term, you'll find there's a bit of mismatch on the dry powder versus, the potential opportunity. But I think that correction is likely to take place over the next 12 to 15 months. So whatever dry powder is there in the market, I think there are ample opportunities in the market which will take care of this dry powder.
Okay, there are ample of opportunities which will take care of this dry powder that's there right now. Vivek, in terms of overall, are we seeing any sort of small deals happening, or even small deals are off the table right now? And what is the sort of delay that is going on currently?
No, deal flow, especially on the small market size, is definitely quite active. Okay. And I find that more and more firms, especially on the early stage ecosystem, they are trying to incorporate elements of AI, right? That is one hot space where, whether it's from the company standpoint or the firm standpoint, those conversations are very active. Okay, so even traditional sector or even the tech sector, wherever I think the conversations around AI, I think that space is very active. Maybe on the large cap side, the large deal making side, there may be a bit of slowdown. But I think that's, again, a temporary phenomenon in my mind. And, ultimately, I find that the last 2 or 3 years have been very healthy in terms of the correction, both in valuations as well as, move towards profitability. So from our standpoint, I think things are looking very healthy here, if you ask me on the deal.
Just Vivek, wanted to understand how much have IRRs come down on an average, say if you had to compare it to the 2021 or 2022 period and now?
IRR, I think, is a very, the number is too diverse, and, the range is very wide for me to be able to come to you with a particular number.
I'm just asking, in terms of the PE exits and the returns, how much of a recalibration has there been in the past 3 years?
I think the top quartile funds maybe 3-4 years ago would be operating in the range of 25 to 30%. That number today may be in the range of about 20%.
Sure.
If you ask me.
And are you expecting this cycle to change? What are you, since we have seen these kind of statistics for the month of August and year to date, are you expecting a move towards, say, a higher return, increase in PE investments?
Oh, definitely, yes. Like I mentioned, right, this is just a cyclical phase in any industry, right? So our industry is same. What happened in the 21-22 time is just, I think there was excess amount of capital which went in. And that time, I think people maybe at some level lost focus of the valuations or, maybe a little over bullish. But I think the conversations which have happened over the last 12 months, 18 months that we are seeing, I think there's a lot more focus on valuation. There's a lot more focus on profitability. And this is ultimately going to play out in the returns that you'll see coming out in 27, 28. So we are likely to go forward, see that 25-30% IRR coming through, for sure.
Okay. Vivek, just a quick one. You said AI, yes, there is opportunity, but X of AI, where are you seeing opportunity? And also valuations of Indian startups versus rest of the world. How are we standing currently?
So besides AI, I think 2 or 3 things look very promising. Okay. Number one, I think consumption is that one space which really has not performed, if you ask me. This is the largest space in our GDP. But I think for whatever reason, maybe it's, taxes, maybe it's low disposable incomes, etc. And I think government does recognize that, right? So if you see the tax rebates, if you see the GST rationalization, etc., I think they are going to give money back to the consumer. So this is that one sector that is poised to grow. The other is financial services sector. I think the last 2 or 3 years, there was, I think, credit offtake has been slow or the delinquencies were on the high. But I think this is one sector where valuations have been very amenable. And this is the other sector that is likely to grow hand in hand with consumption. And the third sector, especially, is the niche manufacturing or the new age manufacturing, which is the national priority areas like defense and aerospace. So besides AI, I think these three spaces definitely will perform.
Take that point, Vivek. Thank you so much for that. So after the highs, we are now pausing for breath, and maybe once there is enough rest that everyone's taken, both the investors and the opportunities, there would be a match over the next 12 to 15 months. We will obviously keep checking in with you periodically to know where that ball is moving. As of now, it's artificial intelligence, consumption, and some of the niche manufacturing areas where he sees some traction. With that, we'll take a short break, come back, get you more on the markets, the listed markets, that is, because the Nifty is consistently zooming ahead right now. 24,650 is where we are, a 60-point bump up led by the Nifty Bank. At the high point, get you more on the markets after this break.
Welcome back to Halftime Report on CNBC-TV18. As of now, the Nifty has moved up a few points, right, from the day's lowest point. Also, we're seeing a recovery coming in, holding on to gains of almost 0.2%, 50-60 points up, day's highest point. But what are we watching out for now in the world of FNO? Mangalam is joining in with us for that. Mangalam.
Well, moments ago, the market was consolidating, flitting between red and green for the Nifty as well as the Sensex. But we had pointed out that the possibility of it moving higher is high, and that's exactly what's taken place. Right now, the Nifty is at the high point of trade. And the reason for that is pretty simple. The Nifty Bank, which was underperforming, has now become the top contributor. So the Nifty Bank is doing extremely well. And for the third straight session, we have the midcaps, which are outperforming. So the midcap index doing well. We have nearly 2,000 stocks which are advancing versus the number of stocks which are declining. But more importantly, even as the market was consolidating, volatility index was cooling off, telling you that there has been put writing activity which has taken place, and the street believes that maybe the market has been forming a base, especially after the sharp bout of decline that we saw in the last hour of trade yesterday. Metals, they're picking pace as well. Now the street believes that there could be some relief coming in from the Fed when it comes to rate cuts. sometime during this month, we have the Fed meeting. So every time there is a US rate cut, we have a concomitant positive impact that we see in terms of the prices of commodities. And that's what we've seen in that's what the expectations are building up for some of these ferrous names as well. Now, as the Nifty is moved higher, let's look at a couple of important levels we need to cross and close above on the Nifty. It'll be the 20-day moving average and the 100-day moving average. Both these levels, the Nifty crossed yesterday but failed to close above. So today, that will be extremely crucial. And the Nifty Bank has taken support at the 200-day moving average itself. The levels that are important on the Nifty, 24,600 call writers, fairly active in today's trading session. The premium that they have is 155, telling you around 24,750, we may see some sort of resistance. 24,600 put writers equally active, telling you that around 24,550 to 24,450, we will see strong support. So between 24,450 to 24,550 is the support. 24,750 is where the next leg of resistance comes in if we go ahead and cross and conquer the 20 and the 100-day moving averages. A couple of stocks on our radar. Piramal Pharma has been doing very well since morning and fairly well bid from an open interest standpoint as well. So a lot of long positions added on that counter. And RBL Bank may enter F&O ban today. Remember, over the last few trading sessions, we've been seeing OI build up on that stock. Now it's very close. In fact, has crossed the threshold of that 95% of market-wide position limits as well. When it does cross that and close above that, the stock goes into F&O ban. So the first stock of the September series to be in F&O ban would perhaps be RBL Bank.
Okay, all right, Manglam. Thanks very much for that. Just look at a couple of these stocks move. E2E Networks is now locked in Abbas circuit after bagging a deal worth around 177 crores. Separately, we have NetWeb also, which is now up around close to 10% at this point in time. So the company, so the market seems to be really rewarding companies which are forging ahead when it comes to, say, revenues or in terms of order wins. So that seems to be the theme which is really playing out at this point in time. Moil also at the high point of the day, up around 5% for that particular counter. We'll take a short break on that note, but we'll connect with the management of Open Company as they receive the SEBI nod for their IPO. Stay tuned.
Well, we were talking about some of the ferrous names doing well. Now look at the non-ferrous names as well. Hindalco's moved to the high point of trade. We're seeing some traction in ITC as well. And just watch out for Interglobe Aviation from the broader markets. That's the one that is taken off currently at the high point of trade for Interglobe Aviation as well. So those are a bunch of stocks which are doing well in a market which has now picked some pace currently, closer to the 24,650 mark for the Nifty. But let's talk about the primary market action. Urban Company, something that is fairly popular with consumers, will now move into the investment bracket as well, because it's received its SEBI nod for the IPO. The 1,900 crore issue is priced at between 98 rupees to 103 rupees, set to open on September 10th. Rima spoke with the management, and this is what they had to say about the growth plans going forward.
If I talk about the last 3 years, we have scaled our net revenue from 437 crores in FY22 to about 1,144.5 crores in FY25. And in this period, for the 707 odd crores of incremental revenue that we've added to the top line, about 385 crores has gone to our adjusted EBITDA, which shows the strong contribution margin and gross margin profile in the business. We track at a contribution margin of about 56% of net revenue, or roughly 19.5% of net transaction value. We've also kept our fixed costs fairly steady in the last few years. Profitability is an important goal for any company, and for us as well. As we continue to scale, we would want to continue to focus on operating leverage, cost excellence, and continue to scale with profitability.
So suppose your top line doubles from here on, right? It's about 1,100, 1,200 crore rupees in terms of net operating revenue. It doubles. Adjusted margins in Q1 were 5-6%. What could that number look like?
It would be hard to sort of put a
Double
specific...
digit?
Let me put it slightly differently. I think the areas where we would want to invest would continue to be technology, would continue to be training and service professional excellence and quality, and brand building. I think we would like to make these investments, albeit at a slower pace than revenue growth. So any growth in revenue that we see, especially in our core business in India, which is already fairly profitable, it was operating at a close to 10% adjusted EBITDA in FY25. I think any investments we make there, we would want to be very mindful that those investments are not growing faster than top line, so that we can continue to see sustained margin expansions every year. I would avoid giving any forward guidance, but we're committed to improving the quality of the business with every passing year. One of the things that is our internal principle is that every cost line item every year should see operating leverage. And that's a philosophy with which we operate internally.
Okay. Just for the benefit of our viewers, you have three sources of income. One is India consumer. That's your core market, profit center, 10% EBITDA margin, 75% of your top line. Second is your native brand, where you are manufacturing hardware products like lockers, like security locks, air purifiers. And third is your international business. That's about 10%. Now, native and international is loss-making as of now. We'll come to it. But let's talk about your India consumer.
Sure.
Talk to us about your ambition here, the strategy, the opportunity that you see.
So, Rima, India Consumer Services is our largest business. As you rightly said, it's about 77% of our net revenue in FY25. It's one where we offer a host of services at home, be it beauty services, cleaning, carpentry, plumbing, AC and appliance repair, painting, etc. We still think we are only getting started in this business. The opportunity is humongous. The total addressable market for home services in India stood at nearly $59 billion last year. And it's expected to grow to about $97 billion by 2030.
You've also laid out your expansion plans. I think you're present in 47 cities right now. You're targeting 200 Indian cities by 2030. So as you expand into tier 2, tier 3, what would profitability look like? Will it be dilutive or will it add to your margins?
Well, typically when we look at a tier 2 city, there are a lot of existing investments that we are able to leverage. For example, our technology platform, which is one of our big areas of investment, doesn't need incremental investment when we expand to a new city. We've, from early on, focused on brand building at a national level. So usually when we enter a new city, there's already awareness of the Urban Company brand from users in that city as well as service professionals. In fact, I keep getting emails from cities where we're not present today by users asking us to launch there. We also tend to leverage our training centers in the larger cities across the smaller cities through a hub and spoke model. So it gives us the ability to sweat our training assets further. So the incremental P&L of a new city that we add is usually better compared to an existing city. And contrary to popular wisdom that whenever you enter tier 2 or tier 3 cities, you have to drop prices, we haven't really done that. We've seen pricing power hold up in these cities.
So now let's talk about your second source of income, right? That is native. Where you're actually manufacturing water purifiers, for instance. What made you get into this category?
So Reema, we have been in the category of water purifier servicing and filter changes for about 8 to 10 years now. And then about 5-6 years back, we entered into our own private label spare parts, the filters that go in. So there was already a base knowledge and a base consumer, consumer base that was transacting on the platform in this category. These consumers had a deep pain point, which they voiced to us, which is that why does our water purifier need servicing and filter changes every few months? Why do I have to go through the hassle? And for a while, we felt that this is how the industry is, this is how it operates, what can we do about it? But when this voice from the consumer became, too loud, we decided that let us see if we would want to further vertically integrate and have our own device. It took us we took that call in 2021. It took us about 2 years of product development, R&D, to come up with a state-of-the-art water purifier that is needing no filter changes for up to 2 years. After 2 years, you service it once, and it's again set for another 2 years. It's gotten off to a great start. It did about 116 crores of net revenue in FY25, which was the first full year of operations. In the first quarter, and we've reported that it's done about 60 crores of net revenue. So it's growing at a rapid pace.
But it's loss-making.
It is loss-making right now.
Okay. But what's the scale that you need to flip the margins?
I think, we have already seen operating leverage starting to play out materially in this business. Year on year, the losses have come down at a margin level. And we believe that as we continue to scale it, that operating leverage will play out, and it's a matter of time before this business also turns profitable.
In 2 to 3 years?
Again, I will not be able to focus on the specifics. But, if you look at our past history, newer businesses haven't taken a very long period of time for us.
Okay, 1900 crore IPO opens on the 10th of September and the price band set between 98 to 103 odd rupees. We'll take a break and come back with Manisha Gupta, commodities editor, and what she's tracking in the commodity space. Stay tuned.
Welcome back, and joining us on the show now is Mr. Prithviraj Kothari, who's MD RSBL and also President of India Bullion and Jewelers Association. Mr. Kothari, thank you so much for joining us here at CNBC TV18. First of all, your sense on where do you think are the gold prices headed from here? We already are trading at a record highs right now. Where would you see gold prices by the time it's end of 2025?
I think in the market right now, in the whole country, on the geopolitical tension is there. Central bank buying is constantly there. People are selling crypto and buying the gold also there. And the de-dollarization. Everything is the buying, and the fund increasing, they're buying gold portfolio also. So everyone is buying, no one selling in the market right now. If you see in the scenario hold every day, if you see in the last week to this week, almost $200 almost increasing in the prices. Still the domestic prices demand, and the same price is the Indian also is the demand. I think maybe price to 3,700, 3,800 in the end of this 2025. And maybe in the second quarter till there is the chances of a $4,000, $4,500. Because everyone is buying as a gold against the dollar. And the geopolitical tension, the sanctioning, everywhere is uncertainty in the market. Right now, in between gold spot market is 3,300 to 3,600 in between. Thereafter, I think slowly they move. Again, any bad news is coming or a tariff, anything else is happening. The market move again to the new direction of 3,700, 750. But in the same in the physical demand also is there in the same. If you see in the India, in ETF also the gold buying huge quantity. Every day we accumulated the gold in the ETF also, as well as the silver. Silver is a huge quantity we accumulated in the ETF also. The buying. Current right now is a buying.
I get your point, Mr. Kothari. As you're saying, there are no sellers in the market right now and strong buying that we are seeing in case of gold and silver as well. So for gold, you've told us that the prices can go to 3,800 by end of this year, even 4,000 in next year. How are you looking at the silver prices? Because silver has outperformed gold in the very near term. We are holding above $40 an ounce. Where do you see silver in the international markets and for the Indian markets by the end of this year?
I think, ma'am, if you see the silver last 10 years is not performing so well. Now it's a start point. Silver is $40 I think is the base price. Silver is a huge demand in everywhere. And also the funds also they create, AMC also they create in portfolio to be a silver. Now initially they are putting only gold there in the portfolio, but now they are increasing the silver also, including the silver also. So I think silver is some resistant at $43. In terms of Indian rupees is around like 30,000 rupees. And maybe silver, I think in a year, it should be $70. It means I think it's a 2,25,000 easily can be touched if it's our rupees should not be depreciate. So I think silver maybe in a year it's a $70 maybe touch easily $70. I think it's a more than that. So I am more bullish than the gold in the silver.
Oh, wow. $70 an ounce in the international markets for silver. And for the Indian rupees, it could be 2 lakh rupees in 1 year. So clearly, silver seems more bullish there. Mr. Kothari, you told us that investment buying in the Indian markets has been quite firm for gold and silver, even as we are trading at all-time highs. How much of a percentage increase in sense of value or volume? I mean, value we can all look at. But for this festival season, are you looking at increase in volume as well? Or do you think that could suffer?
No, I think we will forget about the volume. Volume, it's as usual is there because a lot of people, the equity market is there. The real estate is also booming. So everywhere there is no liquidity problem in the market. Then monsoon is a good monsoon. If you see the monsoon is almost everywhere in the country is a very good monsoon. So there also the new crops is coming and new money is coming in the market. So I don't think there is any liquidity problem. So I think festival should be as usual, marriages as usual is there. So I think it doesn't affect on the import side. I don't think any effect, but it's almost some volume should become lightweight jewelry selling more 9 carat also including. So I think the value-wise there should be high, but volume-wise is as usual.
Point taken. Mr. Kothari, one final question. And, going forward from here, as you've talked about much higher numbers from here on, are you anticipating global uncertainty, strong central bank buying, weak US dollar, all of these fundamentals to continue?
I think day after morning, Trump what said, God knows. So its effect in the market. Everyone is a panic. No, every country is a panic, not in the everyone. So I don't think maybe it's something which should be positive happen, but I don't think till the 3 to 6 months this happen this like this. Ukraine, Russia, Israel, Hamas, everywhere is a tension is there. No, tariff on India also. So it's all affected in the market. No, we can't say anything about that.
Absolutely, Mr. Kothari. Still there's a lot of uncertainty, but surely, Mr. Kothari as well as Manisha, thank you so much for joining us. And that bullish commentary coming in on silver, that's expected to continue to shine, right? $70 per ounce in the next 1 year, 2 lakh rupees in the 1 year and rupee term in India.
Yeah, from here on, but yes, who knows?
It's like, who knows? But surely silver is not going to lose its sheen. That's the word coming in from Mr. Kothari. But on that note, we're going to slip into a very short break. Remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime records global shifts and their impacts on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back to Halftime Report on CNBC-TV18. Nifty, as of now, has given up some of those gains that we saw coming in the second half of 12:30. Around that time, we saw those gains. Now has come back to 24,600 levels, exactly where we started the show with. So as of now, Nifty is managing to hold on to gains of odd 30 points in trade. But the broader end of the market, that's where we're seeing some bit of the gain coming in right as of today. What did well in the last 1 hour? NMDC Steel, that picked up some bit of steam, 2% uptick in the just last 1 hour. Netweb Technologies, that also saw a bit of a further spike up in the last 1 hour. And Coal India, among some of the names that have seen a pickup. While on the flip side, in the last 1 hour, we have seen HBL Power lose some bit of a steam, so keep an eye out on that, as well as Godavari Power has also lost some bit of a steam from the point of, in terms of a further fall coming in for them. But with that, we're going to wind down this edition of Halftime Report on CNBC TV18. Thank you so much for tuning in. Up next, your Business Lunch.
Stocks stay range as the crucial meeting of the GST Council on rate rationalization kicks off. Metals shine with the index rising over 2.5%, IT and telecom drag. Indus Towers is set to piggyback on Airtel to foray into Africa, starting with Nigeria, Uganda and Zambia. The move to scale and diversify its business, while positive, will hit dividend payouts, a key concern for investors. Eternal's food delivery arm Zomato has upped platform fee for orders by 2 rupees to 12 rupees ahead of the festive season. Analysts see the move as modestly positive, as some of it may trickle to delivery partners. The key concern remains competition from Rapido. IPO-bound urban company tells CNBC-TV18 the Indian home services market could be worth $97 billion by 2030, up from $59 billion today. It expects operating leverage to drive up profitability as it scales. Two big policy issues grab the spotlight today, while the critical meeting of the GST Council kicks off to decide on rate rationalization with states firm on revenue protection. Commerce Minister Piyush Goyal holds out hope of clinching a trade deal with US by November. Well, hello and welcome to Business Lunch, live from the CNBC-TV18 Motilal Oswal studio. I'm Vamakshi Thoria, and it's the third trading session of this week, and it's still green on the screen for the third consecutive day. The Nifty is up modestly, only 21 points higher or so. The mid-cap end of the market, though, is doing slightly better as compared to what the benchmark indices are doing. The mid-cap index is up almost 0.2%. Take a look at the Bank Nifty, because that is one index that has not been contributing at all to the Nifty. For now, it is flat. Just a couple of minutes ago, it was trading in the red. The advance decline ratio continues to be in favor of the advances for the third consecutive day. Now, if we take a look at some sector-specific moves, it's the metal index that is actually gaining momentum in trade today, up almost 2.6%. And the move is largely being led by Tata Steel, which is up almost 5%. Jindal is also up almost more than 4% in today's trading session, and so is SAIL. Pharma is the next sector that is doing absolutely well in today's trading session. Glenmark up almost 3%, Ajanta Pharma up almost 2%. But what's not doing well is the IT pack. No stocks from the IT index are gaining in today's trading session. Coforge is down almost 2%. LTI Mindtree also down almost 1.7%. But the key focus is on the GST Council meeting. It has started in New Delhi, and the opposition states have reiterated their demand for revenue protection. My colleague Timsi Jaipuria joins in with what she is picking up on the deliberation of the council. Timsi, over to you.
Well, as you rightly said, we are right now outside Sushma Swaraj Bhavan. You can see the venue for 2 days critical GST Council meeting. And as we speak, just before the council started at 11 a.m., there was a key meeting between the opposition-ruled states to formulate their strategy. Very clear voices coming out of that opposition-ruled states meeting. They are in for the rate rationalization exercise, provided the centre gives them assurance on revenue protection. Centre gives them assurance on the rate cuts to be trickled down to the consumers. Key points here: how will the revenue protection come in? The demand from opposition-ruled states is to bring in an additional levy which could replace the existing compensation cess, which is likely to end by this October, to ensure that the revenue losses that the states are going to have due to this rationalization exercise of moving to a 2-slab structure from a 4-slab structure currently, that is moving from 5, 12, 18 and 28 plus cess, to now moving to only 5%, 18% and a 40% slab only for certain demerit goods. The states are very clear that their revenue protection, their promise from the centre on this revenue protection can only clinch this particular deal. Apart from that, another crucial demand from them is to ensure that there is no windfall gains or profiteering done by the industry. For that as well, there is a crucial demand. And over here, I would like to bring in a small update that the anti-profiteering clause under the GST mechanism has already had a sunset in March this year. So if this rate rationalization exercise goes ahead and if centers agree on having a mechanism to ensure that profiteering does not happen, then will it also revive the anti-profiteering clause? That is also something crucial that we'll have to watch out for. Meanwhile, the discussions happening inside include bringing in ease of compliance, easing the GST registration system, easing the refund processes, easing the return filing process, because that was part of the four-pillar strategy given by the centre after Prime Minister Narendra Modi spoke from the ramparts of Red Fort on 15th of August that GST is now up for a major overhaul. GST 2.0 reforms are now up on the agenda, and this meeting, to be precise, is going to bring in the decisions based on those pillars, where the crucial pillar was also to bring in ease of living, ease of compliance, and that's being discussed upon. But yes, most crucially, as of now, the discussion on rates has not even started inside. We'll have to see what happens, whether the discussion on health insurance and life insurance, the reduction of premia from current 18% GST to exempt category, that also has not started. So something that we'll have to wait and watch for how soon the discussions begin on the rate side. As of now, discussions only on compliance, which could be a smooth sail.
All right. Thank you so much for that, Timsy. And of course, we'll keep getting you more on this very important crucial meet slated to take place today as well as tomorrow. But let's also listen in to what the Andhra Pradesh Finance Minister had to say.
We are supporting, from Andhra Pradesh, we are supporting the major reforms in the GST sector which are being proposed by Government of India. Most of them are going to help the common man and poorest of the poor. They are coming from the food sector, education, health, steel, cement, textiles, all the reforms which are being proposed by the Government of India to bring down the burden on the common man. As a Telugu Desam Party, President Supremo, Mr. Sri Nara Chandrababu Naidu has taken a stand to support the reforms initiative.
Well, moving on then, India's scorching 7.8% GDP print has raised some issue around the deflator. Now, this came days after many economists said that India's higher than expected GDP at 7.8% versus market estimate of 6.8% may have been because of the deflation method. Now, speaking to Lata Venkatesh, MOSPI Secretary Saurabh Garg said that the deflator has nil to negligible impact on the GDP calculation. Take a listen.
Around 40% we use volume estimates, and therefore we are first calculating the real GDP and we inflate that to get the nominal GDP. In the balance, we deflate it. Now, what is the deflator that we use? It's not that we use the entire CPI or the entire WPI number that you see. In the CPI, if you notice, we have a number of sectoral indicators. We have for housing, we have for education, we have for health, and similarly on the WPI side also we have inflators for manufacturing and other goods. Now the question that has been worrying a lot of people is why did we use such a low deflator? And that's a function of the actual inflation rates in the first quarter. So, and that's a direct result of the number of fiscal and monetary policies of the government.
Well, let's move on to the commodity space then. Metal prices have seen a strong surge this week as China pledges expansionary fiscal as well as monetary policies, resulting in copper and zinc hitting one-month highs. We in fact spoke to Citi Global's head of commodities, Max Slayton, who is very bullish on aluminum as well as copper prices. Take a look.
Worst of the tariff impact on growth and inflation is past. So we're kind of rolling cautious on base metals near term, but very, very bullish on, in particular, aluminium, but also copper on a 12 to 24 month view. So heading into the midterms and with lower interest rates globally, we do expect a pickup in global growth. They've got a lot of exposure to decarbonization as well as AI and data center related demand. And they have practically no supply growth, these markets, copper and aluminium. So they're set up for when the global economy turns, they're set up for super bullish markets. Copper, you can be talking about on that kind of time frame, $11,000 to $12,000. Aluminium, you can be talking about easily $3,000 plus.
Well, as we slip into a very short break, here is a look at Maruti's new SUV called the Victoris, unveiled a short while back. Victoris has modern digital features including Alexa auto integration. Now, other features include a Dolby Atmos surround sound system, 8-way adjustable, ventilated front seats, a sunroof, and a 60-watt fast charging support. The car will be offered in 10 color options. Well, thanks for staying tuned in to Business Lunch. But moving on then, the US president commented on the high tariffs imposed on India. He said that the two countries got along very well, but also listed why India was being charged a high amount of duty. Listen in.
With India very well, but India has, you have to understand, for many years it was a one-sided relationship. Only now, since I came along, and because of the power that we have with tariffs, India was charging us tremendous tariffs, about the highest in the world. They were about the highest in the world, number one. And We therefore weren't doing much business with India, but they were doing business with us because we weren't charging them. Foolishly, we weren't charging them. So they would send in massive, everything they made, they'd send it in, pour it into our country. Therefore, it wouldn't be made here, which is a negative. But we would not send in anything because they were charging us 100% tariffs. And, I'll give you an example, Harley-Davidson. Harley-Davidson couldn't sell into India. There was a 200% tariff on a motorcycle. So what happens? Harley-Davidson went to India and built a motorcycle plant. And now they don't have to pay tariffs. Same thing as us.
Well, those were some of the comments that came in from US President Donald Trump, just reiterating his stance on the tariffs imposed on India. But moving on to an exclusive conversation with CNBC-TV18, Mark Mobius, who's the chairman of Mobius Emerging Opportunities Fund, spoke about Trump's 50% tariffs on India. He said that he expects India and US to negotiate the trade tariffs in the next few weeks. Take a listen.
I think, Trump has gotten exasperating news from Russia. There hasn't been any decline in the situation in Ukraine, and this has made him very, very frustrated. So he's taking it out on India. He's hoping that India will help. But I'm afraid his hope is going to be shattered because obviously India doesn't want to give up its imports of oil from Russia. I think he will be disappointed. Now, of course, we've seen Modi holding hands with Putin. That is not going to be very encouraging to Trump. So obviously, the U.S. is going to have to step back. And I think probably they will begin to realize that India is not going to give in to the pressure. I think Modi has given a clear message to Trump that he will not be pressured. And I think for good reason. I think India has got to stand up to this kind of imposition in terms of trade. I think they will reach an agreement. I would give it maybe 2 or 3 weeks, and you'll see the U.S. coming to the table again and negotiating something with India so that this is not going to take place. India may make some small concessions, but at the end of the day, it'll be the U.S. that will have to step back.
Well, on that note, let's slip into a very short break for now. But more news and updates come on the other side, so don't go anywhere. Welcome back. You're watching Business Lunch on CNBC-TV18. Now at the Motilal Oswal Annual Global Investors Conference, my colleague Surbhi Upadhyay caught up with MMRDA Commissioner Sanjay Mukherjee. Here's what he had to say on the recent monorail mishap in Mumbai and the corrective steps that the authorities have taken since.
Monorail is not used much, and the monorail makes a loss every year. On that particular fateful day, when the railway line stopped, the monorail was working and the metro lines were working. And I would like to say that the metro and the mono, if they were having the appropriate number of passengers that they would have to, they can carry, then it would have had that. In the case of the metro, the number of passengers was same as what it has a carrying capacity. Okay. So the metro has not stopped even for a minute. The mono stopped because there was a severe overload. We will introduce better access control because, see, we never expected that this kind of crowd will come, and we will introduce better access control. We have now made an expert committee. That expert committee has 2 people from MMRDA, 2 independent experts, and one of them is from the IIT. So this expert committee will give us the suggestions, but essentially access control will have to be very properly put. We will also introduce new trains. That is something which we will do. And we will increase the monorail service. So we will be completing the metro projects which are in the next 2 years, 2 to 2.5 years, we will be completing the metro projects which are being constructed at this phase. I think that is going to be the biggest thing. Secondly, we will also be completing the road projects that are being constructed at this particular point of time. We will be, in fact, building a vast network of roads in Thane district, which is highly congested. We will be building a vast network of roads in Raigad district, which is also getting congested. We would be building a new city. We would commence the development of Tisri Mumbai, the Mumbai 3.0. The technical name is KSC Newtown, but it is called as Mumbai 3.0 or Tisri Mumbai by the citizens. So we will commence the development of Tisri Mumbai. We will also commence development of the growth centers all around MMRDA.
Well, that was the MMRDA commissioner. But moving on then, Delhi remains on a flood alert as the Yamuna River continues to swell. Following incessant rains, the river breached the danger mark on Tuesday and has now started flowing into nearby areas. Let's go across to CNN News 18's Anshul Singh for the latest on this. Anshul?
Yamuna continues to flow over the danger mark out here in the national capital, which means that all the low-lying areas across the national capital are being flooded with the water that is coming in from Yamuna. Currently at this location at which I am standing, the amount of water that you are seeing behind me clearly speaks a story for itself. Generally, the water is at least 100 meters away from this location at which I am standing, but due to the increase and flooding of Yamuna that has happened due to the floodgates that have been opened from the Hatnikund Dam in Haryana, the water level has increased suddenly, which has meant that people who were living in such low-lying areas have been shifted to safer places where the government and administration is trying to provide them with the basic necessities so that they could live their life. But at this point in time, even as we are speaking, the water level is continuously rising, and it is expected that over the next 24 hours, the water level will increase before coming down eventually, bringing some sort of a relief to the people of Delhi who have to leave their residences, taking all the necessary things with them. At this point in time, the situation continues to remain tense across North India as well, whereas flood reports and landslides have been reported from all across the high ranges of Himalayas, which eventually results in floods in these low-lying areas. Now, once the water resides, it remains to be seen how quickly can the administration and the government make sure that the people who have been displaced can get back to their homes and live a safe life.
Anshul, thank you so much for bringing us the latest developments. But moving on then, Punjab is also facing its worst floods in decades and has been declared a disaster-affected state. Now, over 1,200 villages and lakhs of people have been impacted. Heavy monsoon rains coupled with the release of water from dams have caused extensive flooding in many districts. Now, at present, about 3.7 lakh acres, of farmland remain submerged underwater. With that, that's all the action we have on this edition of Business Lunch. We're leaving you with the Nifty trading with a gain of almost 30 points. Don't go anywhere. Midcap Radar takes the action forward.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra and joining me today is Hormis Patakia. For the markets, it's a 36-point uptick that we're seeing on the Nifty, but it has been very volatile. We've been seeing that 100-point range in which the market has been moving. The mid-caps, they are outperforming. But we'll talk about individual stocks in greater detail. Let's start the show with the top headlines. Stocks stay range as the crucial meeting of the GST Council on rate rationalization kicks off. Metals shine with the index rising over 2.5%. IT drags mid-cap scale.
Netweb Technologies gains after the company receives a purchase order for the supply of servers based on NVIDIA's cutting-edge Blackwell architecture. The estimated order value is approximately over 1,700 crore rupees.
Indus Towers is set to piggyback on Airtel to foray into Africa, starting with Nigeria, Uganda and Zambia, to move to scale and diversify its business. While positive, will hit dividend payouts, a key concern for investors.
Moil has gained after the company raised its FY26 production guidance. The company also reported a 17% rise in its manganese ore production in August. The stock is up over 4.5%.
Eternal's food delivery arm Zomato has upped platform fee for orders by 2 rupees to 12 rupees ahead of the festive season. Analysts see the move as modestly positive as some of it may trickle to delivery partners. The key concern remains competition from Rapido. Okay, those are the top headlines. Let's detail the market moves as well. As I pointed out earlier, it's been quite volatile, but for now, Nifty is holding in the green. There's some recovery from the lows, but we'll have to see. It's still lower from the highs of the day at 24,649 today. Midcaps also seeing swift buying from the lows of the day. That index is outperforming with gains of 171 points. IT, financials and media, these are the three pain points in the markets currently. But metals and pharma, they are batting it for the bulls, and a lot of moves in those particular names as well. But we have to talk about individual names now. This is our segment Mid-Cap Movers. Hormuz has gone across to the big wall. He's going to take us to the mid-caps that are moving around in trade. Hormuz.
Plenty of stock-specific activity in the broader markets and on very, very sharp volumes and significant moves as well in terms of price action. You take a look at some of those movers in the broader markets. TBO Tech is one of them, of course, on the back of the news. We'll get to that in just a bit. But some of the gainers, look at NMDC Steel, 10% higher on the stock. Piramal Pharma was back above the 200 mark in just a couple of minutes earlier. Sirma SGS did not move yesterday on the news, but now is up 5.5% in today's session, and Tejas Networks too seeing gains of around 5%. A sector that has done well today has been the metals pack, and the metals index is up over 2.5%. And take a look at these names. JSPL is up 5% as a positive note coming in from CLSA earlier in the day. SAIL is up 4.5% as well. Hindustan Copper doing well. All the stocks on the metals index are trading with gains as we speak. Some of the newsmakers today, of course, as I mentioned, TBO Tech on the acquisition news up 14% now, is extending its gains. Netweb Technologies after the order win, as we just highlighted. Indus Towers has seen a very sharp recovery from the lows of the day. At one point was down 5%, is now trimmed its losses to just 2.5%. And Jain Irrigation announced a QIP approval yesterday. The stock is up 7% today. And of course, there are stocks that are bucking the trend on the downside as well in today's session. Some of them seeing profit booking, say for the likes of Phoenix Mills. They were the ones that were moving on the back of a positive brokerage note. That is down 4% today. JK Cement is down 3%. Intellect Design and eClerx too seeing some bit of losses in today's session. Both of them too down to the lowest point of the day, Sonal.
Okay, all right. So some interesting names there. Thank you so much for joining us with those movers. With that, we'll slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back. You're still tuned into Midcap Radar on CNBC-TV18. Let's get a corporate conversation going. Rajiv Mantri, Chief Financial Officer at Bandhan Bank, joins us now from the Motilal Oswal Annual Global Investor Conference. And we'll focus on three main points in the segment. Will the loan book growth pick up from here on? NIM's or NIM's trajectory as the loan book tilts towards secured portfolio, and levers for return on assets going ahead. Mr. Mantri, thank you so much for joining in today. Let's start with the first thing, and that's the loan growth. It has taken a backseat for a while. You got it for 8 to 9% growth for FY26 during our last conversation. You also indicated for around 15 to 17% CAGR growth over the next 3 years. Is that still intact? Can we see that growth come by in the second half itself?
In terms of the loan growth trajectory, definitely we've seen the industry level growth coming down. Almost 5 quarters ago, what used to be at 20% industry level credit growth is now down to almost 9.8%, right? As within that context for us also, we had seen in our Q1, I think the overall loan growth being around 6% year-on-year basis. But actually, if you look at the components within that, our secured book, which is the non-EEB book, which is the non-microfinance, that grew by a good 27%, right? And I think that momentum is what we still see continuing. That's largely led by a retail business, our commercial banking business, as well as the housing finance business. So that momentum is on. On the other hand, for microfinance, which we call as emerging entrepreneur business or EEB, we actually saw 15% year-on-year decline. Now for that, actually industry context is industry declined in the year by almost 17%. So we did slightly better. But that's where we expect the trajectory to start picking up. We're looking at a moderate growth of say around 5% or so. And we do expect, I think by the end of the year, towards the end of the year, that trajectory should come through. So our overall guidance of 15 to 70% credit growth is something that we will still stick by. And the reason being that we are confident about the momentum on the non-EEB business. And I think on the EEB, there will be definitely sequential recovery that we expect, especially after the monsoon cycle from Q3, sometime in Q3 onwards, where we expect that the recovery should start to come through.
Mr. Mantri, good afternoon. Thank you for joining in. Do you as a bank have any aspirations for growing in the secured segment this year? You have around 52% of your book, which is in the secured assets now. What are your near-term targets? Where you find comfort given the risk-reward ratio from the secured to unsecured business?
So I think secured mix, we've seen really good progress. In March 2024, we used to be at 42%, and by June 2025, we are at 52%. So we've done almost a 10% increase. I think by FY27 end, we expect this ratio to climb up further by another 5 to 6 percentage points. And that is primarily driven by a higher growth that we are actually expecting in our secured business, which is housing, retail, as well as commercial banking. Whilst the EEB or the microfinance book will grow, but that will grow at a more moderate pace. And therefore, as a result of this pace of change, I think the secured mix will grow further. But we see at least another 5-6 percentage point increase over the next 7 quarters.
Okay, Mr. Mantri, you did mention that NIMs will remain weak next quarter and improve thereafter. Is it fair to assume that exit NIMs will be around the same level as quarter 4 of FY25, which is 6.7%? I'm asking this as you're tilting your portfolio also to secured assets. What should the normalized NIMs be where you find comfort now?
So I think on net interest margin or NIMs, there are 3 or 4 factors to talk about. One is clearly as our secured mix is increasing, we will see some bit of a moderation on the NIMs will come through, right? Between the EEB book and the secured book, there's a 10 percentage point difference in yield. So therefore, a 5-6% increase further would mean a 50-60 basis point impact. But that's over the next 2 years, right, by FY27 exit. During the year, what's playing out as a second factor clearly is the repo rate reduction. So as you know that the repo rate reduction which has come through has impacted some portion of the assets immediately. So from Bandhan Bank's perspective, 45% of our advances portfolio is repo linked. In the first quarter, we saw a 25 basis points reduction, and in the second quarter, about a 75 basis points reduction, which is affecting the 45% of the portfolio, right? Now that impact comes through immediately. But what we've done to offset this reduction, plus also I think 5% of our portfolio, which is MCLR linked, we have a 200 basis points reduction there. So some bit of an impact there also. But what we've done to offset this is that the deposits rate we have relooked at. So in the savings account, we've already done certain reductions, which have come through from the month of May itself. In the first quarter, compared to the fourth quarter of last year, we saw 19 basis points reduction in cost of deposits, and that's because of the savings rate reduction. Some bit of reduction further is coming through in this quarter, but the term deposit reductions that we have done, which largely see an impact in Q4, some in Q3, but mostly in Q4 and some portion in the first half of next year. Because the term deposits, when they come in for repricing or renewal, is the stage where you'll see the benefit come through. So there is a timing sort of a difference where the repo rate immediately impacts some portion of the book right now from an asset perspective, but the offset will come through over a period of time. So you may see, say, the NIMs softening a bit more, but then climbing back up again. The third factor is the slippages. As the slippages reduce, which is our expectation going forward in the Q3 and the Q4, the interest reversal will be lesser, and therefore that will also give some bit of a benefit. So I think it's a function of these 3-4 factors and how it will play out. So as a result, we may see, say, NIM softening a bit steeper in this quarter, but thereafter increase up again. But overall, I think the NIM trajectory should be aligned to the guidance that we're giving.
What about credit costs, Mr. Mantri? You have guided for 2.5%. Do you see any risks to this target? Because there have been some concerns with regards to your return on assets. And apart from the lower credit costs, what other levers do you have in place to get that ROA back above that 1.5% level?
So I think on returns on ROA, I'll probably give a slightly longer term trajectory. What we have said and what we guided is by the exit of FY27, I think we should be able to reach somewhere around 1.8% ROA, give or take 10 basis points. Of course, what our starting point right now is for the full year, financial year 25, we are at 1.5%. But because of the elevated risks or delinquencies in microfinance, our latest quarter, which is Q1 FY26, was around 0.8%, right? So the trajectory is really from the 0.8% to a 1.8% over the next 7 quarters. How that will happen is really a function of that the EB book should start to grow up again, right? The trajectory of growth, which is still not witnessed, we are expecting by Q3, Q4 will start to pick up. The portfolio quality improvement should start to kick in sometime in Q3 and Q4. Sequentially, we are seeing an improvement, but we are expecting, let's say, the cycle becomes a lot better by Q4 of this year and then sometime into FY27 as well. The third is really the various investments that we're doing in terms of our cost, in terms of investing into talent, technology, as well as infrastructure, especially to do an accelerated shift towards a higher secured book, as well as grow our deposit franchise further with the right quality mix. I think those will start to play out its dividends. We are building into a lot of capabilities, newer areas like trade, transaction banking, FX, and so on and so forth. That should start to result some benefits as well. And of course, once the credit cycle normalizes, how the credit costs will play out, I think that will be another determinant. So I think that's the reason, that's the way in which the trajectory will move from the current 0.8% to the 1.8%. Of course, the timing of it will depend upon how each of these factors play out by themselves.
All right. Thank you so much, Mr. Mantri, for joining us and giving us details on the outlook going forward on NIMs and ROA as well. That's the word coming in from Bandhan Bank. Well, for the markets, let's take a look at what's happening there. It's a 60-point uptick now, so there's been some buying that's come by, and it's largely coming from these metal names. So Hindalco, JSW Steel, Tata Steel, all these names are giving some support to the Nifty as well. We also have some buying coming in SBI, so that's the reason why we are seeing that high levels on the Nifty as we speak. The pharma index is the other one, which is high by 1% as we speak. We'll slip into a short break now. When we come back, we'll get chatting with management of TD Power Systems up next.
Welcome back. Continuing our conversations from the 21st Motilal Oswal Annual Global Investor Conference. We are now being joined by Nikhil Kumar, the Managing Director at TD Power Systems. And the discussion today will be focused on three major talking points: the ordering activity that we have had in the second quarter and the order wins, the impact of the tariffs on the business, and the revenue guidance for the full financial year. Mr. Kumar, good afternoon. Thank you for joining in. Before we get down to business, firstly, let's get the tariff headwind out of the way. There has still the 50% tariffs now in place. You had mentioned that you will revisit your guidance after the issues are clarified. Your consolidated revenue guidance for the full year is 1,500 crores and 1,800 for the next year. Do you still stick to that, considering we are currently in a 50% tariff regime, and then maybe things get better going forward? But what is your current assessment because of these tariffs, and what does that do to your guidance?
So at the moment, we are going to be upgrading our guidance for this financial year as well as for next financial year. We are in talks with our US customers about opportunities in which how we could manufacture our generator in another country. We have a full plant in Turkey. It's an operating plant since 2017, and we have the potential to manufacture our generators over there. Turkey is right now subject to 15% duty, so one of the options we're discussing very seriously with our customers is to shift our production from India to Turkey and not lose any of the market. So that's the plan right now for the short term. Let's see how this tariff thing works out for after 3 months or 6 months. If this continues in the long-term way, then we will have to think about how we're going to be able to have sufficient capacity to meet our customer expectations for FY27 from another plant which is not based in India. Of course, this is not good for India, but a 50% tariff is basically a no-trade tariff.
Mr. Kumar, you mentioned that you'll be upgrading your guidance. Did I get that correct? So will you upgrade it from 1,500 crore rupees in FY26?
Yes,
how much will that be? How much are you upgrading?
Yeah, we'll be upgrading our guidance. Yeah, we will be upgrading it. I'll be giving you this, giving the market these numbers only at the end of H1, when I do the earnings call at the end of H1. But we are going to be upgrading the guidance.
Okay, so you'll be upgrading the guidance. You'll be giving us those numbers after Q2. The other point that you mentioned is that you will be shifting your operations to Turkey if this 50% regime continues to export to the US. Will it impact competitive intensity in some case? Will you have to take hit on margins? Will it mean more investments in some form? What kind of major shifts would it bring to your P&L?
Look, right now we're discussing with our customers about the impact of all this, and everybody has an open mind because today all countries have some level of tariffs, whether it's India or whether it's the European Union or whether it's Japan, or all countries have tariffs of some kind or other. So it is going to become more expensive for the US, for any US importer, any US company to buy overseas products. Now, 50% is not workable. So right now we are discussing with our US customers what is the threshold under which we find a solution that doesn't impact them that much and doesn't impact us that much. So I don't foresee any reduction of our EBITDA guidances that we've given so far. For this year, for sure, we'll be able to keep our guidance what we've already given, which is around 18%. And once we have clarity on how we're going to be dealing with the US exports, we will give the guidance for next year. At this point of time, there's so much of uncertainty about which way things are going that even the discussions and decision making is not happening rapidly. Discussions are there, channels are kept open, but at the moment things are so uncertain that it is hard for me to also say it's going to be like this or it's going to be like that.
How much is US as part of your overall business, Mr. Kumar? And are you currently still in the conversation stage for moving production to Turkey, or has some part of it already moved? And once, in a hypothetical scenario, once things get better, once a deal is signed, say by fall or by end of this year, what happens to the production that has been shifted to Turkey? Does that come back to India?
Yeah, I mean, I would like to do that for sure. So, we have an existing plant in Turkey, so it's not like we need to make an investment over there. We opened this plant in 2017. We run that factory. We're producing for the Turkish market. We went up to something like 125, 150 crores in that plant. So we have a big capacity in that plant. And we will produce from there. But obviously my preference is to produce from my home country. And so if the tariffs come down at some point of time, we'll bring it back. First preference is to India, always.
And how much is US as part of your overall business, Mr. Kumar, if you could tell us that as well?
I don't give country-wise breakup, but the US is a really important market for us.
Yeah, that point. So, Mr. Kumar, how has ordering activity been in Q2? It saw a 62% increase in Q1. Has that momentum continued? What's the take right now?
The order inflow has been extremely strong, and that's the reason why I'll be giving an upgrade in the guidance. The numbers are exciting. To say
Better than the Q1 62% increase that you saw?
That's a very leading question, but the numbers are really good, and I think when I declare the numbers at the end of H1, I think the market also will be excited about the numbers.
So does that continue in the second half as well, Mr. Kumar, with the ordering activity that you have mentioned? Are there any large
yes,
orders?
we are in multiple segments. We are in multiple segments, multiple businesses all over the world. We work for the gas engine business, gas turbine business. We're working in Europe in a big way. The number of projects in Europe. We do a lot of hydro in different parts of the world. So we have multiple businesses, and we're very well diversified in terms of product range as well as geography. So the market is really strong right now for power generation.
Okay,
so
we take that
good
point.
numbers coming in next year too.
Take that point, Mr. Kumar. It was a pleasure speaking with you. Thank you so much for joining us and giving us a sense of what's happening with the business on ground and specific to the situation of US tariffs as well. The stock is higher by 7% as we speak, has been the case since we started the trading day as well. But we do one thing. We will take your leave on this edition of Midcap Radar, but do stay tuned. Your stocks when we return.
Hello and welcome to Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. And markets, not much of an upside or a downside, right? A muted day of trade is what we could call, and managing to hold on to gains of around 60 points as of now is what we're seeing for the Nifty. Sensex also is similarly holding on to gains of almost 150 points. So not much of a change that we're seeing coming in there. Now, broader end of the market, that's where we're seeing an outperformance coming in today as well. So whether you look at the Nifty mid-cap or the Nifty small cap, managing to hold on to some bit of a slight bit of a better gain than at least what the benchmark indices are doing. So not much in terms of a move, but yes, better versus benchmark indices. Advance decline ratio clearly in the favor of advances versus decline in today's trading session. Apart from that, today we have IT that's not performing well. So IT is down almost 1%, while in terms of the Nifty Bank, that's managing to hold on to gains of 0.3%. We're seeing that underperformance was there for Nifty Bank. Now that's coming back, right? So Nifty Bank is also holding on to gains in today's trading session. Apart from that, keep an eye out on the pharma pack as well. But that's the market setup that we're watching out for today. But this is a show where we solve all your stock-related queries, and to do that, we have Asta Jain, research analyst at Hem Securities, as well as Somal Mehta, head of alternate research, capital market strategy at Mirae Asset Sharekhan, joining in with us this afternoon. Asta, as well as Somal, good afternoon. Thank you so much for joining us on the show. Somal, today in terms of the market, what we're seeing is a very ranged bounce session, right? 25,000 and 500 around, we're seeing the levels coming in for the Nifty, that right? So we're keeping out the 24,000, I beg your pardon, 24,600 levels for the Nifty. What are we watching out for now in terms of a level?
Good afternoon to everyone. See, at this point of time, there is a very range-bound movement, and we've been in this range for a very, very long time, around 24,000, 25,000 levels. I'm talking about a very broad range. Now, in the very, very short term, what we are seeing is that there was a correction, and now after this correction, there is a very crucial support around 24,400 and 24,200 levels. So this zone has become very, very crucial in the medium-term outlook as well. In the very short term, support would be around 24,500 levels, and I'm not expecting markets to go below those levels, and I'm expecting markets to go towards 25,000. So my view is bullish. The main thing is that the most important thing here is that the Bank Nifty has taken support at 200 daily exponential moving average, which is 53,580 levels, are around those levels. And this bottom has been forming since last 4 trading sessions. So that is the most important part here. My targets would be around 55,000 for Bank Nifty. So I'm bullish in the short term as well as in the medium term outlook.
Okay, bullish on the short term as well as the medium term outlook that we're watching out for there. We have some news flow that's coming for Capital Point as well as Arcade Developers. Keep an eye out on both these stocks, a bit of an up move that we're watching out for. But let's get started with all the stock related queries for today. The first query for today is coming from Kiran, who's writing to us from Mumbai. She's holding 1,25,000 shares of Orient Green Power. This is at a price of 14.33 rupees is a purchase price, currently at 13.93. Wants to know the outlook for this investment. Asta, good afternoon. Orient Green, I don't see this, much talked about in terms of a stock, but what should the viewer do?
Hi, good afternoon, everyone. So talking about Orient Green, this is, one of the leading independent renewable power producers in the country, as we all know. And now if I talk about the results also, what we have seen in the results were quite decent on the year-on-year basis. They have shown a strong performance of more than 30% rise in their top line. In fact, in the EBITDA margins has also seen an increase of around 3% or 300 basis points. So I think on the back of the results which the company has posted and the kind of improvement they have shown in their bottom line especially, I think this company is well poised to move till the levels of 16 rupees. So idea here is to stay invested for the price target of 16 to 16.4 rupees.
Okay, keeping an eye out on those levels over there. So, Samal, your view for Orient Green?
I think for Orient Green, my view would be cautious. Stop loss for someone who has already taken a position would be around 12.60, and I'll be expecting there's a range between 15 rupees and 13 rupees, and if this range breaks on the upside, probably that will be the most important break at this point of time for a target of around 17 rupees. So I'm positive on the stock, a little cautious as well, with a stop loss of around 12.50.
Okay, a little cautious as well. Keep an eye on the stop loss also. That will be important here as well. But let's move on to the next query for today. We have Lijo, who's writing to us from Kuwait. He's holding 250 shares of Bandhan Bank. This is at a price of rupees 500 and wants to know whether to hold or exit at the current levels. Bandhan Bank, looking at their investment, they bought it at a much higher price. Astha, what should they be doing now with Bandhan Bank?
So the problem with the bank, especially in their financial performance, was their, stress in their EEB portfolio. And I think that is majorly weighing down the counter. And that's why we have seen the stock prices are not moving in tandem with the, other banks or with the markets also. Now, the growth momentum, which we believe for this bank is not that strong and it remain muted. And hence, we are not very much positive since the cost price is very high. So idea here is to stay invested at least till the levels of 190 or so and try to exit at the higher level. Maybe 500 is the level which we will not be seeing at least for the 6 to 9 months from the present point of view. But one can make exit at the higher levels rather than exiting from this counter at this point of the time. So I think exit at around 190 or 200 odd level is a better strategy.
Okay, keep an eye on, can exit at the levels that Astha has mentioned. Saumil, what's your view? Bandhan Bank, right? Because the viewer seems to be holding it for a while. 500, I think the last time it was there was somewhere in end of 2019 and 2020 beginning, around that when we saw these levels. What should they do now? What are the levels to maybe look at exiting? And 500, if they're willing to hold on to a year or two, does it merit holding then?
I don't think so. A long way to go. Long way to go. The stock has been struggling to go about 200 daily exponential moving average for a very long time now, and I think it's best to exit this stock and get into some other stocks like even ICICI Bank is at a very good level. HDFC Bank is at a very good level. So I think I would suggest to exit this stock and get into some large caps.
Okay. Can look at getting into, exit the stock and look at getting into large caps. That's the word there from Saumil as well. Next query for today is coming from Vishal, who's writing to us from Gujarat. He's holding 30 shares of Max Healthcare. Buy price is 560 rupees per share, currently at 1,155. So making a profit on this one. Wants to know the long-term view on Max Healthcare. Astha, hospital space overall, pharma space, everyone is positive on this one. Max Healthcare, do you see there's further upside? What are the triggers that could come in here?
So I think capacity expansion can be one of the trigger because the management is expecting the capacity expansion. I mean, they want to double their capacity from 4 to 5 years down the line. And what we have seen that the financial performance was also very strong. They have got a very strong average revenue per occupied bed along with the higher occupancies. So both these ratios are real good indicators for any hospital counter along with the capacity expansion plan which this management is expecting to do in the coming 3 to 4 years. So my idea here is to stay invested, although investor is making very decent profit as of now, but still I think one can wait till the level of 1,300 to 1,400 in the medium term. So hold as a strategy from my side for this counter.
Okay, hold as a strategy for on the fundamentals. On the technicals also, would you suggest the viewer continue to hold the stock, Saumil, or maybe book out some bit of that profit?
At this point of time, I think we've already seen a good correction here, and I'll be expecting this stock to go down till 1,100 levels. But I'm not expecting the stock to below to 1,100 levels. So I think hold is my strategy, and probably on the upside, I'll be expecting 1,500, 1,600 levels in the long-term outlook. So hold would be my suggestion from here.
Okay, hold coming in on the fundamentals and the technicals as well. Next query for today is coming from Anil, who's writing to us from Chandigarh. He's holding 533 shares of BSE. This is at a price of 2,586 rupees per share, making a loss on this one. Should he look to average or just remain invested right now? Astha, your view for BSE, right? There are so many papers coming in as well in terms of the tenure of maybe the derivatives trading side as well. So a lot of changes that one is watching out for. But BSE, should they look to average or just stay invested?
I think stay invested is a better counter because I think this is a better choice. I beg your pardon. So stay invested is a better choice for this counter as of now because what we believe is that this counter will show good growth in the long term because in fact their volume growth has been very strong led by the derivatives. In fact, the company has also shown a strong reduction in their cost price. That is what we have seen in the EBITDA also. But right now the valuation seems to be quite stretched. So maybe the stock can move further downside from here just on the basis of the market conditions also which we are into. So averaging as at this point of the time is not recommended, maybe at the lower levels. But yes, one can remain invested in this counter for the price target of 2,500 in the medium term.
Okay, medium term target you're saying is 2,500 is what one could be watching out for. So remain invested. Not right now is not the right time to maybe look at averaging. Saumil, your view for BSE?
I think in the very short term, definitely negative. In the medium term outlook, I'm expecting the stock to go up as well, positive in the medium term outlook. In the short term, maybe 2000 levels or 1900 levels are also expected. A little downside I'm expecting, but see, we've seen a very good rally from 1200 levels to around 3000 levels. That's a very good rally in probably 4 to 5 months for BSE, and the correction we've seen was also expected. And a little more expected, but these levels, I would say, if you are looking for a long-term investment, then hold on to the stock, and probably I'll be looking for new highs as well.
Okay, keeping an eye out on these levels over there for BSE. But on that note, it's actually time that we take a very short break. But here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store, Google Play Store, or you can just scan the QR code on the screens. Welcome back to Your Stocks on CNBC-TV18. We still have with us Astha Jain as well as Somal Mehta of Mirae Asset Sharekhan. But a quick look at what the market is doing, right? Inched up a bit more in today's trading session. As of now, up 81 points. Day's highest point, 24,660, around that mark. 0.3% of gain. 80 points uptick for the Nifty as well as Sensex, up 200, more than 200 points. So keeping an eye out on that. Gains coming in from Tata Steel, Hindalco, GSW Steel. All these metal names are something that are buzzing in trade today. But let's keep it going with all the stock-related queries. The next query for today is coming in from Bala Subramanian, who's writing to us from Bangalore. He is asking if he can invest 2 lakh in Samvardhana Motherson, and this is for a period of 6 to 9 months. Considering the recent pickup in the auto sector, GST changes that will be coming in as well. There's a meeting going on. Astha, your view. They want to invest 2 lakh in Samvardhana Motherson.
So I think Samvardhana Motherson, definitely it is a good choice, but I don't think that entire 2 lakh rupees should be invested in one stock. So here the lump sum amount should not be invested because the other stories are also looking good to us at this point of a time, in which FMCG, especially if I talk about the FMCG or the consumption space, Tata Consumer Products, Titan, these counters are really looking very strong to me. So I think rather than going for the investment only in one stock, it's better to diversify it in the various sector. Now talking about the Samvardhana, in fact, this is also looking good to us with a price target of 108, 220 in the short to medium term. We are expecting this counter to move till those levels. Talking about the fundamental seems to be very strong, because what we have seen that the demand for the light vehicles which remain muted, although with that also we have seen that this company is continue to outperform its industry averages or the industry peers. So I think that is looking very good to us, and we believe that it is one of the good automotive story in the long term. But investing entire amount is not recommended only in one counter at this point of time.
Okay, do not invest just in one counter. Astha has given some other names also on the consumption story side where you could look to invest in. Somil, your view coming in for Samvardhana Motherson, and should they look at investing the full amount there? Given that, in the last 1 year, we had seen that correction coming in. If you look at the 1 year chart, right, from 141 highs, now it's at 96. So what are you watching out for here?
Absolutely positive in the medium term outlook. In the very short term, there is hurdles around 102, 103, and then there is a hurdle around 108, 109. So I would wait for the 108 level to surpass for a medium term outlook. In the very short term, I'm positive for us with a stop loss of around 93, and I'll be expecting a target of 102, 103 levels. But once the stock closes above 109, that will be the right time to go ahead and buy for a medium to long term outlook for a target of 120, 125 levels. But I would definitely not suggest to invest everything in one stock. Keep your portfolio diversified in different sectors, and even if you are putting the entire money in one sector, choose different stocks.
Okay, choose different stocks. Do not just invest everything in that one basket. That's the word coming in from Somil as well right now. And the levels that he mentioned for the short term is going to be somewhere at 102. So for the short term, yes, keep an eye on that. And then around 109, he mentioned that then we could see a bit of a run up coming in post that. But yes, that's going to be for the medium to long term story. So you're a short term investor, then 102 is the near term target. Do not invest everything in one stock. That's the word there. Let's move on to the next query for today. Now, this query is coming from Swati Jain, who's writing to us from New Delhi. She's holding 50 shares of LIC at a price of 900 rupees per share. She's asking if she should remain invested or, book out her losses. Astha, what's your view?
So I would suggest to remain invested in this counter, and definitely she will see her cost price of around 900, because we are giving a price target of 925 to 930 for this counter. So remain invested. Now talking about the fundamentals of this counter, we think that some of the strategic execution which this company is doing are on the track for the product. In fact, we have seen the margin improvement, volume growth, along with most important point of the VNB growth, which was double digit, I suppose. So I think on these parameters, the counter is looking good to us, and hence recommendations to stay invested rather than booking losses, at least for the cost price or levels of 925, which are somewhat above than the cost price also.
Okay, keep an eye out on those levels over there. The next query for today is coming in from Raja Mani Subramaniam, who's writing to us from Mumbai, holding 5 shares of HDFC AMC at 1,100 rupees, right? That's the IPO price. He's asking whether to book profits now or and he wants to buy more shares as well. Somil, what's your view for HDFC AMC? Somil? Okay, I believe we've disconnected the line with Somil. So, Asta, your view for HDFC AMC, given that these AMC names are, expected to do well, the capital market side, what is your view for HDFC AMC?
So we have seen that the HDFC AMC has shown very strong yield on their overall AUM. So that is really looking good to us. In fact, we have seen a strong or a healthy inflow as well as a market share gain, which this company is making. So it's a good choice to remain invested in and a good counter in the AMC space. Price target can be set at around 57.50 odd levels.
Okay, keeping an eye out on those levels over there for HDFC AMC as well. But that was the last query for today. Somil as well as Astha, thank you so much for joining us on the show. And viewers, thank you so much for sending us your queries as always. A quick word in terms of what the market is doing right now. We did see a bit of a run-up coming in the last few minutes as well for the Nifty. Nifty as of now, 24,660 levels. Sensex is up 235 points, 0.3% of gain there. Mid and small cap, that's seeing an outperformance coming in. So Nifty mid cap is up 0.5% in today's trading session. Day's highest point even for the Nifty mid cap. Nifty small cap also is at the day's highest point, 0.7%. So clearly outperformance continues from the broader end of the market. That advance decline ratio furthermore improving in terms of the advances versus declines as well. And as of now on the NSE, there are around 1,921 stocks which are on the advance side versus 900 stocks on the decline. And you can see that gap increasing there. But with that, we'll wind down this edition of Your Stocks in CNBC TV18. Thank you so much for tuning in. Up next, you have closing bell.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The ASX 200, Nikkei, Shanghai are trading in the red. Now, what is holding on to the green is Taiwan Index as well as Hang Seng.
Well, but India has, you have to understand, for many years it was a one-sided relationship.
Market seems to be finding a bit of resistance. Yesterday's high is 24,756. That's the first resistance level. 24,600 is where the Nifty is at. It's flat, absolutely flat.
With ease of living and the ease of doing business over a period of time with entrepreneurship and a conducive policy environment, you are going to see a consistent long-term growth. This is my view.
States are very clear that they want revenue protection and a clear-cut direction on protection for the consumers.
From a GDP point of view, is maybe 0.5% at most.
60-point cut on the Nifty. The Bank Nifty too is seeing some cuts. It's been volatile in the last couple of trading minutes.
We would want to continue to focus on operating leverage, cost excellence, and continue to scale with profitability.
For the markets, it's a 36-point uptick that we're seeing on the Nifty, but it has been very volatile. We've been seeing that 100-point range in which the market has been moving.
Okay, well, that is the day so far, and markets, of course, a bit of a yo-yo, right? I mean, got to the high point, was up about 80, 90, 100 points. Then there was a sharp sell-off, almost nothing left, and now we're back up about 85 points. So 24,664 is back on the table, looking a lot better. This is, of course, Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Rima should be with us in just a bit from now. Guys, good afternoon.
Hi, good afternoon. So I guess not bad considering yesterday was that disappointing second half sell-off. So compared to that, I think lower expectations. It's not looking too bad. In fact, the screen, if anything, is it's a reversal of yesterday because for what it's worth, we are at the high point. Now we need to see if these gains can be digested in the last hour. A lot of metal stocks shining, a lot of other large cap names shining from auto, from FMCG as well. So overall, Nigel, not looking too bad.
Well, that's right. And this is sometimes what you normally see on the next day of an expiry. So Tuesday was the expiry this time around. And yesterday, the last 90-minute move could be attributed to expiry. So that could be unwinding all the pain that we saw yesterday, point number one. Point number two, Surabhi, for me today, what is encouraging is not just the broader markets are doing well. The biggest drag on the index is the Nifty Bank. And that's gradually trying to make its way higher, which is encouraging. You want the Nifty Bank first to stop falling, then move in line, and then maybe outperform. It's been a big underperform in the last 1 month or so. So I think those two are big positives for me.
All right. Yesterday's high, and point taken, Nigel, yesterday's high for the Nifty, right? I think that's the first port of call, which is 24,756. We are, I think, about still 100 points away from that particular level. But that's the first one which the market needs to take out. I think as we trade right now, we should be, I think, at the 20-day moving average, almost exactly right now. So the 20-day is 24,692. We're at about 24,670. So about 20 points away from the 20-day, but about 100 away from yesterday's high. And beyond that, I think there's perhaps is more repair, recovery. But it's, next 2 days is going to be interesting because there's a lot of pre-positioning. People are focused on, this sector, that sector. Where is the relief coming? GST-related changes, etc. So some stuff being priced in. Some will be unwound. There will be sort of excitement in some places. There'll be disappointment in others. So you've got to keep all that in mind. And the other point, right, when is the announcement with regards to GST going to come? Is it going to come during market hours tomorrow? Is it going to be after? And I think that's also, at least from a near term, very near term, for those who are trading these things, is going to be an important fact. Let me just quickly run you through what's coming up here. So stocks are higher. Street continues to look for the GST meeting for cues, rate rationalization, etc. in focus. Metals are the big mover, and Nigel will tell us more about that in terms of what the hope really is. We have E2E Networks, which is a big mover. There is also NetWeb, which is looking up. We've got some info on both those. TBO Tech, big one, 10% higher. Stock's done well. They've run an acquisition, and Winnie will join us in just a bit to talk about that as well. Rima is here with us as well. Rima, hi.
Hi, I can't take my eyes off the metal screen. Look at what a smart move. 3% up on the metal index, higher for the third day in a row. And that is powering the sentiment today. The dollar index is weakened. There is hope that perhaps some GST rationalization will boost the pure stocks, which you're in the real estate space, for instance, building materials, etc. And that's keeping the sector alive. Pharma is another one up and about. PSU banks are strong in trade. And generally, the broader markets are higher. The mid-cap index is up about 0.5%. The small-cap index is up close to about 0.8%. How should you position yourself in the last hour of trade? Mitesh Thakkar from Bonanza Portfolio is now with us on the show. Mitesh, on the long side, what's the trade for the last hour?
Yeah, I think definitely on the long side. See, good afternoon. One thing is that we have very strong supports around this 400, 350 zone. The PCR is still on the negative side, which means that we are on the oversold side. And therefore, I think, in case this range trade has to prevail, the direction, since we are coming from near the lower end of the range, the direction should be on the upside. So I think with that sense, the market should first head towards 24,800 on the spot, which is about 125 points higher. And once we start getting past that 24,950, 25,000 is a minor supply pivot, which could be the next target. Having said that, on the stock side, Inox Wind is something which is interesting to me. It's, fallen a lot and then did some base building. Around the levels of 137, 138 is now reversing. So it's a conditional buy. Once it breaks about 146, which is about 1% away from here, I think that will be a big reversal. So buy about that 146 level, keep a stop at 143, look for a target of around 160 plus. And the other one is Jindal Steel. You're talking about metals. I think that's one sector which is looking extremely good. So I have a buy on Jindal Steel. Keep a stop below 1,004 and look for targets of 1,080.
Okay, all right. Those are individual trades coming through at this point in time. But let's go back to the Motilal Oswal Annual Investor Conference, which is, of course, in its third day today. Gautam Dugat was with us earlier when the conference was kicking off. He's back now to give a summation of what he's picked up. He's Director and Head of Research Institutional Equities at Motilal Oswal. Gautam, welcome back. So you told us, you will tell us on day 3, what are the key learnings? So distill it down for us from a market standpoint. 3 highlights, Gautam. What's the feedback like? And as I said, your takeaways really.
Hi, Prashant. Good afternoon. Good to be here. So, the conference has a long, backdrop of global macro headwinds, tariff, and on top of that, we are all anticipating the announcements on GST. So that was the high point of the conference. Everyone is second guessing what's going to come today or tomorrow. Second, we've had excellent sessions in the CEO track across manufacturing, industrials, consumption, and of course, we had a very prominent speaker on GST too, Mr. Raju Memani. So a lot of speakers highlighted opportunities on manufacturing over the next 3 to 5 years. Consumption, which has been a very weak point for last couple of years, especially the low-ticket consumption goods, that is seeing some interest coming back. Obviously, there is a short-term kicker in the form of GST. So let's see what actually transpires out there. And third, among the plethora of investors I have spoken with over the last 3 days, both domestics as well as FIs, the eye is sharply on the corporate earnings. When will the corporate earnings revive? Because the macro, the global geopolitics, all of this will keep coming and going. But what truly drives the market, as we've seen in the last 5 years, is corporate earnings. When earnings were solid between 2020 to 2024, with a compounding of 20% plus, we saw market took off. And then in FY25, when earnings were flat, we saw market give 0 returns. So everything else falls by the wayside once earnings come back. And if earnings are not there and everything else is rosy, markets still won't respond. So those are a few of the important highlights that I just thought I'll, enlist.
So low ticket consumption is one space where you are seeing a lot of interest, and there is a case to be made for things to improve and pick up. What else? Based on the corporate speak, the corporate interactions that you've had, which are the other pockets that you would be most bullish on at this juncture?
So auto is clearly the highlight. We've upgraded auto luckily just before this whole discussion around GST began. We upgraded auto from being underweight to marginal overweight in July during our preview. And now auto seems to be the biggest beneficiary of the potential forthcoming GST rate cuts. So the sentiment around auto has picked up. We saw that in the month of August. Auto index rallied 6%, and now auto is the best performing sector of the calendar year 25 YTD. It is overtaken banking, right? So clearly there is a lot of sentiment buoyancy out there. Auto numbers are fine for the month of August. There is festive season around the corner. The rural sentiments have picked up, and on top of that, there could be a GST boost. So that is one sector which is clearly seeing a lot of interest. Second is EMS, and for the right reasons. There is huge growth out there, which we have seen for the last 2-3 years. Stocks have done well. We ourselves are projecting 50-60% earnings compounding in many of those stocks that we cover. We cover roughly 8 to 10 EMS stocks. So clearly big opportunity out there. Though the profit pool still remains quite small, but the growth prospects are huge. And what is happening right now, Rima, is in a market where the earnings growth is settling between 8 to 10%, any sector, any company which is doing upwards of 20%, is getting disproportionately high valuation premium from the investors. So any sector, like for example, we're seeing huge interest in cement because cement this year is going to post more than 50% earnings growth. Prices are stabilizing. Government has kickstarted a capex. They've front-loaded the capex in the first quarter. So that sector is seeing good demand. Then we are seeing a decent demand in the sub-categories of discretionary consumption. Jewelry, hotel, we had a very prominent speaker in the CEO track on hospitality. The demand is still outpacing the supply out there by a margin of 2 to 3% on a compounded annual growth basis. So hospitality should remain a very, very interesting space still, despite performing exceedingly well over the last 4-5 years. And then lastly, I'm seeing some interest emerging in technology, not necessarily the traditional legacy tech players, which are growing at 4-5%. So that's not seeing too much of interest, but mid-cap IT is seeing very good interest. Then of course, the likes of QSR, the likes of food delivery players. We had unlisted, food delivery company out there, which painted a very, very bullish picture for next 3 to 5 years, with the category itself growing at 20% plus CAGR. So segments and sectors which are trying to outperform the market in terms of the earnings growth right now are seeing disproportionate interest. We were in a very different environment between 2020 to 2024 when every sector was growing well. So today, the scarcity premium on growth is running at a very elevated premium.
I'm glad you touched upon that last piece on technology, Gautam. Hi. I was just coming to that. Quite curious to know, because I think the market and investors are already looking for new age tech ideas. Now, whether that is, like you mentioned, food delivery, quick commerce, or even look at some of these stocks which have a bit of a semiconductor play attached to them. E2E networks is one, NetWeb is the other. Some talk of, GPUs and, servers, which they'll be putting out for some of the government tenders as well. But you tell us, beyond some of the names that you mentioned, anything else that you're looking at in newer age technology? There are more listings happening as well. For instance, from the consumer tech space now, Urban Company is going to be listing very, very soon. So what are you watching out? What's the new frontier of technology or AI, whatever little plays we have here?
So very good point, Sobi. We've seen definitions of the sectors evolve over the last decade. Initially 10 years back, financials was all about private banks, PSU bank. Then came NBFCs, then came capital markets, then came insurance companies and fintechs and what have yous. Same thing happened in consumption. 10, 20, 15 years back, you only had staples. The discussion was between lever and ITC. Then, you saw so many subcategories evolve in the discretionary space that today we have 3 consumer analysts in our team. Now, something similar is happening in tech. If you're positive on tech for the last 4-5 years and you were overweight on the traditional legacy names, you underperform by a wide margin. Whereas the new age tech companies have delivered fantastic returns. We just initiated coverage a couple of months back on delivery. The whatever target price the analyst had for 12 months was achieved today in less than 2 months. So clearly, fund managers, asset allocators have to be on the edge because the definitions are changing rapidly. And if you're evaluating the sector with the past lens, the possibility of you missing out on the new age or, the emerging trend is quite high. So as far as tech is concerned, as I said, if you're looking at tech, then it's very important to identify companies which are at least growing upwards of 15%, because the days when 5-10% growth was attracting huge premium, seems to be behind us. In fact, one of the data points I was looking at in December 21, the IT sector had a close to 20% weight in Nifty 50. Today, it is somewhere about 10.2 or 10.3%. So in a matter of 4 years, a big sector like IT has seen its weight in the benchmark index half, right? And it's obviously a consequence of a very prolonged period of suboptimal growth. So you're going to see similar trends evolve in various categories, be it industrials, be it consumption, be it financials, be it technology, or be it even healthcare. Even in healthcare, we are seeing that the modern health tech or the new age, healthcare companies taking market share away from the traditional guys. So the job of an asset allocator has become even harder in the last few years. And as you rightly mentioned, more and more companies are going to list in the next few months or quarters. And who knows, in 3 years or 5 years, the composition or the complexion of the benchmark indices will itself change meaningfully.
Hi, Gautam. Good to see you. When you spotted that delivery and the other one, I think, is car trade. Both of them went ahead and they bought their smaller peers. And suddenly that market itself for them became much wider because the nearest possible competitor was taken over by them itself. That said, we're going to be turning the spotlight on the metal space. And that's moves more according to momentum rather than according to what's happening on the fundamentals. How are you placed out there? I mean, what's the view? Because the coming months should be very good. For ferrous as well, things will look up because the government is playing its part. How are you all positioned out there?
Nigel, that question is for me?
Yes, on metals.
Yeah, okay. So look, on metals, oil and gas, commodities, usually we've always kept a very underweight kind of a stance because it's very difficult to time those sectors. As of now, we are very selective there on metals. We like Tata Steel, we like Hindalco, and we also heard very positive commentary from JSPL, or I know the name has changed. But look, I mean, it's very difficult to second guess the commodity prices given the churn that is happening globally on both growth, geopolitics, and demand capacity. I mean, the demand supply mix, which is ever evolving. So for now, from our portfolio point of view, we know that the sector has done reasonably well in the recent period, and even the earnings were slightly better than expectations. But for want of predictability, because it's very difficult to predict those commodity prices and the fortunes of the sectors change very rapidly, we generally tend to be conservative out here and keep our positioning slightly neutral to underweight more often than not.
Gautam, let me ask you, at the end of the conference, right, do you have added conviction on something which you were unsure about? Or from an investor point of view, I mean, I'm sure, stuff which investors wanted, companies which investors wanted to meet. Lots of these names which are kind of beaten down, and maybe it's always the case. People watching closely if there is a turn happening, or any changes broadly in your assessment of companies. If you can name 2, 3.
Sure. So, Prashant, look, at a big event like this, when there are 1,200 plus investors and roughly 200 corporates, and so much happening both domestically as well as globally, always going to be a lot of, discussions around portfolio strategies and changes and what to look at, given that the market has been range bound for more than or almost 12 months now. So we've had a decent period of time correction. So a lot of conversations happened around portfolio construction in this times, what needs to change. For example, I'm seeing some interest back on hitherto ignored sector like consumer staples. Now, it can be very opportunistic given the events which are lined up over the next few days, but at least I heard few investors discussing consumer staples, which I've not seen for a long period of time. Similarly, people who have a slightly contra mindset, they're getting, excited about large cap IT because no one seems to be talking about it. And for right reasons, because the growth has been very, very subpar. But those with contra mindset have seen 3-4 years of underperformance of large cap tech, very attractive risk reward in their view. So those are sectors which are seeing some interest coming back after a very, very long time. Amongst the ones which are already performing well and where we have seen renewed and continued interest is auto, consumer discretionary, capital market players. There's a whole host of capital market companies representing at our conference. electronic manufacturing services, EMS, defense, right? We had a very interesting session by former Army Chief yesterday in our CEO track. So clearly, there is a lot of interest in some of these spaces which have already been doing well. But at the margin, to address your query, consumer staples, large cap IT are some segments where after some time we have seen some interest emerged.
Okay, that's some ideas where I think there will perhaps be some tactical or otherwise, but pockets to think about really in that sense. Gautam, thank you very much for joining us and telling us what's been happening at that conference. Very, very busy, 1,200 plus investors, lots of CEO tracks, lots of meetings, etc. So that's Gautam giving us the intel from there. We'll take a quick commercial break here. We're going to come back and we'll have Sudeep Bandyopadhyay joining us on the other side. Markets are holding on 80 points, so 24,660, almost basically at the 20-day so far. Stay tuned.
Welcome back. So the market's trying to hold on to most of the green, at least for now. 100 points, almost 100 points up on the Nifty. As always, it's that time when Hormuz gets us the list of the buzzers beyond the obvious. Hormuz, all yours.
We start beyond the obvious, but then there is one name that has been an obvious choice over the last few days, and Ola Electric is that, of course. Yes, it is. 5 out of the last 6 sessions now that the stock has been higher. Another 10% today. Now, in these 5 sessions that the stock has gained out of the last 6, the stock is up 40%. 42% in those 6 trading sessions. Now, already we've had 75 crore shares that have changed hands today compared to a 20-day average of 30 crore. And a trend over the last 6 days that has emerged is that the daily average volume traded is above 50 crore shares every single day. And courtesy of this move, the stock is also closing in on its IPO price of 76 rupees a share. Now, a not so obvious one is Vimta Labs, and that stock is something that Prashant also highlighted earlier in the morning. There was 4 out of the 5 sessions that the stock has gained, was up 17% yesterday as well, is building onto those gains, 5% higher today. We had almost 1.7 crore shares change hands, a 20-day average of just 21 lakh. Now, the stock began the year of 2020 at 46 rupees, currently stands at 800 rupees. And you take a look at the returns annually as well. The stock, almost in the last 5 years, the stock has doubled in 2 of them, and also YTD, the stock is up almost 60% as well. Of course, mind you, the stock has no institutional holding, neither on the domestic side nor on the foreign side as well. The third one in the list today is NMDC Steel, the demerged unit from NMDC. The stock is moving 10% higher on volumes that have 6 crore shares compared to 20-day average of 1 crore. And as a result of this move, the stock has also gone above its 200-day moving average, which is at around 39.5. And the last one on the list today is Piramal Pharma. But despite the stock being up almost 8% today, it has declined in 4 out of the last 6 trading sessions. Today's volumes, almost 2.5 crore shares traded compared to a 20-day average of just around 23 lakh, and a 50-day moving average, the stock is broken above that at 198, now 201 on the stock. And an interesting nugget that Sudarshan highlighted to me in the newsroom when we, early in the morning was the fact that the stock has found support at levels of 180 4 times in the last 12 months, and it has reversed from there every single time and has significant returns from those levels. So even this time around, the stock reversed from 180, the stock now at 202, 8% higher in today's session.
Okay, thank you very much for that. Markets are inching higher now at the day's high. It's a 100-point up move on the Nifty now. When we started the show, we were up in the green for just about 30-40 points, and now the gains are getting stronger. It's banks now pulling their weight. Shriram Finance pull up HDFC Bank and Axis Bank, Kotak Mahindra Bank, particularly in HDFC Bank, has seen quite a lift in the last 30 minutes or so. There you have it, all the private sector banks. Sudeep Bandyopadhyay is now joining us on the show. Sudeep, thank you very much for joining in. Let me start with Indus Stars. The stock is still down close to about 2%, but it's managed to trim the losses. I mean, the street is concerned that this whole Africa expansion plan is going to eat into the dividends which would have otherwise come their way. Firstly, does this Africa expansion make sense for a company like Indus Stars? Is it a strategic move? And how would you address the concerns about this delay in dividend payouts, potential delay?
Well, I think, from an Indus Tower point of view, it makes tremendous sense to expand. Post what has happened with Vodafone, I think they can't rely on the Vodafone business going forward for a long term, and they needed to diversify. Their biggest client, Airtel, is already well entrenched in Africa in these particular 3 markets, which they are talking about. So it is absolutely logical for them to go and expand in these markets. I'm sure they will get a lot of support and business from Airtel in these markets as well. So I think from a long-term perspective, even medium-term perspective, I think this is a very good strategy from the company point of view. Yes, from a dividend shareholder point of view, there's a bit of a disappointment as the dividend is getting delayed, and the investors were expecting a dividend, so there's a bit of a disappointment, and market is reflecting that. But I think market will get over it. As a strategy, I think I like the strategy.
Okay, all right. Sudeep, I wanted your view on metal stocks. But first, let's run our viewers through the 5 probable reasons that, in fact, metal stocks are buzzing today. The US Fed could be heading for a rate cut, as the Fed funds futures, well, they are pricing in close to around 87% probability of a 25 basis point cut later this month. The spotlight now will shift to Friday's non-farm payrolls data, which could determine the pace and the size of the expected rate cut. So that's point number 1. Point number 2, China's anti-involution drive, that's gathering momentum. And the new measures that are aimed to cut excess capacity and curb disorderly pricing in sectors like steel as well as base metals. This in turn could help reduce the supply glut and support global prices as well. Point number 3, China's economic data actually has surprised positively this week. The manufacturing PMI for the month of August came in at around 50.5. That marks the fastest pace of expansion since March. And the services PMI came in at around 53. That was early this morning. That as well beat expectations. Point number 4, India. Well, we have gone ahead and recommended that safeguard duty on steel imports for the next 3 years. That could protect the domestic producers and also remove any kind of overhang with regard to uncertainty. Point number 5, China-India relations, well, they are improving. That's boosting sentiment as well. So those are the top 5 points and probable reasons why metals are excited. Well, company-specific data as well is looking up for the month of August. MOIL, they delivered a solid growth number, and they have, delivered close to around 17% growth. But they'll have to up their game to meet their ambitious 20% volume growth guidance that they've set out. So that's on MOIL. Pricing as well has improved on MOIL. On Coal India, they delivered their first positive month after 4 straight months of decline with regard to the dispatches. So the street likes that. NMDC, well, they delivered good growth. That was fueled by the growth, 25% growth that we saw in Karnataka. So company-specific as well, things are looking up. Globally as well, things hopefully are on the mend. So to sum things up, dovish Fed signals, recovering China, India protectionist policy, as well as improving operational metrics, they are creating a perfect storm for all these metal stocks today. So that explains why that index is looking up. Sudeep, are you impressed or not? And what would you buy from the metals pack?
Well, absolutely, Nigel. In fact, I've been positive on metals for quite some time. In fact, I think yesterday or day before on your show, again, I had mentioned that I'm positive on metals. US rate cut was around the corner, and I think that's kind of real now. We will get to know soon. And that definitely supports metal prices. China taking initiatives to prevent the glut and overproduction is definitely music to the ears of the metal producers. Overall, I've been positive on the demand for the metal in India, metals in India, and that's pretty much showing in the numbers which multiple companies are declaring. Look at Coal India, look at MOIL, and look at pretty much every metal-related company. They are coming up with good numbers because industrial demand, infrastructure demand is significant, and that will give a boost for domestic metal producers. And of course, the safeguard duty on steel definitely does help local producers. So overall, we have been positive. I do like Tata Steel at current levels. We, of course, like Vedanta, and we've been liking it for quite some time. And we believe that, in Vedanta, you get to participate in the entire metal pack and in a very effective way. Of course, icing on the cake will be the demerger as and when it happens.
As and when it happens, right? I mean, that's the... it's I think at the same price where it was May of 2024. April was the last big month for Vedanta. I mean, when it had gone from about 270 to $400. But after that...
Prashant, but I'll have to... No, Prashant, if you look at Vedanta and you look at the Nifty, okay, let's pull that chart up for the last 1 year. Both of them actually have not moved at all, right? But Vedanta, I think, has given close to around 50 rupees of dividend. That's what it's become a dividend machine, actually. Because you look at it, you'll say the stock has not moved. But actually, the dividend from that same time period that you're talking about, May 2024 till date, I think it's around 50 rupees, 45 to 50 rupees, or maybe even 55 rupees. So it's become a dividend machine. So that's what's protecting it, actually, in the near term, that uncertainty on the demerger. But the dividend machine, it's helping shareholders. Shareholders are happy about it. And also the promoter, well, they are deleveraging themselves at the promoter level, Vedanta Resources. So that's why this dividend actually spells good times for them.
But Nigel, how does that compare if you look at Nifty dividends? Like, for example, if you take Vedanta total returns versus Nifty total returns. I think Vedanta would still come out on top, as you said. Yeah. I think the difference will not be as large. Bloomberg will be able to maybe...
No, I'll give you the dividend is around 53 rupees, I think so. If I just look at the time frame that you're talking about, actually it'll be a little more than that. It's more than 56 rupees. 56 rupees on a 440 rupees stock actually will be, it's more than 12.
I'm saying Nifty dividends. I mean, if you are like total returns,
I think it would be unlikely to be 10%.
No, it won't.
Nifty,
it won't. You're absolutely right. I mean, dividends, of course, have protected. But I mean, at the end of the day, price-wise, capital appreciation is dividends. Of course, is when as I say, you get paid to wait. But the point is, the wait's been very long. In the case of Vedanta, for a while now. Actually, I mean, you can go back many years. The business we all know is worth a lot more than what the stock actually trades at. But at some point, it's going to start to get unlocked. We'll see. Sudeep, what else? Names like, by the way, do you have a view on names like NetWeb, E2E Networks? There is a news flow as well, which we will address with Vinny in a bit from now. But do you have coverage? Have you looked at these businesses?
I have, and I think the excitement is building because of the entire AI story and the chip manufacturing, which is definitely going to be very hot as far as India is concerned. Our belief always had been that the second wave of beneficiaries of this entire AI wave will be companies in India. I mean, which company and all that we'll have to see. But definitely the first wave has been, of course, the US companies, Taiwanese companies, and some of the Chinese players. But at the second level, I think Indian companies will catch the wave and take them to themselves to the next level. And that's pretty much what is happening. Now, these are not very popular and very, hot companies that way. Both these companies you mentioned, NetWeb as well as E2E. But I think there is a traction and there is excitement. And some of these companies are doing very good work. Some of the unlisted players are also, I understand, doing pretty good work. As far as these two are concerned, I think NetWeb is pretty well established. And I think, even at current level, we feel positive about it. E2E is not that much is known or, researched at this stage. So I won't really comment on that. But of course, the recent developments have been pretty encouraging.
NetWeb is still about 17% away from its high of, which is more than about 3,000 rupees. The stock today after the surge is about 25.36. The other one, Sudeep, making big moves today is TBO Tech. That's the B2B travel platform. So unlike your Make My Trip, Ixigo, Yatra, which is B2C, this is B2B. And they've made this big acquisition in the US, which opens up the luxury market for them, luxury travel. Valuations look okay, 1x price to sales. How does TBO Tech stack up now after the up move in terms of valuations and the growth profile?
I think it's a very interesting acquisition, as you rightly mentioned. The valuation at which they are doing the deal is also interesting. Of course, this entire sector is very hot, and we strongly believe that this the traction or the upswing in this travel and tourism will continue in the foreseeable future. Under the circumstances, luxury travel and a company having global presence, I think that's a great acquisition. So we are definitely positive on the stock as well as positive on the acquisition which they have done.
By the way, in some other stocks on the move, JSW Cement is tracking a gain of about 4% as we see. And I don't think it's an overall sector-specific rally. It's more of a JSW Cement phenomena. Numbers, of course, came in earlier and now inching towards the highs of the day. Sudeep, hi, good afternoon. How do you find this stock? I mean, it has the pedigree, but if you were to pick cement names, then where would this feature?
Well, we like cement and we have been liking cement for quite some time. And apart from the usual reasons, which was valid till 14th August, I think post the GST reduction announcement, GST rationalization announcement rather, I think cement has become even more attractive. And we do like Ultratech for quite some time. And we still believe Ultratech is a good buy from a long-term portfolio perspective. JSW, yes, interesting, but I don't think I will buy JSW at current valuation. If I have to buy, I'll still go and buy Ultratech Cement. If I have to buy some of the mid-cap cement companies, I'll go for Birla Corp.
Just about 1 month done for JSW Cement from its listing. Issue price was 147. The stock right now is 159. And the other one where you are seeing a bit of pressure is NSTL today. And that's because the lock-in has opened up. And NSTL share price has slipped close to about 3%. So that supply is hurting. Sudeep, thank you very much for joining in. We'll get into a break. On the other side, we'll get you a few BTST calls. Our technical expert will join in.
Okay, welcome back. Let's go across to Mitesh once again. Get final sense of trades that one can look at. Mitesh, for what it's worth, at least there's green on the screen today. Final advice then, and any stocks?
There's quite a good amount of greens, Surabhi. I think both the Bank Nifty and the Nifty are doing well, and metals are leading from the front. I earlier had Jindal Steel, now Tata Steel is a BTST. Keep a stop at about 166. Look for targets of 171 to about 172. And United Spirits or McDowell's, as it was known earlier, that's also reversing after a deep correction. So BTST here with a stop below 1339 for targets of 1370.
Okay, all right, got that. Mitesh, thanks very much. We'll connect again tomorrow morning, bright and early. But for the time being, let's focus on TBO Tech, the stock that we have been discussing. It's done so well today on the back of that US acquisition. Manglam is here to explain the dynamics to us. Manglam.
Well, a couple of things that really stand out in this acquisition. One, the company is paying $125 million, which is up to 1,100 crore rupees, which is pretty much almost all of their cash balance that was there on in their books as of March, which was close to around 1,285 crores. Secondly, this company, which has a network of luxury travel advisors and suppliers, is in a category which is doing well, in a category which already is doing well. So travel is doing well, in that luxury travel is doing even better. What is the revenue addition? As of 2024, the Classic Vacations did a revenue of close to 1,000 crores, $111 million to be precise, and the EBITDA was $11.2 million, which is 10% margins. The company's own margins, however, 16%, and their own revenue is 1,737 crores as of last financial year. So you club both of them, the revenue of the company increases by close to 55%, but there is a slight element of margin dilution. So to that extent, it will be very important to see how they scale the operational performance and the revenues of this company that they've gone ahead and acquired. It's a good acquisition, and the street is responding accordingly. It's up around 15% for the stock.
Thank you very much for that. The street likes the growth aggression shown by TBO Tech. With this, as he said, revenues could go up by more than 50%.
Sorry, the other one in the same line of business, listed much earlier, RateGain.
RateGain.
I don't know if it is on the back of TBO Tech doing well, but RateGain is also has come off quite nicely from the lows, right? 7th of August, stock was at 430 rupees. It's almost 600 rupees now. So that's the other one. RateGain at one point used to grow at, their stated guidance was 50, 60, 70% growth.
But that used to be with acquisitions. Organic was also very, very high. But,
but I think now it's what, 10, 15, 20% kind of growth rates.
I think it's in
and they're sitting on
single digits.
Yeah,
they're sitting on cash.
And they've been looking for an acquisition for a long time, but it's not doing well. But as if so many other stocks which are bombed out and they're coming back up. So you've got to go stock by stock. I remember Sonal pointed out, did a piece on, I think, was it BGR Energy, right?
Energy, yeah.
Now, that is a definition of bombed out name, which is kind of, doubled or something, as she was pointing out. But is something happening, or is this? So you got to be mindful, not comparing this or that, but there's a fair bit happening in terms of that line of thinking. Where have stocks fallen quite a bit, and maybe there is at the margin perhaps a little bit of turn happening or whatever. So just thought I would point out. So TBO Tech and RateGain both largely from the same kind of space.
Okay, let's get to the other big mover, and that's E2E Networks. Vinny joins in for more. Vinny.
Hi, afternoon. So yes, E2E Networks, that's the one buzzing in trade, and this is coming after the company has received a letter from Indian AI Mission, Ministry of Electronics of Information and Technology and Government of India. This is for an order for some allocation of GPUs. Mainly this company is, into delivering GPUs, AI related, and that is why in AI hyperscale is their main focus area. This order value is of 177 crores, and that is why a good order win coming in for the company is keeping the stock a buzz. Also in the recent times, they've had a lot of order wins coming in as well. On 26th of August, they had an order win of around 88 crores on the AI front as well. 28th August, there was an announcement coming in of an acquisition they made, and this was also AI related acquisition. So furthermore, pushing their AI story, this is a strategic move that is coming in from the company as well to focus, given that the government's mission is also AI. They also want to focus more in terms of the AI technology as well. Do not forget, in around December 2024, we had seen L&T that had acquired 15% stake in the company, and as on 30th of June, L&T still holds 19% stake.
Okay, all right, Vinny, thanks very much for that. E2E has really been completely up and about today, 10% circuit for the better part of the day, right from the morning onwards. Okay, let's now head to Nigel, who's at the F&O desk. Nigel, the green is getting greener, 150 points up now.
Well, that's right. And the end of the day, you know, this F&O data will be very, very exciting because just going by the look of it, the Nifty bank is outperforming. We are seeing this after many, many trading sessions. And the shorts are heavily stacked in the Nifty bank. The problem is we ain't able to get past that 54,000 mark decisively and move towards a technical mark, the resistance mark of around 55,000. Let's see whether or not we have enough this time around to move up. But otherwise, the Nifty bank outperforming, that's the biggest highlight of today. And that will do the heavy lifting if it got the momentum. So that's an important part to track. If you look at the Nifty options data, well, normally we see this, right? On weekly expiry, we have a bit of a swing factor. Normally that takes place on Thursday. So on Friday, it realigns itself. Now, this time around, on Tuesday itself, we had the expiry that played out. And that's why on Wednesday, we're realigning ourselves. So we are undoing some part of the pain that we saw yesterday from around 1:30 to around 3:30 p.m. in yesterday's trading session. And that's why, in fact, we're seeing a bit of a bounce back. And the options data is quite encouraging. 24,500 put, massive open interest built up out there. 24,600 put as well. Good amount of open interest built up out there. And in an uptrending market, you want to see the nearest possible strike, see a good amount of writing. And that seems to be the case on the put side. On the call side, however, in yesterday's trading session as well, we did see a good amount of writing at around the 24,700 call. And that continues even today, the new contract. This contract will expire in the coming Tuesday. So the premium out there is in that vicinity of around 50 to around 100 rupees, which gives you the levels. Yesterday's high, the 20 DMA, all of that is in that vicinity of around 24,700, 24,750. So that becomes a resistance mark in the near term. The reference point on the downside is 24,400 because we have visited that mark, and from there we have seen a bit of a bounce back. Moving to stocks that are unfocused, Piramal Pharma, that's seeing fresh buying in today's trading session, good amount of open interest built up. You have Tata Steel as well, that good amount of open interest built up out there. So fresh buying is what we're seeing on both these two names. However, if you look at Yes Bank, that's one of the smaller counters that's popped up in trade today, and it appears as a bit of a short covering bounce that's playing out on that smaller name. The stock that I'll keep an eye out on when I'm looking at the evening files, you know, post-market hours, will be RBL Bank. And I say this because the open interest as a percentage of market-wide position limit, or MWPL, is moved to around 101% as of 3:05 p.m. And since it's moved over the 95% mark, that's a likely stock that could come into the F&O band. So that's the one that I'll keep on my radar. Back to you.
Thank you. Let's get in Mayuresh Joshi. It's 24,700 in the Nifty now, just getting stronger, 135 points up, with the Sensex up nearly 450 points, and the Nifty Bank literally flying now. Mayuresh, hi. We've seen a lot of big movers in today's trades, some which are bombed out, some names like Ola Electric, where the momentum continues to be there and stocks are moving higher and higher, news-based stories in TBO Tech and E2E, NetWeb, etc. What are you liking right now?
Hey, afternoon, Rima. So I think the screen's green, and I put my background screen as green as well. So remain optimistic on the markets as we speak. I think a couple of stories that we like. One, I think within the mid-cap space, there is a stock called Acutaas Chemicals. Now, they've produced a very strong set of numbers in the quarter gone by. And again, I think the kind of operations that they are into, the expectations in terms of their pharmaceutical intermediate business is expected to remain extremely strong and robust. Their facilities now are also PMDA GMP certified, which means that the Japanese authorities have given them the go-ahead, which is very, very positive in terms of an earnings pedigree. The other element in terms of their specialty chemical business, which is 15%, they've got a joint venture in South Korea, which gets them very, very close to the semiconductor markets in the specialty chemical business. And because a lot of their value-added products are engaged in these line of businesses, semiconductors, battery chemicals, CDMO, I think the expectations that the management has put forth is a 25% growth. Last year, they closed with EBITDA margins of 23%. They've already done 24.5%. If you probably go by what the management is saying, and they grow 25% with a 25% or a 25.5% margin, I think the bottom line growth will even be stronger because there is hardly any debt onto their books, which means the earnings growth that we look at markets with end of more than 20-25%, with ROEs expected to be around 17.5%, 18%. I think this is one stock, in my opinion, placed in the right sector, placed in the right areas, and the sphere of business that they're probably delivering at this juncture makes us believe that it's a very, very good story to probably follow. The other stock within the auto Ang pack, I've obviously discussed Uno Minda. quite a few times. We do like a stock by the name of SJS Enterprises. It's moved today in today's trade, but our own sense is the kind of numbers that SJS is posting, the expectations in terms of content per car expected to go significantly higher. The kind of value-added technical products that they're probably making, which is around 25% cash rich balance sheet of about 130 odd crores onto that balance sheet. Again, very, very strong margin profile at 27, 28 odd percent, and expected to deliver strong earnings growth moving forward. Obviously, the tailwind with GST rationalization or auto OEMs can act as enablers in terms of even stronger earnings growth. So being very, very selective, but where ratings, rankings are looking strong, earnings are looking strong. I think these two names from the mid-caps is something that we are lacking in markets.
Okay, that is some names. Mayuresh, hi, good afternoon. Let me ask you for more. Okay, what would be your top 3 GST stocks? They could be from auto. I don't know, maybe Uno Minda could be classified as one within auto. I'm not sure. It could be beyond what you just said. But top 3 GST stocks.
Afternoon, Survi. So I think SGS is something that I've already covered. So it's part of the auto anch universe. Is what our belief is that it should continue doing well. One, again, the hotel space. Our own sense is hotels as a space should continue doing well. With expectations of GST rationalization on average room rates below 7,500, I think that can be a big enabler for the industry as a whole. And therefore, a stock like ITC is something that we have held in our portfolios. Was Lemon Tree Hotels is something, in our opinion, that is on the verge of a good breakout as we see it in markets with India. And again, the fundamentals are very, very supportive. What they have probably done in terms of their own rooms, the delivery thereof, specifically in terms of the F&B segment, which is contributing decently well. The managed portfolio is doing well for Lemon Tree as well. And the expectations is that they're going to add another 7,500 rooms. On the 10,000 rooms, a combination of 5,500 owned, 4,500 managed rooms, along with the annuity business that they're probably expected to grow at a very, very decent pace. So hotels as a space is something our belief is where the rating rankings and earnings should sustain. The third stock might be from the footwear space. And obviously, I think the ratings are a little bit on the softer side as we speak. This is one space, I think, as the rationalization efforts kick in, specifically in terms of lower priced footwear. And again, I think the sanity achieved in terms of GST rates. Stocks like a Relaxo, stocks like a Campus Activewear, where I think the expectation is that volumes might start coming up very, very strongly, both in terms of rationalization as well as an organic growth coming through, both in terms of rural and semi-urban demand and urban demand kicking in as well. I think the value chain will move bottom up, and therefore footwear stocks, where the risk reward probably seems to be very, very favorable at this juncture, and the valuations as well, along with the placement as we see it on our evaluation charts. I think a couple of these stories can also perform well once the new rates probably.
Okay. All right, Mayuresh, stay on. We'll come back to you for some more questions. In the meantime, we have to take a break. But in the meantime, here are some comments that came in from Mark Mobius, chairman of Mobius Emerging Market Opportunities Fund. He spoke about Trump's 50% tariff on India and said that he expects India and the US to negotiate trade tariffs in the next few weeks. Take a look. We'll be back with more in just a bit.
I think, Trump has gotten exasperating news from Russia. There hasn't been any decline in the situation in Ukraine, and this has made him very, very frustrated. So he's taking it out on India. He's hoping that India will help. But I'm afraid his hope is going to be shattered because obviously India doesn't want to give up its imports of oil from Russia. I think he will be disappointed. Now, of course, we've seen Modi holding hands with Putin. That is not going to be very encouraging to Trump. So obviously, the U.S. is going to have to step back. And I think probably they will begin to realize that India is not going to give in to the pressure. I think Modi has given a clear message to Trump that he will not be pressured. And I think for good reason. I think India has got to stand up to this kind of imposition in terms of trade. I think they will reach an agreement. I would give it maybe 2 or 3 weeks, and you'll see the U.S. coming to the table again and negotiating something with India so that this is not going to take place. India may make some small concessions, but at the end of the day, it'll be the U.S. that will have to step back.
Welcome back. Well, the markets actually are continuing to hold up. Today is going to be a day where we go home at the highest point of the day. And as I said earlier, encouraging part is the Nifty bank continues to do well. Mayuresh Jayashree is still with us. Mayuresh, what do you do with these capital market plays? BSE at 3,000, everyone was falling in love with it. The stock has corrected closer to 2,000 rupees. In the unlisted market as well, NSE was running away. I think that's corrected closer to around the 2,000 odd mark. How do you play the capital market theme? Because in the near term, there could be speed breakers. But in the longer term, there's tremendous potential as the equity cult is developed here in India.
Afternoon, Nigel. Oh, absolutely. No two ways about it. But at the current juncture, I think the best play or proxy to capital markets might be these asset managers. And therefore, Nippon AMC or HDFC AMC probably might be a safe bet at this juncture as we speak, because there is still uncertainty in terms of how volumes will play out for most brokers because of the expiry tweaks that have probably happened and the regulatory changes thereof. And typically, I think that will also have a say in terms of the exchange volumes. As far as the exchanges are concerned. However, I think for asset managers in general, I think the Sept trend continues. The expectations in terms of them creating a very decent asset base. And again, the operational costs have now largely plateaued off and stabilized, which now means that it acts like a funnel. I think anything which keeps on coming in to the system, which will keep on coming in through SIPs, I think that will have a huge say in terms of their managed AUM. And because costs will remain stable and rationalized, I think the bottom line growth can be far larger because of costs under control. Therefore, I think asset managers like HDFC in the form is something that at least our ratings and rankings and our sector rotation graph indicate might continue doing well as far as capital market participants.
Okay, all right, Mayuresh, just hang on. This is an update coming in from Reuters. Jane Street has filed a case against SEBI at Sept, saying that SEBI is not providing documents and data it's using to make its case of market manipulation. Okay, we remember that this case, the big order that SEBI had put out against Jane Street. After that, it had allowed Jane Street to get back to the market, based on certain conditionalities, strict compliance with, of course, a lot of the details. It seems now that Jane Street has gone to SAT. Not quite sure if it's the same case. Obviously, they would have taken to SAT because you can't file a fresh plea in SAT directly. It seems to be the same case, saying that SEBI is not providing all the documents based on which the order was issued in the first place. Let's see. This is an ongoing matter. Mayuresh, final 2 minutes. The whole metal space. Any topic here? Big mover today.
So I think Hindalco continues doing well. And in our opinion, again, I think once the global operations stabilize at the Novelis end, you'll largely see that next year's financial performance for Novelis should be relatively better. And the domestic performance is expected to continue doing well. Obviously, I think how aluminum prices move is going to be dependent on global demand supply, but I think they should also stabilize going forward. And because of their backward capacities, when it comes both to alumina and other raw materials, I think they are a tad bit better off in terms of EBIT and absolute EBITDA per ton that they do.
Mayuresh, thank you. Just want to wrap out today's trading session. Markets have extended their gains and the Nifty is closing above 24,700 ahead of the GST Council announcement tomorrow. There was considerable strength. We had a flattish opening, but markets only built on the momentum, 0.5% up on the benchmark indices. The big winner today was the Nifty Metal Index, ending with a gain of more than about 3% and higher for the third consecutive day. This week, the Nifty Metal Index has seen an up move of nearly 6% odd. On the way down, I think there's only the IT index which stands out in terms of losses, ending firmly lower, 0.8% gone. So stock winners include Tata Steel, Hindalco, JSW Steel. Top three are from the metals pack. Nifty Bank provided its support. The State Bank of India, IndusInd Bank, HDFC Bank, Kotak Mahindra Bank also supporting the markets on the way up. On the way down, it was Infosys, Nestle, Wipro, HDFC Life as some of the laggards.
Yeah, IT also a bit of a weak spot today. On the mid-cap screen, actually not a bad day at all. You had almost 2,000 stocks advancing, about 900 stocks declining. And some of the interesting movers included Ola Electric once again, 11% up on Ola. You had Piramal Pharma about 7.5% higher. And then the stocks we've been discussing through the course of the show as well, TBO Tech, NetWeb, E2E Networks. a lot of these names on the upside today. And many of them, of course, news-based because they've got fresh order wins and TB on the back of that acquisition. Rate Gain, Yatharth Hospital, quite a few names actually on the upside. SJS Enterprises, which is a pick that Mayuresh just highlighted. Many of them doing well. Bank Nifty actually one of the best performing indices of the day. Metals takes the lead, but then banks are coming in as a close second, about 0.7% over there. All in all, not a bad Wednesday. The Nifty managing to inch higher and close above 24,700. Well, with that, it's a wrap on this edition of Closing Bell. Thank you so much for being with us, but do stay tuned. We have Markets Forward taking the action ahead.
The market charges higher in the second half of the trading session, ends close to the highest point of the day with decent gains amidst mixed global cues. The Nifty closes above the 24,700 mark. The Sensex gains over 400 points. Metals, pharma and PSU banks are the top gainers, while IT and media stocks underperform.
Indus Towers is set to piggyback on Airtel foray into Africa, starting with Nigeria, Uganda and Zambia. The move, while positive, will hit dividend payouts, a key concern for investors. Stocks slipped in trade. Netweb Technologies, on the other hand, jumped after receiving purchase orders for the supply of servers based on NVIDIA's Blackwell architecture.
Metal stocks were the highlight of today's session as China's anti-devolution drive gathered momentum along with hopes that the US Fed may cut rates in the middle of September. The metals index was up over 2% today. You're with us here on Markets Forward and your go-to show where we aim to get you all the key data points to gear you up for the next trading day and of course look back at how the day panned out. I'm Homas Fatakia. With me is Vamakshi Thoria. Vamakshi, well, yesterday's session left a lot to be desired, but today there's no reason to complain and we are almost back at the same levels on the index from where we had reversed in yesterday's session.
Well, absolutely. Good evening, Hormas. This session today actually reminds me of this one saying, der aaye but durust aaye. But so that's what panned out this time around. The Nifty picked up pace in the second half of the day. The Nifty ended the day almost 130 points higher, and it was largely the metal pack that continued to shine in trade today, up almost 3%. Gains were largely led by Tata Steel, Jindal Steel. Apart from that, the pharma pack did extremely well. Pharma was up almost 1%. The PSU bank pack also contributed. But on the flip side, what did not do well is IT. Most of the stocks in the IT index were lower. Infosys was down almost 1.3%. Coforge was also down almost 1.3%. But we have an action-packed show lined up for you today. We start with the top movers and shakers of the day. We'll then focus on the stocks that are in focus. Indus Towers, which slipped on the back of its African foray, while TBO Tech was buzzing on the back of acquisition news, and NetWeb gained on the back of an order win. And last but not the least, we delve into the key market events to watch out for tomorrow's trading session. But on to our first segment of the day, let's go across to Hormas and understand what were the stocks that moved around in trade today. Hormas.
The one pack that took the limelight in today's session, of course, were the metal stocks, and you pick up any metal stock and they were in the green today. It was a shiny session for all of these metal names. Take a look at Tata Steel, 6% higher on the stock. JSPL also with a 5% gain. SAIL with a 5% gain. Nalco, Hindustan Copper, Vedanta, all of them seeing healthy gains in today's session. What also saw healthy gains were the pharma names. Predominantly the mid-sized pharma stocks were the ones that outperformed today. Piramal Pharma was up 8%, also closed above a key moving average. Solara was up almost 6%. IOL Chemicals was up almost 7%. Similar gains also seen in Glenmark and in Ajanta Pharma as well. So a healthy day for pharma names. The other pocket that did well were some of the newsmakers in today's session. TBO Tech, of course, on the back of the acquisition, 15% higher on that stock. NetWeb on the order win. Acme Solar on the order win. TD Power spoke to us earlier in the day and they mentioned that they are going to raise their revenue and order inflow guidance, not just for this year but for the next one as well. And Lupin on the back of the drug approval that it received earlier in the day, 3.25% higher on that stock as well. Multiple names that ended at a 52-week high in the broader markets. SJS Enterprises was one of them. Cartrade, India Cements and Sagar Cements, the two small cement names. And Sirma SGS did not move on the news yesterday but moved in today's session, ending with gains of around 5%. But of course, there were some stocks that bucked the trend as well in the broader markets, ending lower. And Global Spirits was one of them. And Aditya Vision, Lumax Auto continues to decline. Sharda Cropchem and JK Cement were some of the other names that saw some bit of profit booking in today's session, Vamakshi.
Well, thank you so much for that, Hormas. But it's a good time to go across to our guest Mayuresh Joshi, who's the Director of Research at MarketSmith India, and Shrikant Chauhan, who's EVP at Kotak Securities. Well, good afternoon to you, gentlemen. Let me first start with you, Shrikant. The move today, second half of the day, was extremely good, especially if you're a bull. Where does the market go on from here?
Good afternoon, Vamakshi, and good afternoon, Horwas. For Nifty, one thing is very clear that it is finding difficulties to sustain at higher levels. Today, we saw broad-based activity in the market. Pharma, bank, and number of few real estate stocks did well from their lows. The overall activity was much better than last few days, but it is still struggle that we are seeing in the market. It is not, I mean to say, the market is finding a lot of difficulties to move higher. Today's support from the Bank Nifty and the overall outperformance from the Bank Nifty indicating us that we may see further more upside in the near term. But to erase the real bearishness of the market, we need market to cross the level of 25,200 decisively. Till then, we are expecting market to consolidate within the broader range of maybe 25,000 and 24,500 on the downside. I think we need to be more and more stock specific in this market till the markets are not crossing 25,200.
Just before we get chatting with Mayuresh, Srikanth, thank you for joining in. The Nifty Bank, as you mentioned, has been the pain point, right? It's been the reason why the Nifty has not managed to go higher, and has been the reason for its underperformance as well. The bounce that you saw today, a 400-point up move on the Nifty Bank, do you only see that as a tactical bounce? What level does the Nifty Bank have to cross to reverse the bearishness that it currently finds itself in, because it has been a bigger underperformer compared to the Nifty?
Yeah, I think 54,000 was the level, and today we saw the Bank Nifty was comfortably crossing this level again and again. While looking at the entire setup of last 3 days, there was good amount of hammer hitting close to 53,500 sort of levels. But the Bank Nifty managed to survive above those levels, and today it recovered back and it closed above somewhere close to 54,000 levels. So broadly, I am of the view that Bank Nifty is ready to move towards the levels of 55,000, and that will help the market to do well. So Bank Nifty looks like out of woods, and we can see further upside in the near term.
All right, expect further upturn in Nifty Bank is what you're indicating. But, let's focus in on Indus Towers, because that stock slipped in trade after a board allowed foray into the African market. While the move is considered positive, it will fit well with the investors. Reema Tendulkar tells us about this foray and what are the brokerages saying about it. Reema?
Thanks so much for that. So Indus Towers, as you rightly pointed out, was under pressure because this company's foray into the African market, starting with Nigeria, Uganda and Zambia, might affect the company's potential dividend payout. Remember, historically, Indus Towers was a dividend-paying company. Then there were troubles, receivables from Vodafone Idea, and that put a lid, or the company paused on its dividend payouts. But now that the situation had improved and the company was getting all the money from Vodafone Idea, the street was hopeful about this dividend payout resuming at Indus Towers. But now again, there is a question mark. Will there be a delay? Will the amount get cut? Which is why CLSA, although has a high conviction outperform rating on Indus Towers, lowered the target price to 520. They said that we expected the management to focus on the capital structure by paying out high dividends. And now there is this unjustified delay in dividends. Citi, on the other hand, continues to remain bullish. The target price is 460. They believe the concerns are overdone. The valuations are fairly attractive. In fact, according to them, the bear case for Indus Towers is 300 rupees, and the stock is not very far from that, which is why the downside from here on is limited.
Reema, thank you for that. Mayuresh, Indus Towers, the stock is already down, 30-odd% from its 52-week high. And the dividend payout may have been delayed, but the prospects of a foray into Africa, the correction from the record highs, does that make it an attractive enough bet? And once that bet sooner or later pays off, hopefully the dividend payout should also return? Your call here.
Afternoon, Hormas. I think the eventuality in terms of earnings recovering over a longer period of time might be a possibility. But from an immediate perspective, getting into the African markets, it's a hyper-competitive market. And therefore, I think how much of capital allocation will actually yield what kind of ROAs and ROCs, and if any, because of the competitive intensity, whether this gets delayed for some reason or the other by a few quarters, I think that can have an impact on cash flows. And therefore, as Reema was pointing out, the fear on the street in terms of their dividend payouts as well. The second aspect, as far as the domestic business is concerned, largely, I think, dominated by both Jio and Airtel. And as far as their tenancy ratios are concerned for both these major players that they probably service, I think a large part of that tenancy ratio stability should be maintained. So I think an exponential growth in tenancy ratios and margins on the Indian front seems to be very, very improbable at this juncture. Last but not the least, I think with expectations of some element of balance sheet recovery that was happening over the last couple of quarters, this fresh capex plan, again, puts a lid to return the ratios. So in our opinion, again, I think the rating rankings look very, very weak. And therefore, we carry a neutral view on this.
All right. Thank you so much for that, Mayuresh. But let's also put the spotlight on NetWeb Technologies. The stock jumped after it received purchase order for the supply of servers based on NVIDIA's cutting-edge Blackwell architecture. Vinny is here with more details on this order. Vinny?
Hi, Vamakshi. Yes, we saw the stock closing with gains of, almost 11 to 12% in today's trading session. And like you mentioned, this has come in after they've received that purchase order for supply of servers based on NVIDIA's cutting-edge Blackwell architecture. Now, obviously, do not forget in 2023, sometime they had signed a partnership with NVIDIA, and that is why they do have this technology available, which is backed on by NVIDIA. Now, this is an order size of around 1,734 crore rupees, mainly for deployment of AI infra facility using GPUs and accelerated platforms. And overall execution time is by first half of FY27. So in 12 months time period, they will be completing this order. So positive for the company. Why? Because that means in FY26 and FY27, you will see additional revenues coming in. Order size is really big, right? It's 102% of what analyst sales estimates were of FY26 and 72% of FY27 sales estimate. Do not forget, for FY25, the revenue for NetWeb was around 1,149 crores. As of now, if you look at it in terms of, comparing it with the sales and the order, it's 1.5 times that of FY25 sales as well. So a huge order that's come in for the company. This could maybe lead to some better growth in terms of the revenue for the company. Growth driver is what we're watching out for FY26 from this revenue order that has come in. And that's a big one for the company.
Vinny, thank you for that update. Mayuresh, NetWeb Technologies, the order size almost 12% of its overall market cap. IPO'd a couple of years ago. The stock is already up 5x from that IPO price. And this is after correcting from its 52-week high. Your call on NetWeb, and does it still warrant buy interest, especially for the prospects that lie ahead for the company?
So I think if you peg numbers, Hormaz, in terms of what is expected to come through by the guidance that they've probably given, and if you probably peg in an FY27 or an FY28 exit based on the numbers, I think it is priced to perfection. So again, I think from a valuation standpoint, from a price action standpoint, I think valuations have probably peaked off. Obviously, if they're able to outperform their guidance in some way or the other, maybe the premium valuations and the re-rating that the stock is probably getting at this juncture might sustain. But again, I think it really depends in terms of their numbers delivery. At this juncture, I'll be tempted to say that it's priced to perfection from a valuation perspective.
All right, thanks for that, Mayuresh. Now, Shrikant, I'd actually like to ask you about Ola Electric. Over the last couple of sessions, that particular counter has been doing extremely well. Today as well, the stock managed to post a gain of almost 11%. So do you have a view on this counter, chartically speaking?
Yeah, the stock is doing really well. It is forming higher top, higher bottom series on a day-to-day basis, as well as we are seeing very strong, extraordinary expansion in volumes as well as delivery-based volume. So while looking at its entire technical pattern and the way it recovered from the deepest, lowest level of 50, 40 something, we are of the view that the stock is in the process of retracing to its entire fall that we saw from the highs of almost 155, 150. So in case if there is any furthermore, I'm going to say the way there is a formation, the very high chances of hitting 80, 85 sort of levels, because it has crossed almost all its important level like 58, 68. These are the levels where we were expecting some resistance, but the stock has managed to surpass these levels along with good volumes. I'm of the view that the first target is 85, and in the best case scenario, the stock may even hit the levels of 100, where it has spent a lot of time when it was falling from the heights. So yes, there is like a lot of scope that the stock can do well. In case if there is any correction, then close to 60, 62 sort of levels, the stock is having very good support.
All right, thank you so much for that. But moving on then, let's also talk about TBO Tech because the company is expanding its global footprint with a major acquisition. The company has announced plans to acquire US-based Classic Vacations from Phoenix headquartered investment firm, the Najafi Companies. Mangalam is here with more details on this. Mangalam?
That's right. TBO Tech was among the big gainers in today's trading session after an acquisition announcement that the company made late last evening to the exchanges, where they said that they will acquire US-based Classic Vacations for about $125 million, which is roughly amounts to about 1,100 crore rupees in INR terms. Classic Vacations is a company which has a network of luxury travel advisors and suppliers. So the one thing that we know about the travel industry right now is that the luxury tourism is outpacing overall tourism industry, which anyway is on a strong growth trajectory. Classic Vacations, last year's revenue were close to around 1,100 crore rupees, which is $111 million, and they were at about 10% operating EBITDA margins. Overall, in terms of TBO-Tech's revenue accretion, this would be up to 50-55% sort of revenue accretion. So it may be slightly margin diluted from 16% to close to 10%. So we'll watch out for that. And the cash and equivalents that TBO-Tech has as of March is close to 1,285 crores. So fairly well funded to pay for this acquisition as well. Scalability and operational synergies are something that we'll watch out for going forward.
Mangalam, thank you for that. TBO Tech ending 15% higher on the back of that acquisition. Of course, the sector that shone bright today was the metals index, largely on the back of China's commitment to adopt an expansionary fiscal and monetary policies. Manisha is here to tell us what are some of the other key triggers for these metal names. Manisha.
Well, metals clearly have been the top gaining sector today. And when you look at overall underlying metals, many of them are trading at a multi-week, even multi-month highs. China has pledged further expansionary fiscal and monetary policies, and that clearly has been supportive for the markets. And in any case, going forward, when you look at the supplies or inventories seem to be declining, and the demand from traditional as well as segments like EVs, AIs, green technology, renewables is expected to increase going forward from here. That clearly has been supportive. Also supporting the metals is the dollar index, which is trading at a 5-week close right now. So you have the copper prices trading at a 1-month highs. Zinc is holding a 5-week highs right now. Steel prices also have been on a rise after China is looking to curb production for the season 2025-26. Already, when you look at this crude steel output, that has seen a decline of 3.1% for the time of between Jan to July 2025. Not just steel, iron ore prices have been on a rise as well. If you look at Rio Tinto, that has suspended operations at its Simandou mine in Guinea, and that has led to some supply concerns coming in from there as well. Markets do believe that if China comes out for any more stimulus measures, you could be looking at a further leg up in case of metals.
Worst of the tariff impact on growth and inflation is past. So we're kind of rolling cautious on base metals near term, but very, very bullish on, in particular, aluminium, but also copper on a 12 to 24-month view. So heading into the midterms and with lower interest rates globally, we do expect a pickup in global growth. They've got a lot of exposure to decarbonization as well as AI and data center related demand. And they have practically no supply growth, these markets, copper and aluminium. So they're set up for when the global economy turns, they're set up for super bullish markets. Copper, you can be talking about on that kind of time frame, $11,000 to $12,000. Aluminium, you can be talking about easily $3,000 plus.
All right, that explains why all of these metal counters were up and away in trade today. Mayuresh and Shrikant, thank you so much for joining in with us. With that, it's time for a very short break. Now, on the other side, we get you top corporate voices and key events to watch out for tomorrow's trading session.
You're still with us here on Markets Forward. On to some key corporate voices from the day. First up is Sept, and the management, while commenting on the Camso acquisition, said that it is expecting this acquisition to increase its turnover by 10%. It added that it will cater to the North American and European markets, adding that it is open for more acquisitions and opportunities for the same. Now, that's not all. It expects to continue double-digit growth in FY26, and the management also believes that the GST rate rationalization will be a long-term positive for the tire industry. Now, commenting on the US tariffs, Sept says that the exports of off-highway tires from India to the US will come to a standstill if duties remain at 50%.
Well, next up is Urban Company, which recently received SEBI's approval for an IPO. The 1,900 crore rupees IPO is set to open on the 10th of September. Now, speaking to CNBC-TV18, the management says the company hopes to maintain its focus on operating leverage, cost excellence, and to scale with profitability. Adds it wants to invest in technology, training, service professional excellence, and brand building. They further expect to see sustained margin expansion every year. And before we wrap, we bring you some key market events to watch out for. Gaurav is standing by with the key events to focus on for tomorrow's trading session. Gaurav?
Well, yes. From the global markets, we will be watching out on the European region. Ministers of Energy are going to meet and they will discuss some key events in regards to the clean energy segment. So definitely we'll watch out on that. But on the Indian front, the key event to watch out is the GST meet. Now, it will happen on September 3rd and 4th. And Street is very optimistic about this meet, given that they're expecting 2 slab rates in India in regard to the GST that we currently follow in 4 slabs. Other than that, PM Narendra Modi is going to meet Singapore's PM Lawrence Wong. They will be discussing and they will be having a bilateral talk during this meet. So definitely that is something that we should be watching out for. Semicon India, now this is again a key event to watch out for tomorrow. And next, on the stock specific, we will be watching out on Bluestone. This newly listed entity will come up with the results of first quarter FY26, and we will also be watching out on Rolex Rings, because there is going to be a board meeting where company will consider and discuss about stock split. So definitely these stocks are going to be on our radar tomorrow.
Interesting, Gaurav. Thank you for that update. And with that, we call time on this edition of Markets Forward. From Amakshi and me, thank you for watching. More news and updates continue on the other side.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty end at the high point of the day after a late rally. Nifty moves back above 24,700. Rupee gains marginally against the US dollar but remains above the 88 mark. Big reforms on the anvil as the crucial two-day GST Council meet gets underway. The panel on rate rationalization has proposed a two-slab structure of 5 and 18% and a special rate of 40%. Sources say challenges in GST registration and refunds were discussed today. We get you the most comprehensive coverage. 8 states governed by opposition parties reiterate demand of revenue protection even as they back the union government's proposed GST cuts. BJP ally and Andhra Pradesh finance minister supports the central government's proposals. US President Donald Trump calls trade with India one-sided yet again amid the tariff standoff. Also says the US gets along with India very well. India's Commerce Minister Piyush Goyal remains hopeful of a bilateral trade agreement with the US by November. Chinese President Xi Jinping says the world was facing a choice of peace or war as the country hosts its largest military parade. Russian President Putin, North Korean Supremo Kim Jong-un and leaders from over 20 nations attend the parade. President Trump accuses Beijing of conspiring against the United States. Google avoids a breakup as it dodges heavy penalties in a US antitrust ruling. Judge bars the company from exclusive deals but allows it to keep the Chrome browser and a high-stakes deal with Apple. Google must share some search data to foster competition in the sector. Punjab declares all districts as flood hit as the deluge claims 40 lives and affects 3.5 lakh people. More than 10,000 evacuated from the banks of the Yamuna in Delhi as it flows above the danger levels. All right, let's start with the day's market action. Sensex gained over 400 points and the Nifty gained over 130 points after a late rally lifted sentiment on Dalal Street. The Nifty moved back above the 24,700 mark. Financial stocks led the rally with the Nifty Bank Index gaining over 400 points. The midcap index outperformed the benchmarks with gains of nearly 370 points. In the currency market, the rupee gained some strength against the dollar, but the Indian currency remains well above the 88 mark even after gaining about 9 paisa in trade today. 10-year bonds gained in trade today and yield softened to 6.5%. And the top story this evening, the two-day meet of the GST Council kicked off today in New Delhi with Finance Minister Nirmala Sitharaman at the helm. The Council is expected to deliberate on a series of next-gen reforms which are likely to include major reforms on rate rationalization. A panel of state ministers has proposed a two-rate structure and a 40% tax rate on sin goods. The council is also discussing ways to simplify compliance process. 8 states governed by the opposition have reiterated their stance, asking the union government to compensate for their revenue losses. Andhra Pradesh Finance Minister and BJP ally pledged support to the central government's proposal.
From Andhra Pradesh, we are supporting the major reforms in the GST sector which are being proposed by Government of India. Most of them are going to help the common man and poorest of the poor. They are coming from the food sector, education, health, steel, cement, textiles, all the reforms which are being proposed by the Government of India to bring down the burden on the common man.
All right, and to understand these developments better, my colleagues Timsy Jaipuria and Shivani Bazaz are reporting on these updates. They join us from outside Sushma Swaraj Bhavan in the national capital. That is the venue of the crucial GST Council meet. Let's start with Timsy first. What are you picking up?
Well, as you rightly said, the two-day crucial meeting here at Sushma Swaraj Bhavan in New Delhi has started today at around 11 a.m. We heard in the morning opposition states saying that they are in for rate rationalization provided revenue protection assurance is given by centre. Also an assurance from centre that the rate cuts will be passed on to the consumers and will not result in windfall gains only for industries. Apart from this, as we speak, sources during the day have told us that when it comes to easing the compliance, those proposals have been cleared by the council. That is registration process under GST regime to be simplified, registration to be issued in 3 days for non-risky businesses, simpler processes if monthly liability of tax is below 2.5 lakh rupees. Also refund for exporters in 7 days based on risk analysis, provision for refund for non-risky taxpayers have been cleared. But as I speak to you now, the discussions on rate rationalization exercise, which was the key highlight or the key agenda item on the GST Council's table, has started, including the decision, or to be precise, the discussion on reducing the GST on life and health insurance premia. Both the presentations have been given to the GST Council members. The proposal is under deliberation right now. The proposal is to bring down GST on life insurance and health insurance premia from 18% to exempt, and rationalizing rates from a 4-slab structure, that is 5, 18, 28, 5, 12, 18 and 28 to about 5 and 18. Key items are part of this proposal, including common use items, medicines to be brought down to 5%, common use items to be brought down to 5%, a lot of common use items to be under exempt category. Also aspirational goods likely to be come down from 28% to 18%. So let's see what happens. But yes, as of now, compliance on the agenda has been cleared when it comes to rates on all the items, rationalization of slabs and health and life insurance. That discussion has started.
Right. Thank you for that, Timsy. So what are the key items and goods that will get cheaper or expensive if the rate rationalization on proposals go through? Remember, all these are the proposals at this moment, and tax rates will change only if approved by the council. My colleague Shivani Bajaj is here with more. Shivani, please take us through the proposals made by the group of ministers.
Well, Archana, as Timsy rightly pointed out just now, that the discussion is still on. It's a very important GST Council meeting, and the big agenda, of course, is the rate rationalization. From a 4-slab structure, we are likely to move to a 2-slab structure with a 40% slab just for sin goods and luxury items. So what does move to a 5% from a 12% or existing 18% or a 28% to 5 and 18 has to be seen right now. As you said, these are just proposals, and we have to see whether or not GST Council agrees to give it a go-ahead. So very important household items like soaps, detergents, school supplies, medicines, textiles, all of these could move to the 5% lowest bracket, which means that the household stuff, the household things that we use on a daily basis could become cheaper for the end consumer. However, a lot of aspirational stuff, aspirational items can also move from 28% to the 18% tax bracket. However, on the other hand, the luxury items, a lot of sin goods can move to 40%, which means they will become even more expensive if this proposal is given a go-ahead. This is, of course, from a step from the government to balance revenues from GST. So, as of now, the proposal is that household items that the middle class uses on a daily basis should go to the lowest slab possible, and aspirational items should come from 28% to the 18% slab. However, the luxury goods and the sin goods could go to the 40% tax slab, and that is what we are understanding at this moment.
Right. Thank you, Shivani, for that. And thank you, Timsy, for the updates. We will keep coming back to you as and when the news develops. Moving on to the other big story that we are tracking. US President Trump remains firm on the 50% tariffs imposed on India as he continues to defend his trade policy. Speaking with the media after a brief hiatus, President Trump said the US gets along with India very well. However, he continued to claim that the US had a long-standing one-sided dynamic trade with India, charging high tariffs and US not charging India anything. Now, Trump also cited the example of Harley-Davidson setting up a manufacturing plant in India to avoid tariffs of 200%. These remarks followed comments from Commerce Minister Piyush Goyal, who expressed optimism over finalizing a bilateral trade agreement with the US by November and blamed geopolitical issues as a dampener in the trade talks. Meanwhile, sources tell CNBC-TV18 that Finance Minister Nirmala Sitharaman has been meeting with exporters and assuring them of some relief soon. Sources add that the inverted duty structure needs to be reviewed to make the domestic markets more attractive.
We get along with India very well, but India has, you have to understand, for many years it was a one-sided relationship. Only now, since I came along, and because of the power that we have with tariffs, India was charging us tremendous tariffs, about the highest in the world. They were about the highest in the world. I'll give you an example, Harley-Davidson. Harley-Davidson couldn't sell into India. There was a 200% tariff on a motorcycle. So what happens? Harley-Davidson went to India and built a motorcycle plant. And now they don't have to pay tariffs. Same thing as us.
We've had a little bit of a geopolitical issues overtaking trade issues in our negotiations with the United States of America. I do hope things will get back to track soon and we'll conclude a bilateral trade agreement by fall, November or so, as was discussed by our two leaders in February.
Chinese President Xi Jinping hosted nearly 20 foreign leaders, including Russia's Putin, North Korea's Kim Jong-un and the Iranian president, to mark the 80th anniversary of China's victory over Japan in the Second World War. This is the first time leaders from China, Russia and North Korea had gathered for the same event. Riding in a black limousine, President Xi inspected the Grand Military Parade consisting of 45 formations and echelons at the Shang'an Avenue in Beijing. In a show of defiance against the West, Xi reiterated that China will never be intimidated by bullies and asserted that the world is facing a choice between war and peace. Beijing flexed its military muscles by showcasing its modern weaponry, including fighter jets, drones and nuclear and ballistic missiles. China showed off its new intercontinental ballistic missiles, which it claims has a range of over 15,000 kilometers. Now, US President Donald Trump accused China's Xi Jinping of conspiring against the US. In a social media post, Trump said, "Many Americans died in China's quest for victory and glory in the Second World War and called for their sacrifice to be remembered." Trump went on to say, and I quote, "Please give my warmest regards to Vladimir Putin and Kim Jong-un as you conspire against the United States of America." End of quote. Now, Elaine Yu joins us from Beijing. Elaine, is she trying to project a troika against the United States? Is there more to it than optics?
We see the platform, the SEO Summit, being used as a way to also call for these conversations. There are analysts who have told us that we won't likely be looking at the SEO as a way forward for how global trade will look like, but it's certainly used as a platform to discuss these things. And if you look at the Putin and Kim summit, we talked about how these sideline meetings were getting the attention at the SEO summit, and this Putin and Kim meeting is certainly taking the limelight now. Their conversations very much about projecting that spectacle you talked about, and Putin praised North Korean soldiers, saying they were fighting bravely and heroically in the Ukraine war, and Kim in turn thanked him for praising North Korean soldiers. So you've got them talking about the Ukraine war at an event where President Xi was really casting it as China wanting peaceful development and also deterrence, and also European leaders are largely skipping the event because of Putin's presence there. So yes, the optics are strong at this parade, and it's meant to send a signal.
Right, thank you, Elaine, for that. Shifting focus now, North Korean leader Kim Jong-un's daughter made her first international public appearance in Beijing. She was seen stepping out of her father's armored train as they arrived in the Chinese capital for the Victory Day celebrations. The pictures added to the speculation that she's being groomed to become North Korea's first female leader. North Korean officials have never revealed her name, but South Korean officials believe she is identified as Kim Joo-ae. Now, Google has avoided harsh penalties in a monopoly case. A US court has ruled that the company will not have to sell its Chrome and Android business in a monopoly case. The US Columbia District Court ordered Google to share some search data with rivals as a remedy against the alleged monopolistic practices. However, Google's status as a default search engine in iPhones was left untouched. Now, Rachna Dhanrajani is here with more details on the landmark ruling. Over to you.
Well, it is a big win for Google and for Apple. US Judge Amit Mehta has issued his final remedy order in the landmark antitrust case over Google's dominance in online search. So let's break it down. For Google, this means that it can no longer sign exclusive contracts with device makers and browsers. That is significant because those deals helped Google secure close to a 90% market share in search. So going forward, it cannot prevent rivals like Bing or DuckDuckGo from competing for default status. At the same time, Google can still pay companies like Apple to feature prominently as the default search engine. Those payments are worth more than $20 billion annually for Safari alone, so you can imagine. The only caveat here is that the agreements cannot be exclusive. What the judge has rejected is the Justice Department's push for harsher remedies, including a forced Chrome spin-off or a broader structural change that it had called for. Now, Judge Mehta called that too extreme, pointing to how artificial intelligence is already altering the competitive landscape in search. Now, if you remember, it wasn't too long ago when AI search startup Perplexity had even placed an unsolicited bid for Chrome earlier this year, betting that regulators might force a sale. That bid is now effectively off the table. But it underscored how central browsers have become in the AI era as the gateway for billions of queries. Now, reactions have been quite swift. Google welcomed the ruling, saying it recognizes how much the industry has changed with the advent of AI and maintains that competition is already intense. However, it expressed concern about the new data sharing requirement and said it is reviewing the order closely. The Justice Department, meanwhile, is not fully satisfied. Antitrust Chief Abigail Slater posted on X that the government proved that competition was frozen in place for over 2 decades and said that the remedies will be scrutinized to determine if they truly restore choice. For Wall Street, though, the outcome looked decisive. Shares of big tech rallied after the ruling. So the bottom line is that Google has avoided a breakup. Apple keeps cashing on the default search deal, and regulators are left considering whether these remedies go far enough.
Right, thank you, Rachna, for that update. Back home, it's day 2 of the Semicon India Summit. Prime Minister Modi held a closed-door meeting with top executives of the semiconductor industry. Speaking at the summit yesterday, Prime Minister Modi called semiconductors digital diamonds and promised incentives for companies to make in India. India's services activity has hit a 15-year high in August. The HSBC India Services Purchasing Managers Index climbed to 62.9 as against 60.5 in July. A reading above 50 indicates growth. The improvement was on the back of new orders and a rise in output led by international demand. Maruti Suzuki has launched its new SUV, the Victoris, in India. The model debuts with hybrid and CNG options and will be available in 8 different variants. The SUV has secured a 5-star Bharat New Car Assessment Program safety. It's Maruti's second mid-size SUV following the launch of Grand Vitara last year. The company is hoping to be the market leader in this segment.
This car is got it all, as you see. This car has everything in it, and it has got a very strong competitive edge. So I'm sure that with this car, we can increase our market share in the mid-SUV space, and we'll get back the #1 position in this segment also. Then we'll be a #1 in all segments in India.
All right, time for a short break. Coming up next, Punjab declares all districts as flood hit as the deluge claims 40 lives and affects 3.5 lakh people. More details when we return. Welcome back. The monsoon fury continues across North India. All 23 districts in Punjab have been declared flood hit. The deluge has claimed the lives of 40 people so far, while over 3.5 lakh people have been affected. Nearly 20,000 people have been evacuated, with the Army, Air Force and NDRF leading rescue efforts. All schools, colleges and universities remain shut till September 7th. The Met Department has issued a red alert for several districts of the state, including Jalandhar, Moga, Ludhiana and Sangrur. Network 18's Manoj Rathi is here with more details on the flood situation in Punjab.
सरकार के आंकड़ों की भी बात करें तो कई एकड़ फसल बर्बाद हो चुकी है, कई लोगों की मौत हो चुकी है। हालांकि कई जो रिलीफ फंड या फिर और भी चीजें संस्थाएं काफी लगातार काम कर रही है। अभी हम मौजूद हैं पठानकोट के चक्की दरिया पर, जहां पर काफी ज्यादा नुकसान हुआ है और 3-4 चीजें इसमें इफेक्ट हुई हैं। ये रोड आप देख रहे हैं, ये पूरी तरह से ढह चुका है, क्योंकि कई जो गांव हैं आगे, उनकी कनेक्टिविटी टूट चुकी है। बिल्कुल साथ में ही मिलिट्री हॉस्पिटल है, बिल्कुल ये जो गेट है मिलिट्री हॉस्पिटल बिल्कुल साथ में है, उसके आगे गांव हैं, उनके आगे हिमाचल जो है वो शुरू हो जाता है। और साथ साथ में 3-4 चीजें इसमें इफेक्ट हुई हैं। सबसे पहले ये जो रोड है पूरी तरह से टूट चुका है। इसके साथ साथ जो ये दरिया बह रहा है, जो ये इसमें बनाई गई थी जो प्रोटेक्शन जो वॉल थी, प्रोटेक्शन वॉल भी पूरी तरह से डैमेज हो चुकी है। ये प्रोटेक्शन वॉल की तस्वीरें देख सकते हैं, क्योंकि बहाव इतना ज्यादा था, पानी का बहुत ज्यादा फ्लो था, जिसकी वजह से ये प्रोटेक्शन वॉल जो है वो पूरी तरह से डैमेज हो चुकी है।
The Yamuna River in Delhi has crossed the danger mark of 206 meters following incessant rainfall over the last few days. Over 10,000 people living in low-lying areas nearby have been evacuated to safer locations. Delhi has recorded over 1,000 millimeters of rainfall this season, making it the wettest August since 2010. The Met Department expects light rain showers to continue in Delhi, Gurugram and Faridabad. No casualties reported so far, but fears of a 2023-like flood remain. The Met Department issued a red alert for several districts of Jammu and Kashmir, Himachal Pradesh, Madhya Pradesh and Odisha for today. Now heavy rainfall continued to lash J&K's Dora district for the second consecutive day, triggering a flash flood-like situation. Landslides occurred in Himachal's Kullu and Mandi last night. Rescue operations are underway. At least 6 people were killed in Mandi. Over 1 lakh kilograms of waste equal to 52 dumpsters. That's what Maratha quota activists left behind after they eased their stranglehold on Mumbai after holding the city to ransom for 5 days. More than 1,000 civic workers were pressed into service across 2 shifts over a period of 5 days to clear this mess. Dhananjay Khatri gets us more on the BMC cleanup drive.
Well, after 5 days, the Maratha quota agitation led by Manoj Jarange Patil has finally ended, leaving the civic authorities with a massive cleanup job. The BMC conducted an extensive overnight sanitation drive to restore normalcy. The agitation drew thousands of protesters from across Maharashtra to South Mumbai, severely impacting traffic and civic functioning. The municipal authorities also deployed massive manpower and resources to clean up the stretch. According to the officials, nearly 200 sanitation workers worked through the night of September 2nd, continuing until the early hours of September 3rd to bring the ground and nearby roads back to the original condition. In total, more than 1,000 civic workers were pressed into services across shifts, ensuring round-the-clock cleanliness at the protest site. To prevent health hazards, civic staff also scattered 100 kilograms of disinfectant and insecticide powder across the site to check the spread of flies and mosquitoes. Civic and railway authorities had a tall task of clearing the remains as thousands of protesters began to leave. From food packets to plastic bottles, footwears to discarded flyers and posters, the BMC has total removed more than 1 lakh kg or 101 metric ton of waste from Azad Maidan and its adjoining areas. Mumbai police had given permission for a one-day protest on August 29, allowing only 5,000 protesters for the agitation at Azad Maidan. But as the agitation began, over 60,000 people gathered in the city in 8,000 vehicles, which blocked all the roads leading to the protest site. In the last 5 days, there were instances in which the groups of the protesters agitated in front of Mantralaya, Bombay Stock Exchange, and they were also seen at Marine Drive, Jahangir Art Gallery, Girgaon Chowpatty, as well as to the Gateway of India. A similar situation was also seen at Mumbai's busiest railway terminal, Chhatrapati Shivaji Maharaj Terminus, which virtually became a camp or a shelter place for the agitators. The Bombay High Court on Monday noted that the city was literally paralyzed due to the Maratha agitation, which violated all the conditions. According to the All India Motor Transport Congress, the protests had brought cargo movement across Maharashtra to a grinding halt, with all major connectivity routes to South Mumbai, including Atal Setu, Navi Mumbai routes, Panvel and the Eastern Freeway completely shut for heavy vehicles and ODC assignments. Back to you.
Right, thank you Dhananjay for that. And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host Surabhi Upadhyay. Today's show is all about taxes. And why not? Because we are moving very close to the income tax return filing deadline. Now, you'd wonder why we are having this conversation now. Usually, it's the 31st of July. That's the red letter day when it comes to your ITRs. But this time, we have a grace period. That deadline is the 15th of September. Therefore, we still have time to quickly get you the best tips for a hassle-free tax filing experience and tell you all that you need to know before you get down to filing your income tax return. So joining us today, two guests. We have Suresh Surana from RSM India and Sonu Iyer from EY to make it all very, very simple. Now, I don't know how the lady and the gentleman will do that because let's jog our memories a little bit. We're all filing income tax returns for FY25. And in FY25, we had not one, but actually two budgets. There was a vote on account, then there was an election, then there was a final budget, and lots of tax changes in between. So thanks so much for joining in, Sonu and Mr. Surana. Let's get your opening thoughts. I'm sure you folks would have been very, very busy across your teams, particularly those members who look at personal taxation. Sonu?
Hi, sir. Good to be back on your show. And yes, we are in the home run. As you said, 15 September is looming large over the, people who have to file their tax returns. So in our lingo, it is the tax filing season. So the teams are busy preparing tax returns, making sure that people pay up their taxes and file their returns. So yes.
Yeah. Mr. Surana, it has been complex. When I started also preparing for the show, I realized, so much had changed in July. July of, it was 2024. When we had the final budget come in, we had the capital gains tax change. 10% became, 12.5%. And even within the tax regime, the new regime, there were some changes here and there. So, where does one begin when you're talking about the ITR? How do we, put it all together?
Yeah, so I think as you rightly said, there are more than 7 crore, individual tax filers, and 15 September is the deadline for the same. I would say the most important thing first is now there are two tax regimes. One is the old tax regime and there is a new tax regime. And the new tax regime is more liberal in terms of the tax slabs. But at the same time, you do not get some deductions. And each year, you need to select between the two regimes.
Correct.
And you have the option to select each year. Even at the time of filing of the return, you can do that. Now, if you look at the two regimes broadly, and I think most people are gravitating towards the new regime. Last year, if you look at 72% people had actually opted for the new tax regime. This year, I think number will go even further. So the basic exemption limit is 3 lakh rupees under the new regime, whereas it is 2.5 lakh under the old regime. Then the slabs are from 3 lakh to 15 lakhs under the new regime, whereas under the old regime, after 10 lakh rupees, then you have the highest tax rate of 30%. Then those who are having more than 5 crores of income, the tax rate under the new regime is 39%, whereas the effective tax rate under the old regime is still 42.74%. But you do not get some deductions under the new regime.
Correct.
So some of the important deductions are, for example, interest on housing loan, which up to 2 lakh rupees you can claim.
Yes.
The second is ATC deduction, which is up to 1.5 lakhs.
Yes.
When you make investment in your recognized provident fund or PPF, National Savings Certificate, long-term bank deposits. The third thing which is there is that you have also deduction which are under ATG, for example, which is for donation. You have Mediclaim, ATD. All those things you cannot claim under the under the new regime.
Under the new regime.
So you really need to do the calculation under both regime, and then you can select. Absolutely. And you can select each year what basically suits you.
Yeah, absolutely. And that's why it's also important to understand whether this selection between old and new, can it be done even now for FY25? So no, the year is over, is long gone, and maybe you decided to be with the old regime, and that's, or your default regime in your office was the old regime or whatever, or maybe it was new, and you suddenly now realize that you want to switch. First of all, what are the big thumb rules if you look at FY25 in which maybe a person is still better off, say, in the old regime, and can they even make the switch now as the return is being filed?
So, Surabhi, if you are a salary income earner, if you have income from other sources, if you have capital gains, essentially non-business income cases, you can, switch any time. So even if the employer has been withholding tax as per the new tax regime, if you decide on comparison, old tax regime is more helpful, so you can switch on to the old tax regime at the time of filing the tax return. So for non-business income cases, this switch on and switch off can happen anytime. They can do it at the time of filing the return. They can opt out each year and opt in every year. They can change their mind. But I think people who have income from business and profession, if they want to opt out of the new tax regime, because that's the default tax regime, if they want to opt out of this new tax regime, they have to actually file a Form 10IEA to the tax authorities before they can file their tax return. And you need to quote the acknowledgement number of this Form 10IEA in your return form. So for them, it's only an option that's available after filing this form. And then say in a subsequent year, they want to get back onto the new tax regime, they can make this change only once in their lifetime. So unlike the salary income and income from other sources, capital gains income taxpayers who can do this switch every year, it's dynamic. But for business income, this can happen only once in lifetime. After you've made one choice earlier, then opting back in can only be once in your lifetime.
Okay, important clarification there, that you can still do all your calculations with all the types of income that you've earned during the year and still decide to switch if you're largely a salaried tax person between the old and the new. Which brings us to the next question.
And maybe another tip. Sorry, Sir, we
Yes,
can
yes.
tip on this because it's important, and you know your viewers may want to know how do we know which is better for us. So income tax portal actually gives you a calculator. You know, you go on to the income tax portal under tax information services, you get the tax tools. You have the first is the calculator, which shows you which regime is better for you. You can input your income details and you have the answer. So it's easy.
Okay. All right. So that would be very, very helpful. Absolutely. Now let's, understand what some of these important forms are. Again, if you go on the portal, you will have something known as the Form 26AS. There's anyway the Form 16. If you're a salaried person, then your employer gives you that Form 16. There is also the AIS, the Annual Information System, right? There is a TIS as well. So, exactly, largely for CAs and tax professionals. But if I want to get a complete picture of my income, how much tax I've paid, and what has really happened in my financial profile in the year, how do I make use of all of these documents, Mr. Surana?
So I think very important what you mentioned, because it is you must reconcile before you file your tax return with 26AS and also AIS, which is the annual information statement, and TIS. Now 26AS will contain the whatever income is there which is reported, and also tax which has been deducted. So what credit you are claiming must reconcile, otherwise you will not get credit when the at the time of processing of the return. So in case, for example, somebody has not uploaded, then you need to reach out to the payer that he must upload that information. Now, AIS actually contains a lot more information. It also contains in terms of the high value transactions, any investments made by you are also there. Any property transaction will be reflected.
And
there.
all of it is being captured seamlessly now because it's all linked to our PAN.
It is all linked. So you need to see that all those transactions are are captured. One more important thing I would like to say, that apart from this, you should also review your bank statements and demat accounts, because there may be transactions which you need to report. And so apart from AIS and TIS and 26AS, you
what
should
does
also...
TIS tell us?
That is the tax information in terms of tax information statement, what is tax deducted and other and also TCS, which is the tax collection at source. So you may have, for example, bonus shares or other things which you all need to capture properly, which may not be financial transaction. Other thing I would also like to say, that non-monetary transaction, sometimes people skip that. For example, very common thing is the redevelopment of property. Now, there may not be any monetary transaction, but it may trigger a tax implication. Similarly, you may have gift received from somebody. Now, relative gift is exempted, but non-relative is taxable.
Okay, so gifts from relatives are exempt, but non-relatives taxable.
Taxable.
Okay.
Similarly, inheritance could be there. So you need to make sure that
But we don't have any inheritance tax.
No, there is no tax, but it may have, because it might impact what you are reporting. Like, for example, the statement of shares. You need to give your shareholding. So those things I think must be captured also. So I would say, look at your 26AS, look at AIS, look at TIS, look at your bank statement, demat accounts, non-monetary transactions, so that you do correct reporting.
Okay, all right. So make use of all of these documents, and all of them are there on the income tax portal, and you can look at them, revisit them, cross-check them, and then get ready to file your income tax return. Which brings us to the next step. Now, which is the income tax form that you need to pick? For those who, actually do want to go ahead and file their own tax returns, 4 key forms that we always speak of: income tax return form 1, 2, 3, and 4. So let's quickly, understand broadly, Mr. Surana. 1 and 2 are for salaried income.
1 and 2 is for people who do not have business income.
Okay.
So you may have capital gains, you may have other income from other sources. That is all fine. And 3 and 4 is for those who have business income.
Okay. Business income or income from profession?
Yeah, income from profession, business or profession. That all comes under that one category. So first you decide, are you in ITR 1 and 2 or ITR 3 and 4?
3 and 4 category. Okay.
Now next step is, if you look at ITR 1, which is called ITR Sahaj, which means it is simple. So while ITR form is simple, but the criteria are not simple. So
it is called Sahaj. It's supposed to be a one-pager form or something like that, right?
So it not as short as that, but I think whether you are eligible for ITR 1 or not is very important. Now, before that, one more very important point I would like to mention, and a lot of people make mistake in that. people think that only if they have tax liability to pay, then they have to file the return, which is a misnomer.
Yes.
So
yes.
if your income is more than the basic exemption limit,
which is 2.5 lakh rupees
under the old regime,
under the old
under the
regime
new
for
regime.
FY25, and it's 3 lakh rupees under the new regime.
No, but that also not the taxable income, but it is taxable income before Chapter 6A deduction, which means
Before claiming any deductions.
Yeah. So it is, which again many people miss out.
They've missed that.
And secondly, even if tax is deducted, you still need to file the return. And now, for example, rebate is available up to 7 lakh rupees. People don't have to pay any tax. But that doesn't mean that you don't have to file the return. You have to still file the return to claim the rebate also.
Everyone has to file the return.
Yeah. So I'm just saying there is a difference between tax payable and tax filer.
Yeah, so I'm exempt from that threshold, so I don't need to file. So why do I file my ITR? Doesn't apply.
Yes.
Or I've paid all my taxes. My company's already been cutting tax from my salary. So then what do I need to do? You still need to file your income tax return.
That's very important because many people miss out on this.
No, absolutely. So so we were talking about the forms. So as we've understood that 1 and 2 is applicable if you do not have any business income or any income from profession. Now, a lot of people are actually self-employed. Salaried is one big category, but there's a whole category of people who are self-employed, self-professionals, delivering professional services. For them, how do they go about deciding between 3 and 4? I think 4 is a simpler form, right?
Yeah, so ITR 3 is typically what would be applicable to these people who have business or profession income. Now, ITR 4 will be applicable for individual taxpayers who would otherwise have filed this ITR 1, which is the Sehaj form, but end up having income from business or profession, which they pay tax on presumptive basis. So if you're a small business person, or even if you're a professional where you're paying tax on a presumptive basis, where percentage of your gross receipts being offered for tax without taking any expense deduction, etc. In that case, ITR 4 comes in for people who are eligible for income 1, but they have a business or profession income, which is taxed on presumptive basis. But I think what Mr. Surana's point was about the criteria for ITR 1, where most of your taxpayers would potentially be filing tax returns. That is one that bears some discussion, if you allow me to bring that back on the table. Because the criteria, as he pointed out, is not so sehaj. We're saying that, ITR 1 is simplest of all these forms, but there are the 3 basic conditions. You can file ITR 1 only if you are a resident, an ordinary resident for tax purposes in India. And if your total income is up to 50 lakh rupees is there, and then the baskets of categories of income for which this form can be filed. So you have to satisfy all 3 criteria. You have to be a resident. You have to have total income, which is up to 50 lakhs. Beyond that, you can't file this form. Plus, you should also be falling in the categories of incomes that are covered. So you have income from salary. You have income from one house property. You have income from sources such as, your interest income, dividend income, family pension, and you have income, agricultural income, which is only up to 5,000 rupees. And you have exempt long-term capital gains and, from sale of equity-oriented mutual funds, long-term equity-oriented mutual funds, or long-term equity or units of business trust. So, you can understand just by me calling out all these sub-criterias, the eligibility is a big thing to cross. If you don't fall in any of these categories, then you have to consider ITR 2, ITR 3.
Yeah, so then Sehaj is not for you unless you manage to fulfill some of these critical conditions. Got that? Well, we do have to take a very quick break on that note. On the other side, our experts are going to give out very simple, easy to understand, handy tips when you go ahead and get ready to file your income tax return. And also, we must remember the timelines, the penalties, in case you don't file, what happens then? Back with that in just a bit.
Let's talk money. money.
Welcome back. Here with us on Let's Talk Money. And this week, along with money, we are talking taxes because it's tax filing season and we need to ensure that our income tax returns are filed by the 15th of September. Actually, just for the sake of understanding, what happens if someone is not able to file by 15th September, if there's a delay or some issue happens? Usually the server always gets overloaded and then there's an extension. But, how does it look, Mr. Surana?
So there are, I would say, three different implications. One implication is that there is a late filing fee, which can range from 1,000 rupees to 5,000 rupees.
Okay.
So that is one part. The second part is there is an interest which may be payable if there is a self-assessment tax which you haven't paid.
Okay.
So even if you are delayed, it is better to pay the self-assessment tax.
Correct.
Because otherwise you pay 1% per month, interest, but even for part of the month. So for example, even if you delay by 1 day, you have to pay for the 1 month.
Full 1% on that
full 1%.
outstanding amount.
So better that at least you do a quick calculation, pay your self-assessment tax if you are delayed for any reason.
Okay.
The third thing is that there can be penal consequences because particularly if department issues notice to you before you file the return, they can presume that you were trying to conceal the income. So there can be penal consequences. There is a provision for even the arrest or in terms of prosecution, what we can call.
Okay.
But very rarely
Very
we
rare
have seen
cases.
that being used. So I don't want to scare anyone. I'm just saying that.
Absolutely. Also, speaking, you mentioned department. I just remembered that refunds are also something very, very important that we all look out for. So Sonu, I mean, at the time of filing your ITR, what about the process of claiming a refund? Can you only claim for the same financial year FY25? What if you realize there was some outstanding amount? Basically, how does the whole refund process work?
So the income tax return is essentially for that fiscal. So, in this case, April 24 to 31st March 2025. So incomes of that year have to be offered for tax. So refund of that year also has to be claimed. There is some allowance in terms of carrying forward TDS from previous years. If you have, say, composite TDS deductions, you can use it in this year. But you can't claim refunds of another year in this year. It has to be per year filing. So therefore, the point you're making about filing your tax returns on time is very important. You have to file on or before the statutory timeline, in this case, 15 September. We can file revised returns up till 31st December 2025. But after that, there is no other window. You would only be able to file updated returns, which in case you've missed reporting something, missed paying taxes, then you have an opportunity to file an updated return, which goes on till 31st March 2030. But the important aspect is, A, to stop the trigger of interest in case the taxes are not paid. Make sure that you file on time. If you have, brought forward losses, make sure you file timely return to be able to claim that.
Okay, all right. So completely listening to you carefully and taking that advice, better to simply file on time or even before time if possible. Which brings us to final thoughts. And now we need to summarize everything to make it simple for our viewers in terms of the key things that we need to think about, surely discuss with our CA and, go ahead for smooth and error-free filing of that tax return. Let me ask both our guests. Mr. Surana, I'll start with you.
So I think some of the points which we already discussed about in terms of making sure that all your income is captured, the TDS, TCS is all captured, you reconcile with 26AS, AIS, TIS, all those things. Look at your bank statement, demat account, non-monetary transaction. Apart from that, also see that in case you have any carried forward losses of the earlier year, you also looked at that. One important point for non-residents is that they must determine their residential status properly, because for non-resident and those who are resident but not ordinarily resident, the income arising outside India is not taxable. So if you have to, and the criteria has become fairly complex in the last 3-4 years. So now it is not simply based on number of days stay in India. You have to also look at citizenship. You have to also look at taxable income. So it is a function of 3 factors. So very important that you also look at what is your residential status. Also make sure that if you have refund, or otherwise also have one validated bank account which you submit the information so that the refund can be directly credited to your bank account. Also make sure that you have PAN and Aadhaar card linked, all your whether it is your in terms of depository accounts, and those are linked with the mobile numbers so that you get proper intimation. So these are some of the other hygiene checks I would say we should look at.
When you mentioned income from maybe overseas or foreign sources, that got me thinking, Sonu, because now a lot of retail investors as well, regular investors with salaried income, they have started taking exposure to global assets. They could be doing it through Indian mutual funds, which are investing in US stocks. Many people get, very excited. They end up buying, say, US equities or any other country's equities directly as well, and holding in, in overseas accounts, demat accounts or foreign broker accounts. Now, what is it that they should keep in mind? Maybe they're not booking that profit or booking that gain, but is disclosure important? It might be in small quantities. I want to own 5 Apple shares, 5 Google shares, but what are the tax implications?
Surabhi, I think a great point. The fact that determination of your residential status, and if you are more than likely ordinary resident in India, you need to report all your foreign assets and liabilities. So all your foreign asset, foreign source income needs to be reported. As you said, you may not even have booked any profit. You may not have got any income. But if you have an asset overseas, a financial asset, immovable property, you've set up a bank account overseas, you need to report that. And failure to report even a single asset, would trigger a penalty of 10 lakh rupees. So I think that's the most critical aspect. If you are, foraying into buying assets overseas, please make sure that you're doing the disclosure under the foreign assets and liabilities schedule in the tax return.
Okay, all right. That's really important, and important to keep in mind, because this whole talk about global diversification in our investments, that's a reality. We have been speaking about it on this show as well for a long time. So in case you've managed to diversify your investment base, make sure that you're compliant with all the disclosures. Well, thank you so much, Sonu and Mr. Surana. Great conversation. Thanks for joining in. Very, very enlightening. And we hope it'll help all our viewers file their tax returns seamlessly and on time. Thank you for joining.
Thank you very much. Pleasure.
All right, with that, it's a wrap on this edition of Let's Talk Money. Keep sending us your feedback, comments, queries. We'll see you again next week.
Let's Talk Money.
Hello and welcome to the GST Centimeter. I'm Shireen Bhan. The two-day meeting of the GST Council kicked off in New Delhi this morning with Finance Minister Nirmala Sitharaman at the helm of affairs. Now, the Council is expected to deliberate on a series of next-generation GST reforms, which will include major reforms on rate rationalization. The central government has proposed a two-rate structure and a 40% tax rate on sin goods. Now, this was also cleared by a group of ministers, and the Council has now started deliberating on the rate rationalization. The council is also discussing ways to simplify compliance processes. 8 states governed by the opposition have reiterated their position, asking the union government for revenue protection, which essentially means they want the central government to compensate states for any possible revenue losses. Andhra Pradesh's finance minister, the BJP ally, has pledged support to the central government's proposal. Take a look.
From Andhra Pradesh, we are supporting the major reforms in the GST sector which are being proposed by Government of India. Most of them are going to help the common man and poorest of the poor. They are coming from the food sector, education, health, steel, cement, textiles, all the reforms which are being proposed by the Government of India to bring down the burden on the common man.
Well, that is the finance minister of the state of Andhra Pradesh, a supporter and an ally of the BJP part of the NDA, saying that they will support the government's proposal. Timsi Jaipuria is standing outside the Sushma Swaraj Bhavan in the capital. She's, of course, been bringing us all the GST news breaks, not just today, but through the course of the last several weeks. Timsi, what has happened so far in the council? What are we picking up from our sources in terms of what has now been likely cleared?
Well, as you rightly mentioned, the meeting began today in the morning at Sushma Swaraj Bhavan. Before the meeting started, opposition states were clear. They are okay for the proposal to be cleared on the rate rationalization, but they need assurances on revenue protection and on profiteering so that there is no windfall gain profiteered by the industries. And this rate cut should actually be transpired directly to the end consumer. Meanwhile, during the day, as we spoke to a lot of sources, they are indicating key decisions on ease of living and ease of compliance have been approved, including allowing a GST registration within 3 days for non-risky businesses, simpler processes if monthly liability of tax under GST is below 2.5 lakhs. Also, refund for exporters to be expedited in 7 days based on risk analysis, and provisional refund for non-risky taxpayers. So these were some of the key highlights on the compliance side. When we come to rate rationalization, well, yes, as we are speaking, deliberations are underway. Centre has made a detailed representation on what could be the possible next roadmap for the GST, which Prime Minister spoke about, that is shifting from a 4-slab structure to a 2-slab structure, coming down to 5% and 18% and 40% only for certain demerit goods. Also, a detailed presentation has been made to the GST Council on exempting GST on life and health insurance premia, which is expected to have a revenue loss of 9,900 crore rupees annually. When it comes to the revenue loss estimate for the entire rate rationalization exercise, that has not been presented so far to the Council. Deliberations are underway. States are now started to speaking as to what they want to say on this proposal. It includes both the ruling party ruled states, that is the BJP ruled states, and the opposition ruled states. These are quite high in number, so each and every state given a chance to speak as to what are their views on this proposal. Yeah. That is currently underway.
All right, Timsi, many thanks for joining us. We'll keep coming back to you. Timsi Jaipuria there reporting from outside the Sushma Swaraj Bhavan, which is where the GST Council is currently meeting. We're now joined by Najib Shah, the former chairman of the CBIC. Also with us, we've got other guests with us, Saurabh Agarwal, tax partner at EY India, and Abhishek Rastogi, the founder of Rastogi Chambers. Gentlemen, appreciate you joining us here on the program. Mr. Shah, let me start by asking you, 2 days and the GST Council has to make up its mind on a whole host of big-ticket issues. As Timsi reported, it started with addressing the compliance-related issues. We just took our viewers through some of those issues. For instance, bringing down the registration process down to 3 days in case of non-risky businesses, as Timsi was reporting. Also decided to provide an optional simplified registration scheme to grant registration automatically to those whose tax liability does not exceed 2.5 lakh rupees per month. Also easier refunds and so on and so forth. While rate rationalization has got all the attention, actually the compliance-related issues are also significant, are they not, Mr. Shah?
Yes, indeed. They are indeed very significant and essential for GST going forward. But I guess the big elephant in the room is, of course, rate rationalization. And thus everybody is looking forward to. The state ministers would need to be assured on the revenue implications. But these are other issues which have been discussed and debated are critical for ease of doing GST going forward.
The crucial aspect now is going to be what the 8 states, opposition-ruled states, have been demanding: revenue protection, a way of compensating states for revenue losses. Now, we don't know what the estimate is that the government is going to present or may have presented already in terms of revenue loss on account of the rate rationalization, but estimates suggest, and that's the number that states were talking about, it could be anywhere to the tune of 80 to 85,000 crores. Now, Mr. Shah, do you believe that the likelihood of additional levy which replaces the cess, which is what opposition-ruled states are demanding, is perhaps the way forward?
I think the concerns of the states have to be addressed, and these are serious concerns. I think a short-term and it could be a 2-year, 3-year window within which some degree of compensation will be required. But these are calls I think the GST Council really has to deliberate upon, because that's the only way you'll have all the states enthusiastically participating in what is a major reform carrying forward the GST transformational reform itself.
Yes, all states will need to come on board. Remember, so far, all decisions of the GST Council have been by consensus, have been unanimous. And of course, the expectation would be that this proposal will also be cleared with consensus and with unanimity, as opposed to going down the voting route. That is not what anybody would like at this point in time. Let me go across to Saurabh Agarwal. Saurabh, many thanks for joining us. Have you done the math in terms of what the potential revenue loss could be and what the way forward could potentially be in terms of offering revenue protection to states?
So, Shireen, in terms of the revenue loss, till the time the final rates are out, it's anyone's guess. But based on what is coming out in the media, what we foresee is that the loss should be somewhere in the tune of around 1.5 lakh crores to 1.6 lakh crores. And that is how the other financial institutes have also been talking about. But given that there will be a reduction in rate, and we have seen that reduction in rates have led to people coming into the taxable base and the evasion reduces, which means that the consumption will increase, evasion will reduce. So net, what we foresee is that holistically the loss should not be more than to the tune of 80,000 crore. And of course, overall, we foresee that it will have a very good impact on the GDP. So whatever we are losing out on account of the US tariffs, somewhere there will be a mitigation which will happen on account of the rate cuts which the government is offering. Coming to your second point as to the ask of the states, I think as Najib said, the overall ask of the state governments have been legitimate. We'll have to wait for the centre's final decision on this as to whether they will continue with some type of cesses or they will agree on the compensation with the state government. But the ask appears to be more genuine as far as the manufacturing states are concerned, because even when the GST was rolled out, at that juncture of time also, this ask has come in from the manufacturing state, because for them, it is a huge revenue loss as the tax goes to the consumption state.
That is right, and I think there is consensus that there are legitimate concerns that states are raising. This is not just politics. Abhishek, let me come to you. 2 slabs, 5 and 18%, and then that 40% slab for special items, demerit goods, hidden goods, call it what you like. Abhishek, what is the fear that we're likely to see an expanded 40% basket? But more importantly, where do you believe that we could see the maximum relief as far as the common man is concerned as we go through this rate rationalization exercise?
So I think first thing, Shireen, the rate which goes from 28% to 40% increases the kitty of the state governments also, because state governments, when they get the collection from the CGST and the SGST, is about 70% of the entire GST collection. So the rate which was at 28% now makes it to 40%. They get a higher percentage of 70%, which makes their collections from these products more than 40% as they would have got in the earlier, before the rate reject. So from that perspective, I don't see a lot of revenue loss to the state would happen, and this needs to be explained to the state because there will be products in this. Now, as far as the cess is concerned on these products, that goes to Consolidated Fund of India, and that will be used for a specific purpose, and that could be used by the center for any purpose which is required for several states at different times. So I think that message must go clearly. Now, as far as the common man is concerned, there are a lot of these items which will shift. And as Timsi mentioned about the health services, these insurance services, this would get a major benefit in terms of the consumer. A lot of these other products also, which are at 12%, goes to 5%. And a lot of these 28% items also, which would be very, very relevant at the time of Diwali, would come down to 18%, such as your AC, refrigerators, microwaves, cars, we are talking about 1200cc and motorbikes less than 350cc. So there will be a major relief for the consumer sector. As Saurabh mentioned, the consumption pattern in the next quarter will get a major boost. So I think from that perspective, the revenue dip will not be that much.
Yes, so that is the hope, that we will see consumption offsetting any possible revenue loss at this point in time. But Mr. Shah, one of the other aspects that is being revisited again is the fact that sectors like auto, etc., are saying, look, let there be a uniform slab. Why do this business of below 350cc, 18%, above 350cc, perhaps 40% for two-wheelers? Apparel makers saying the same thing, that why have that line of 2,500, below 2,500 at 5%, above that 18%, and so on and so forth. Do you believe that that is a logical ask, and one that perhaps the council may wish to consider or should consider?
I think the council should consider this, simply because, again, having reduced the rates, you're again introducing classification based on price slabs, and this is never a good idea. It has been there in the past. I think we have always felt that it should not be there. I do hope the GST Council does not recommend rates linked with slabs, and instead has uniform rates for a product, be it in 5 or 8 or 18. I think that's the way to go forward.
Right. Mr. Shah, one of the other aspects, and I think this is a issue that many state finance ministers have raised as well, that, look, we'll go through this rate rationalization exercise, but we must ensure that the benefits actually accrue to the end consumer. Now, that anti-profiteering provision is no longer available because the sun has set on the anti-profiteering provision. Do you believe that there needs to be a way to revisit that in some form or fashion at all at this point?
I think the hope of the central government is that benefits are passed on to the consumers, and they'll be extremely disappointed if this does not happen. And they would also like to ensure that this does happen. Now, the mechanism for it, which was there as an anti-profiteering, which faced a lot of criticism and has now ceased to exist, is no longer there. But I believe that needs to be an understanding with the history that this benefit has to be passed on to the consumer, not in the exact proportion, perhaps if they can work out the economics, but definitely a sizable reduction needs to be there to be seen by the Government of India. And I think the Minister of Consumer Affairs will definitely be watching this very closely.
Yes, they will be watching this very closely indeed. The Prime Minister has promised a Diwali dhamaka, and so the hope and the expectation is that this will be passed on fully and as early as possible. And that begs the question, Saurabh Agarwal, if indeed the GST Council were to clear the centre's proposal by tomorrow evening, which is when the Council's meeting concludes, how soon do you anticipate a rollout of the new rates?
So, Shireen, if you have to ask me, I would possibly wish that the rates are rolled out from 5th of September, because from 15th August onwards, we are seeing a wait and watch story as far as the consumer is concerned for multiple products, whether it is auto or whether it is some of the consumer electronics. And if the rates are being into effect from 21st or 22nd September, which was the large expectation as a Diwali gift, then the entire period from 15th August to 22nd September will be a washout period for many of the companies. At the same time, Shireen, I would like to point out on the anti-profiting part, while the provisions still exist, they have only been suspended, saying that they'll not be accepting any anti-profiting application from 1st April 2025 onwards. So effectively, while the GST Council never wanted to do it, and in 2024 minutes of meeting also it has been documented, but such a big change which is happening and the ask coming from the state governments, I don't know what is there in the stores. But of course, the industry needs to be very cautious of as far as anti-profiting is concerned, and they need to pass on the entire benefit. And I believe that India is a price-sensitive market. It will automatically get passed on based on the market forces over a period of a month or 2 months' time.
Yes, Abhishek, the same question to you. How soon do you anticipate we could see these rates being rolled out? Our understanding from the government's perspective was that they're pretty much ready. If the decision is taken by the council, they should be good to go ASAP.
I think the rate implementation, the changes will come in soon. They would not want to wait till the day of the Diwali. I think it will come in soon. It may come as soon as within a week. Coming back to the profiteering element, as far as the provisions are concerned, Section 171 subsection 2 is there, which provides that a notification can change that date. So even if there is a sunset clause, that notification can either be revoked or a new notification could be issued to extend the profiteering provisions to industry. So I don't see passing of this benefit will be a problem. The government certainly doesn't want the situation of robbing Peter to pay Paul. And hence, anti-profiteering will come into play. The benefits will have to be passed on to the consumers. The industry will have to be very, very careful. But I think from the industry perspective, what will be very relevant is that the methodology is there for the consumer durable items, for the real estate sectors and all. And if these methodologies can come at the time of this rate rationalization, I think both industry and consumer will get the benefit.
Well, that's an important point. As all of our guests are mentioning, the provision exists. Will it be re-notified is the question, the anti-profiteering provision as part of the GST regime. But let me get final comments from each one of you. And Abhishek, let me start by asking you, the compensation says there is no provision for it to continue beyond October, which is till the period till which the cess will be paid out. Now, if there were to be a decision taken on an additional levy, will the government have to do so by way of an ordinance till it goes back to Parliament? What will the way forward be if it does decide that there is a need for an additional levy?
So, Shireen, very clearly, a narrowly tailored cess with a distinct purpose is constitutionally sustainable. The only issue is that this amount goes to the Consolidated Fund of India. Once the amount goes to Consolidated Fund of India, it can be apportioned by the centre either on the basis of some event which happens or on the basis of some contingency which happens. So I think the centre gets that control on this additional distinct purpose, cess or duty, whatever you may call it. The centre gets the control of it, and the states must realize that there are still products which goes to 40%. Till yesterday, they were getting only 28% taxes on these products. Now 40% gets distributed. Effectively, the states get 70% of the GST collection. So the revenue collection for the states will also not reduce. So I think Consolidated Fund of India will have to be managed very, very carefully, and it needs to be a very tailored cess with a distinct set of purpose.
All right, gentlemen, before we say goodbye to you, information that's coming in from our colleague Timsy Jaipuria, we understand that at the council meeting, the states of Karnataka, Punjab and West Bengal have asked for a revenue loss estimate, and that is important. It's crucial that the revenue loss estimate is provided. They've also expressed concerns on revenue protection. Telangana and Sikkim also likely to have expressed concerns as far as revenue loss and revenue protection is concerned. the three GOM reports, rate rationalization, the life and health insurance, and the compensation cess discussions and deliberations on the three GOM reports are currently underway. That's the inside story right here, breaking on CNBC-TV18. This is exactly what's going on at this point at the GST Council meeting. Abhishek, Saurabh, Mr. Shah, always a pleasure. Appreciate you joining us here on the GST Centimeter. We are going to, of course, continue to bring you all the latest updates from the GST Council meeting. Stay tuned. We're back in a moment. Don't go anywhere.
Welcome back. Now let's focus on the other big stories that we're tracking this evening. U.S. President Trump remains firm on the 50% tariffs imposed on India as he continued to defend his trade policy. Speaking to the media after a brief hiatus, President Trump said that the U.S. gets along very well with India. However, he continued to claim that the U.S. had a long-standing one-sided dynamic relationship on trade with India, charging high tariffs and U.S. not charging India anything. Trump also cited the example of Harley-Davidson setting up a manufacturing plant in India to avoid tariffs of 200%. These remarks followed comments from Commerce Minister Piyush Goyal, who expressed optimism over finalizing a bilateral trade agreement with the U.S. by November and blamed geopolitical issues as a dampener in trade talks.
We get along with India very well, but India has, you have to understand, for many years it was a one-sided relationship. Only now, since I came along, and because of the power that we have with tariffs, India was charging us tremendous tariffs, about the highest in the world. They were about the highest in the world. I'll give you an example. Harley Davidson. Harley Davidson couldn't sell into India. There was a 200% tariff on a motorcycle. So what happens? Harley Davidson went to India and built a motorcycle plant. And now they don't have to pay tariffs. Same thing as us.
We've had a little bit of a geopolitical issues overtaking trade issues in our negotiations with the United States of America. I do hope things will get back to track soon and we'll conclude a bilateral trade agreement by fall, November or so, as was discussed by our two leaders in February.
Google has avoided harsh penalties in a monopoly case. A US court has ruled that the company will not have to sell its Chrome and Android business in a monopoly case. Rachna Dhanrajani is joining us now with more details on the landmark ruling from the United States.
Well, it is a big win for Google and for Apple. US Judge Amit Mehta has issued his final remedy order in the landmark antitrust case over Google's dominance in online search. So let's break it down. For Google, this means that it can no longer sign exclusive contracts with device makers and browsers. That is significant because those deals helped Google secure close to a 90% market share in search. So going forward, it cannot prevent rivals like Bing or DuckDuckGo from competing for default status. At the same time, Google can still pay companies like Apple to feature prominently as the default search engine. Those payments are worth more than $20 billion annually for Safari alone, so you can imagine. The only caveat here is that the agreements cannot be exclusive. What the judge has rejected is the Justice Department's push for harsher remedies, including a forced Chrome spin-off or a broader structural change that it had called for. Now, Judge Mehta called that too extreme, pointing to how artificial intelligence is already altering the competitive landscape in search. Now, if you remember, it wasn't too long ago when AI search startup Perplexity had even placed an unsolicited bid for Chrome earlier this year, betting that regulators might force a sale. That bid is now effectively off the table. But it underscored how central browsers have become in the AI era as the gateway for billions of queries. Now, reactions have been quite swift. Google welcomed the ruling, saying it recognizes how much the industry has changed with the advent of AI and maintains that competition is already intense. However, it expressed concern about the new data sharing requirement and said it is reviewing the order closely. The Justice Department, meanwhile, is not fully satisfied. Antitrust Chief Abigail Slater posted on X that the government proved that competition was frozen in place for over 2 decades and said that the remedies will be scrutinized to determine if they truly restore choice. For Wall Street, though, the outcome looked decisive. Shares of big tech rallied after the ruling. So the bottom line is that Google has avoided a breakup. Apple keeps cashing on the default search deal, and regulators are left considering whether these remedies go far enough.
Well, that's all we have time for on this special broadcast. Thanks so much for watching. News and updates will continue right here.
We've all used the services of Urban Company, whether it is to repair your washing machine, a deep clean before Diwali, a quick salon treatment at home. But now is the bigger question. Is it time to own a piece of Urban Company? Founded in 2014, Urban Company is India's largest tech-enabled platform for home services, and it's hitting the capital markets. 1,900 crore of an IPO size, valuation hitting nearly 15,000 crore rupees. Joining me on this special episode of IPO KYC is the founder, CEO, CMD, Abhiraj Singh Bhal. Thank you very much for joining in, and I am Reema Tendulkar. Abhiraj, it's a great story, right? 2014, you've scaled rapidly, your revenues are annualizing 1,500 crores, you've got international expansion, you're growing at 30%, now getting into hardware. But the question is, you turned profitable in 2025. Is this company going to be profitable on a sustainable basis?
Reema, thank you so much for inviting me. It's an absolute pleasure. Taking your first question on profitability, if I talk about the last 3 years, we have scaled our net revenue from 437 crores in FY22 to about 1,144.5 crores in FY25. And in this period, for the 707 odd crores of incremental revenue that we've added to the top line, about 385 crores has gone to our adjusted EBITDA, which shows the strong contribution margin and gross margin profile in the business. We track at a contribution margin of about 56% of net revenue, or roughly 19.5% of net transaction value. We've also kept our fixed costs fairly steady in the last few years. Profitability is an important goal for any company, and for us as well. As we continue to scale, we would want to continue to focus on operating leverage, cost excellence, and continue to scale with profitability.
But talk to us about operating leverage, because your adjusted EBITDA last year, FY25, it was about 11-12 crore rupees. In Q1 of FY26, it stands at 21 crore, which means in the current quarter, it's almost double of last year. So what explains, is this the power of operating leverage? When your top line doubles, what could your EBITDA look like?
So, Reema, again, in internet businesses, typically, one has to forward invest in a few areas. This would be, in our case, for example, training centers to train our service professionals, our technology team that builds the apps, the website, as well as the entire back-end layer for our service professionals, the entire workflows, marketing and brand building to acquire consumers, and so on and so forth. These costs typically don't scale with top line. In fact, they can scale much slower than top line. And therefore, once you hit threshold scale...
What is threshold scale?
Well, in our case, threshold scale was hit, I would say, in FY25. It was the first full year of profitability for us at all levels, adjusted EBITDA, PBT. Prior to that, we were loss-making. So I think FY25 was, in that sense, a reasonably pivotal year for us. We crossed 1,000 crores in net revenue. We crossed 3,000 crores in net transaction value. We broke even on a sustainable basis for the full company for the first time. India business had been profitable earlier as well, but now at a consolidated level. So I would consider it to be an important milestone for us. And now I think going forward, we would want to continue to focus on growth while also improving our margins.
So profits are sustainable?
I would imagine so. I think we will have to continue to be strategic about growth. We're still a very small company in the scheme of things. We think we're just getting started. We would like to be 10, 20, 30 times bigger in the coming decades. And for us to be able to do that, we will have to continue to make investments in growth.
So suppose your top line doubles from here on, right? It's about 1,100, 1,200 crore rupees in terms of net operating revenue. It doubles. Adjusted margins in Q1 were 5-6%. What could that number look like?
It would be hard to sort of put a
Double
specific...
digit?
Let me put it slightly differently. I think the areas where we would want to invest would continue to be technology, would continue to be training and service professional excellence and quality, and brand building. I think we would like to make these investments, albeit at a slower pace than revenue growth. So any growth in revenue that we see, especially in our core business in India, which is already fairly profitable. It was operating at a close to 10% adjusted EBITDA in FY25. I think any investments we make there, we would want to be very mindful that those investments are not growing faster than top line, so that we can continue to see sustained margin expansions, every year. I would avoid giving any forward guidance, but we're committed to improving, the quality of the business with every passing year. One of the things that is our internal principle is that every cost line item every year should see operating leverage. And that's a philosophy with which we operate internally.
Okay. Just for the benefit of our viewers, you have three sources of income. One is India consumer. That's your core market, profit center, 10% EBITDA margin, 75% of your top line. Second is your native brand, where you are manufacturing hardware products like lockers, like security locks, air purifiers. And third is your international business. That's about 10%. Now, native and international is loss-making as of now. We'll come to it. But let's talk about your India consumer.
Sure.
Talk to us about your ambition here, the strategy, the opportunity that you see.
So, Rima, India Consumer Services is our largest business. As you rightly said, it's about 77% of our net revenue in FY25. It's one where we offer a host of services at home, be it beauty services, cleaning, carpentry, plumbing, AC and appliance repair, painting, etc. We still think we are only getting started in this business. The opportunity is humongous. The total addressable market for home services in India stood at nearly $59 billion last year. And it's expected to grow to about $97 billion by 2030.
So to tap into this $100 billion addressable market by 2030, you've also laid out your expansion plans. I think you're present in 47 cities right now. You're targeting 200 Indian cities by 2030. So as you expand into tier 2, tier 3, what would profitability look like? Will it be dilutive or will it add to your margins?
Well, typically when we look at a tier 2 city, there are a lot of existing investments that we are able to leverage. For example, our technology platform, which is one of our big areas of investment, doesn't need incremental investment when we expand to a new city. We've, from early on, focused on brand building at a national level. So usually when we enter a new city, there's already awareness of the Urban Company brand from users in that city as well as service professionals. In fact, I keep getting emails from cities where we're not present today by users asking us to launch there. We also tend to leverage our training centers in the larger cities across the smaller cities through a hub and spoke model. So it gives us the ability to sweat our training assets further. So the incremental P&L of a new city that we add is usually better compared to an existing city. And contrary to popular wisdom that whenever you enter tier 2 or tier 3 cities, you have to drop prices, we haven't really done that. We've seen pricing power hold up in these cities.
Pricing is the same now, whether you...
It's not exactly the same, but it's in the same zip code, I would say.
In the same zip code, okay. There's one concern that a lot of the top line, not a lot, part of the top line, your revenues are growing at what, 25% for the India consumer business for the last 2 years. But that is coming on account of expansion into newer categories and expansion into newer cities. Your annual transacting customers is growing at a slower pace, I think 16%, roughly, thereabout. Is it hard for you to get new customers? Is scalability a concern?
I would say that scalability for us has been something that we take great pride in, how rapidly we've scaled in the last few years. And we continue to see great opportunity to scale up in the coming years. Our oldest cities and oldest categories continue to grow at a very healthy clip.
Like what?
Can't get into the specific numbers, but most of our growth comes from our big cities and big categories. You spoke about new user growth vis-a-vis revenue growth. Revenue growth will always lead new user growth, and that's because as our users mature, they try out newer categories. They cross over to other categories, and therefore their annual spends only increase every passing year, which is a good thing. So if you started off in beauty services or in AC repair, over time you will move on to trying other categories, and therefore the spends that you make on the platform annually will keep on growing.
So is a double-digit or a mid-teens kind of annual transacting customer increase growth something that you're confident about sustaining?
We will try.
We will try.
And we will work hard towards it.
Okay. Do you see the risk of disintermediation where a customer and the service provider, I mean the handyman, bypasses the platform? So, very often we use urban company, right, to get the lead. And then he comes in services, and then the next time you say, I'll call you directly, or he will say, call me directly, right? And we will save on that commission, right? I mean, how do you deal with that? I mean, and what have you ever been able to quantify the loss to you on account of that?
Look, I'm sure there's a little bit of that happens. Our focus as a company has been to add enough value to both the sides that they see the value of going through the platform and continue to focus on that value add. Because, as a philosophy, we don't want to prevent people from doing this. If we focus on prevention, this is India at the end of the day. So people will find newer and newer loopholes to go around the system. So I can talk a little bit about the value add. I think a significant part of the value add is very, very high earnings for our service professionals. When
like what? I mean, do we have some numbers?
Absolutely. So in FY25, the average service professional in urban company, net of all commissions, fees, taxes, travel costs and product costs, made over 26,000 rupees a month. And this is with only about 83 monetized hours on the platform on a monthly basis. If we look at the top 20% of service professionals, they made well over 40,000 rupees net. And the top 10% made about 45,000 rupees. So I think service professionals have also realized that if they go through the platform, their income opportunities are higher. They get free life, accidental and health insurance cover. Safety is something that's very important for them, and it's an area of investment for us. And similarly, I think on the consumer side as well, we have subscription programs today. We have a UC Plus membership program. We have warranty covers to protect the consumer in the situation of a downside. So for all of these reasons and more, over a period of time, we've seen that disintermediation has only come down meaningfully.
often be compared, especially once listed, to Zomato and Swiggy. How comparable or similar will the journey be of urban vis-a-vis them? Because, at the end of the day, the way I see it, they're two separate categories, right? And each category brings its own dynamic. For instance, I can order, from a restaurant once a week. I can probably order groceries every single day. But I would require a deep clean once a year. I would require a handyman to repair my AC perhaps twice a year, right? So there is a difference in the frequency. Plus, yours is a more asset-heavy business where you are spending on training all your service professionals. I mean, how do you see the comparables being drawn as a consumer tech platform in India?
I think we are a unique platform, Rima. Truly category-defining company with no real comparable. But a company that exactly looks like urban company and operates like urban company, there are very few and far between. And part of the reason is ours is a full stack model. It's not, technology is only one part of it. We focus a lot of energy on training. We focus a lot of energy on tooling, helping service professionals with certification, SOP compliance, pricing standardization. And the brand urban company stands behind every single service delivery. So if anything goes wrong, it is our neck to choke.
Have you modeled your company after any company?
I think we definitely derive a lot of inspiration from players like Amazon. I think truly extraordinary company which focuses on the consumer. That's a company that we look up to. In India, we look up to DMart. We look up to Zomato. I think these are iconic companies as well. So we draw inspiration from several great companies.
Got that. So now let's talk about your second source of income, right? That is native, where you're actually manufacturing water purifiers, for instance. What made you get into this category?
So Rima, we have been in the category of water purifier servicing and filter changes for about 8 to 10 years now. And then about 5-6 years back, we entered into our own private label spare parts, the filters that go in. So there was already a base knowledge and a base consumer, consumer base that was transacting on the platform in this category. These consumers had a deep pain point which they voiced to us, which is that why does our water purifier need servicing and filter changes every few months? Why do I have to go through the hassle? And for a while, we felt that this is how the industry is, this is how it operates, what can we do about it? But when this voice from the consumer became too loud, we decided that let us see if we would want to further vertically integrate and have our own device. It took us we took that call in 2021. It took us about 2 years of product development, R&D, to come up with a state-of-the-art water purifier that is needing no filter changes for up to 2 years. After 2 years, you service it once and it's again set for another 2 years. It's also very transparent and smart water purifier. It's integrated into the Urban Company app. You can see the quality of water you're drinking, the life of the various filters and so on and so forth. So very starkly different from how the industry has operated, which is with opacity in a sort of a razor blade model. It's gotten off to a great start. It did about 116 crores of net revenue in FY25, which was the first full year of operations in the first quarter, and we've reported that it's done about 60 crores of net revenue. So it's growing at a rapid pace.
But it's loss-making?
It is loss-making right now.
Okay. But what's the scale that you need to flip the margins?
I think we have already seen operating leverage starting to play out materially in this business. Year on year, the losses have come down at a margin level, and we believe that as we continue to scale it, that operating leverage will play out, and it's a matter of time before this business also turns profitable.
In 2 to 3 years?
Again, I will not be able to focus on the specifics. But if you look at our past history, newer businesses haven't taken a very long period of time for us to flip.
But hardware is a different beast, right? There is inventory, there is working capital, there are warranties involved. Like, how much capital are you willing to invest, or you plan to invest in native? And what are the new categories you're entering? I think you're present only in 2 right now, smart locks and air purifiers.
Yes. So historically, I think in the last few years, we've invested a little over, I think in the range of 50 to 100 crores in this business. Total. I think it's gotten off to a great start. That's been over the last 2 to 3 years. So it gives you a sense of what could our investments look like over the next couple of years. I do think that, this business will demonstrate operating leverage as it moves forward. And therefore, we are hopeful that at least for the two lines of businesses that we operate today, which is water purifiers and smart electronic door locks, the meaningful portion of investments is behind us and not ahead of us.
Are there new categories you're exploring or where work has started, where you've identified pain points?
Not at this point in time. I think, as you rightly said, it's a different business. It has lots of synergies with our existing business, particularly on the service side. The fact that we're inside the home, we have all of these insights, we have a supply chain that exists, which we've leveraged. But at the same time, it has certain unique aspects to it. So we also have to make sure that, we are focused.
It's a calibrated approach.
It's a calibrated approach.
Got it. What about your global expansion plans? You're present internationally. I think UAE is already turned EBITDA positive. You've got presence in the Kingdom of Saudi Arabia, in Singapore. Today, it's, I think, 10% of your revenues. What could international revenue contribution look like? And how much of the IPO proceeds are going to go into your global expansion plans?
So you're right, Rima. Internationally, we have wholly owned subsidiaries in UAE and Singapore, and we're in a 50-50 JV in the Kingdom of Saudi Arabia. The JV went live only on the 1st of January 2025. We are quite excited by our operations in UAE and Singapore. UAE, as you rightly said, is already EBITDA positive. Singapore hopefully will get there in the near future, and these businesses also demonstrate strong operating leverage. We have built a good brand in these two markets, but at the same time we're very early, and the opportunity is large. So we want to be focused on these two markets. The Kingdom of Saudi Arabia is even more early. It's a 50-50 JV.
There are no new geographies you're targeting right now?
Outside of these three, no, because I would say the opportunity here is huge. And given the recency of our expansion into these markets, we would again want to focus on these markets first and make sure they get to scale, they get to profitability, they become a meaningful percentage of our top line. And more philosophically, I would say the opportunity in India today is so huge that we would rather focus our energies on going deeper into tier 2 and tier 3 cities in India versus expanding into newer countries.
You all also expanded in Australia and USA, and then you all rolled back. You all wound down the operation.
Yes.
All right. Okay. Let me get to your newest offering, and I think it'll get everyone very excited, at least all the homemakers and the women. This Insta Help.
Yeah.
Which is basically like if your Badli Bai doesn't show up on any day, in 15 minutes you can get someone to clean your homes. Pilot operations in Mumbai. I mean, what's been the response so far, the offtake?
Response has been phenomenal. The pilot is now no longer a pilot.
Okay.
It's started
how big is it?
Well, we're now present in multiple cities to start with. So we're present in Bangalore, Hyderabad, Delhi, expanding to other cities. It has grown at a breakneck pace month after month. Consumer demand significantly outstrips supply right now. So the only thing my team is doing is training and onboarding in this category.
Do you know a number of how big the opportunity is, like the market that you're targeting?
Well, in the total addressable market that we looked at, about $10 billion roughly in that zip code was the daily home cleaning and housekeeping services. So it's a fairly large opportunity.
Yeah.
And I think that opportunity will only grow because, as you know, Rima, when a market is completely unorganized and completely fragmented, the total addressable market, is typically understated vis-a-vis what it could actually become when that market organizes. Through this platform and other similar platforms, for the first time, house help in India will make a decent middle class wage and become part of sort of the formal middle class India that we all, the promise of India will come alive for them.
If 10 years later, someone has to write the urban company story, what is the one line that you think they should lead with?
I think the first 10 years was about building a platform for home services. I think the next 10 years will hopefully go beyond that to building a true home platform which offers Indian consumers reliable and high quality access to home services and solutions. And in the process, Urban Company becomes an institution for urban India, one that has impacted and empowered hundreds of thousands of service professionals to lead dignified and respectful lives. An institution that is known for its ethics, its corporate governance, and carrying all stakeholders along. I think that's what we aspire to build over the next 10 years. In one line, an institution that India can be proud of.
Thank you, Abhiraj. This has been such a great conversation and wish you all the very best. Thank you.
Thank you so much. Thanks for having me.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty end at the high point of the day after a late rally. Nifty moves back above 24,700. Rupee gains marginally against the US dollar but remains above the 88 mark. Big reforms on the anvil as the crucial two-day GST Council meet gets underway. The panel on rate rationalization has proposed a two-slab structure of 5% and 18% and a special rate of 40%. Sources say challenges in GST registration and refunds were discussed today. We get you the most comprehensive coverage. 8 states governed by opposition parties reiterate demand of revenue protection even as they back the union government's proposed GST cuts. BJP ally and Andhra Pradesh finance minister supports the central government's proposals. US President Donald Trump calls trade with India one-sided yet again amid the tariff standoff. Also says the US gets along with India very well. India's Commerce Minister Piyush Goyal remains hopeful of a bilateral trade agreement with the US by November. Chinese President Xi Jinping says the world was facing a choice of peace or war as the country hosts its largest military parade. Russian President Putin, North Korean Supremo Kim Jong-un and leaders from over 20 nations attend the parade. President Trump accuses Beijing of conspiring against the United States. Google avoids a breakup as it dodges heavy penalties in a US antitrust ruling. Judge bars the company from exclusive deals but allows it to keep the Chrome browser and a high-stakes deal with Apple. Google must share some search data to foster competition in the sector. Punjab declares all districts as flood hit as the deluge claims 40 lives and affects 3.5 lakh people. More than 10,000 evacuated from the banks of the Yamuna in Delhi as it flows above the danger levels. All right, let's start with the day's market action. Sensex gained over 400 points and the Nifty gained over 130 points after a late rally lifted sentiment on Dalal Street. The Nifty moved back above the 24,700 mark. Financial stocks led the rally with the Nifty Bank Index gaining over 400 points. The midcap index outperformed the benchmarks with gains of nearly 370 points. In the currency market, the rupee gained some strength against the dollar, but the Indian currency remains well above the 88 mark even after gaining about 9 paisa in trade today. 10-year bonds gained in trade today and yield softened to 6.5%. And the top story this evening, the two-day meet of the GST Council kicked off today in New Delhi with Finance Minister Nirmala Sitharaman at the helm. The Council is expected to deliberate on a series of next-gen reforms which are likely to include major reforms on rate rationalization. A panel of state ministers has proposed a two-rate structure and a 40% tax rate on sin goods. The council is also discussing ways to simplify compliance process. 8 states governed by the opposition have reiterated their stance, asking the union government to compensate for their revenue losses. Andhra Pradesh Finance Minister and BJP ally pledged support to the central government's proposal.
From Andhra Pradesh, we are supporting the major reforms in the GST sector which are being proposed by Government of India. Most of them are going to help the common man and poorest of the poor. They are coming from the food sector, education, health, steel, cement, textiles, all the reforms which are being proposed by the Government of India to bring down the burden on the common man.
All right, and to understand these developments better, my colleagues Timsy Jaipuria and Shivani Bazaz are reporting on these updates. They join us from outside Sushma Swaraj Bhavan in the national capital. That is the venue of the crucial GST Council meet. Let's start with Timsy first. What are you picking up?
Well, as you rightly said, the two-day crucial meeting here at Sushma Swaraj Bhavan in New Delhi has started today at around 11 a.m. We heard in the morning opposition states saying that they are in for rate rationalization provided revenue protection assurance is given by centre. Also an assurance from centre that the rate cuts will be passed on to the consumers and will not result in windfall gains only for industries. Apart from this, as we speak, sources during the day have told us that when it comes to easing the compliance, those proposals have been cleared by the council. That is registration process under GST regime to be simplified, registration to be issued in 3 days for non-risky businesses, simpler processes if monthly liability of tax is below 2.5 lakh rupees. Also refund for exporters in 7 days based on risk analysis, provision for refund for non-risky taxpayers have been cleared. But as I speak to you now, the discussions on rate rationalization exercise, which was the key highlight or the key agenda item on the GST Council's table, has started, including the decision, or to be precise, the discussion on reducing the GST on life and health insurance premia. Both the presentations have been given to the GST Council members. The proposal is under deliberation right now. The proposal is to bring down GST on life insurance and health insurance premia from 18% to exempt, and rationalizing rates from a 4-slab structure, that is 5, 18, 28, 5, 12, 18 and 28 to about 5 and 18. Key items are part of this proposal, including common use items, medicines to be brought down to 5%, common use items to be brought down to 5%, a lot of common use items to be under exempt category. Also aspirational goods likely to be come down from 28% to 18%. So let's see what happens. But yes, as of now, compliance on the agenda has been cleared when it comes to rates on all the items, rationalization of slabs and health and life insurance. That discussion has started.
Right, thank you for that, Timsy. So what are the key items and goods that will get cheaper or expensive if the rate rationalization on proposals go through? Remember, all these are the proposals at this moment, and tax rates will change only if approved by the council. My colleague Shivani Bajaj is here with more. Shivani, please take us through the proposals made by the group of ministers.
Well, Archana, as Timsy rightly pointed out just now, that the discussion is still on. It's a very important GST Council meeting, and the big agenda, of course, is the rate rationalization. From a 4-slab structure, we are likely to move to a 2-slab structure with a 40% slab just for sin goods and luxury items. So what does move to a 5% from a 12% or existing 18% or a 28% to 5 and 18 has to be seen right now. As you said, these are just proposals, and we have to see whether or not GST Council agrees to give it a go-ahead. So very important household items like soaps, detergents, school supplies, medicines, textiles, all of these could move to the 5% lowest bracket, which means that the household stuff, the household things that we use on a daily basis could become cheaper for the end consumer. However, a lot of aspirational stuff, aspirational items can also move from 28% to the 18% tax bracket. However, on the other hand, the luxury items, a lot of sin goods can move to 40%, which means they will become even more expensive if this proposal is given a go-ahead. This is, of course, from a step from the government to balance revenues from GST. So, as of now, the proposal is that household items that the middle class uses on a daily basis, should go to the lowest slab possible, and aspirational items should come from 28% to the 18% slab. However, the luxury goods and the sin goods could go to the 40% tax slab, and that is what we are understanding at this moment.
Right, thank you, Shivani, for that, and thank you, Timsy, for the updates. We will keep coming back to you as and when the news develops. Moving on to the other big story that we are tracking, US President Trump remains firm on the 50% tariffs imposed on India as he continues to defend his trade policy. Speaking with the media after a brief hiatus, President Trump said the US gets along with India very well. However, he continued to claim that the US had a long-standing one-sided dynamic trade with India, charging high tariffs and US not charging India anything. Now, Trump also cited the example of Harley-Davidson setting up a manufacturing plant in India to avoid tariffs of 200%. These remarks followed comments from Commerce Minister Piyush Goyal, who expressed optimism over finalizing a bilateral trade agreement with the US by November and blamed geopolitical issues as a dampener in the trade talks. Meanwhile, sources tell CNBC-TV18 that Finance Minister Nirmala Sitharaman has been meeting with exporters and assuring them of some relief soon. Sources add that the inverted duty structure needs to be reviewed to make the domestic markets more attractive.
We get along with India very well, but India has, you have to understand, for many years it was a one-sided relationship. Only now, since I came along, and because of the power that we have with tariffs, India was charging us tremendous tariffs, about the highest in the world. They were about the highest in the world. I'll give you an example, Harley-Davidson. Harley-Davidson couldn't sell into India. There was a 200% tariff on a motorcycle. So what happens? Harley-Davidson went to India and built a motorcycle plant. And now they don't have to pay tariffs. Same thing as us.
We've had a little bit of a geopolitical issues overtaking trade issues in our negotiations with the United States of America. I do hope things will get back to track soon and we'll conclude a bilateral trade agreement by fall, November or so, as was discussed by our two leaders in February.
Chinese President Xi Jinping hosted nearly 20 foreign leaders, including Russia's Putin, North Korea's Kim Jong-un and the Iranian president, to mark the 80th anniversary of China's victory over Japan in the Second World War. This is the first time leaders from China, Russia and North Korea had gathered for the same event. Riding in a black limousine, President Xi inspected the Grand Military Parade consisting of 45 formations and echelons at the Shang'an Avenue in Beijing. In a show of defiance against the West, Xi reiterated that China will never be intimidated by bullies and asserted that the world is facing a choice between war and peace. Beijing flexed its military muscles by showcasing its modern weaponry, including fighter jets, drones and nuclear and ballistic missiles. China showed off its new intercontinental ballistic missiles, which it claims has a range of over 15,000 kilometers. U.S. President Donald Trump accused China's Xi Jinping of conspiring against the U.S. In a social media post, Trump said, "Many Americans died in China's quest for victory and glory in the Second World War and called for their sacrifice to be remembered." Trump went on to say, and I quote, "Please give my warmest regards to Vladimir Putin and Kim Jong-un as you conspire against the United States of America." End of quote. Now, Elaine Yu joins us from Beijing. Elaine, is she trying to project a troika against United States? Is there more to it than optics?
We see the platform, the SEO Summit, being used as a way to also call for these conversations. There are analysts who have told us that we won't likely be looking at the SEO as a way forward for how global trade will look like, but it's certainly used as a platform to discuss these things. And if you look at the Putin and Kim summit, we talked about how these sideline meetings were getting the attention at the SEO summit, and this Putin and Kim meeting is certainly taking the limelight now. Their conversations very much about projecting that spectacle you talked about, and Putin praised North Korean soldiers, saying they were fighting bravely and heroically in the Ukraine war, and Kim in turn thanked him for praising North Korean soldiers. So you've got them talking about the Ukraine war at an event where President Xi was really casting it as China wanting peaceful development and also deterrence, and also European leaders are largely skipping the event because of Putin's presence there. So yes, the optics are strong at this parade, and it's meant to send a signal.
Right, thank you, Elaine, for that. Shifting focus now, North Korean leader Kim Jong-un's daughter made her first international public appearance in Beijing. She was seen stepping out of her father's armored train as they arrived in the Chinese capital for the Victory Day celebrations. The pictures added to the speculation that she's being groomed to become North Korea's first female leader. North Korean officials have never revealed her name, but South Korean officials believe she is identified as Kim Joo-ae. Now, Google has avoided harsh penalties in a monopoly case. A U.S. court has ruled that the company will not have to sell its Chrome and Android business in a monopoly case. The US Columbia District Court ordered Google to share some search data with rivals as a remedy against the alleged monopolistic practices. However, Google's status as a default search engine in iPhones was left untouched. Now, Rachna Dhanrajani is here with more details on the landmark ruling. Over to you.
Well, it is a big win for Google and for Apple. US Judge Amit Mehta has issued his final remedy order in the landmark antitrust case over Google's dominance in online search. So let's break it down. For Google, this means that it can no longer sign exclusive contracts with device makers and browsers. That is significant because those deals helped Google secure close to a 90% market share in search. So going forward, it cannot prevent rivals like Bing or DuckDuckGo from competing for default status. At the same time, Google can still pay companies like Apple to feature prominently as the default search engine. Those payments are worth more than $20 billion annually for Safari alone, so you can imagine. The only caveat here is that the agreements cannot be exclusive. What the judge has rejected is the Justice Department's push for harsher remedies, including a forced Chrome spin-off or a broader structural change that it had called for. Now, Judge Mehta called that too extreme, pointing to how artificial intelligence is already altering the competitive landscape in search. Now, if you remember, it wasn't too long ago when AI search startup Perplexity had even placed an unsolicited bid for Chrome earlier this year, betting that regulators might force a sale. That bid is now effectively off the table. But it underscored how central browsers have become in the AI era as the gateway for billions of queries. Now, reactions have been quite swift. Google welcomed the ruling, saying it recognizes how much the industry has changed with the advent of AI and maintains that competition is already intense. However, it expressed concern about the new data sharing requirement and said it is reviewing the order closely. The Justice Department, meanwhile, is not fully satisfied. Antitrust Chief Abigail Slater posted on X that the government proved that competition was frozen in place for over 2 decades and said that the remedies will be scrutinized to determine if they truly restore choice. For Wall Street, though, the outcome looked decisive. Shares of big tech rallied after the ruling. So the bottom line is that Google has avoided a breakup, Apple keeps cashing on the default search deal, and regulators are left considering whether these remedies go far enough.
Right, thank you, Rachna, for that update. Back home, it's day 2 of the Semicon India Summit. Prime Minister Modi held a closed-door meeting with top executives of the semiconductor industry. Speaking at the summit yesterday, Prime Minister Modi called semiconductors digital diamonds and promised incentives for companies to make in India. India's services activity has hit a 15-year high in August. The HSBC India Services Purchasing Managers Index climbed to 62.9 as against 60.5 in July. A reading above 50 indicates growth. The improvement was on the back of new orders and a rise in output led by international demand. Maruti Suzuki has launched its new SUV, the Victoris, in India. The model debuts with hybrid and CNG options and will be available in 8 different variants. The SUV has secured a 5-star Bharat New Car Assessment Program safety. It's Maruti's second mid-size SUV following the launch of Grand Vitara last year. The company is hoping to be the market leader in this segment.
This car is got it all, as you see. This car has everything in it, and it has got a very strong competitive edge. So I'm sure that with this car, we can increase our market share in the mid-SUV space, and we'll get back the #1 position in this segment also. Then we'll be a #1 in all segments in India.
All right, time for a short break. Coming up next, Punjab declares all districts as flood hit as the deluge claims 40 lives and affects 3.5 lakh people. More details when we return.
time here anymore now that he's not leading CII. But I know that through the course of his CII tenureship, he was spending a lot more time here in Delhi. So we do miss having you here in the city. But, we're talking about global uncertainty. And of course, we're all accustomed with the term VUCA world. But you have your own coinage, Sanjeev. And I want the audience here to pick up on what you believe is your philosophy. That's TURN: turbulence, uncertainty, rapid change, and novel strategies. Take me through what TURN is about. How are you using TURN to steer and navigate ITC through this period of turbulence and uncertainty?
Thank you, Shireen. It's always a pleasure to be on your, interact with you. So, TURN really reflects what's happening in the world. We have this business about geoeconomics, geopolitics. In fact, if we look back and see from the time we had COVID, it's been events and events. And then we have climate crisis, which was always there, but it's got more severe. It's right on the face right now. We have also the large changes that are happening on account of technology. AI is another chapter that's opening up, and all this is happening while social inequity is rising. I think the market is also getting transformed. Market is getting transformed because on one hand we have new marketplaces getting created, like the quick commerce and so on and so forth. On the other hand, consumer trends are changing. You have the millennials, you have the Gen Zs, their outlook and their needs are evolving, and their voice is being felt now. And regulations are also shaping products because of sustainability. So things are changing quite fast on account of many of these issues. And coming to the second part of how do you really embed this in enterprises. So at the end of the day, I think it's back to basics. But right now it's really I would say the agility and the rigor of some of these facets that change. So to my mind, three, four things are very important. Portfolios need to be contemporary. So portfolios need to transform much faster than they ever did.
Okay.
So you need to be, and in ITC we talk about not only trying and scaling up the core that we have or using the core to address adjacencies, but continuously looking at vectors for the future. Like in the paperboard business, sustainable packaging is a future vector. So that's a continuous process, because that is what will take over in a much shorter time than it ever happened before. And to do that, I think investments in R&D have to go deeper.
What is the current R&D investment that ITC is doing? And I know that this has been something that has been part of the culture and the DNA at ITC for many years now, Sanjeev.
Okay, before I come to that, let me just finish the last leg of this. I think the third aspect that is very important is the aspect of resilience in supply chain. And resilience because of trade-related issues, trade-related barriers, geopolitics, and resilience also because of climate change. You can have one supplier somewhere, I think it was in 21 or 22, when the water levels in the Rhine River went down and people could not transport. So if you had a supplier there, your supply chain would be disrupted.
Right.
So your supply chains have to be, so I think these three are the facets that are very important. Now, R&D for us is very important. In many of the categories that we are there, we are challengers. So we realize we cannot just succeed by, doing the same thing. So innovation and differentiation is very, very important for us. And we have a large R&D center at Bangalore. We are incidentally some years back, a private research identified that the ITC Life Sciences and Technology Center was the largest private sector innovator in India. And we are, of course, not in the kind of sectors where R&D index is of a very high order. We are not in those kind of sectors. Yet, we were classified as the largest private sector innovator. Now, you had an interesting debate just a short while back on deep tech and balance sheets, etc. So, there is some stuff that happens in our R&D which I don't understand, and you need PhD, so I don't know whether it is deep tech.
It qualifies as deep tech or not.
But what I can say is that, in our research, there is stuff that takes 5, 7, 8 years to come to the table. Even when I'm developing, plantations for our paper business, which are disease resistant or weather resilient, by the time the whole thing gets commercialized is about a decade. So there are long-term investments there. When we made chocolates, it took several years to get something that was, we believe, better than what is available in anywhere, right? We launched a brand recently called Right Shift, which is for people above 40 years. It's nutrition-dense products with proprietary extracts. This has been in the offing for several years. The solutions were there. I think we were waiting for the right time, and I think this was the right time, so we brought it into the market. So there is a lot of work happening on R&D, and long-term also.
Enough patient capital at work.
Yeah, there is no hesitation from investing that. I think it's about citing the opportunity and the business case, and we remain committed to that.
Sanjeev, talking about citing the opportunity, let's talk about the big change that everyone is anticipating. And of course, that meeting is currently underway, and hopefully we should have clarity by tomorrow on which way the GST Council votes as far as GST rates are concerned. But the assumption is that for a large part of your portfolio, which is in the FMCG space, there are going to be significant reductions. I don't know about the cigarette basket. That's a different story altogether. But from the FMCG point of view, from a consumption, larger India consumption point of view, what could this potentially mean? What kind of unlock do you anticipate?
So I think this is a very bold step that the government has taken. It's the Honorable Prime Minister announced it on the Independence Day. And I think it's going to have multi-dimensional impact, because it's not just about rate reduction. It is also about simplification. It is also about ease of doing business. So the changes are multidimensional, and impacts are going to be even more profound. I think it's certainly going to make things cheaper for the common man. So it will fuel consumption. It will lead to a lot more formalization of the economy. It's going to make life simpler for corporates, for MSMEs to comply with simplicity in structure, and some of the processes, etc., getting streamlined. So I think it's a significant step forward, and it will remove a lot of friction and provide good momentum to the economy over a period of time. Yeah.
But, in terms of, I understand taking away the friction, which is to do with the compliance-related procedures that we expect the government to act on, and I believe some of those decisions have, in fact, been cleared by the GST Council today. But on the consumption momentum, given the reductions that are expected, are we expecting a big pickup? Because that's the expectation, that if there is any potential revenue loss, it will be made up by a boost in consumption. What are you working with? Because for FMCG, the last several years, volume growth has remained largely flat. Do you believe that this could be the kicker that you were waiting for?
I think it will be a very significant intervention to grow volumes. If we step back and see, in a country like India, where the penetration levels are low, per capita consumption is lower, why is it that consumption has been slow? I think it's simply because of the elevated table of costs. Between pre-COVID and today, things have changed. A lot of factors are external, and the other factor is to do with climate change and food inflation, which has been sticky. So in a common man's budget, you see, food is a significant part of the wallet, and that inflation has been sticky. So that's the reason why the consumption, we believe, has been under stress. But now that, if with the taxes going down, prices are going to go down, I think it's going to make a significant boost to consumption. Also, and it's not just one step, interest rates have eased. I think fortunately the inflation is also under control.
Yes.
The experience in the recent past with farm incomes has been better. So a lot of factors are coming together, and this is going to provide, I think, a significant more impetus.
A significant impetus, that is the hope. But on cigarettes, what's the expectation? There is a demerit slab of 40%. Do you expect that that's where it will hold, or that's where you will find yourself? Or do you anticipate that there could be more cesses and levies on top of that? Well,
I was just waiting for that question. So, you see, I very well informed by what is stated in media. So I guess you know it better than I, but my understanding is that, what our expectation and understanding from whatever I'm reading is more that it's revenue neutral. What percentage will be here, what will be in some other form, or what will go back to, some other form of taxation to make it, how the bucketing will happen, I can't really comment. That will be very speculative.
Yeah.
But that's what we hear, and that's what we hope and believe will happen.
Well, the expectation is that it will perhaps be status quo in terms of rates. We may, in fact, see a higher incidence. I don't know if the demand for an additional levy that many states have moved to cater to revenue protection, but one will not speculate on that.
Historical data has shown that actually does not lead to revenue protection.
Yeah.
It leads to revenue depletion. Because of the illicit
but that's okay. Illicit market picking up. But, we talked about consumption. Let's talk about investment, because one of the peeves of the government has been that we haven't seen private investment, private capex picking up, despite the fact that we put lots of sweeteners and sops on the table. But in the case of ITC, you are actually putting money into investments. You've got a 20,000 crore rupee capex plan for Bharat, so to speak. What are you seeing as trends on the investment side from an ITC perspective as you build out for the future?
So we are very optimistic about the potential in the Indian market for the reasons I alluded to, the headroom to grow. At the end of the day, the economy, despite all the global challenges, Q1 was 7.8, which is brilliant, and we have been, the forecast are around 6.5 or so. So it's a significant growth there, and that opens up many opportunities. And that is why we are investing that kind of money. Although we are not in I would say, a capital intensive sectors, though paperboard a little bit, but others are not that capital intensive. But still we are putting that amount of capital because of the opportunities we see in FMCG, in agriculture, in paperboards, and tourism. So all of these sectors have enough headroom to grow. If I was to just give you an example of paperboard itself, we are the fastest growing market on paperboard. Of course, we do have challenges right now of dumping from some countries. Leaving that aside, as far as domestic demand is concerned, we need to add about 1 million tons every year.
and welcome to Startup Street. I'm Ritu Singh, and here are the top headlines from the startup space. Indian and American venture capitalists and private equity firms launch India Deep Tech Investment Alliance, a new industry group that aims to mobilize private capital and expertise for deep tech companies in India that will strengthen US-India deep tech collaboration. This is set to boost investment in deep tech sectors with $1 billion of total capital commitments. Short-form learning platform Seco secures $28 million in a Series B funding round led by Bessemer Venture Partners. The fund plans to use the funds to build new experiences through new content formats and to leverage AI-first solutions. BizDate Up's first alternative investment fund, Pulse Fund 1, gets market regulator SEBI's approval. The closed-ended Category 2 alternative investment fund carries a corpus of 1,000 crore rupees, comprising of a base fund of 500 crore rupees and green shoe option of another 500 crores. It will deploy the capital across high-growth startups, SMEs, and select real estate equities. Flash.co unveils Flash AI, first-of-a-kind AI shopping assistant that will enhance the shopping experience for over 1 billion active shoppers. With this, it makes a global foray and will be accessible to shoppers across 100 countries. And ID Fresh Food makes its foray into Vizag's Tier 2 and 3 markets by opening its first-ever batter shop. The company, with this entry, aims to cater to the bustling local market there, which has been dominated by unbranded batters. Those are the headlines we're tracking for you today. But in what's brewing, form learning platform Seco has secured $28 million in a Series B funding round that was led by Bessemer Venture Partners with participation from Goodwater Capital and existing investors as well. Founded in 2020, Seco provides bite-sized, curated, vernacular learning content for Bharat. This content, delivered in 3 to 5 minute videos, focuses on practical knowledge for career and self-growth. The company now has 25 million monthly active users and claims to have seen a 60% quarter-on-quarter growth. It will use these funds to build new experiences through new content formats and so on. But to understand more about the company's growth trajectory, joining me now is its founder, Rohit Chaudhary. Rohit, thank you so much for your time here on CNBC-TV18 and welcome to Startup Street. Tell us a bit about Seco before anything else. What is the gap you're trying to solve for and the size of the market opportunity you're chasing?
Yeah, so we are just trying to, help people in India live better and actually build a better world along the way. And Seco is exactly filling that gap where we are a country full of aspirational people who really want to learn and grow, but definitely face challenges when it comes to getting support in terms of, what next to do. If they want to set up their own business or want to earn online or want to just grow as a YouTuber. So we are just helping them through these short form curated videos to learn and become better.
But Rohit, in a space where YouTube, Instagram, even new age edtech players are vying for attention, right? How do you ensure users come to your platform specifically for edutainment rather than, just picking up knowledge from mainstream apps?
Yeah, so YouTube, or for that matter, internet is full of knowledge and information. However, there's too much of it that people don't really know what to rely on and, what exactly to trust when it comes to moving towards their goals. And Seco, on the other hand, comes into play and provides content which is exactly what users need in a very crisp, short, 3 to 5 minute kind of a format, where we only talk about things which actually matter, which are going to help people grow, and all of that created by experts who are kind of verified by Seco. So all of those are the reasons why people love, learning through Seco and not really through the free to use educational platforms or information platforms.
Well, I'll come to users in just a bit, Rohit, but how are you going to deploy this $28 million check that you've got? In terms of immediate priorities for growing the company, where will you deploy this money?
Yeah, so as I said, the mission is to make learning fun and easy for everyone. And towards that, the first step is, of course, to expand into as many categories and languages as possible. and on top of it, also use new formats of learning, which could be blended, of course, using new technologies like AI, and build more interactive, personalized learning journeys for our users, so that we can actually make Seco a global learning brand, and move even further towards that direction to expand globally.
Expand globally. What are the markets that you're looking at the moment, apart from India?
Yeah, so we are definitely going to launch, the English language of our app very soon, and going to launch in the US in the coming quarters. And we definitely want to build the first edutainment brand, which is built from India but for the world.
All right. India's subscription economy at $2.5 billion or so. How are you convincing the first-time digital, payers in Bharat, in Tier 2, Tier 3 and below cities to pay for your content? What's your early experience with the churn and the retention that you've seen so far?
Yeah, so, it all comes down to talking to users and understanding the market. And since day one, we have been speaking to all of these users who talk a lot about, how learning can actually lead to success and how it can change their life. Learning, how to start their business or how to improve speaking in English, or small things which can actually compound and make them successful in the longer run. And that's primarily the reason why they not just pay for once, but also keep paying and keep using the platform, leveraging the offerings that we have to offer, and of course improve their lives throughout in their lifetime. And yeah, we have kind of the industry best retention numbers when it comes to how far we are able to take our users in their lifetime.
All right. You've already hit about 25 million monthly average users, and that 60% growth number quarterly that you're talking about. What drove this adoption curve? And as you scale, as you become a larger company, how do you hope to sustain this?
Yeah, so the secret essentially lies in the nature of the platform, which is very horizontal. Before this, of course, people have tried building vertical plays where they have went deeper into one particular area of learning. But the idea with Seco is that we are trying to build something like a Netflix for learning, where users can actually explore a lot of areas in which they can learn and grow. And that is what drives a lot of demand, because as we keep growing, we keep expanding more and more categories, which not just increases offerings for our existing users, but also attracts new and more users to the platform. So please don't be surprised if you see categories like AI or deep tech that you want to maybe develop a better understanding into, or even journalism for that matter, very soon coming on Seco.
So, quickly we've run out of time. You've mentioned leveraging AI-first solutions. Concretely, what will that look like for Seco in 10 seconds?
Yeah, so it's just interactive learning experiences where you not just learn by watching videos, but also clear your doubts specific to your needs, which only AI can offer, of course.
All right, Rohit, we'll have to leave it at that. Thank you so much for your time today. It's been a pleasure speaking with you, and we hope to touch base again in future. Thanks very much. Now, India wants to be more than just a consumer of chips. It wants to be part of the global semiconductor value chain. That is the focus of Semicon India 2025, where policymakers, global majors, and local startups are all under one roof. Now, one of the companies drawing attention this year is Lam Research, a US-based leader in chip-making equipment. CNBC-TV18's Aishwarya Anand reports from the exhibition floor.
We are here at Semicon India 2025, the country's annual showcase of its semiconductor ambitions. Among the global majors present is Lam Research, a US-based company whose wafer fabrication equipment is used by chip makers worldwide. From etching nanoscale patterns to enabling deposition processes, Lam tools are at the core of making world's most advanced semiconductors possible. But what role does India play in this story, and how is Lam engaging with the country's growing semiconductor ecosystem? That's what we're here to find out from Rangesh Raghavan, India head of Lam Research. Rangesh, the first question that I want to understand from you is that, help me understand, take us through a little bit about Lam's India operations. What are some of the core functions that you're running here, and how do those connect with your global operations?
So Lam India pretty much does every function in the company. We started as an engineering services organization for software, hardware engineering over time. Today, we represent every function in the company is represented in India. So for example, we have an organization that works on logistics, shipping our equipment around the world. So we have a team in India that helps our global team with that. We have an organization that does procurement globally, and we have a team in India that works on that. We even have an organization that builds manufacturing fixtures, etc. We have a team in India that does that. So most people think of a technology company as hardcore engineering and software engineering and hardware engineering. We do a lot more than that. Very happy to say that in India we cover pretty much the whole gamut of the company's operations in some way or the other.
Okay, so that brings me to the next question, and which is India is right now positioning itself as a global semiconductor hub. Yeah. So tell me, how does Lam's India operations fit into that bigger vision that we have?
Sure. So if we want to make these fabs that are being announced successful, we need to develop this ecosystem.
Correct.
Right? So a fab can't exist on its own. It needs people to supply things to them, high purity gases, components, materials, equipment, and the like. And they also need partners who can help train their engineers in a particular way to operate the equipment. And they need partners who can supply and maintain and service that equipment.
Correct.
So if we already have a footprint in the country, the India operations we have give us a great springboard to when Tata, for example, our next door neighbor, when they complete construction of their factory, we'll be able to support them very well because we're right here and we're able to do that. So in terms of our contribution, it's basically to broaden the ecosystem, and the breadth of that ecosystem really helps develop the whole industry, actually.
Okay. So also help me understand that when we talk about India's design and engineering talent, what role does that play in your operations?
Well, India has a large talent pool, as we all talk about. I think we graduate around 2 million engineers a year. Huge number of people.
Correct.
So that's a lot of raw talent. What we do at Lam is we hire those people and we train them in our specific domain. So once we've trained these people in our domain, they become the experts that we rely on. So we've been doing this for 25 years in India. We find that the design engineering talent is outstanding. In many cases, our engineers have very quickly caught up to and outperformed some of our operations globally in terms of how they deliver. So we've been very pleased with our progress in this regard.
So that was all about Lam's India footprint, but the real action here at Semicon is happening on the ground, where Lam is showcasing some of its advanced tools, which is helping it make some really advanced chip makers. What these tools are, let's go and find out. I do want to understand from you that what are some of the key technologies that you're showcasing here at Semicon India 2025?
Well, some of the most important technologies to manufacture semiconductors is what we do as a company. Okay. So we want to showcase that exact thing. So over here is a small representation, it's a simplified representation of what happens to a wafer and how chips are manufactured. Okay. We start with a blanket wafer. It doesn't look like that, it looks like a big disk. But this is a sample. It comes through to one of the Lam tools where we deposit a film. These films are often of a thickness of, say, 1/100th of a human hair or something like that, so extremely nanoscale. And then we bring it to, we need to create a pattern. So to create this pattern of a circuit, you need to use a technology very akin to stencils. So you have a mask and we want to remove or etch in the parts where you don't want things, so you cover the other parts with a mask. So that's what we do here. We deposit a photoresist material using an Aether system from Lam. and other companies project the mask that they need, which is the stencil, and then we come back to a lamp tool and we remove the materials as per the design. And once that's done, we come back to other lamp tools and clean up any debris or residue, for example, removing these unwanted layers. And then we come back to lamp tools and deposit new films again, and now we've formed one layer. Like this, there are 400 or 500 repeats with different designs throughout the process. It can take 30 to 90 days to complete. So that happens in a sort of a repeated cycle, and we are engaged in many of the most important steps. So that's what
Could you give me a use case of this?
Well, these chips go into everything we know.
Okay.
We have lights there, they're running on LEDs, they're made with similar technology. We have our cell phones, they use microprocessors, they use clock processors, they use audio control processors, they use microphones. All of them are made with a process similar to what this is done. So the use cases are many and diverse.
Could you give us some use case of this technology?
Sure. Almost all chips are made using a similar process.
Okay.
And if you think about the use cases of chips, they go into everything from, cars where we control automatic brakes, to your cell phones where you need a microprocessor to process the videos that come in that you want to watch, to your refrigerator these days that turns the light on and off, etc. So the use of chips is widespread and it's only growing. And we look at the explosion of AI as one of the largest now new use cases, because every AI question you have, so every time you open up ChatGPT and you say, you want to ask ChatGPT something, that goes through a chip on your phone, it gets out through another chip as an RF chip that goes to the network, then the network has many chips that process that information and send it to the processor. So the whole thing is all made with chips. So the use cases are so many.
All right. So this is one tool that we have seen. What else do you have on the showcase here?
Well, what we're doing is we're kind of showcasing what our tools look like so people get a feel for it. So here is an example of a system that we produce commercially, that we sell. Basically wafers, those wafers that we talked about, they come over here, they get loaded onto this system, they get distributed into this tools where it's kind of like a pressure cooker, you can say, right? There's we put in gases, we put in various things into those chambers, and then we make the magic sauce of the films happen or the removal happen. So it's a complex thing. It's hard to explain very easily. So what we try to do is to explain that by showing you what a real life tool would look like. So one of these little guys here that you see, one of these little guys, we've brought an example of that. And so this is what a real wafer looks like. It's inside here. So that's what chips are made on. And so we've opened up this chamber to kind of show you what happens. And then we put in gases, chemicals, heat that thing up. We put in a plasma, and I'll show you in a little bit what a plasma is. And then that's how we do our secret sauce. So it requires a lot of components, a lot of things to make all this work. So it's a very complex engineering marvel, what we do in the industry and at LAM.
Rangesh, my final question to you is that how are these tools enabling next-gen technologies, say, for example, AI, 5G? How does it work?
Well, the next gen of technologies need these chips to be faster. They need these chips to consume less energy. They need these chips to be cheaper, right? That's what we do in the industry. We call it Moore's Law. So every 2 years, we produce chips that are twice as fast, half as expensive, and perform twice as well as the previous generation. That's the kind of pace of research and development that is needed in the industry. So that's what we do here at LAM. We need to keep innovating. We need to keep moving that bar so that our customers can get the benefit and apply these technologies to advance the state of AI or 5G, all these networks.
Okay, all right. Thank you so much for speaking to us. It's been lovely interacting with you.
Thank you so much, Aishwarya. It was a real pleasure hosting you.
From research and design to showcasing next-gen tools, LAM Research is betting big on India's semiconductor journey. And here at Semicon India 2025, the message is clear. Fabs alone won't define India's chip story. It's the tools, technologies and talent that enable them which will determine whether India can truly become a global semiconductor powerhouse. In New Delhi, Aishwarya Anand for CNBC-TV18.
And on that note, we're going to wrap up this edition of Startup Street. Thanks very much for tuning in, but stay with CNBC-TV18. More news and updates will continue after this break.
Even after spending billions of dollars, we are unable to solve the cybersecurity problem. And one of the reasons for that was that we were always using yesterday's technology to solve today's problem.
So how long did it take to build the computer?
For quantum computer, we took around 1.5 years. The way it was so exciting was when the fridge came. Fridge was from glucose and we did fabricate outside. People were on the truck from the airport, Bangalore airport to office, and we were all waiting in the basement for this to arrive. And that moment, it was unbelievable. Okay, finally we have this here, because we were waiting for 3 years. And the bigger moment will be next few years when we fabricate it here.
And that moment is a couple of years down the line?
No, next year.
Next year.
As long as my data is encrypted using quantum keys, it is unbreakable. Even quantum computer, most powerful quantum
So
computer,
he can't break into you.
Till the time the people don't encrypt it, he can break it. We built India world's first end-to-end SaaS quantum security SaaS platform. I went into US and presented this to few investors there, and they were little not convinced. But after some time, they said, we haven't heard this story anywhere. So that was the moment for me that India has arrived.
The US is far ahead. China is significantly ahead, especially as far as quantum, etc. is concerned. Where does India find itself?
There was an inventor of Wi-Fi. They did all the research. That's Bell Labs. And who became a leader in Wi-Fi is Broadcom. So similarly, it will not be that people who start first, they'll be leaders. IT era is over. Deep tech is where the next generation really has to focus.
You have to build products. India has to move from services.
What are those ingredients that will ensure that we make that transition?
When you're in services, and I spent some time in the service industry, you try to solve somebody else's problem. When you say product mindset is all about looking at the problem.
For the country like us, where we have largest population, I think the services will be one of the sectors. We can't eliminate that. And then the product will be the sector that creates the wealth of the nation. So these two should continue to coexist.
India is accelerating its push in the global quantum race, from building the nation's first superconducting quantum computer to securing critical digital infrastructure with quantum-safe encryption. At the forefront of the deep tech revolution are two Bengaluru-based startups. Hello and welcome to Young Techs Reloaded. I'm Shireen Bhan. Leading the charge in building India's quantum future are QPi AI with its full-stack quantum AI platforms and the country's most powerful 25-qubit system, and QNew Labs with its indigenous quantum communications technology, safeguarding defense, government, and enterprise networks. Today, we meet the men shaping India's national quantum mission roadmap, from taking quantum computing from lab to the market to ensuring that in the age of AI and quantum, India's data remains not just encrypted but unbreakable. I have with me today Nagendra Nagaraj, the founder and CEO of QPi AI, and Sunil Gupta, the co-founder and CEO of Q New Labs. Gentlemen, many thanks for joining us. You know, to start with, like, my mind overnight has been on superpositions and quantum cryptography and quantum supremacy, but I want to break this down for our viewers so we really understand what we're talking about. You don't just wake up one morning and say, I want to disrupt quantum computing. I'll start by asking you, Nagendra, how did this come about? I mean, you were working with NVIDIA. You could have continued to do that. What made you want to bet on quantum computing and bet on it in India specifically?
Yes. One of the things I observed early part of my life is, of course, I was very interested in quantum physics. At NVIDIA, there was DeepMind, which was doing some experiment in 2012. And they were playing this Atari game using their new model called DQN, double DQN. Okay. So I thought AI would not stop. And that was the thing. I tried to design that chip using AI then. Okay. So then I tried to do a chip which is agent-based compute. I was too early for the time in 2016 where I coined the word agent-based compute.
Huh.
Okay. So now everybody knows what agents are. But this was a different thing. Other problem I saw is, as in this endeavor, I saw like the classical way of doing AI is not going to be sustainable because it will consume a lot of energy. And of course, Google has really proved a point with their 2020 paper with Sycamore, where they told that what takes 26 kilowatt in quantum computer with 53 qubits would take around 15,000 kilowatt for classical one, and it consumes around 26,000 GPUs. Of course, people can call it as a bias towards quantum. Of course, it can do some workloads better, but we are knowledgeable that chemistry is quantum, all the chemical reactions are quantum, materials are quantum, and also optimization is quantum, and there are things like drug discovery which is quantum also. In finance, they are going to move towards quantum. So in that way, the next generation of intelligence modeling, which requires high dimensional data, does require quantum computers. So for my journey in AI, it took a turn to my earlier interest in quantum physics. Now I am into this form this quantum computer. In 2019, we formed this company with the aim to have better intelligence modeling, better intelligence compute.
Sunil, the same question to you. When you finally decided that this is what you wanted to do, what was the initial reaction? I mean, was there belief, was there conviction from people that you spoke to that this, I'm going to do this, and did they back the idea? Did they support the idea?
So the way it started in 2016, when one of our co-founder, Srinivas Alluri, actually was a very successful venture capitalist.
Yes.
And he decided to start deep tech in India, but he didn't know how to do that. And that is when he also came across Professor Anil Prabhakar from IIT Madras, who had a technology, laser technology, and said, we can build something in quantum tech. But that you have to solve a problem, not just
exactly.
So that is where I came in, because I came from the cybersecurity background. I had done AI in cybersecurity in 2015-16, and I realized that being a cybersecurity professional, that even after spending billions of dollars, we are unable to solve the cybersecurity problem. And one of the reasons for that was that we were always using yesterday's technology to solve today's problem. And hackers are always ahead. So the only way we realized that we could solve this problem is if we create a technology gap, which means that if enterprises can get a technology which is way ahead of time, before hackers get a technology to even try to break it, basically it's about bringing a future technology into present. If we can do that, then probably for the first time we are
ahead.
We are actually changing the paradigm of cybersecurity. And then another important point was in 2016, India started using cloud applications. We had Paytm, we had Taxi for Sure. People started using cloud applications. So it was very clear that 1 billion people coming onto digital applications.
There is a use case.
This means that digital trust is so important. And when we looked at digital trust, we found that we cannot build digital trust buying technology from outside. So we saw that probably a confluence of quantum science, national security imperatives, and digital sovereignty probably can give us the solution that we were looking for.
Nagendra, what has that been like for you in terms of building recognition for the product and getting clients on board as well? And it's not just tech for the sake of tech. You have to be able to solve problems. Now, what are the key problems that you're hoping to solve as far as QPI Labs are concerned?
See, yeah, the vision is intact when I started earlier, intelligence modeling, intelligence compute. We're very fortunate to get our first few clients, including, L'Oreal and Siemens. Siemens was our first client. We did a lot of joint project with that. And then we got clients across India and also abroad. And then slowly our order book keep on increasing. Now we are at around close to around 1,000 crores. And we built first quantum computer. Now we're installing quantum computers across the universities for education. And then we are also building a quantum computer which can be commercially deployed in our enterprise customers. That means commercially in the sense, it will be a workhorse for day-to-day activities like in chemicals, in materials. And then there is a lot of business model we can branch off. We can do a solutioning, we can do software licensing, we can build infrastructure for them, including the quantum computer on their premises.
But the point about building the supercomputer here, and I want to understand what it took to be able to not just imagine that you could do it, but to finally then do it as well.
Absolutely.
Because I think there's a lot of questions on, can India do it? Can we do our own chips? What will it take to do deep tech in India? Now, this is completely designed, developed, manufactured in India, correct?
Yes.
What was that like?
Oh, that was fascinating because we took almost like 3 years to build a hardware. See, we had two teams, one which was generating revenues and one which was doing the deep R&D. And these are the people who are PhDs who came from abroad, and they started doing all this chip design and planning for the foundry and the controller, which controls the quantum computer. It's a microwave device. So we did that first device, and we built all the software that is required for quantum, like system software and application software. Then we finally assembled when we got our first pre-series A, that is $6.5 million. We put together the quantum computer.
So how long did it take to build the computer?
For quantum computer, we took around 1.5 years.
Okay. Take me through when it actually came together. What was that like, and what has been the response that you got from the world to that?
The way it was so exciting was when the fridge came. Fridge was from Glufosan. We did fabricate outside. We didn't have the fab here. So the thing is, when the fridge came, people were on the truck from the airport, Bangalore airport to office. One person who was a lead, hardware lead. It was a VP of hardware. He took next to truck driver to show because the clearance from SCZ and all those things has to happen. And we were all waiting in the basement for this to arrive. And Blue Force team came from Finland and they installed everything. And that moment, it was unbelievable. Okay, finally we have this here. Because we were waiting for 3 years. And the bigger moment will be next few years when we fabricate it here in India. Designed and fabricated in Bangalore.
And that moment is a couple of years down the line?
No, next year.
Next year. While you are born in India for the world, and that is the aspiration as far as QNew Labs is concerned, but what about the India market is exciting at this point in time? I mean, we've seen this digital explosion, especially as far as digital payments, etc. is concerned with UPI and, what the NPCI has managed to do. Explain to me the significance of what you're seeing in India and the kinds of solutions that you're being able to provide, not just for India, but using India as a sort of test case, as a use case for the world.
Yeah. So I think that today in a hyper-connected digital world, we say that our data is actually in a paradox, in the manner that it is safe at one end, but that it is also at risk at the same time.
Yeah.
Until unless it is hacked. So it is not safe. I mean, it is we call it a dual state, it always. And we realize that we are trying to solve problem, world's trying to solve problem in two different ways. One way is the people trying to solve, we call it malware protection. People buy so many software, put their, virus, antivirus software.
Yes.
Basically, what you're trying to say is, who is trying to come into my house, who is trying to attack me, and I'm trying to protect that. Now, hackers, advanced hackers with AI and all, they need only one single success, to get in. So instead of spending our time and energy there, we felt that at the end of the day, hackers are behind data and information. And the only way to secure that is through encryption. We call it, whoever controls the encryption controls the world. And we said, instead of spending our time and energy in all other superfluous areas, which we should still invest there, what if we make encryption unbreakable? Which means that even if a hacker comes in, steals my data, but he can't do anything with it. So the incentive for him to come and hack my house or hack my servers. And
there is no incentive.
There is no incentive. So we said, can we take a ransom out of ransomware? I can't protect ransomware. But so what we did is, we are in the business of QNU. We said we are going to build the encryption key. So encryption is two parts. Encryption is on a lock where you actually encrypt the data, and the other is you use a key. So key is what everybody hacks. So what we said, we are going to use quantum physics to build unbreakable keys, encryption keys, which has no bias. We'll distribute these keys wherever it is needed in network, endpoints, cloud, edge. Wherever it's needed, we'll deliver those keys. And once those keys are used for encryption, we'll store those keys securely in a vault that nobody can hack there. Now by doing this, we actually built a very powerful capability for enterprises, for defense and so on. Now what it means is, I don't care about anybody, because as long as my data is encrypted using quantum keys, it is unbreakable. Even quantum computer, most powerful quantum computer,
he can't break into you.
Till the time the people don't encrypt it, he can break it. Yeah. But once it is encrypted using my quantum tech, that's already quantum safe encryption.
And so I would imagine that the government, defense forces
is already deployed.
It's already deployed,
Yes.
and this will continue to be the big adopter as far as this technology is concerned. Where else do you see this being adopted?
So we seeing this multiple
Financial
use
services,
cases,
of
financial
course.
services,
Yeah.
payment gateways, telecom infrastructure. One of the largest telecom player is now trying to build a sort of a very interesting concept. He has already an optical fiber network with them. He's saying, how can I put quantum encryption as a service on top of optical fiber and offer it as a quantum security as a service? If you have to use this quantum security as a service, we have built a platform so the enterprises can use it as a service. So now what has happened is democratize the whole technology. Instead of the defense, some of the other critical infrastructure, they will buy our hardware. We have a very special purpose hardware which has more than 10 patents. Army, our Indian Army, Armed Forces, they are buying infrastructure of boxes and they're installing it in the network. But other enterprise players like banks, telecom,
will get on board with the software as a service.
they will go buy my Q-Shield platform, we call it. So they will host that platform in their data center and offer quantum secure services to the clients. Just because we're too ahead, we have seen problems in India, we found use cases. We built India world's first end-to-end SaaS quantum security SaaS platform.
It's the world's first India developed quantum security SaaS platform. But
So
since we are talking about India and its role and relevance in what we're seeing, whether it's the AI wars or now as far as quantum technology is concerned, where are we? Because again, the perception is that, look, the US is far ahead. China is significantly ahead, especially as far as quantum, etc. is concerned. Where does India find itself today?
See, we are at the right time, first thing is. Okay, so I'll give an example that, there was an inventor of Wi-Fi. They did all the research, that's Bell Labs. Okay, and who became a leader in Wi-Fi is Broadcom, right? So similarly, it's not be that people who start first, they'll be leaders. So what really is required is to have that innovative mindset, okay? So I would say that there, I think we have a level playing field. See, although you can say that, okay, AI, they are ahead, quantum, they are ahead of semiconductor, but nobody can deny that Indians are very creative. We have to endure. What we have to do is, I can tell you what, to win this race or to be a major player here, we have to build a companies which are enduring, which can take this brutal journey and really get some output for society.
Quantum computers and computing tech is one of the most precious technology in the world. Whoever will get it will be the king, because they will be able to solve problems that nobody else can, whether it's a financial model, whether it's a faster drug discoveries, finding new materials, they will be the king. This is going to be a quantum war, right? Which means somebody who gets the technology, they will not share with everybody else, it is given. Idea here is not only to be independent of them, we will actually turn the tide by saying that we will be the global supplier of this tech to everybody. And that's what India has to do.
I want to understand from the two of you, because as a lay person, you pointed out that AI has been around since the 70s and so on and so forth. But from a common man's perspective, the real breakout moment happened when ChatGPT exploded, and it came out of nowhere. I mean, nobody expected the kind of reaction and response that we saw for ChatGPT, and it's just built on that. I mean, forget the valuations. We're actually seeing real adoption. India is the largest market now for that. Are we likely to be anywhere close to having a ChatGPT-like moment as far as quantum tech is concerned?
So I will just add to what he said. Now today, for example, India has got capability to establish a safe networks over optical fibers. We can secure drones. We can secure satellite networks. We can secure Wi-Fi networks. So you take in any media, and our technology is ready where we can secure and we call it quantum Q-shield dome. So in our vision, what we are trying to do, we are building a quantum dome for India so that we are protected from any AI or quantum attack in the future.
A quantum dome for India, and are we there, or
yeah, we are already.
We're already there.
70% of the pieces already exist. They are right now. We're deploying them in pieces, but eventually, idea is that put them all together, and we do. Today, we protect like armed forces networks, optical fiber networks. We are now trying to implement our technology in drones. We have already demonstrated that to armed forces.
That's interesting, and that's also good to know, because I think in the era that we live in, that kind of protection is absolutely necessary. But as I was asking the two of you, when do we see that kind of breakout moment when when there is a large-scale conviction on what you're attempting? I mean, you're a believer. You've seen the results for yourself. But for the world to become a believer in what you're doing, what will it take for that to happen?
See, the world is still looking for a killer application, and everybody is in search. And I always say to my team as well that we are on the dartboard, but haven't hit the bullseye yet. And everybody is waiting for that moment. It is a quest. We have to keep doing it.
Worldwide, you will not know first ChatGPT moment of quantum because it will be kept secret.
Yeah.
Okay. So you will only know when some popular application becomes known to us. Like for example, somebody solved a fertilizer problem. You know that. But somebody actually decoding some of the secrets of the nature, you will not know.
So what are the 5 things that people must know about quantum technology, why it's important for the future, where India finds itself, and what companies like yours will do to disrupt this space? I want to start with you, Sunil.
I think everybody has to, this is a different tech. So everybody has to understand and spend some time understanding and learning about it. People probably have to understand that how this is the application of this tech for them. The future world is going to be quantum and AI. Everybody has to figure out that what is in for them in terms of either to learn or what type of application and technology they would use.
Nagendra?
So difference between many countries when compared to India when IT started was India was able to latch on to IT. They were a good programmers, software programmers, and they were able to program. If you look at the mirror image of that, look into Japan. It was a giant. It was one of the largest tech countries in the world. So what happens, they missed out on open source. So similarly, this is a movement where it will separate out the countries which latched on to adapt it to it and then mutate and to become something else and something like quantum literate, and they can catch on the technology and do many applications. We do require more engineers who are into deep tech now. IT era is over. Okay, but then
IT era is over.
Yeah. Over in the sense, not a peak of them. So it will continue to have its own thing, but the growth is decelerated for first time. If that era is slowing down, India requires a better growth, the vehicle for this, right? We have huge population. We are most populous country in the world. And strategically for us, the deep tech is where the next generation really has to focus.
You have to build products. India has to move from services. Services will continue. AI will also be there. But what India needs future is to build a product nation, as Dr. Rajesh always says.
But in this shift from services to becoming a product nation, what is the shift that we need in terms of mindset? There is, of course, a shift that we need in terms of capital deployment as well. There's a shift that we need in terms of R&D. What will it take? What are those ingredients that will ensure that we make that transition?
So I think the most important part is that when you're in services, and I spent some time in the service industry, you try to solve somebody else's problem. When you say product mindset is all about looking at the problems, identifying the problems. And then, for example, we saw an opportunity, we saw a problem, a future problem for India. We said, this must be solved. So when you look at a problem, then you try to find solutions. And then when you try to find solutions, you definitely have to build a sustainable solution. And that is where the product, platform, and everything come.
What will it take to become a product nation?
For the country like us, where we have largest population, I think the services will be one of the sectors. We can't eliminate that, but it's a very important sector, services. And then the product will be the sector that creates the wealth of the nation. So these two should continue to coexist. To do a product, we need to take the ownership. That means it's your product, and basically you have to have a roadmap. You have to have a continuity, business continuity for your customers. When you have a product, also in services, the customer depends on you heavily. But in services, what happens is the replaceability is easy, at least in short to medium term. The product replaceability, when you go to you just put something on the enterprise usage, it's not easy to replace. Nobody can replace easily your Amazon cloud or Azure data center.
When we do products, services, the risk is customers, right? Here you have to take risk. Right? So risk-taking ability, right, is very, very important, and your ability to handle the failures. How do we celebrate failures? Because product you fail. And a lot of time when we hire people, sometimes we ask them this question, right? Can you handle failure? Because we expect you to fail at times, right? Because it's a very long, tedious
and brutal journey, as he mentioned.
And we do a lot of deep R&D, right? We will do a lot of things which will not work. Right? Which is okay. We do experiments, we have hypotheses, we fail we say the hypothesis not worked. We learn from that and move forward. So ability to take failure in your stride, and ability to work for long hours, very hard work, and take risk is very,
so
very
70
critical.
hours, 90 hours is a given, right?
Don't give us on that, please.
There's no hours. There's no concept of hours.
Enjoy that. Okay, don't count
As
it.
an enterprise, 24/7. You are always there, right? Always in the zone, right? It's not about hours, right? It is always being that when your heart and mind is in it, then boundary of hour doesn't make sense.
I agree with you. So finally, let me ask both of you, because that's very interesting that you said you have to have the risk-taking ability, but you also have to have the resilience to rebound from a setback, to rebound from a failure.
Very fair.
What has been the mantra for you to build that muscle?
If you have the clarity of the vision that what you're looking at, you will have failures, but you're glued to your goal and vision. They'll say, okay, I'll rise up and go forward, because you're looking, you have the clarity of your vision, right? And that is what gives you the courage. If you can get confused and you don't know what you are doing, and you fail, you don't know what to do, and the people quit.
One of the most important aspect apart from vision is the leadership. See, what happens when you build something like this? See, I don't know what clarity means. When you have a vision, only you know the vision. You have a picture of that. How do you reach there will not be clear all the time. But you know where you want to reach. You know the imagination. So with that imagination, you need to lead set of people. So that leadership is very important in a product company. Okay, where you can lead your investors, your employees, your customers, and make sure that they all buy into your vision. Everybody is focused on reaching that vision. So honesty is another thing. You have to be very honest with your employees, very honest with your customers, very honest with your investors. Okay, so once they start trusting you and you start delivering, you will slowly start moving towards that vision. So to take everybody in your journey is very important. That's the most important thing in a product or deep tech companies.
Is to have the clarity of purpose, the clarity of vision, the resilience to actually be able to execute on that vision, and to take everybody along, and to have a lot of passion, patience, and perseverance as well.
Yes.
Well, we wish you both the very best of luck. You told me at the start of the program that your vision was that whether good or bad, you want it to be a story. You are a story today.
Thank you so much.
And I hope you will be a very successful story, and I hope you will be a very successful story as well. Thank you so much for joining us here on the Young Turks podcast.
Thank you,
Appreciate your time.
for having us.
Well, I hope this conversation gave you a glimpse into the world of quantum technology, where India finds itself, but more importantly, how do we transition from being a services nation to being a product nation? The two founders that you heard from today are certainly hoping to leverage on on their capabilities, the capital that they've managed to get, as well as their differentiation to make a difference in the world. From all of us here on the Young Turks team, we hope that you enjoyed watching this program. If you have feedback, comments and suggestions, do write to us. We always like to hear from you. We'll see you again next week with more exciting stories. Till then, goodbye. Thanks for watching.
Even after spending billions of dollars, we are unable to solve the cybersecurity problem. And one of the reasons for that was that we were always using yesterday's technology to solve today's problem.
So how long did it take to build the computer?
For quantum computer, we took around 1.5 years. The way it was so exciting was when the fridge came. Fridge was from glucose and we did fabricate outside. People were on the truck from the airport, Bangalore airport to office, and we were all waiting in the basement for this to arrive. And that moment, it was unbelievable. Okay, finally we have this here, because we were waiting for 3 years. And the bigger moment will be next few years when we fabricate it here.
And that moment is a couple of years down the line?
No, next year.
Next year.
As long as my data is encrypted using quantum keys, it is unbreakable. Even quantum computer, most powerful quantum
So
computer,
he can't break into you.
Till the time the people don't encrypt it, he can break it. We built India world's first end-to-end SaaS quantum security SaaS platform. I went into US and presented this to few investors there, and they were little.
Cyril Amarchand Mangaldas presents CNBC-TV18, The Thought League Season 3, A Glorious Decade, A Century of Service.
Hello and welcome to Cyril Amarchand Mangaldas presents CNBC-TV18, The Thought League Season 3, a platform where pioneering minds come together to shape the future of law, business and society. In this episode, we are joined by Professor Richard Susskind, CBE KC, the world's most cited author on the future of legal services and one of the foremost voices on the impact of artificial intelligence, from serving as technology advisor to Lord Chief Justice of England and Wales to being appointed Special Envoy for Justice and AI to the Commonwealth. Professor Susskind has been at the forefront of reimagining how law, technology and humanity intersect. Alongside him is Cyril Shroff, Managing Partner at Cyril Amarchand Mangaldas, a distinguished legal mind who has consistently championed values, purpose and innovation in the practice of law. Together, they will explore how AI is reshaping legal systems and opportunities and risks it presents, particularly in developing countries like India, and the frameworks that can help us think about AI in ways that prepare us for the decades ahead. Gentlemen, thank you both very much for joining us here on another episode.
Thank you.
Professor, if I can start with you, your new book, How to Think About AI, A Guide for the Perplexed, makes two important points. One, AI is not new, and the most recent innovations are part of a continuum of innovation since the 80s. Number two, that we should not be trapped by AI's limitations today in thinking about the trajectory that the technology can take. Can you give a few frameworks on how to think about AI and the opportunities that it brings?
Well, thank you very much. AI, in my view, actually stretches back to around 1950. So it's been with us for